all that far on US stocks. Yeah, really interesting to see how those talks between Commerzbank and UniCredit develop. As you said, the leadership of Commerzbank keeping quite tight-lipped on what the plan is to discuss at those meetings, said they will report back later. But there does seem to be a suggestion that some collaboration between the two could deliver some positivity, which is a more positive line maybe from Commerzbank that we've seen on M&A previously. So that's the banking story over in Germany and, well, more widely in Europe, I suppose. So we'll keep an eye on the M&A story within banking. We're also watching those earnings themes. As you mentioned, Lizzie, Siemens upgrading its guidance. Could that be something that's positive for that giant of the German markets? We'll watch to see if that one goes higher at the open. So the FTSE 100 is open, not up by very much, up by 0.1%. But it is Germany where we got a lot of those earnings. But it is Germany where we are often waiting for the DAX to open, Lizzie. And so we're not expecting to see an instant judgment on those. The CAC 40 is up by 0.6%. The IBEX up by 0.4%. So we do have some areas of positivity as we wait for Germany.
Well, let's take a look at the sectoral breakdown in the meantime. And we've got about 3/4 in positive territory this morning. Media leading the gains today. Utilities not far behind. Bottom of the basket, though, basic resources, travel and leisure, real estate. And if we look at some of the individual names that we were just discussing, those that are already trading, we are looking at Wizz Air shares down more than 5%. Of course, we also had numbers from them this morning, and some of the other those who've been reporting include Diageo up 1.3%, Zurich Insurance just opening down 2.5%, Swiss Re down 2.5% as well. Of course, we've been talking a lot about the impact of wildfires when it comes to those names, but we're still waiting for the German names that have reported results to open. Diageo, I should say, hasn't yet reported its earnings, which is strange because we were expecting them.
It was supposed to, and that didn't happen. So that's a strange one. We'll no doubt dig into why that happened. In terms of the individual movers, I'm looking at percentage change. We don't see any of the companies that have reported necessarily out with numbers. I see Tritax is negative. Rent Group, you'd flagged that earlier, is negative. Lizzie, we've got Persimmon up in positive territory. I think we got some an update there. From a points perspective, ASML is the biggest weight on the Stock 600. Does this tell us something about those Asia and US tech dynamics that we were tracking from SanDisk to SoftBank? Maybe that's where we see that showing up. To the upside, we've got some of the big pharmaceutical names, so maybe we're hiding out there for now. Let us speak to Eric White-Ennis, who's EMEA Head of Investment Strategy over at JP Morgan Private Bank, and with us on set here in London. Eric, nice to speak to you. Thank you very much for coming in. We spend a lot of our time tracking stocks, tracking bonds, probably too much reflecting some sort of 60-40 portfolio assumptions. What are you thinking about global asset allocation to those areas of markets, but also alternative investments right now? What does it look like from a private banking landscape?
So the 60-40 is probably under some degree of challenge in terms of its long-term diversification value proposition. Many investors have relied upon the negative correlation between stocks and bonds for many, many years over market history. And one of the trends that we observe, particularly in the family office community, is a bit of a recognition that that value proposition is under a degree of challenge because there's actually mostly been a positive relationship between the movements between stocks and bonds most recently. And that's not quite ideal because many investors want to have things that are doing different movements in your portfolio at different periods of time. You want those bonds to ideally buffer the downside when equities have to some degree of sell-off. So one of the things that we think makes a lot of sense is to lean more heavily into the alternative space as a bit of a counterbalance to that. And in fact, going back to that same family office community, for those that flag inflation as a concern, and it is something that's on our mind, they are tending to lean into alternatives to a much heavier degree, and we think that makes sense.
Okay, and so is that infrastructure? And do you have concerns that for family offices or for anybody else, that takes you into some space that is maybe a little less liquid, and stocks and bonds might have their downsides, but they're pretty tradable?
So private infrastructure strategies can indeed be a little bit less liquid, but we do think that they are very attractive for a number of different reasons. The top three being, number one, they have bond-like consistency of cash flows in a lot of these strategies, but at higher levels, typically mid to high single-digit consistency of returns. Secondly, extremely low levels of volatility, so a rather smooth ride. And then thirdly, a lot of these strategies actually have almost no relationship whatsoever to what's happening in broader markets. So genuinely giving you that zero or in fact negative correlation. And back to those trends in terms of what we're seeing with family offices, many of these entities and groups out there agree with this. However, a recent study that we did reflected the fact that 79% of portfolios in this community actually have zero allocation to infrastructure. So if people put their money where their mouth is, so to speak, and move with their feet, we think there'll be tailwinds of inflows into the space, which we think makes sense in an environment where that 60-40, that traditional 60-40, is under some challenge.
Eric, I just want to flag some of the moves that we're seeing on shares off the back of the earnings, because we were waiting for Germany to open up, and now they're coming through. Siemens shares down more than 5%, 5.4% lower. Deutsche Telekom shares up the other way, nearly 5%. Commerzbank up 0.2%, and Rheinmetall down 1.7%.
Yes, and Eric, this prompts a question around Germany, I suppose, and the broader equity landscape and what you like and don't like. We had some really strong numbers. I think it was factory orders out of Germany that were really strong. There's a lot of commentary about whether we're going to see some sort of turnaround in the German industrial landscape, manufacturing landscape, or not. How are you thinking about Germany and broader European equities at this point?
Most economic data in most of the major economic centers of the world has actually been more resilient than many people would have feared, given all the energy and inflationary disruptions that we've had. The ECB had to move in the direction of being a bit hawkish with a hike. It's possible that they have to go again in order to try to combat some of those inflationary pressures. But mostly what we've seen is an impressive amount of sustainability of economic growth. It has been led in the U.S., which has continued to be our preference. But for the most part, the data has held up here in the region. And in terms of the U.S., where it is our preference to have the greatest degree of overweight, it has also been driven by this very impressive consistency of earnings, which is also commensurate with valuation levels that we think are quite reasonable.
Well, when you come to the US economic data, of course, we had ADP numbers yesterday preceding the payrolls numbers tomorrow. They were lower than every estimate in a Bloomberg survey. What do you think is going to happen out of the Fed in September? Because different guests say different things. We've had Fed speak overnight, Kashkari floating the idea of a hike. Is that what you're expecting?
So the ISM number in the States was a bit of a smidgen below expectations, but a couple of days ago, a number that I paid more attention to was the manufacturing ISM in the States, which was north of 55.5, and the expansion number is north or south of 50. So that's a good reflection of what's happening with manufacturing in the U.S. and the sustainability of that economy. As it pertains to the Fed, I would categorize the recent Fed meetings as a little bit spicy, so to speak. In June, the new head of the Fed, Warsh, comes in with a more hawkish disposition than most had been expecting. Subsequent to that, though, in July, there was a bit less clear of a message, and that seems to have brought a lot of these questions into focus about what is the Fed most likely to do next and when. We've had an upside pressure on global bond yields for the most part. It happened in July. We've had a little bit of relief so far here in August. So there is a lot of focus on, does the Fed go perhaps one time or so? Some believe it could be in September. Others are pointing later in the year. We do think that it is possible that the Fed does indeed go, and it's probably more likely than not, but probably just one time or so.
But when you've got the doubt over the Fed's commitment to fighting inflation, when you've got all this change in the way it communicates, the Middle East, you've got the
task
fiscal
forces,
concerns, all of these broader things, why are we not going back to sell America?
Sell America. Well, it's because of the sustainability, mainly, of that earnings story. I mean, we're very likely to finish this quarter of earnings with what will be the 7th quarter in a row of double-digit percentage earnings growth in the U.S. 10 of the 11 sectors in the S&P are showing margin expansion. We're seeing hundreds of basis points of positive spread between companies that are leaning into AI and those that are not in terms of their profitability. So the earnings story very much so is coming through, and that makes it very reasonable to continue to allocate to a healthy degree to the U.S. And on that valuation point, partially because the earnings have been so robust, I mean, the valuation level, the forward PE of the S&P is just south of 20. Even for tech, it's only at about 21. These are pretty close to 5-year, half-decade types of averages, and with that earnings delivery and reasonable valuations, we think it is reasonable to be healthily long the U.S. market.
And Eric, we ask ourselves a lot of questions about, we see the data center rollout, it's going at an incredible speed, and we ask whether the companies that are going to be buying these services are going to spend, what will the return on investment be for them? Will AI prove to be as good as everybody hopes it will? And you've got some analysis. You find there's actually already a spread between the margins for companies using AI and those who are not. How do you do that kind of analysis? Because the AI sort of costs and benefits seem to be quite distributed around P&Ls when we speak to CEOs. So how are you getting into that kind of data?
So we see it in terms of the earnings delivery and the numbers, and those that disclose how much they are using this technology and those that are not, and that spread is only widening. And we believe that will continue to be the case over time. Many of us experience that in our own day-to-days. Less degree of burdensome weight of slower pace of work, greater degree of efficiency, typically decreased level of costs, more productivity, which is translating into earnings. The ROI question, return on investment, in terms of these enormous amounts of CapEx, capital expenditure dollars that are being put into the ground, that is something that the market will continue to focus on in each one of these quarters going forward, because the numbers are genuinely gigantic. So while it has been showing impressive proof of concept thus far, those questions will continue for this theme to remain buoyant going forward, continuing to invest this CapEx into the ground with an expectation, that kind of buoyancy and that delivery comes going forward.
Eric, nice to see you. Eric White-Hennis there. Thank you very much for coming to see us. EMEA Head of Investment Strategy at JP Morgan Private Bank. Well, let's check in on the core six this morning, shall we? We've already talked a lot about Rheinmetall. Those shares up 1.8%. What else is on the board here? Well, LVMH is gaining, so's Nestle, but it's losses in the tech space, ASML and Schneider. You might have expected that, given that all we've been talking about with SanDisk and also the SoftBank earnings, bit of a mixed picture for them, and Novo Nordisk shares down more than 1%. Of course, we had disappointment from them on the results the other day. Now let's turn to some of the individual stocks on the move as well. Chloe Melly is beginning with WPP. Big move there.
Yes, good morning, Lizzie. We are seeing a huge boost for WPP shares this morning. We're up almost 23% after the earnings reassured investors. So the first half profits beat expectations, and that was thanks to all those cost-cutting efforts that were made by this new CEO, Cindy Rose, who joined last September. So this has been really reassuring to investors, given a lot of weakness in a WPP, which had lost so many contracts and had really struggled against its biggest rival Publicis for the last few years. But it seems that the turnaround is now taking shape, and we are seeing that reflected in that huge boost to the share price this morning. Moving on to another positive mover, we've got Deutsche Telekom raising its buyback by as much as 3 billion euros after earnings came in line with estimates, and so that is driving the stock up about 5.5% this morning. Staying in Germany, but going over to a little bit of weakness with Rheinmetall. Oh, actually now it's back in the green, but it was originally in the red this morning after cutting its sales outlook after losing out on this German warship contract. But we are seeing now the shares going back into the green. Maybe some of that was already priced in. We are seeing, however, the shares down for Siemens, which is quite surprising given that it did raise its guidance this morning thanks to this data center demand, this software demand as well. But perhaps the expectations are really, really high and they did not manage to meet those elevated expectations. Perhaps this is because there's a bit of weakness in the mobility division, which makes trains. But in any case, we are seeing the shares take actually quite the hit this morning. We're down more than 5% there. And finally, let's go over to Glanbia, which is an Irish maker of protein powders, seeing a big boost this morning after hiking its guidance. Has been one of those big beneficiaries of this protein craze, with both this uptake of weight loss drugs, but then a general sort of wellness trend with people just wanting to buy loads of protein, and it's really, really benefited from that. So we're up about 9% there.
Chloe, thank you very much. Chloe Melly on the protein beat there. Yeah, that WPP move, incredible, isn't it? And Bloomberg Intelligence talking about it being just a glimmer of hope. That's a big move on a glimmer of hope. Let's talk about some of the German companies that are reporting. We'll get more into the banking story in a moment. Coming up, UniCredit talks loom as Commerzbank announces $1 billion buyback. We will bring you some of our conversation. Lizzie was talking to her, in fact, the Commerzbank CEO, Bettina Orlopp. That is next. This is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Now, Commerzbank says a strategy developed together with UniCredit might be beneficial for investors. I was speaking to the CEO, Bettina Orlopp, earlier, and she's outlined the bank's current relationship with the Italian bank.
We have talked after every quarter, UniCredit and Commerzbank, because there are a very large investor since a couple of quarters. So it's very normal that we have interactions with a very significant shareholder, and and these meetings will continue for sure.
Yeah, I just wondered what your relationship's been like with Andrea Orcel, Bettina, because we know that he wants to speak with the German government and the Workers' Council, and made no mention of Commerzbank management when in the recent comments.
Well, first of all, I think we are both. We're both committed to increase and maximize the value for our stakeholders. And I think that is a good basis for meetings, also meetings between the two of us.
Mm-hmm. Well, what will your main other asks be then in the takeover talks? I'm thinking about keeping the international network, the headquarters, keeping the public listing. Maybe you want some job guarantees.
I understand the interest in that, but you will understand that I think things like that should be discussed first between Commerzbank and UniCredit, and then we will definitely come out to the public to share more details on it. For the time being, I think it's important, A, that we deliver and that we continue to deliver against our targets, and B, that we are in constructive dialogue with UniCredit to figure out also some technical details, but also then how we organize the phase ahead of us, but also how potential target pictures could look like. And the best thing to do that, and the most value accretive thing to do it, is to do it jointly, and that's the basis.
That was the Commerzbank CEO, Bettina Orlopp, speaking to me earlier off the back of their earnings. Let's get some analysis now. We're joined by Tom Metcalf, Bloomberg Managing Editor for Finance in Europe, the Middle East and Africa. So, Tom, you were listening to Bettina there. She's since been talking on an analyst call. She's speaking to analysts right now, saying that they're optimistic they can find common ground on a business model with UniCredit. The talks have started on a common path. What did you make of what she said there about where they go from here?
Yeah, I mean, understandably cagey, right? Not wanting to show her hand. But yeah, it's sort of inevitable, right? Like, 48% stake, you're obviously going to need to engage. And, I think this change of tune effectively does show that, we are getting close to the end game for what's now been like a 2-year sort of saga. But yeah, those points you raised are exactly the ones you imagine will be kind of top of her Orlopp's mind, but also Berlin's. Job security, they don't want to see sort of an exit in any way, or kind of a big rationalisation in Germany. So I think what will be interesting is kind of where the two sides meet, because there's an extreme version where UniCredit effectively takes full control. But there's reasons that might not happen. They could, as I think all it was kind of indicating is, we can work together. There's some kind of joint venture here. Well, I think it will be a very, I'd love to be a fly on the wall, because obviously it's been very fiery, and, whatever they're saying publicly, they clearly are not seeing eye to eye. And there was many different ways have gone down from both sides. They were pretty sort of at odds, right from the beginning. So yes, those first talks will be fascinating.
Yes, and Commerzbank from the beginning has not appreciated the style of the approach, perhaps.
Yeah,
but interest.
The tone changed when I started asking about UniCredit.
Right. So, but the tone has changed then this morning from them, which is interesting. But what about the earnings story underlying this? They from the beginning tried to demonstrate they've got an independent future. So what does the earnings picture look like?
Yeah, look, I think they sort of did that again this quarter, right? It's like, so the couple of big things there would be the buyback, 1.2 billion euros. And profit did jump, so they can sell that story of, look how strong Commerzbank is as an independent entity. We are in a position of strength here as we enter these talks, negotiations. I think on the flip side, what you're seeing from analysts is describing these results as mixed, fairly in some ways underwhelming, because while there was a profit beat, I think the net interest income was a little bit soft for some analysts. So you can kind of see that in the shares today. It's flat. Obviously, these shares have risen quite a lot, so. It depends which side of the story you are on. You can kind of make a positive or a negative out of it.
All right, Tom, thanks very much. That's Bloomberg's Tom Metcalf.
Now, Siemens shares are down after disappointing investors, hoping that it would show a bigger benefit from AI spending. It seems to be the digital industries, the factory automation part of the business, that disappoints investors this morning. But earlier, I spoke to the Siemens CEO, Roland Busch, and began by asking where the strength is coming from, because they've upgraded their EPS guidance.
These are two pieces. One is our automation business and our software business, and both are really firing. So our automation business had an order intake increase of 11%, grew by 7%. So we see a good momentum there that comes with a good conversion. And our software business is very strong. It grew by 11%. If you take our total Siemens digital business, software and services, it grew by 15%. So we have a growth momentum, which obviously translates also into good profitability.
And what about the competitive landscape? I'm thinking in particular about factory automation. There are Chinese competitors who are in that space, and I wonder how competitive the landscape is right now.
So we are very competitive also in China. You know, we developed and launched new Chinese products. The first 16 landed in the market, another batch of 26 we launched early this year. They grow in the mid-20s percentage points. So we are winning customers, we're winning new customers, we're winning customers back. So automation business is doing in China very well. But then the rest of the portfolio globally as well. We see a pickup also in the machine business, also in China, which helps us also on the high-end side, where we see our core portfolio of automation landing very well. So therefore, in total, we did our homework in developing really super competitive new products in all markets, by the way, in China, of course, in particular.
Okay, so standing up to the competition in China, then, Roland, let me ask you about the data center build-out and the ways that the Siemens product lineup is able to supply that. How sustainable is the demand that you're seeing in connection with the data center rollout?
So let's briefly talk about the impact of data center business. So again, this is a massive investment which goes there. I come to your question in a second. That helped us also growing our smart infrastructure business. For example, electrification business grew by 20%, electrical products by 18%, but we had also a growth from our automation business as well, which was pulled also in this one. So now you understand that we have, of course, the electrification piece, low voltage, medium voltage, where we have a huge demand, which we can serve. But then AI factories, they go more and more into industrial PLCs, where we have a strong offering. We're also adapting our functionality, we can use it. And then after all, if you want to build new data centers, you want to build them fast and super efficient. So we offer a digital twin of a whole AI factory or data center, which you can optimize in the digital world and then build it, which is definitively a benefit for our customers. So it's a very strong offering here. And then it goes into other technologies like 800 volts DC, so direct current. We launched new products, DC products, switching products, which we have in the market. They get a pull. And then when it comes to liquid cooling, the whole situation changes again. And we have an offering there also for things like solid-state transformers. We're working on that. There are new technologies. And we are working with NVIDIA for a blueprint of these new AI factories together, again, using our digital twins. And we are putting products behind that.
Siemens CEO, Roland Busch from Siemens there, sounding pretty positive, but Lizzie, digital industries is quoted as the area of concern by Citi, by Goldman Sachs and Morgan Stanley, and this is to do with standing up to that Chinese competition around automating factories.
Yeah, well, we are looking at the basket in which Siemens sits down, the worst performing sector in Europe for industrial goods and services. Rheinmetall, though, booking the trend up 0.6% despite cutting its outlook. But coming up, we'll turn back to the geopolitics. Iran and Oman looking to seal a deal that could reopen shipping in the Strait of Hormuz. We'll speak to Jane Kinnamont next. This is Bloomberg.
anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation was a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
This is the opening trade, 30 minutes into Thursday's session, and we've got gains across European equity markets, sort of standing aside from some of the negativity around technology that we saw in the Asia session and in the US. Nasdaq futures for much of this morning here in Europe has been negative as well. So we're standing aside from that and factoring in, of course, the earnings stories that we've got here in Europe instead. But there's an interesting dynamic here because overall we see these markets going higher, but the earnings stories do seem to be weighing on the markets this morning. So you see the Xetra DAX is underperforming a little bit. It's only up by 0.1%, and that's where we've had a lot of the earnings stories coming through. So whether it's defense or the industrials landscape, in both of those areas we seem to see a little bit of disappointment as to what's been reported, Lizzie. So that's the overall picture, but some complexity under the hood.
Well, I'll get to those individual names in just a moment, but just broadly looking across the Stock 600 this morning, Anna, you have got investors piling in today. Volumes up nearly 30%, but the skew very much to the upside. Nearly 400 names in the green compared to nearly 200 in the red. So let's take a look at those earnings that have come out, starting with the leaders this morning. And I'll kick off with WPP. What a whopping great move to the upside here, up 25%. Analyst estimates beaten on the cost-cutting efforts by the advertising company. Deutsche Telekom also in focus. They've got an improved outlook. Further buyback announced, so up 5.4%. And earnings as well from Banco BPM this morning. These shares up the most in almost 4 months, but investors particularly focusing on the EPS beat, so up 3.9% there. Turning as well, though, to the laggards today. What's in the red? Well, we can't start with Siemens. You, of course, are speaking to the CEO. The outlook in focus because of the data center and software gains, and yet disappointment here, down 5.2% as things stand. We also have Zurich Insurance falling, underwhelming earnings from that company, down more than 2%. We're going to talk about insurance later on in the programme as well. Wizz Air as well, they've had an income miss and softer guidance, so it makes sense that we are down nearly 5% here on that airline. Anna, what else do we need to know this morning?
Let's get up to date with some of the other corporate news flow then. SoftBank reported a beat in profit, helped by a rally in its chip stock holdings while it awaits further gains from its bets on OpenAI. The Tokyo-based tech investors' results are in the spotlight alongside concerns about the debt levels that AI companies are taking on to spend billions of dollars on data centers and other infrastructure. Bloomberg has learned that hackers launched a wave of sophisticated attacks on Wall Street firms targeting information systems at major money managers. Point72 Asset Management told investors it had been attacked, but there were no initial signs of stolen client data. Attackers also attempted to infiltrate other major hedge funds, including Millennium, Two Sigma, and Citadel. And Iran says it has reached an agreement with Oman on a proposed shipping route through the Strait of Hormuz. The deal is seen as a potential step toward reopening of the critical waterway for energy supplies. According to the Iranian Foreign Ministry spokesman, a joint statement from Tehran and Muscat is under review and in the final stages of drafting. Any agreement, we understand, could be temporary. Lizzie.
Well, let's get more on that story now. We can speak to Jane Kininmont, CEO of the United Nations Association UK, a geopolitical expert. Jane, really good to see you this morning. So let's just talk about the Middle East first, and we can come on to Ukraine after. If there is going to be a Strait of Hormuz settlement, as it looks like there will be, do you think it'll last? And if you're an investor, should you stay pretty cautious about the situation in Iran? I wonder how stable the situation is likely to be from here on out.
Good morning, Lizzie. And I think listening to these news items about a possible temporary deal, many people will feel a sense of deja vu, as we have had on again, off again talks. And we did, of course, have the previous memorandum of understanding between the US and Iran. I think that both the US and Iran feel under short-term pressure to get an agreement. The US wants to ease the pressure on the global economy and on oil prices. Of course, Donald Trump will have an eye to the midterm elections coming up there. And similarly, Iran too suffers if it can't export much of its oil. So it will be keen to have at least a temporary pause so that it can start getting more of that oil out and then sell it on to places like China. But I think the situation remains really unstable in the longer term. These two countries have been at each other's throats for quite some time. There is no trust between them, and they are both now engaged in this strategic competition of trying to prove who has won the war. They're also, in very different ways, in their different political systems, facing a lot of internal divisions. Now, obviously, we can look at the US political system and all the divisions are clear for everyone to see and reported in the news on a daily basis. Iran is much more opaque, but even there, we have seen a lot of signs of division becoming public in recent days as this anti-American political system struggles with itself over whether to make a lasting deal with a country that it has traditionally called the Great Satan.
And interestingly, US Vice President J.D. Vance honing in on that point, saying that it's the divisions in the Iranian leadership that's been holding up a deal here. I also, Jane, want to ask you about the European part to play in all of this. There have been reports that diplomats are saying European nations could be involved in demining the Strait of Hormuz. Wouldn't that risk giving the impression, maybe, that they're supporting the US's war effort in Iran?
Europe's in a very difficult position now because this is a secondary issue for Europe compared to this much bigger question about the state of European relationships with the US, the future of NATO, US security guarantees and all of that. So traditionally, Europeans were significant mediators between the US and Iran. But really, since Donald Trump first bombed Iran, which is over a year ago now, Europeans have been basically seen as not significant political players. They didn't want Donald Trump to bomb Iran last year. They didn't want Donald Trump to start the war this year. But because they're so generally nervous and insecure about the US, they've been loath really to condemn the war with just a few exceptions, such as Spain. So they're not really seen by either side as independent players, and there is even a confusion where I think Iran does see them as complicit in the war, whereas European countries generally feel they're doing their best to sit it out. It's still unclear how badly mined the Strait of Hormuz really is, and one of the issues in the negotiations is, will Iran actually reveal what has been done in terms of mining, because that's quite ambiguous at the moment.
Can I take the conversation, Jane? Good morning, to Ukraine. Just in the last 24 hours, we were covering Russian air attacks that killed some 17 people, Ukraine seemingly unable to stop some of the missiles that Russia is sending over. Not the drones, they're able to stop those, but the missiles in particular. They've called on the US for support here, but that process seems to be dragging. What do we expect to happen there? And maybe that ties actually back into the Iran story because of other demand on those same supplies.
Yes, that's right. And, Ukraine has had a few months of seeming to be able to turn the tables militarily and to regain strength in its war with Russia, which, of course, is a war against an illegal invasion. But they are clearly very worried as they start to think about the winter, because Ukraine gets extremely cold in the winter, and we have seen Russia using missiles and drones to devastate the country's energy infrastructure in and ahead of the winter in an attempt to make civilians suffer and to sort of break the morale of the population. So this is a really critical time period for Ukraine, and they are deeply concerned because, right now there's a global shortage of missile interceptors, and with the war with Iran, Gulf countries want those interceptors as well. The world is responding by trying to ramp up the defence industry's production of interceptors, but certainly we at the UN Association would argue the world needs to be investing more in arms control, diplomacy, and efforts to stop the conflict spreading, especially in the Middle East, where we can see the potential for it to spread around the Red Sea. It is very important to try to contain and reduce conflict and not think that we can solve these problems by increasing the supplies of military hardware.
Yeah, meanwhile, we see Ukraine hitting 2 Russian oil refineries, that confirmed by President Zelensky just this morning. So that conflict continues. Just picking up on the point you made just there, you actually think that the West is disinvesting in diplomacy, Jane. Where does that take us?
Well, we are seeing this. I mean, of course, many people would say that defence spending itself is designed to prevent war. There is a whole debate there. But we certainly are seeing that as Western countries spend much more on their militaries, they're also cutting other things. The UN's budget has been slashed. The State Department has been gutted. The British Foreign Office is going through major job cuts. And we're seeing foreign aid budgets being cut massively over the past couple of years. Many people assume that foreign aid is simply about poverty alleviation, but the reality is much more complex. A lot of overseas development aid spending does go into peace and security work, whether that is conflict prevention, equipping mediators, funding diplomacy, or sometimes building the capacity of fragile states to do things like police their own borders or, get equipment for their coast guards to function so that they can tackle smuggling and illicit financial flows. All of these things actually contribute to global peace and security. So when we see the kind of massive aid cuts that many rich countries, not only the US, have made over the past couple of years, that does ring alarm bells in terms of this being a disinvestment in global peace, security, and conflict prevention. Philanthropy is also not doing much in this regard. So there really is a need, I would argue, to reinvest in those areas if we don't want to keep hearing the same news stories about seemingly endless wars.
Jane, thanks very much. Thanks for joining us. Jane Kinnemont, the CEO of the United Nations Association UK. Coming up on the programme, we'll talk to Anders Malmström, the Swiss Re Group CFO, the reinsurer, out with numbers this morning. Profits beating estimates, but there's lots to discuss when it comes to global catastrophes these days and heat in Europe, wildfires, drought. We'll get to that. This is Bloomberg.
people have written that your bank, Revolut, is worth $75 billion. Have you ever thought of taking your organization public?
Well, the way I think about it, we kind of will be ready probably in 2 years' time. But then again, depends on how good the market is.
Since you don't have an IPO, how do people who work for you make some money? Do you make a market for people to sell their shares internally?
Yeah, so we do secondaries every 1 or 2 years when people can sell a certain portion of their stocks to external investors.
So you've done secondary sales for your employees, so employees can then get some liquidity. Do you expect before you go public you'll do any more of those, or are you just going to wait till you go public before you liquefy any more stock?
Yeah, I think so. We might do secondaries as well before we do IPO, because we do it every 1 or 2 years, so we might do secondary as well.
All right, well, if anybody wants to sell their shares to me, let me know. And have any investment bankers told you why they're the best to do the IPO for you?
Yeah, obviously every single one is the best.
Everyone is the best. You're not in a rush to do it. You don't need the money.
So we're a bank, and then for the bank it's super important to have trust, and then public companies are trusted more compared to private companies. So that's the reason.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to the opening trade. 8:45 a.m. here in London, 45 minutes into the cash session. This is how it's playing out. Euro Stoxx 600 up 0.4%. But the DAX is the laggard here this morning. We've had a raft of earnings out this morning from Siemens to Commerzbank to Rheinmetall. And so that is clearly what is weighing on the index. Rheinmetall in the red, down 1.2%. Siemens down nearly 5% as things stand. Commerzbank down 0.5%. But lots more earnings to talk about as well, Anna.
Yeah, absolutely. Let's talk about the reinsurance sector. Swiss Re has reported a first-half profit beat as the reinsurer saw all key business units perform in line with expectations, while the firm announced a fresh round of cost cuts. Joining us now is Anders Malmström, the Swiss Re Group CFO. Anders, very nice to speak to you. So the numbers coming in broadly in line or above in some cases. So how sustainable do you think this performance is from Swiss Re?
Yeah, so good morning and thanks for having me. Look, I mean, I think, as you said, I mean, the results are strong. I think we're up 9% to $2.8 billion for the group. Important here, it's coming from all 3 business units, which really shows now the diversification benefit and the breadth of the group. And what's really important as well is here, it's from the underwriting results. There's no one-offs. It's the underwriting results from all 3 business units that contributed here for this result, which puts us right on track to achieve our full-year target.
Yes, I did read one comment, Anders, this morning from one analyst who said, yes, they were impressed by the numbers overall, but that perhaps they've been flattered by the fact that there weren't, thankfully, I'm sure, so many natural disasters in the reported period. And maybe that hides then a lack of structural progress underneath. Is there anything in that?
So when you look at the Nat Cat, I mean, usually the biggest events always come in the second half of the year. That's when the hurricane season happens. I think we're just in the beginning of it. We haven't seen anything yet. That doesn't mean there will nothing be here. So overall, yes, supported by lower Nat Cat, but we still paid out $17.7 billion US dollars to our clients in the first half of the year. So quite a large amount of money.
Well, of course, we've already seen the wildfires spreading across Europe, very much in focus for insurers, Anders. We've heard estimates that the damages will be a few $100 million. Can you narrow that down for us?
Yeah, so this is an important development that we now see in Europe with the heat waves and the corresponding wildfires. So that's something that, I mean, we probably see developing even more over the future. So that's big. To really give you numbers, it's too early. I mean, things are still happening here. But what is important here, we need to understand the risk, we need to mitigate the risk, and then we need to basically give protection here. And there's still a big protection gap here that people are not covered for the remaining risk here.
Well, how close is Europe to entire regions simply becoming uninsurable?
Yeah, I don't think they become uninsurable. I think it's really what I meant here is we need to understand the risk. We need to say, okay, what's happening here? How can we mitigate the risk? And that's an area where we work a lot now with different parties, with municipalities, with utility companies, to make sure they can reduce or mitigate the risk to the extent possible so that it is insurable or reinsurable, I mean, for us in particular here. But that's a key point here.
So, Anders, is that the solution to the insurance gap? Because you've mentioned it, the ECB has mentioned it in the past. They've repeatedly flagged the existence of a potentially dangerous insurance gap that, just European assets just not being sufficiently insured. What closes that gap?
Yeah, so, I mean, there is a gap, as we mentioned. I think everybody acknowledges that, which is the first thing that needs to happen. Then, again, I repeat myself a bit because it's so important, is understanding the risk, assessing the risk, and then mitigating the risk. Because it's not just to have insurance on it. We don't want that something breaks. We don't want that the utility companies have issues with the infrastructure. We don't want that the premises burn down. We want to make sure that we can prevent that. But then there's the remaining risk that needs to be insurable, and that's where we have to work on as well.
Yeah, so what is the role for businesses like yours in the reinsurance space or even in the insurance space to invest in prevention, to help with prevention, to support adaptation? Is there a role for the insurance sector in that?
Absolutely. I think there's a huge role that the insurance sector here plays, and we as well as reinsurers. We have an organization called RDS that goes specifically in and talks to the involved parties, as I mentioned, municipalities, as an example, and explain what's happening, explain how this risk can be managed going forward, and then how it can be insured. Yeah, absolutely.
Well, specifically on that prevention resilience front, are you looking at lower premiums for households and companies that invest in shoring up properties proactively?
So when it comes to the premium, it's very important at the end of the day that the premium are risk adjusted so that they really cover the risk. There's no benefit in just reducing premiums and then people take the wrong risk. So it all has to hang together between what is the risk, how do you assess the risk, how do you price the risk, and then the premiums need to follow. They cannot be upfront low premiums for risk that is not covered by that. It needs to really hang together, but that's why prevention is so important here.
At the moment, Anders, it seems that the wildfire catastrophe bonds market is very much focused on California, and California dominates. Do you see that market developing to cover urban areas in Europe? How do you see that playing out for Europe?
Absolutely. I mean, the alternative capital market is developing, and I clearly see that this is also now going into other areas. When alternative capital comes in, which is an important part, and it's a good addition to the traditional reinsurance, it's again we need to be able to assess the risk properly so that you can price it, and then also issue bonds, corresponding bonds. So, and this is happening. This is happening. This is now also going into Europe and other areas.
Okay, really interesting conversation. Thanks so much for joining us. A lot to learn about wildfires now in Europe, it would seem. Anders Malmström joining us there from Swiss Re, the CFO. Thank you very much. We'll continue this theme into the next hour. On the Pulse, Zurich Insurance Group CEO Marco Greco will be with the team. That's at 9:15 London time.
Well, let's take a look at what else we're watching throughout the day on Bloomberg TV. At 9 a.m. London time, just a few minutes, the ECB will be publishing its economic bulletin. Then at 10 a.m, it's Euro area sales, retail sales numbers. 1:30 p.m. UK time, stateside will get initial jobless claims in the run-up to payrolls tomorrow. And then more US earnings will be published. Ralph Lauren and Warner Brothers dropping results, plus more than $100 billion worth of SpaceX shares to be unlocked and available for trading. So let's get more on that story, because SpaceX investors really are hanging on to shares after a plunge below the IPO price, bracing for the next potential hit. And that massive share unlocking today, the influx of stock, could trigger further volatility. We can speak now to Charles Capel, Bloomberg's equity capital markets editor for Europe. Charles, this isn't unique to have a lockup like this, but we've never seen anything on the scale of what SpaceX is doing here. Given the roller coaster that the shares have been on since the IPO, how big of a market reaction should we be braced for right now?
I mean, that's the $1 million or even $1 trillion question. You know, everything about this IPO seems to be unprecedented, and we've never really had a lockup like this. Generally, you have one lockup day, and generally it's around 180 days. But for SpaceX, you've got a 9-stage lockup, and so bit by bit, more and more shares are coming to the market. Today, we're expecting about 900 million more shares to come to the market. Currently, there are only about 680 million shares on the market. So it's going to be a substantial increase in the number of shares for sale. And if you think, well, you've got a massive influx of supply of shares, presumably around the same level of demand, that would lead to people thinking, okay, well, the share price is going to fall. But think again, because this is a known date. This has always been set out. This was in the prospectus. So arbitrage traders, the market would have been anticipating this day. Yeah. They know it's coming, and that would have played into the share price. And so the big question, when pre-market trading starts and when full market trading starts in the US, is how much of that has been baked into the actual IPO price and or the trading price. How much of that is actually going to be people selling the shares? Because even though the shares become available for trading, we don't necessarily know that they're going to want to sell them.
Yes.
Importantly, the shares that are becoming available for trading are from insiders and employees, and that means that they would have received those shares over time, and they would have received them at a price which is likely to be lower than the IPO price. So even though SpaceX is trading underwater, that doesn't necessarily mean they won't want to sell, because they could still take profits.
That's really interesting, and the makeup of the people who own these soon-to-be unlocked shares then is really important for the reasons you just described there, Charles, because I was reading that piece by Matt Levine, Bloomberg opinion columnist, saying you have to have a framework for thinking about what percentage of these people are likely to sell, and that's just really difficult to know. But it's worth dwelling on, isn't it? Because other tech companies might come to market with similar structures in the future. I'm thinking about OpenAI, Anthropic. This could catch on.
Yes, exactly. And we are seeing a series of mega IPOs. Companies are staying private for longer. They're growing quicker than ever in private markets. And when they're coming to the market, they are absolutely enormous. And so in order to avoid this massive influx of shares, partly because they have grown so much in private markets and have this massive shareholder register, you may well see people replicating this type of structure, and you may well see more of these multi-stage lockups happening. You know, one of the really interesting things is that I think it's around October, we're going to have an even bigger influx of shares coming to the market in SpaceX, and that's going to continue to increase the liquidity. So it's going to be a really unprecedented situation.
Okay. Yet again, something to watch that is potentially has bigger implications from SpaceX. Thank you very much for joining us, Charles Capel. Lizzie, so that is it for this hour of programming. The Pulse is up next, of course. Stocks are kind of wavering, aren't they, this morning? We've got an Iran deal, which we're focused on. Stock making gains, I suppose, here in Europe, but US futures look a little bit more mixed.
Yeah, Nasdaq futures down 0.4%. That's it for the opening trade. The Pulse is up next. This is Bloomberg.
world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gurr.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
Stocks waver after hitting record highs as renewed weakness in chip makers weighs on sentiment while investors look ahead to key U.S. jobs data. Iran says it has reached an agreement with Oman on a proposed route through the Strait of Hormuz, raising the prospect of energy flows resuming. Plus, Bloomberg learns that major hedge funds were targeted by hackers in a wave of attempted cyber attacks in recent days. So it's Thursday. There's quite a lot of earnings still coming out in Europe. Stocks broadly flat amid this worries about technology sector. Investors awaiting also developments in the U.S.-Iran talks and looking ahead to key U.S. jobs data tomorrow. Now, the pause in this tech-led rally really comes as investors, I guess, are trying to reassess valuations after some AI-related stocks rebounded from last month's sell-off. And then a couple of other things we're watching out for. Look, gold is a big one. Again, is it gold under Kevin Warsh? Is it gold because we're expecting something with Oman, 4,265 for gold? And then, of course, we look at the U.S. 10-year at 46188. If you look at the European markets, they're mainly following what we're seeing over in the U.S. There's a couple of things that we need to watch out for. Brent holding below $80 a barrel, again, after Iran said it reached this agreement with Oman. The picture across the board, you have the CAC 40, the DAX is flat, and then the FTSE gaining some 0.2%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, tech earnings and U.S.-Iran talks driving the markets yet again, with tomorrow's U.S. jobs report also in focus. Now, plenty to discuss with Aaron Captain from UBS Investment Bank in just a moment. But first, investors really digesting a wave of company earnings, which have tested the strength of AI optimism. SoftBank reported a smaller than expected decline in quarterly net income after high-flying U.S. memory storage stocks SanDisk and Western Digital failed to meet lofty expectations. Well, let's get more with Neil Campling, Bloomberg's senior strategist. Neil, I have three questions for you. It's basically earnings, Google, and SpaceX. Sure. But if you start with the earnings, I mean, it feels like every day there's a bit of a pull, you know, and pull back depending on what we hear from them.
Indeed it is. So SoftBank, the
big headline beat comes in because of the investment gain from the Intel being up 300% in the second quarter that it reported to. Western Digital and SanDisk, effectively, this is a bit of a travel and arrive. Let's remember that SanDisk is the best performing stock in the S&P 500 year to date, up nearly 500%, had been at one point up more than 800%. Yeah. So, but the guidance is poor relative to expectations on the sales line. So that is certainly a concern. So there's a reset there in terms of the memory space. So as you mentioned, there's as many questions as there are answers in this space currently.
Yeah, we're not sure exactly in terms of valuation. We'll ask Aaron in a second. What's your take on, we've had huge changes actually yesterday at Google. What does it tell us fundamentally?
This tells you that there's a fight for talent in the AI space. Now, it was mentioned yesterday that these changes at Google were significant. So significant, it was literally like the Rolling Stones, Keith Richards and Mick Jagger leaving the band to form a new band. You know, seismic changes. So there is this battle for who can be talent. And of course, partly that is remembering that OpenAI lost a lot of talent before, and born out of that was Anthropic, for example, as perhaps the most powerful AI frontier model. So this is management changes is something that's a big focus in Silicon Valley.
And then, I mean, it's actually quite a big day for SpaceX because SpaceX investors bracing for billions of dollars worth of stocks becoming available for trading today.
That's right. And what this actually means is that for some of the short sellers that wanted to borrow for the stock, the cost of that is likely to be lower as more stock becomes available. We saw into the earnings print, there was very little stock available for those short sellers to borrow. So that actually could create more pressure for the stock as some of the hedge funds potentially will question the long-term risks, if you like, of the SpaceX model, because there are many questions, again, on valuation and the future hopes that Elon Musk has for the company.
Yeah, and to put it bluntly, we've just never seen an IPO like this. So thanks so much, Bloomberg Senior Strategist Neil Campling. Now let's get more with Aaron Captain, Global Head of Economics and Strategy Research at UBS Investment Bank. Aaron, there's a lot to talk about. I know we'll have a full debrief in a second from our Paul Wallace on the ground with Hormuz. But when you look at these fighting forces, I mean, how much of your time is actually spent on AI valuations? How much is it on data in the U.S. and what we're hearing from Kevin Warsh? And how much of it is actually geopolitics?
So a lot of it's on AI, but not necessarily on the AI valuations, right? I think what's been interesting about the CapEx build out, so everyone gets excited, the CapEx numbers are up, that it's almost all memory, right? So if you look from it, because I'm an economist, I look at what does it mean for GDP growth. It actually looks like about 60% of the CapEx build out is memory prices, and next year it's like all of it, right? So memory spend is was 14% of all the CapEx last year. It's going to be 89%, I think, next year, right, of the total cap, like the 1.2 trillion number, right? It's a massive number, but the implication of that is that it will generate no growth. Right, so you're not actually adding compute if it's all just a price effect from memory, and so I think so you can then sort of reconcile things because you can look at the S&P and say, well, no wonder earnings for the whole supply chain are good because we've got a big CapEx number. It's a nominal number, but if you look at what kind of activity it's generating, it's not. I think we're going to see the contribution sort of roll over the next couple of quarters because you need to start increasing the units of memory, and so that's happening also, but it's not happening, I think, as fast as people sort of penciled it.
But Aaron, I mean, CapEx, there has to be demand. I mean, it feels like this is a bit of a race, right?
Yeah.
In the past, and we used to talk about it, for example, oil drilling. I mean, this is CapEx that took time and that was well thought out. Yeah. Are we moving too quickly on this CapEx?
So it's not clear. So our tech analysts are sort of quite relaxed. So obviously, the big debate the last month or so has been about, going to cheapen open source models, and isn't that going to reduce, demand or revenue for the frontier labs? It's sort of unclear because we're at the very early stage of the rollout. So, what you see now is the reason everyone's getting concerned about token costs is partly because as you start to implement it and it doesn't go to sort of seat-based pricing, but user-based pricing, you have to sort of start to look at the cost relative to what you're getting out of it. And I think, companies are in the very early stages of that. So I think where the optimism comes from is if, only 20% of firms have actually implemented AI in any degree, you've got a lot of runway here to sort of for the demand to go up, even if the prices come down. So I think it's not that clear yet that the CapEx is sort of overdoing it, especially if all the build out of the CapEx is just prices and not volumes.
Aaron, keep it there because we're going to also get a debrief from Paul Wallace. Iran says it's reached an agreement with Oman on a proposed shipping route through the Strait of Hormuz. Now, an Iranian foreign ministry spokesman said a joint statement from Tehran and Muscat is in the final drafting stage. President Trump has suggested an agreement is close.
I'd rather make a deal
because I don't want to kill people. I do not want to kill people. But at some point, we were set for the biggest attack of any attack, and we've hit them very hard for the last few months. But we were all set for the biggest attack since World War II. And they called me and they said, please don't do it, let's talk. And then they said, we never said that. You know what? The fake news knows they did say that, but we are talking. Let's see what happens.
Well, for more, let's bring in Bloomberg's Middle East editor, Paul Wallace. So, Paul, good morning. Iran, Washington, and Oman are all talking. How close are we actually to an agreement?
I've seen we're certainly close, and it's certainly possible that we get something today. But I think what we're waiting for right now is for Oman and Iran to announce a deal over the Strait of Hormuz, a deal that would essentially partially reopen the waterway. It wouldn't be a full reopening, but it would be some kind of 60-day deal to get more traffic moving through it. Iran has said that they've essentially agreed on a draft, the two countries that is. However, we've still not got full confirmation of that, the final thing being signed either by Iran or Oman. It's possible that Iran's Supreme Leader, Mojtaba Khamenei, who's been in hiding for the past few months, still hasn't agreed to it. We don't know for sure, but there are some signs within Iranian media that we still need his consent, and that could take time. In this war situation, Iranian officials, even the likes of the foreign minister, take a long time to get any answers from him because he's essentially out of contact, and getting message to him involves runners and people shuttling back and forth. So that could be what the delay's down to. And then if they do announce they've finally got a deal, we have to see if it's acceptable to the Americans. They will obviously pass it very closely for the detail, as will the energy and shipping industries.
Paul, thank you so much. Bloomberg's Middle East editor, Paul Wallace, still with us, Aaron Captain from UBS Investment Bank. Aaron, I mean, when you look at, and this is part of your core conviction, right, is that if you look at the energy markets, if you look at trade, everything's still disrupted. Yeah. So what's your base case, of the kind of impact this has on the price of oil and inflation?
Okay, so it's disrupted when you look at supply chain stress indicators and things like that, right? It was showing up in the soft data. Soft data is actually rebounded, and it hasn't shown up at all in the hard data, and the financial conditions are super easy, right? So the market just doesn't seem to care. So we have a real tension, I think, between seeing the disruption and not really seeing it in the data, or basic behavior not really changing as a result of the disruption. And part of that is the optimism about the deal, right? So that's sort of... Now, the longer this goes on, you do accumulate more and more inflation, right? So of course, it helps that oil's come down from a recent peak of over 100 back to sort of 80. But at these levels, we're going to get a more elevated CPI print again next month in the U.S., and none of that's helpful for sort of the, will the Fed hike or not debates, right? So we had sort of, our premise was that the data flow is increasingly disinflationary. We expect unemployment to go back up. We basically, we think we're going to get, that's a pretty benign data, but we also get the BA revisions going to lower inflation by 20 bips. So by the time you get to September, if it were just down to the data, I don't think the data flow is supportive of the Fed hiking. But with this energy sort of uncertainty sort of lingering on, it's very uncomfortable because it feels like you don't have a clear route out of sort of the high inflation prints.
But, so I've been trying to think back at, what we were thinking 2-3 months ago, which was people were really concerned that the price of oil would go to 110, 120. That hasn't really come to fruition. Yeah. And part of it, and we're not sure why, is China, right? China has just been consuming less. So is this a weakness in the economy, or is it that they found new routes?
No, I think it's not a weakness in the, because it's like it's a complete drop. Like the conflict starts and suddenly they consume 5 billion barrels a day less. So that's a quarter.
Like half almost,
that's like it's like a quarter of the total shortfall, but it's like a half of the shortfall if you think of what's getting out through the pipelines and et cetera. So were it not for China, I think we would have higher prices. Now the question then is, well, how long can they sustain that reduced level of oil demand? And that's unclear, right? So I think the reason we're not seeing stronger inventory drawdowns, which ultimately then would get you sort of into tighter markets, is in large part, I think, at this stage, China.
Okay, so what do you make of Kevin Warsh so far? The bond market is giving him a very clear signal.
Yeah, so the problem is he doesn't say anything in a press conference. So his first meeting, I think 5% of what he said was policy relevant. Powell used to average about 27.
Yeah.
Okay, his second meeting, he was about 9%. He got a little bit better. But the problem is everything he says is hawkish, right? So, and it's funny that, he then says, well, I'm just going to listen to the market. But of course, the market is partly responding to the hawkishness of the little that he does say. So I think at this stage, it's sort of difficult to read. So our view on the Fed is that if you look at the voters, then it's probably 8-4 or 9-3 in favor of not hiking. But the problem is that those that want to hike feel stronger than those that don't. So if Warsh wanted to hike, then I think he could persuade all of them, and they could hike in September. But then again, it's down to the data. We're going to get 2 labor reports, obviously one tomorrow. If unemployment ticks back up, then I think the setup into September is pretty interesting because 11 out of the last 15 reports going into the September meeting have been weak reports. Coupled with lower inflation, why are you hiking, right? So I think I think the market is obviously understandably confused, as are we, but that's sort of right now how we're thinking about it.
And what are you expecting tomorrow?
So it's 70K on payrolls. I think more important than the payroll print is going to be the unemployment print. We've had basically 1 million people leave the labor force since January. It's the largest drop in labor force participation basically since World War II outside of recessions. It's completely inexplicable. It doesn't jive with any of the other data, and it's happened a few times in 2013, 2015. So that data doesn't get revised, but it does have a tendency to sort of bounce back up a little bit. So if you drift back up, from 4.2 to 4.3, then rather than going down to 4.1, I think 4.1 would be very uncomfortable. I mean, I think then the likelihood of the hikes goes up materially. But because this is a sort of an unexplained drift lower in the participation rate, we think it ticks up. And if that happens, then I think the market will price out a little bit more of the hikes.
And we can't tell yet whether this is, AI related. There's nothing to point to
Nothing in the, when you look at the Challenger data, a very large percentage of the layoffs is now attributed to AI, but the Challenger data is only about 5% of the flow. And there's a lot of AI washing because basically people haven't figured it out.
Yeah.
You've got your target, so I think that's partly what's going on. It's really, if you look at the sort of the nominal numbers of supposed AI layoffs, they are tiny relative to the monthly inflows and outflows in the labor market.
And Aaron, I guess it's difficult to know whether it's because you're spending so much on CapEx that actually you need to save somewhere, and so it's the entry-level jobs, or whether it's productivity that you don't need those jobs anymore.
Yeah, I think that's going to be a very difficult trade-off. So the way I sort of think about it is it all depends on how much of each job you think you can actually replace, right? If you can only replace 20-30% of a entry-level job, it's still not that easy to cut people because you have to reorganize your entire workflow, put all the 30% bits with one group that you can cut, leave all the 70% bits. It's not that easy, especially if you have smaller firms or smaller teams where the tasks are not transferable between the teams, right? So I think we're in the figuring it out phase. So all the surveys say that. The firms are experimenting. They're trying to sort of, and it's not just about the cost at this stage, because if you're going to compare, your token usage, you also have to figure out, well, what is the revenue I'm getting for that, right? And so you sort of have to do both at the same time, and it's really difficult, I think, to actually measure that.
Aaron, what do you know about the UK? So we're all watching the social media videos of the Prime Minister. We're waiting for that budget on the 28th of October.
Yep.
The Chancellor feels
we do
like he's going to spend more, but otherwise...
It feels that way. It's got a lot of commitments that need to be funded. So far, if they adhere to the fiscal rules, then I think the market will breathe easy. But I think the market will want to wait to see that budget.
So nothing until then?
Nothing until I think it's very difficult. The problem is it needs to add up, right? And so I'll give you one data point. So this week, basically they said we're going to leave more money in the regions, right? You get to keep all your own revenue. The problem is they already keep all their own revenue. There's massive transfers from the south of England or south of the UK to the rest of the country. There are massive fiscal deficits if you go through the regions, up to like 22%. So it's not clear what that means. Like, it doesn't make any sense, at least just looking at the numbers. So I think it'll get clarified if we get a budget and you see the sort of proper costing of what they're promising to do.
Aaron, thank you so much, as ever, for joining us. Aaron Captain, a Global Head of Economics and Strategy Research at UBS Investment Bank. Now, coming up, global data center demand helps boost earnings for Zurich Insurance. We'll speak to the chief executive next. This is Bloomberg.
the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome back, everyone. Now, Zurich Insurance has reported a 13% gain in profit for the first half. The Swiss firm saw growth across all businesses, boosted by global data center and energy infrastructure demand. Now, we're joined by Mario Greco, the Chief Executive of Zurich Insurance. Mario Greco, as always, a great pleasure to speak to you. Now, what is the exposure so far to the wildfires, and actually what impact are you seeing from it?
No, good morning, Francine. First of all, my pleasure to be in the show this morning. We don't have any material exposure at the moment with the wildfires and with the current situation, but we know well wildfires from our experience in the U.S. and Australia, and we are prepared to support customers should our customers be involved in that. We know prevention, we know mitigation of wildfires. This is something that, unfortunately, we are kind of experts of.
So, Mario, overall, and I want to get into the data centers in just a second, but does it mean that actually certain of your competitors will also be able to, will have to stop insuring certain parts? I mean, because of climate change and what we're seeing, does a larger, proportion of the economy become uninsurable?
I would not say that it's uninsurable. I would say that the cost of this insurance might be higher over time and could reach levels that might not be interesting convenience for the customers. But in terms of availability of insurance, at least speaking for Zurich Insurance, we will definitely continue to provide coverage to customers for weather events, for natural catastrophes, at the right price.
At the right price. So you've had a good set of earnings boosted by this global data center demand. How much more infrastructure do you think we'll need for data centers? There's concern about, the fact that we're spending a lot and we don't see revenue. Do you have a projection of how much demand could grow? Oh, I think we've lost you. Mario Greco, can you still hear me? I think we have a little bit of technical issue, and that's never a good thing when you're trying to speak to a chief executive about some of the earnings that they've put out. So I think we'll try and go back to Mario in just a second. But Siemens, in the meantime, has raised its earnings expectations for a second time this year due to a surge in data center spending. Well, the chief executive, Roland Busch, also data center spending, has been discussing the outlook with Anna Edwards.
These are two pieces. One is our automation business and our software business, and both are really firing. So our automation business had an order intake increase of 11%, grew by 7%. So we see a good momentum there that comes with a good conversion. And our software business is very strong. It grew by 11%. If you take our total Siemens digital business, digital business, software and services, it grew by 15. So we have a growth momentum, which obviously translates also into good profitability.
And what about the competitive landscape? I'm thinking in particular about factory automation. There are Chinese competitors who are in that space, and I wonder how competitive the landscape is right now.
So we are very competitive also in China. You know, we developed and launched new Chinese products. The first 16 landed in the market, another batch of 26 we launched early this year. They grow in the mid-20s percentage points. So we are winning customers, we're winning new customers, we're winning customers back. So automation business is doing in China very well. But then the rest of the portfolio globally as well. We see a pickup also in the machine business, also in China, which helps us also on the high-end side, where we see our core portfolio of automation landing very well. So therefore, in total, we did our homework in developing really super competitive new products in all markets, by the way, in China, of course, in particular.
Okay, so standing up to the competition in China, then, Roland, let me ask you about the data center build-out and the ways that the Siemens product lineup is able to supply that. How sustainable is the demand that you're seeing in connection with the data center rollout?
So let's briefly talk about the impact of data center business. So again, this is a massive investment which goes there. I come to your question in a second. That helped us also growing our smart infrastructure business. For example, electrification business grew by 20%, electrical products by 18%, but we had also a growth from our automation business as well, which was pulled also in this one. So now you understand that we have, of course, the electrification piece, low voltage, medium voltage, where we have a huge demand, which we can serve. But then AI factories, they go more and more into industrial PLCs, where we have a strong offering. We're also adapting our functionality, we can use it. And then after all, if you want to build new data centers, you want to build them fast and super efficient. So we offer a digital twin of a whole AI factory or data center, which you can optimize in the digital world and then build it, which is definitively a benefit for our customers. So it's a very strong offering here. And then it goes into other technologies like 800 volts DC, so direct current. We launched new products, DC products, switching products, which we have in the market. They get a pull. And then when it comes to liquid cooling, the whole situation changes again. And we have an offering there also for things like solid-state transformers. We're working on that. They are new technologies. And we are working with NVIDIA for a blueprint of these new AI factories together, again, using our digital twins. And we are putting products behind that.
Well, that was Siemens Chief Executive Officer Roland Busch speaking to Anna a little bit earlier on. Now, stocks broadly flat. There's quite a lot of weakness in the technology sector, but again, that is compared to what we saw in the last couple of days. Investors awaiting developments in the U.S.-Iran talks and looking ahead to key U.S. jobs data on Friday. Look, the pause in tech rally really comes as investors now reassessing valuations after AI-related shares are rebounding from last month's sell-off. Coming up, we'll have plenty more, of course, on AI and infrastructure, given the results we had with Zurich, of course, Insurance. This is Bloomberg.
Look at the more successful economies in the region. The key to their success is continuity. But the way our Constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
At the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, everyone, and welcome back to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Renewed weakness in chip makers weighs on market sentiment as investors look ahead to key U.S. jobs data. Iran says it's reached an agreement with Oman on a proposed route through the Strait of Hormuz, raising the prospect of energy flows resuming. Plus, Bloomberg learns major hedge funds were targeted by hackers in a wave of attempted cyber attacks in recent days. Now, let's return to our interview with Mario Greco, the chief executive of Zurich Insurance, after the Swiss company reported earnings. Mr. Greco, thank you so much for being patient with us. I'm delighted to have you back to talk a little bit more about your earnings that were really boosted by AI infrastructure and AI data centers build out. How much more can we build?
We believe there is still a lot of demand out in the market to ensure construction of technology, energy, pipelines. The world is in a transformation, and construction and infrastructure is a very hot sector. And we, as an insurance company, have been proud of being specialized on that for decades. And now we can deploy all our knowledge and expertise in following the customers on that. Now it's going outside of US, so we have lots of projects currently in Europe, in the Middle East, and in Asia, and we expect this demand to even get hotter over the next couple of years.
Yeah, and just to make sure that all the viewers understand, it's basically because Zurich offers these specialized insurance products for large, complex projects. So is that going to be the bulk or the most significant growth in terms of revenues going forward?
It's going to be one part of the growth. We also see a lot of growth in middle market and specialties outside of construction. But this is a very significant, to give you a size, our total property and casualty revenues are a little short of 40 billion. And the construction business in H1 was in the 1.3, 1.4 billion revenues ballpark. So it is significant, but then the rest of the portfolio also is growing, especially with mid-market customers, SME customers, and rest of specialties.
I know you're doubling down on this specialty insurer with the acquisition of Beazley. On Wednesday, Beazley disappointed actually on earnings for a number of things, including some of the large payouts because of cyber risk exposures. What does it mean for your appetite with Beazley? Are you having any second thoughts?
No, honestly, the vision to create a merged unit on specialty with Beazley is a long-term vision, is a strategical vision. I think the portfolios can complement each other, and we can create a very strong and stable, big specialty writer. So they're not dependent on the quarterly or half-year results in any way, positive or negative.
Mario Greco, to what extent are you being impacted, that Zurich is being impacted by the war in the Middle East?
Not directly. We don't have a real exposure there. We don't have a marine business, so we haven't been impacted by any damage to ships, to fleets out there. Indirectly, for the financial market, movements, we've been impacted as everybody else, but we do not have a direct impact, and our accounts, I think, show that.
Mario Greco, just a final question, because there's also been some ongoing enforcement proceedings by the Swiss regulator FINMA about, some sales bans, basically, as related to policies in Swiss corporate life and pensions unit at Zurich. How long do you expect that to last?
That I don't know. That's a question for FINMA. We did what we had to do. So we changed the management, the organization, the structure of the company. We have been acting on improving the systems, the controls. Then it's up to FINMA to decide when they will find all these changes proper to the standards that FINMA wants us to have. We acted as quickly as we could have done it.
Thank you so much, Mario Greco. As ever, it's a great joy to speak to the Chief Executive there of Zurich Insurance. Now, Commerzbank has unveiled a fresh share buyback. The Chief Executive, Bettina Orlopp, is trying to show that her strategy delivers strong returns, while Italian rival UniCredit prepares to expand its stake in the German lender. The two banks are set to kick off what could be months of discussions about the bank's future, while Orlopp spoke to us a little bit earlier.
We have talked after every quarter, UniCredit and Commerzbank, because there are a very large investor since a couple of quarters. So it's very normal that we have interactions with a very significant shareholder, and and these meetings will continue for sure.
Yeah, I just wondered what your relationship's been like with Andrea Orcel, Bettina, because we know that he wants to speak with the German government and the Workers' Council, and made no mention of Commerzbank management when in the recent comments.
Well, first of all, I think we are both. We're both committed to increase and maximize the value for our stakeholders. And I think that is a good basis for meetings, also meetings between the two of us.
Mm-hmm. Well, what will your main other asks be then in the takeover talks? I'm thinking about keeping the international network, the headquarters, keeping the public listing. Maybe you want some job guarantees.
I understand the interest in that, but you will understand that I think things like that should be discussed first between Commerzbank and UniCredit, and then we will definitely come out to the public to share more details on it. For the time being, I think it's important, A, that we deliver and that we continue to deliver against our targets, and B, that we are in constructive dialogue with UniCredit to figure out also some technical details, but also then how we organize the phase ahead of us, but also how potential target pictures could look like. And the best thing to do that, and the most value accretive thing to do it, is to do it jointly, and that's the basis.
Well, that was the Commerzbank Chief Executive, Bettina Orlopp, speaking with Lizzie a bit earlier. Now we're joined by Paul Davies, who covers banking and finance for Bloomberg Opinion. Paul, my head is spinning. So now they're maybe looking at teaming up with UniCredit. Like they used to be, the two chief executives didn't used to talk, and now it feels like there are warmer connections.
Yeah, well, they kind of have to, really. It's when you look at where we are with the deal, most people in the market assume this is done now. They're like, UniCredit has won. So they've got, with the tender offer and with their derivatives, they've got, I think, 48% of the shares. That would give them, a majority at most AGMs because not everybody votes. So they can kind of put their own people in charge, over time if they want to. We had a story in Bloomberg News last week that they've got approval now from BaFin to go over 30%, so to take on the rest of the shares that were tendered. That goes to the ECB. They should probably give approval by sort of October. And then, after that, the UniCredit will have to consolidate Commerzbank. Now, the interesting and slightly awkward thing there for a while is they then have to supply all of the capital to run the bank, but they still only get 48% of the earnings. So they're going to be in a slightly costly situation for a while. But, Bettina Orlopp, as well as she has done over the past couple of years, under pressure of UniCredit as an active shareholder, has no choice now but to kind of be a bit more warm.
Paul, do we understand exactly what this takeover looks like from the UniCredit side? She was very coy on job cuts and things like that. Yeah, so she really wants to protect the international network, I think. That seems to be the main difference of opinion between, Andrea Orcel and UniCredit and Bettina Orlopp and the Commerzbank team. When UniCredit get control, they will almost certainly get their way on this. I mean, it's an in-Germany deal. It's a deal between HVB and Commerzbank. It's not a kind of a pan-European cross-border deal in that sense. They will keep Poland, whatever happens, mBank, and they still need to get some approvals for that. But the rest of it will... it will probably ultimately come down to what, Andrea Orcel wants to do. In Italian banking, like domestic banking, there's loads of M&A that's going on, trying to outdo each other and buy stuff. Where are we?
So, it's all finally settling down a bit. I think, Intesa, San Paolo has this bid for Montepaschi, Banca Montepaschi di Siena, which has been, the center of a lot of this kind of consolidation for a long time already. Over the weekend, we had Crédit Agricole, a big shareholder in Banco BPM, saying, a proposed merger between BPM and Montepaschi was not going to happen. BPM has kind of now said the same thing. Luigi Lovaglio, the great, the man who kind of, is never quite defeated, CEO of Montepaschi. Who
came back against all odds.
Yeah, keeps coming back against all odds. You can never quite count him out. But, it does look like Intesa is probably going to win that deal as well now.
Earnings overall for European banks, Italian, German, they've been okay.
Yeah, they've been pretty good. I think... revenues on average have risen, much faster than costs, even though costs have been a bit sort of looser than people hoped. But, the profits have improved everywhere. Capital is strong. Balance sheets are clean. Everything looks, quite decent.
We're a little bit obsessed. I think it's our most read story on the Bloomberg terminal about these hedge fund bets in the wake of the near collapse of situational awareness.
Yeah.
That was an incredible story because Citadel swooped in. Yeah. And it's doing very well on the back of it.
Yeah, so one of the things I've been looking at a lot over, earnings season and just beforehand is just, the amount of leverage in the stock market at the moment. A lot of the big banks, particularly in the US, have been really leaning heavily into prime brokerage, which is lending to hedge funds. Obviously, retail investors in their margining accounts, there's record leverage in sort of margin trading as well. I think, both Jamie Dimon of JP Morgan and Brian Moynihan of Bank of America kind of commented about this yesterday as well. And one of the things I've been looking at a bit actually is our traditional way of trying to judge this is by looking at the amount of debt in relation to the value of stock markets. Yeah. And, on that measure, things don't look too out of whack with the past. But a couple of people who I've been speaking to are saying, look, actually we should think about debt against GDP as we do with all other kinds of debt. And when you do that, you start to realize that, hedge fund leverage in particular is way higher than we have ever seen in history, and the same with margin debt as well. And that's kind of makes things a bit more worrying, I think.
Yeah, worrying in terms of systemic, or is there a specific, not all hedge funds, you have small hedge funds, you have big hedge funds. Is there a particular area that we should worry about in these hedge funds?
I think primarily it's about, stability of the stock markets and, and the scope for high levels of volatility and sharp corrections. We had a taste of that over the past sort of 6 weeks with a lot of leverage, leveraged investors coming out of the Korean market, this situational awareness situation, and the important thing about that is that sell-off could have been much worse if it weren't for Citadel coming in and basically taking out the book. And stopping a kind of, potentially a worse fire sale. So it's about stock market volatility first. That can feed into more economic weakness if it goes on for quite a while. But the real issue for financial crisis is always, bigger problems with credit, supply of credit, that sort of thing.
Paul, as always, thank you so much. Paul Davies there from Bloomberg Opinion. I urge everyone, I read all of Paul's columns. They're great. We'll push them out in social media. Of course, you can find them on our website. Now, Bloomberg has learned that hackers launched a wave of sophisticated attacks on Wall Street firms, targeting information systems at major money managers. Point72 Asset Management told investors that it had been attacked, but there were no initial signs of stolen client data. Now, for more, we're joined by Bloomberg's Jill Deasy's. Jill, how was the attack carried out? Because it feels like it was coordinated and big, and who else was targeted?
Yes, Francine, so this is actually the really fascinating part of this attack is that these hackers were using primarily this concept called voice phishing or phishing. So the idea here is that they're actually using technology to mimic voices on voice memos or on telephone calls where they're trying to convince employees to actually trick them into releasing sensitive information. So that's really kind of the tactic that we're looking at that's being used here. So in addition to Point72, people familiar have also told us that there were others targeted, including Millennium, including Two Sigma, Citadel. We haven't heard, some of them declined to comment. Two Sigma says that these attacks weren't successful. So, a lot going on here, but ultimately does kind of resemble a really sophisticated version of cyber attack targeting some really major hedge funds.
Jill, why are cyber attacks surging across Wall Street?
So I think, Francine, this is might feel a bit obvious here, but ultimately it's really kind of comes down to some of these advances in technology and artificial intelligence. We talked to experts who said that, cyber attacks that maybe in the past would target, 50, places at a time now are capable of targeting, 1,000 or so. So you're looking at that development of this technology that's really enabling these types of cyber attacks to get, one, more sophisticated, but to also target a broader net of places, including, obviously, several major financial firms.
Jill, thank you so much. As ever, Jill Deese is there with the very latest, of course, on these pretty incredible cyber attacks. Now, coming up, a last-minute say for Gianni Infantino as he, so far, survives the FIFA World Cup sell-off scandal. We'll have the full details next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Welcome back, everyone. Now, as we await news of a possible deal between the U.S. and Iran over the Strait of Hormuz, there is also hope for a peace agreement between Israel and Hamas. Well, Mark Champion from Bloomberg Opinion says the Middle East could look very different by the end of this year, with Israelis and Palestinians both taking part in crucial elections. Well, Mark joins us now. Mark, thank you so much for being here. It's true that, I guess because of everything that's happening in the Middle East with Iran on geopolitics and the Strait of Hormuz, we're just not spending enough time on what's going on between Israel and Palestine. Are you hopeful for some kind of movement forwards?
Well, I think you have to be deliberately optimistic because the current status where it's kind of got stuck since the ceasefire and the Trump 20-point plan last year in October. So we're kind of stuck since, and the Israelis are. The IDF is gradually creeping forward, occupying more of the territory. Aid isn't really getting in. There's enough food, just about, but otherwise nothing. And it's utterly miserable for 2 million Palestinians who remain there, civilians mostly. And it's not really a sustainable outcome. So, the sort of logical end to that, which some members of the Israeli government, espouse, is basically to make it uninhabitable, drive the Palestinians out, and, effect what, they call a voluntary exit, but it amounts to ethnic cleansing. So the alternative is that you try and get some sort of wider agreement, bring the Arab world in. That means Israel has to move. That's not going to happen until after elections. So, I think the reason to sort of hold out hope is that, there will be, we think, some change in the players involved, some change in the political landscape, and, you may start to see some movement.
But this is not in the international community that, frankly, has almost been nowhere to be seen. Is it because of elections in Israel?
I think it's because, essentially, Donald Trump took possession of the issue and then got distracted in Iran. So, he, organized this peace plan, built the Board of Peace, and the Board of Peace has been working, but it's very, very difficult to bring, sort of irreconcilable positions together. The other point of sort of some hope is that, Hamas just appointed a new leader. That's not great. He's very much the continuity leader, used to be Yahya Sinwar's deputy. On the other hand, they have said, okay, we're willing to, disarm in principle. Lots of, differences with the Israelis about what that entails and when it should happen and who should move first and all that sort of thing. But it's the first time that Hamas has ever said, we will disarm. So, another reason to try and get some, leverage into that and to sort of use it and try and get towards some better outcome.
You also wrote that, like Iran, the Ukrainian war has a potential to draw in the wider world. So what's your outlook on that conflict?
Well, I mean, increasingly pessimistic, unfortunately. The Ukrainians, very briefly, they've had a good year, essentially. They've done well on the front lines. They've, despite, against all odds, they remain outgunned and outmanned. And yet they have been able to do a lot. They've also begun deep strikes into Russia, which they weren't able to do before. All of this is quite sort of positive from their point of view, and you would hope that that would open a window of opportunity. But just at the moment when, that is there and you can see pressure beginning on the Russian economy, etc., just at that moment, they've run out of Patriot missiles. And because of war in Iran again, they aren't available. We're going into a winter when, as in previous winters, the Russians will try and make it so that there's no power, no heat in the Ukrainian cities. This time they may well be able to succeed because, the Ukrainians now have no defenses against ballistic missiles. So it's somewhat depressing. On top of that, there is some discussion of whether the Russians may mobilize again after the elections in September.
Mark, I guess there's a danger that when you look at the stock market, you think that nothing's going on. And I remember reading this piece by John Authors just a couple of weeks ago saying, even in the 1920s, 1916, 17, the stock market was fine, and geopolitics actually took over, and we had a world war. Without asking you whether there's a risk of World War III, do you think that conflicts could really widen worldwide, into something that we should really worry about?
I think we should be worrying about it all the time. I mean, that doesn't mean that there's a probability that will happen anytime soon. But the thing about world wars is nobody intends them. Nobody plans for them. They happen because governments in generally major powers get themselves into positions they find it difficult to extract themselves from, and you see that happening all the time. Look at Putin in Ukraine. Look at Donald Trump in Iran. You're a great power. You get yourself into a position it's hard to extract yourself from. Rationally, you need to, but then you tend to keep doubling down and escalating. And then that affects other countries, other great powers that get involved. Look at China. They're trying to, keep a light fingerprint on these various conflicts, but they're there. They are supplying the Russians and the Iranians with what they need in order to make the missiles that allow them to continue the war. Look at the North Koreans. So it's, all of the kind of pieces are there. Doesn't mean that they're going to fall together, but yes, we should be worrying about it all the time and trying to make sure that we don't end up blundering into another wider conflict.
Mark, thank you so much, as ever, for joining us. Mark Champion, our international affairs columnist with Bloomberg Opinion. Now on to football, and FIFA has apologized for what it called errors over Gianni Infantino's failed plan to sell stakes in the World Cup. Well, senior staff say they have reaffirmed their full support for the president at a crisis meeting in Morocco. Well, Bloomberg's Tiwa Adebayo has been following the story very closely. Tiwa, thank you so much for joining us. So what do we actually know about this emergency meeting?
Well, the statement about it was pretty emphatic. The headline here is that members of the FIFA Management Board, including the Secretary General, have reaffirmed their full support for Gianni Infantino in his position as president. I do think it's quite interesting, actually, the meeting took place at FIFA's Africa office in Morocco and Rabat. That says maybe quite a lot about where his support lies. We've talked about before the level of support he has from CAF, which is the African Member Association that's part of FIFA. It does seem like they've really been rallying around him. He's been in Morocco for the last week, actually, and yesterday we saw him alongside the Secretary General of FIFA at one of the Women's Africa Cup of Nations matches. Of course, there is a major international tournament happening right now, so it does seem like there has been a bit of a support rising within the FIFA organization, but there is still criticism there for him as well. And in the statement, they do mention that Gianni Infantino has apologized to both FIFA's management board and also to those member organizations as well.
Tiwa, I mean, where does this leave the future of Gianni Infantino, FIFA, and the World Cup? It feels like, it's quite difficult to just put it behind and say nothing's happened, let's move on as normal.
Yeah, well, what we can tell from this, I think, is that he's going to fight for his position. There was perhaps some talk of maybe resignation. It doesn't look like that's going to happen. The statement says that moving forward, they're going to try and find a way for what they're calling FIFA Forward Enterprise. That was the controversial proposal to involve investors. They're going to try and find a way for that plan to develop football and for some of the earnings perhaps to go to developing the women's game and other things that were mentioned. So it seems like for now he's going to try his best to stay and defend his position, but still facing criticism from world leaders. We even heard from Mark Carney yesterday, Canadian Prime Minister, saying that he's lost confidence in Infantino, so a difficult position for him.
Tiwa, thank you so much for joining us. Tiwa Adebayo there with the very latest on Infantino. Up next to Bloomberg Brief, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in this space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see, the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent. But when she's here, she can have her app open, and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Stocks wavering as a tech-led rally loses steam and investors look ahead to Friday's payrolls report. An AI rethink, DeepSeek plans a significant price hike, and Google shakes up its AI leadership. And President Trump reportedly has spoken repeatedly with Fed Chair Warsh since he became head of the central bank. Another roller coaster ride for South Korea's stocks today. Let's check in on the Asian session with Winnie Su in Hong Kong. Winnie.
Yeah, good morning, Bonnie. Well, we are seeing memory stocks leading declines in Asia today, especially following those disappointing earnings from the likes of SanDisk and Western Digital. Now, the expectations have been running sky high, but investors still demand more. They want to see stronger outlook and stronger pricing power, and that is why you are seeing Samsung and SK Hynix leading losses today, dragging the Kospi down by almost 5%. Now, flip the board, you take a look at the broader Asia market. We are seeing that regional benchmark down more than 1%, while the Japanese yen still stabilizing right below that 158 handle against the dollar after that historic U.S.-Japan intervention. But still, when it comes to bond space, we are seeing, in fact, Japanese bonds extending a bit of gains following those firmer demand for the JGB 30-year bond auction earlier today, indicating a bit of a calm after all these markets really struggling amid the fiscal concerns.
All right, Winnie, thank you so much. That's the Asian session with Winnie Su. Now over to London for a look at Europe with Justina Lee. Justina.
Good morning, Bonnie. It's one of those weeks when it feels like everyone in Europe is on vacation, and maybe we should be too. It's been pretty quiet, but still another positive day as the Stocks Group 600 extends that record high. We've had another set of pretty good earnings numbers, from the likes of advertising agency WPP and also an Italian bank like Banco BPM, and that is like fueling further gains in banks, which is a very important sector to the European index. Now, bonds are pretty quiet today, as I've told you, and if we flip the board here, what I find really interesting is there's a story my colleagues wrote today about the possible re-emergence of the Sell America trade with this renewed doubts over America's commitment to contain inflation and, taking part in the intervention to support the yen. And we can see here that's kind of supporting the euro, and lately that's been on the rise again. And we kind of remember the last bout of the Sell America trade. That could be another source of support for the euro, as we've seen lately.
Absolutely. Justina Lee, thank you so much. Yep, a little bit of credibility, fragility, let's say, and that won't be helped by today's Wall Street Journal report about the president's calls to Fed Chair Warsh, though the journal does suggest that it's not certain that they spoke about monetary policy. Let's see if that South Korea weakness in chips and AI-related stocks, and also Japan SoftBank with a little bit of weakness after their numbers today, bleeds into the U.S. session. Certainly for the moment, NASDAQ 100 futures are pointed lower. We were down, of course, yesterday. S&P futures, though, are holding on to gains, as are Russell 2000 futures. Now, regarding that South America trade, let's have a look at the bond universe, because we haven't seen that much movement. Obviously, non-farm payrolls, the big event this week. We're holding in below 420 on the 10-year, and we're not as elevated as we were, obviously, on the 10-year, 462.08. The 30-year creeping just a basis point or two higher once again, though, and not moving from these levels right now. All right, let's get to some individual pre-market movers. Here's Chloe Melly in London.
Good morning, Vonnie. We are seeing Sandex shares down this morning quite significantly, down almost 9%, after giving quite a disappointing revenue outlook. It seems that analysts are quite optimistic about the growth prospects of the company going forward into the medium term. But in the meantime, this short-term disappointment is weighing on the stock quite significantly. We are seeing very similar dynamics at Sandex's peer Western Digital, which is another computer hardware company, also in the red this morning, after it also gave quite a subdued revenue outlook. It's for both of those companies, it's really a matter of running against those very elevated expectations, given that they're both AI players as well. And finally, AppLovin is another company that's in the red this morning after issuing quite an underwhelming margin outlook. And it seems that its expansion into e-commerce advertising, so going beyond its usual video game clients, has proven to be quite an expensive, quite costly expansion. And so we are seeing that weighing on the stock this morning. We're down more than 15% for AppLovin.
Some drops for those stocks. Chloe, thank you so much. Chloe Melly there in London. She'll be back later in the hour. Also coming up this hour, we'll catch up with Kelsey Barrow of JP Morgan Asset Management. We'll be looking ahead to the non-farm payrolls report. So, shares of Sandisk falling in the pre-market after the company issued weaker than expected guidance. It also says demand is outpacing supply, and it will continue rationing memory supply among customers beyond 2027. Joining us now is Bloomberg's Neil Campling. Neil, normally if something is in low supply, that's good for investors in the stock, right? It has pricing power and customers out the wazoo, right? So why are investors continually punishing these memory chip companies?
Partly it's a case of the profile of the returns that these stocks have had year to date. So Sandisk is the best performing stock in the S&P 500 year to date, up nearly 500%. So we have to keep that in perspective. But you're right, in terms of the supply-demand dynamics, it is strange to see that the guidance for the following quarter on the sales line is actually below street expectations. And that doesn't really quite stack up with what we're hearing, especially given 2/3 of revenues are built on long-term commitments. So it's definitely going to send some tremors today in the whole memory and storage stack of the AI trade.
Yeah, and we can see that in the pre-market across the board. Let me ask you about DeepSeek raising prices, which you would have thought would also be good for U.S. companies. So it's currently charging 14 cents and 28 cents, right, for its two offerings. That would go versus $3 and $10 for Kimi K3, and up against $15 and $50 for the US version. Now, how will it raising prices help US makers of models?
I suppose what we've seen is token costs for AI have come down significantly from recent highs, and we've seen some of the US companies pulling back on use of tokens because the costs have been very high historically. It may well be that DeepMind and some of the Chinese very low-cost models are having to raise prices because they are losing money, I would suspect. So what they're having to do is they got early sort of traction by basically discounting just to get some business through the door, and now they're having to raise pricing. But it certainly should help the differentiated models of from the AI frontier that are the best-in-class businesses. But it's something where perhaps the Chinese models aren't as cheap as were initially thought. So it's going to help the US companies for sure.
Yeah, still a big difference, but less of a difference than there was. Then there's Google shifting its AI leadership. The lab had obviously been in London. All of those people are now going to go to Mountain View, California, and Google is going to try and catch up because it's been lagging significantly, really. Can it catch up quickly with its peers?
It has. It's interesting, isn't it? Because if you think Google actually at the start of this year basically had caught up and was considered to be one of the leaders in some of the models, and then it's fallen back behind again. Now, the war on talent is significant in the whole AI industry. We saw some of the open AI early leaders there move and actually create Anthropic. Some people talked about the changes that were announced yesterday within Google, that it was kind of like Mick Jagger and Keith Richards leaving the Rolling Stones and going to set up a brand new band. You know, these are big talents that are changing and moving to other companies. So it's something to watch out for in Silicon Valley, because the amount of talent available in this industry is still very limited.
Yeah, and there's even court cases about it ongoing, which we'll speak about another time. Neil, thank you so much. Bloomberg's Neil Campling. President Trump sharply denying the Washington Post's reporting that he clashed with Defense Secretary Pete Hegseth on missile depletion concerns. He posted on Truth Social that the U.S. has, quote, massive amounts of munitions. Let's get more with Bloomberg's Abir Abu Omar. What more do we know about this reporting, Abir? I mean, this has been in the ether for some time that the U.S. is running low on munitions and isn't able to do potentially what it's threatening to do.
Yeah, good morning, Vonnie. I mean, you're right. We had multiple media reports throughout the course of the week, and even before, really, but the latest perhaps a couple of days ago from Reuters, saying that the U.S. has depleted or is at the bottom of its long-range missiles after this war with Iran. Now, President Trump again refuted those claims multiple times over the past 6 months or throughout the course of this war. Now, these latest claims by President Trump come after he did say on Truth Social, of course, that the U.S. has plenty of ammunition. He did refute those claims through other media reports over the past 3 weeks or so, saying that the U.S. has enough ammunition. He would like for the United States to have more, but that the Biden administration had run through some of those ammunitions, giving them to Ukraine, for example. Those are some of the claims that he had said. But then we run into the reality, Vonnie, and the reality is President Trump has threatened to attack Iran. The latest threat came earlier in the week when he said that Iran is now prone to the biggest attack since World War II. And then he went back on his claims and said that they were talking through with the Iranians on a deal. Now, this back and forth has happened so many times over the past 6 months, leading us to believe that there might be some truth to the U.S. running low on ammunition. And then you are also confronted with the Iranian side, where the U.S. has come up multiple times and said that they've destroyed Iran's military capabilities. But then you see what Iran can do to the region with its drones and short-range missiles. And Iran can manufacture those for really, really cheap, according to our reporting and multiple other media reportings. And so Iran has the ability to disrupt shipping, for example, through the Strait of Hormuz, through those drones that it can produce for cheap. And that is sort of the argument here. Even with the U.S. massive amount of weaponry and Iran's already depleted military capabilities internally in the country, it still can hit or it still can threaten shipping through the Strait of Hormuz. And that is enough to really paralyze the movement there, similar to what we're seeing in the waterway right now.
Just really briefly, Abir, we do have a deal apparently just ready to be signed off on between Iran and Oman. What does that actually mean for the Strait?
Yeah, that's a good question. We don't have a lot of clarity on what exactly the deal will entail. We know that it will ensure some kind of mechanism to help ships through the Strait of Hormuz, or to help ships have a trickle of movement through the Strait of Hormuz. We await the blueprint that we have reported will come out probably later today from both Iran and Oman, but the Iranians are adamant that Washington had no involvement whatsoever in those negotiations, that these are negotiations between them and Oman to reopen the Strait of Hormuz temporarily, and maybe not even immediately, Vonnie.
All right, Abir. Thank you so much, Abir Abu Omar in Dubai. Turning back to trade now, the Trump administration preparing to impose tariffs and minimum prices on imported polysilicon, which is used to make chips and solar panels. Bloomberg's Rosalind Matheson joins us now for more. What's the thinking, Ros? How would this in any way benefit U.S. companies, particularly solar companies? And obviously we're seeing the stocks sell off.
Well, we are, but the question is how much might this actually impact these companies? Obviously, this is targeted at China, which dominates the solar sector, and US solar companies are heavily reliant on imported polysilicon. So obviously a move here to consider tariffs of at least 15% and those minimum import prices on raw polysilicon, but also some of the solar products. The question is, what would that actually do for the solar sector in the US? Domestic production of polysilicon is actually pretty small, so these companies are in a bit of a bind. The idea is they would have some kind of leeway, a bit of a grace period to adjust to this, but does that mean anything in terms of production in the US, or does it just mean probably in the end higher prices potentially for US consumers? But it's part of this whole package, this approach by the Trump administration to try and bring manufacturing back to the US, to try and get more capital expenditure, capital investment happening in the US. And of course, in recent weeks, part of these growing tit-for-tat actions that are happening between the US and China, which are coming all in the run-up to this planned meeting between the presidents, Donald Trump and Xi Jinping, and that's only coming up in a matter of weeks.
Exactly. Now, in terms of this particular policy, what manufacturers of polysilicon would, create manufacturing jobs in the US in order to get around these exemptions? Are there any out there that don't have operations in the US that might consider moving here?
Well, at this early stage, it's very hard to say. There are only a couple, as I was saying, that produce domestically at the moment, and a lot of it is imported. And again, if you're a company looking at all of this, you've got to consider all the costs involved with moving production to the US. And it comes also as the Trump administration has really been pretty much anti-solar. Donald Trump has been very critical of the renewable sector in particular, and also solar, and rolling back, some of the tax credits, for example, that were available in the solar sector. So the question is, would you want to put your bets on the US solar sector if you're a company, if this is an area that the administration, at least of Donald Trump, doesn't seem to be that supportive of? Again, this seems to be more targeted about China than anything else. In terms of, would it have an impact on the US economy? It's way too early to say.
All right, Ros, thank you so much for the update as always. Rosalind Matheson joining us there from Singapore. Now to other top stories trending on the terminal this morning. SoftBank reporting a smaller than expected drop in quarterly profit. Performance was boosted by its stake in Intel and the value of TikTok developer ByteDance. Shares are lower though in Asia trading. Commerzbank shifted tone on a deal with UniCredit. In a statement, the bank said a strategy developed with UniCredit might be beneficial to investors. Commerzbank CEO Bettina Orlopp spoke to Bloomberg TV.
We are in constructive dialogue with UniCredit to figure out also some technical details, but also then how we organize the phase ahead of us, but also how potential target pictures could look like. And the best thing to do that, and the most value accretive thing to do it, is to do it jointly, and that's the basis.
OpenAI is asking a federal judge to dismiss a lawsuit filed by Apple accusing it of stealing trade secrets through job candidates and hires from Apple. Lawyers for OpenAI say the allegations are meritless. Apple didn't respond to a request for comment. Coming up, back to business. Situational awareness has returned to making investments just days after it was on the brink of collapse. More on that next. This is Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Situational awareness back in business. Bloomberg learning that the hedge fund has completed a $400 million investment to back a private company earlier this week. For more, Bloomberg's Jill Deeses joins us now. It wasn't a leverage bet, I'm imagining, Jill, so there's that. But also, do we know if this private company is in the AI space or what kind of space it's in?
I mean, I think at this point, Bonnie, we're still obviously getting, very many details here. But I think obviously the most fascinating part of this entire story is really just obviously how much situational awareness was really on the brink of things here. And so obviously now, the fact that we do have these details here about this investment in, this private company, I think does indicate that, there's obviously going to be more to the story than, what looked like a pretty wide-scale implosion just a few days ago.
Yes, and you have to just wonder at the speed at which, all this due diligence was done and that investment was already able to be made just days after collapse, as you say. But Leopold Aschenbrenner had put out that letter. He had tried to make sure that his investors continued to have confidence in him. Will this help?
Yeah, I mean, I think that that's really the open question here, right? I think, it's a very difficult place to come back to when, you're obviously looking at some of these leverage bets and how, again, close to complete implosion situational awareness was. I mean, obviously capturing the attention of people around the world. And so, you're looking at this company in terms of how exactly do you trust this as an investment firm going forward? And I think that that's a really long road to sort of come back from. But as we've seen, a lot of different things that sort of unfold in this space. So I think it's one that's going to be, really key to really kind of, keep a close eye on going forward.
And just one other detail that stood out to me. I mean, this was on top of a $100 million investment that situational awareness had already made in the same company. So you have to really underline the fact that when Leopold Aschenbrenner likes something, he's all in on it, right? Talk to us more broadly about hedge funds' performance in July. I mean, there was obviously that bruising AI sell-off.
Yeah, I think that, when you're looking at the overall picture for hedge funds in July, really, really, really devastating picture for a lot of places. Obviously, some fared a bit better than others. I think this table right here really kind of indicates that, obviously the situational awareness, really stunning numbers there, but there were many others that were hit incredibly hard. One thing to kind of note, though, is that when you're looking at the overall picture from the year, a lot of hedge funds still did incredibly well through the first 6 months of the year. So even when you're accounting for these really massive losses in July for some of these hedge funds, you still are looking at some positive figures for the year, broadly. But it does kind of point again to what we've been talking about for months at this point, which is the volatility in the AI space, particularly in July, has been I think just incredibly notable. But again, looking at that overall performance, the fact that you can still kind of weather some of these storms despite that really volatile July really, I think, speaks volumes for performance of some of these hedge funds.
Absolutely. They're doing what they say on the tin. Jill, thank you so much. That is Bloomberg's Jill Deeses. Coming up, a look at what else is making headlines in your front page news. That's next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bloomberg Brief. I'm Bonnie Quinn in New York. It's time now for your front page news. First up, the Wall Street Journal reporting President Trump has spoken repeatedly with Kevin Warsh since he became Fed chair. It says the president calls Warsh in bursts several times in a stretch of days. Trump has sought Warsh's counsel on the war in Iran, how AI is affecting the economy. The Journal says it isn't clear if the two discussed monetary policy. Next up, the Washington Post says President Trump recently told donors in private he wants to see Vice President Vance win the 2028 presidential election. The private remark contrasts with what the public remarks have been from the president over the past year, egging on a contest between Vance and Secretary of State Marco Rubio. And finally, the Financial Times reporting several top law firms have explored selling stakes in their businesses to private equity groups without triggering rules that bar ownership by non-lawyers. Firms are interested at a time when many are spending large sums on talent and on AI. Coming up, we're going to be speaking with Kelsey Barrow of JP Morgan Asset Management on where she sees opportunities in the credit market and the outlook for the Federal Reserve as we approach Friday's non-farm payrolls report. This is Bloomberg.
called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise ahead or Gattaca?
Maybe somewhere in the middle.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Stocks mixed as a tech-led rally loses steam and investors look ahead to Friday's non-farm payrolls report. An AI rethink, DeepSeek plans a significant price hike. Google shakes up its AI leadership. And President Trump reportedly has spoken repeatedly with Fed Chair Kevin Warsh since he became head of the central bank. Let's take a look at markets now. It's all about the memory chip makers today, really, after the weaker than expected outlooks from SanDisk. We also had some fluctuations with SK Hynix overnight in Korea, actually dropped by the limit 30% in the pre-market on that bourse. We do have S&P futures higher, though, and Russell 2000 futures higher, indicating perhaps a broader optimism out there over an Iran deal, at least with Oman on the Strait of Hormuz, if not with the United States. We are also getting Challenger job cuts down 46.1% year over year, coming in at 33,429. Once again, Challenger July job cuts down 46.1% year over year, coming in at 33,000 and change. So that's a pretty low monthly total. And we had the lowest monthly total this year in June. So that's 2 months now of low marks for Challenger. If we look at yields, the 2-year yield at 419.56 and really doing nothing on the 10-year and the 30-year also at 517.22, just hanging in where we are before tomorrow's payrolls report. Let's get to some individual market movers now, though, with Chloe Melly.
Good morning, Bonnie. You've just mentioned SanDisk, so let's take a bit of a closer look there. We're down more than 9% in pre-market trading after the company provided a revenue outlook that was seen by analysts and investors as quite disappointing. Analysts have mentioned that they are still quite optimistic about the medium-term growth prospects for the company, but in the meantime, we are seeing this short-term disappointment of really weigh on the shares this morning. It's a very similar story, similar dynamics with Western Digital, which is one of the peers of SanDisk, and there we also have a revenue outlook that missed expectations, that was seen as quite disappointing. Both of those companies were facing quite high investor expectations and did not quite manage to meet those. So this is part of this kind of broader AI player sort of story that we've seen playing out. And finally, let's go over to AppLovin, which is also down this morning and quite significantly in pre-market trading. We're down more than 15% after a margin outlook that was seen as quite underwhelming as well. It's been trying to expand into e-commerce and consumer advertising, so going beyond its normal video games customers, and that has been quite a costly expansion. And so we are seeing that weighing on the margin and therefore weighing on those shares this morning as well.
All right, Chloe, thank you so much. That's Chloe Melly there in London. One more time, I just want to let you know that the Challenger Grain Christmas job cut announcement's out, down 46.1% in July, year over year. That's 33,429 job cuts announced, which is lower than the previous month of 45,849. So that number, good for the Fed, and that continues to drop. Joining us at the desk is Kelsey Barrow, fixed income portfolio manager at JP Morgan Asset Management. Once again, I mean, as much weight as you put on Challenger or no, we didn't actually see anything to be concerned about here.
Right, and it's consistent with a lot of other data points that we have seen. Earlier this week, we had the JOLTS report, which has a layoff rate that remains low. We'll have the initial jobless claims later this morning. We get that every Thursday. That has been very low. And so, you know, I think that the picture as it relates to the risk of elevated layoffs or firings is very benign.
That said, the jobs data that we've got all year has been pretty volatile. So if we were to start getting weaker data or evidence of wage pressures, would it surprise you?
So I do think we have to be prepared for some type of trend shift at some point, because we are in a point right now where the market is very comfortable with the stability of the labor market. It's what's allowed the Fed to stay on hold. It's what's allowed them to be patient, even though we've seen this rise in inflation because of energy and other things. And so I do think that, you know, we should be watching it very closely. The three things that I'm watching for in the payrolls report: wage growth, as you mentioned, that's really key. No one data point is going to be the make or break, but we do want to make sure that the labor market is not becoming a source of inflation again, like it was during the pandemic, because that is a different regime than what we currently stand in. And that could reinforce some of the views for rate hikes that are already in the price. The second thing is the unemployment rate. So the unemployment rate is low. It has actually been coming down a little bit most recently. Some of that has to do with what we view as a fairly unusual move lower in the labor force participation rate. So we do want to see where the unemployment rate ends up settling. And the third thing is the breadth of job growth. So the breadth of job growth has been fairly concentrated more broadly in this cycle, but it has improved more recently. I think if we continue to see an improvement in the breadth of job growth, that again points to more confidence around the stability of the labor market.
So what are you looking for tomorrow? What will you be looking at first?
So, you know, I think the unemployment rate, as I mentioned, is something that we're going to be watching. We're going to be watching job growth more broadly. It's interesting how the market has become more comfortable with low job growth numbers, you know, not necessarily being a concern. If you look at prior expansions, the pace of job growth we have right now is actually much lower than it was back then. But, you know, the key is really to look at aggregate income growth, and that is the speed limit for consumption, and that's what powers the economy. I think the additional thing that has really been underpinning the strength of the U.S. economy this year has been the AI build-out and the resilience in business investment. It's really been less of a story about the labor market, I think, and more a story about this new emerging source of growth, which is business investment, and that is all, of course, centered around data centers and AI.
Exactly. We'll have to see if there are more AI job losses in certain industries. We've been seeing that in various industries in the last couple of months, but also, as you say, wage pressures. On the one hand, you want the consumer to stay strong, but on the other hand, you don't want wage pressures to add to the inflationary environment. What did you make of this report this morning from the Wall Street Journal that the president is calling the Fed chair? Now, it didn't say that they were talking monetary policy, but...
Yeah, so obviously there's some communication, or at least that's what's being reported. You know, to me, what I am focused on in terms of assessing the credibility of the Fed and their ability to act independently is looking at inflation expectations. And I do think it's quite notable that inflation expectations have remained very low. There was a lot of conversation around the last press conference and the performance of Warsh in that press conference. And we did see a fairly large steepening in the yield curve, which I think if you look at it at the surface, maybe that's concerning. But I think what counterbalances some of that concern is the fact that you have two-year inflation swaps that are actually now at their lowest levels in 2 years. Longer dated inflation swaps are also very low, which indicates to me that at this point, the market still views the expected path of policy that the Fed is endeavoring to achieve as one that does not create excess runaway inflation. So the inflation credibility is still there, and that's what all this reporting is really trying to assess, is the extent to which they're making decisions based on the data or based on political pressure. And at least as it relates to the inflation market is saying that the policy path is appropriate enough that we're not expecting a lot of excess inflation over the next many years.
We have been hearing from various Fed speakers, though, most recently Mary Daly yesterday saying that, she would be looking for a hike if we are to continue to see these kinds of inflation pressures. Are you suggesting that a hike is necessary?
It is potentially a consideration. I think it will depend on the data. But, the market is pricing in hikes for a reason, and I do think that the burden of proof is on the data to push the market away from rate hikes. So, we were in a period for a while where it was kind of the opposite situation, where the market was assuming cuts and the burden of proof was on, the data surprising to the upside, such that those cuts were no longer appropriate. Now we're in a different situation where, the hikes are essentially baked in. Although, what I would want to highlight is even those who are calling for rate hikes, they're calling for an adjustment, a recalibration, not the start of some new hiking cycle where we're going to be hiking, a large amount for a lot amount of time. I think right now the market is expecting, if we are going to see hikes, we're talking about a 75 basis point unwind of the insurance cuts that we got last year, not more.
And that is an excellent point. It does seem like we have a new floor for yields, but if what you say and the picture you paint does continue to pan out, that hike that's priced in should come out slowly, no?
It could, and that is a possibility, but there are a lot of steps between now and September in order to see that come to fruition. So our expectation is actually that the Fed stays on hold, and you do start to see some of that premium associated with a September rate hike start to come out. But admittedly, there are a lot of steps between now and September. We have 2 payrolls reports, 2 CPI reports, 1 PCE report. Obviously, I'm counting. Yeah. And you have the Jackson Hole symposium at the end of the month, which I do think is taking on increasing importance because there's been, some confusion about where WER stands within this debate.
And it could be anything from bland to extraordinary on the spectrum, right?
Right.
Kelsey, is it a precarious time to be investing? Where are you trying to pick up incremental yield right now?
Right. So I would say, taking that step back, looking at a labor market that is stable, looking at very strong business investment. The earnings season has been going very well, especially from the perspective of the credit markets. And so we do feel comfortable extending into credit. And we're seeing a lot of opportunities within the investment grade and extended sectors for incremental pickup of yield and spread. You could look down the capital structure at energy, hybrids, and utilities. That's linked again to that data center build out. We are looking at some of the data center deals. And more broadly, this is a yield environment that has been met with a lot of positive reception by investors. So I do think that, in the past, when we got to these yields, maybe there was a little bit more trepidation around what it meant and if it would be sustainable. What I'm seeing is that at these yield levels, we're seeing a lot more demand for fixed income coming into the market. Flows are positive, and it's supporting what is going to be probably another 6 to 12 months of a lot of supply as businesses continue to issue to fund all of this investment.
Yeah, there seems to be no end in sight. Kelsey, thank you so much for your thoughts today. That is Kelsey Barrow of JP Morgan Asset Management. Now to all the top stories trending on the terminal this morning. Situational awareness investing again just days after it narrowly avoided collapse. Founder Leopold Aschenbrenner reportedly invested $400 million in a privately held company it already had an investment in. A representative for situational awareness declined to comment. Meta says one of its AI models accessed the internet and breached systems of a third-party service during cybersecurity testing. The hack follows multiple reports by other companies, escalating concern over their control of AI. FIFA leaders reaffirmed their full support for Gianni Infantino following a meeting between the Secretary General and the board. Several football organizations, including UEFA, publicly denounced Infantino after he announced now dropped plans to privatize FIFA's commercial business. Coming up, $101 billion worth of SpaceX stock to hit the market. More next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Historically, bubbles were characterized by a notion of if you build it, they will come. In the late 90s, when we were building out data networking equipment, people were putting huge amounts of fiber in the ground on the assumption that it would come. And economists like to go back for reasons that are unclear to me to the railroads. They were also, if you build it, they will come. What is unusual about AI right now is the builders are so far behind the demand, it's absurd. We have a backlog of more than $25 billion of demand. That there are none of us, not AMD, not NVIDIA, that can keep up with the demand that your employees are driving. That's, in a lot of ways, the opposite of a bubble. We are chasing. Our customers and their customers are moving at the speed of software, and we're moving at the speed of real estate, data centers. Right, and so we are behind.
Good morning, this is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. A leadership shakeup underway over at Google, the tech giant appointing a new AI research head, while DeepMind co-founder Demis Hassabis steps back. This as the AI race against Anthropic and OpenAI heats up. Bloomberg's Neil Campling joins us now for more. Not just that, but they're also moving the lab basically to Mountain View, California from London. Will this help Google speed things along, Neil?
Yeah, I think because there's a significant battle for talent, you want to have the most important leaders close to the headquarters. So it kind of makes sense for the shifting the talent to California, and also it's also shoring up the talent pool they have, because obviously yesterday there was a lot of announcements about them losing some of the leaders from the labs. So Google's gone from kind of the leadership AI models at the start of the year to actually lagging behind some of the other frontiers. So there's fast catch-up at play here. So hence explains why they're moving management around location-wise.
Yeah, we'll see if they can catch up again. Now, in other news, DeepSeek is planning what it's calling a significant price increase for its AI services, the token costs, if you like. It's obviously very, very cheap at the moment. So is this more of a concern for Moonshot, its China rival, or for the US rivals?
Yeah, I think the concerns will be around the Chinese models, in that they probably tried to get to scale in terms of new clients on board by offering loss-leading services. Like the models were too cheap relative to what they're actually costing them. So they have to raise pricing. In the meantime, the token costs globally have been reducing, which is good for overall usage of tokens, allowing other companies to use them. But it probably shows that despite the fact that the US models are more expensive still, they also have probably the best in terms of the capabilities at this juncture, even though China has been catching up quite significantly in recent months.
Will they be able to bring those prices down, Neil, or is everything just costing them too much right now for them to do that? The US makers, I mean.
Yeah, it's a really difficult question to answer in terms of, because of the memory pricing has been so high. There have been some signs that spot pricing beginning on DRAM side beginning to level off somewhat. That will help potentially for the US companies to a lower pricing, but it is because of the supply-demand dynamics in memory and other parts of the AI chip trade. It is difficult to do that anytime soon. But maybe we'll get some more indicators in terms of pricing from the AI GPU chips, etc., from NVIDIA when they report later this month.
Yeah, and speaking of memory chips, we're seeing a sell-off today in the memory chip makers after SanDisk, obviously Western Digital, the halo effect and so on. Why? I mean, I know you're going to say they've had a lovely run up this year, and it's true, you know, SanDisk up 450%, but in the middle of June, it was up 850%, Neil.
It's a very fair point, Bonnie, and actually, to be honest, I'm surprised by the guidance, in particular from SanDisk, because the midpoint of the sales guide is below some of the street expectations, and they haven't really given clear color on why that is. So whether it's because of supply constraints themselves, perhaps in components, that may be a reason, but it is a surprise given that we know that underlying demand is extremely strong at the moment. So that's definitely, I think, something to concern some investors that have been heavily weighted into memory, storage, and hard drives.
Yeah, but your point is also well taken. If you'd been in at the beginning of the year, you'd still be happy, I imagine. Bloomberg's Neil Campling, thank you so much. Turning to SpaceX, investors bracing for a potential hit when $101 billion worth of stock becomes available today after the first part of the lockup agreement expires. Joining us now is Bloomberg's Lean Al-Rashdan. This is just the first new offering, Lean. How are investors anticipating it will be received by the market?
Hi, Bonnie. Even some of SpaceX's veteran backers are kind of unsure of what to expect. This is somewhat unprecedented. This many shares, the shares variable are going to be doubling today of a company that's already huge. This is kind of massive, unprecedented. So we're not sure how the stock market is going to react. And some of the people most familiar with the company, their oldest investors, are also unsure of how the stock price will be. We know that the stock is under a lot of pressure. We saw with the earnings, the expenditure around AI was massive, and that didn't really appeal to investors. The stock went down 14% yesterday. So really, it's coming, the new shares are landing at a time where the company is already under pressure and investors are unsure of what to do.
That said, I suppose even this portion of the sell-off might make the shares look attractive to some new investors if you did believe some of the price targets that the street has put out there?
Yeah. There's relatively been a lack of transparency compared to other companies in the stock market around SpaceX. So a lot of the predictions and a lot of the estimates that the company gives have been extremely ambitious. But we also have to look at this, and this is not the only time the shares will be available. The company has this complex 9-stage lockup structure that's going to expire in December. So we'll have 1.55 billion in shares today, but then that number is going to more than triple by December. So there's more pressure specifically today, but it's probably going to increase until the end of the year. So investors are kind of holding back, wanting to see more on what happens with the company, more of their analyst calls, get a better sense of structures around these ambitious claims around Starship, data centers in space, and the AI business.
Might there be more index or ETF buying at these prices?
We're honestly not sure. Some of the investors that we've spoken to have said that they're kind of holding back. Some have sold off their shares when the price of the stock was higher. But long term, some investors are quite confident that Starship, which will have its 9th launch, the 14th launch, sorry, this month that it's going to boost some of the anticipation around data centers in space, and they're confident that a lot of the ambitions around the company entering the telecoms sector is going to pay off in the long term.
All right, Lean, we will monitor the market today. That is Lean Al-Rashdan there on SpaceX for us. Coming up, more Fed speak and data on deck in your day ahead. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
News whenever and wherever it happens. I'm Haslinda Amin in Mumbai. This is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now, let's take a look at what's ahead today. First up, more data. Initial jobless claims coming out at 8:30 New York time. We also get Fed speak from St. Louis Fed President Alberto Musalem. That's at 5:30 p.m. And in terms of earnings on deck, well, we have Warner Brothers and Keurig Dr. Pepper reporting before the bell. Lyft, DraftKings and Microchip Technology among those reporting after the market close. Let's take a look at some brutal earnings moves. Western Digital dropping 14% after a pretty tepid revenue outlook. Now, in terms of metrics, it did a little bit better than SanDisk in terms of comparison with street estimates, but both of those stocks and the memory chip makers in general selling off wildly today. AppLovin also down more than 14% after it missed on revenue estimates, and Honeywell Aerospace also 14% lower. It updated its full-year outlook on supply chain issues, sending that stock down. Here's your macro picture for the day. So obviously a little bit of wait-and-see mode before the non-farm payrolls report, so not much happening with yields, slightly lower in terms of bonds. Brent crude below 80 on the Iran-Oman deal, and S&P futures pointed higher. Nasdaq futures, though, they're lower. That's it for Bloomberg Brief.
world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlet Food, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space. Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The reality is this is an arms race.
We've come a long way very quickly.
It's healthy to see the market digest, the market to rotate a little bit.
We're still in an environment where you have earnings growth continuing to rise.
Is this an earnings bubble? The answer is no, it is not.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, tech stocks inching lower. Equity markets snapping a four-day rally, pulling back from all-time highs as investors brace for the beginning of the staggered end to the SpaceX lockup. And underwhelming earnings from SanDisk are sparking a flash crash in SK Hynix, dropping as much as 30%.
Yeah, and this just really goes to the ultimate question of how much has the leverage actually been beaten out of the system? How much has the volatility driven from South Korean stocks actually been taken out of the system? SanDisk missing earnings, Western Digital not exactly overwhelming earnings, and suddenly with 11 trades, the shares of SK Hynix can be down 30%. On an exchange that actually has had somewhat of an issue in terms of being able to back your
Can you make the argument we've had a clearing event when you still see price action like that in the last 24 hours?
The fear is no, and that is why you're seeing a little bit of hiccups. You've also seen a bounce back that has gotten a lot of people really nervous, where people are saying, okay, we've already taken out the undersold or sort of oversold, and now we're overbought in a couple of days, and that's the reason why people are getting a little skeptical.
Let's talk about a bond market that might be making some people nervous as well. 2s, 10s and 30s this morning, yields higher by, let's call it a basis point. The 10-year at around 462, the 2-year at around 420, 517 on 30s getting people's attention, still around 520. The Treasury Secretary, Scott Bessent, with a few things to say about the journalistic community, incapable of performing real economic or monetary policy analysis without being spoon-fed.
Well, that's not actually also their job. This is a journalist who's going to report on what his sources are telling him, and he has every right to do that. A lot of people have a lot of reaction to this tweet, and they're going towards the fact and looking back at what did Nick write recently. And he wrote something recently about the facility that the Treasury used, that's part of the Federal Reserve, to intervene in the yen. And actually the fact that the Treasury Secretary wanted to expand that. An individual who's talked about mission creep at the Fed, well, this kind of sounds like mission creep. You're talking about Nick Timiraos, and that's who he singled out and actually named in his X post. And it really was interesting to me how different the rhetoric has gotten. And we were talking about this yesterday, about how there was this conflating between reaction function and forward guidance. And it's very difficult to have an argument about anything when there is this vitriol being targeted at specific individuals for overall not having done their jobs or being weak or whatever the case is. It is hard to have
a sort of academic discussion about what is the appropriate path of action.
Most people we speak to are very happy to move on from forward guidance. Let's park that there. Any criticism to the Fed chair and his recent performance in its early days, and we should give him a chance, but any criticism so far centers on one thing: his refusal to articulate his reaction function and an apparent unease to draw a distinction between that and forward guidance. Getting the answers to the test and understanding the formulas to answer the questions are two very, very different things. And I want to move on from this debate because I keep hearing the same thing again and again and again. People are just unhappy about the end of forward guidance. No, they're not. I'm thrilled about it. Absolutely thrilled about it. I just want to understand where he stands on his reaction function so that when you see the data, you've got a better idea, just a better idea of what it means for the Federal Reserve. That's very different to forward guidance.
We're getting reaction functions from the other Fed officials, and what we're hearing is that next week's CPI report is going to be crucial in terms of understanding just whether the inflation rate in this country is accelerating or whether it's decelerating enough to keep them on hold. Whether Kevin Warsh is on board with that still remains a question. We don't know exactly where he sees things going, what exactly he wants to lean into to restrain inflation, because increasingly the debate isn't just reaction function, it's also what's the best tool to bring down inflation, because it seems like maybe this is someone who might lean more on the long end than on the short end.
And making matters a little bit worse, the fact that the Treasury Secretary is coming out and going after journalists in defense of Kevin Warsh. The Wall Street Journal front page this morning is what? The President of the United States has been calling Fed Chair Kevin Warsh in bursts, according to sources. They maintain a line of communication. So we're trying to understand how Kevin Warsh is going to react to certain situations. Does the President know how he's going to react in certain situations?
I have absolutely no problem with criticism of the journalistic community whatsoever. No issue. It's the whole of Wall Street that are asking the same questions. It's policymakers in and around the Federal Reserve asking the same questions. It's not the journalists. And as for the Treasury Secretary, he's talked about going through a detox. It's the Treasury itself that seems uncomfortable with the detox right now, who are offering their own forward guidance about what's about to happen with Treasury issuance. It's the Treasury itself right now that seems uncomfortable with spillover risk coming out of Japan. What about the detox that we need to go through here in America for running persistent 6% deficits, even in the good times, that are weighing on Treasuries and pushing up yields? The Treasury itself seems very uncomfortable with the detox process this bond market needs to go through.
Yeah, there's some speculation that they might actually reduce the amount of 30-year yields that 30-year bonds that they end up selling going forward, and increasing the bills that much more, which once again makes the Fed all the more political.
We can build on this throughout this morning. We'll catch up with Bob Elliott of Unlimited Funds as equity snap a 4-day winning streak. Gil Luria of D.A. Davidson as SK Hynix suffers another 30% flash crash, and Nita Richardson of ADP as wage growth complicates the Fed's policy path. We begin this hour with stocks hovering near all-time highs. Bob Elliott of Unlimited Funds writing the rotation isn't a sign of resilience but misplaced optimism. As talks ramp up, folks ramp up, the FOMO caution is warranted. Bob joins us now for more. Bob, good morning. Good to see you.
Good morning.
What are your thoughts on this rotation so far? And do you think we've had that so-called clearing event that's going to allow us to rally on a sustainable basis?
Well, it looked like even a week ago that we might be moving towards to the point where we got a clearing of the mania that existed in the AI and semi sector, and all of a sudden we're back to FOMO and catch-up here. And that's really been the driver of what's been going on in this market, is everyone is so concerned about being behind the curve as prices go higher and higher. It's classic bubble-type activity. Now, calling the top in a bubble, a little challenging. Anyone who's been in this business for long enough knows. But when you see something like that, you've got to recognize that levering in and going full bore on the bubble is often an imprudent move.
You're calling it a bubble. Just define why you're calling it a bubble right now.
Well, I think a classic bubble is extremely high expectations, which, to be clear, on earnings, we have the highest expectations for earnings growth over the course of the next 5 years that we've had in the post-World War II era. An extraordinary outcome is priced into these markets, combined with the fact that people are using significant leverage to buy assets because they're already full up on getting exposure to these names. They have to go and add leverage, and that leverage is everywhere. I wrote a recent piece in my Substack called Leverage Everywhere, right? And it's interesting, this isn't the leverage of the GFC concentrated in highly levered banks. This is like Wells Fargo giving significant amount of securities leverage to their wealth clients. This is levered ETFs. This is options trading. It's kind of everywhere and diffuse, so it's hard to point to the exact place where all the leverage is piling up, but it's kind of everywhere. And that's a good sign that this market is overbought on borrowed money.
So what would make you think that actually is starting to get cleared out? Because some people were saying that after the declines that we had seen in some of the chip names, as well as the hyperscalers, and then, of course, with situational awareness, that gave them the confidence to go back in. What are you watching that says, hold on a second, not so fast?
Well, I think one of the challenges is the rotation means that the overall S&P 500 earnings expectations actually haven't changed that much, right? Overall, at the economy-wide level, hasn't changed that much. We're just sort of shuffling between whether the money goes to the AI names or the hyperscalers or to the real economy, let's say. And the challenge is when the overall expectations are so high at the economy-wide level, this shuffling can get confused, and you might think, oh, things have repriced. But in aggregate, we're still expecting over 20% earnings growth for 5 consecutive years. That is an extraordinary outcome that's priced in.
But the earnings have actually been extraordinary, and it's actually been some of the best earnings we've ever had outside of a recovery period post-crisis. Why do you think that that is unsustainable, especially given where rates are here?
Well, you can have earnings for a quarter, you can have earnings for 2 quarters. A lot of that stuff is asset-oriented earnings, right? A big chunk of the earnings growth that we're seeing is, basically holding equity in other positions and booking that as earnings. And so the question is not, can you get good earnings for 1 or 2 quarters? The question is, can you get it persistently? And if you think about 25% earnings growth, which is roughly what's priced in the 5-year expectation, in order to get 25% earnings growth in an economy that's growing at 6-7% nominal, you either have to have one of the most extraordinary expansions in margins ever seen in recorded history, which will crush workers, or you have to have some sort of productivity boom that has never been seen in the history of humanity. So look, could that happen? Sure, anything could happen, right? But the idea that extraordinary is priced as consensus, that's the problem right now.
When you look at, though, what's going on in the memory makers, the memory supply shortage is going to last and persist into 2027. DigiTimes has had a whole article about this. Doesn't that set up, at least at minimum next year, to be an expansion of the AI trade?
Certainly, you're getting good nominal growth out of that sector because there's supply constraints. But the question is, who's paying for it? I mean, we see, as an example, the relationship between all the AI-related names. So you have, OpenAI is basically financing Microsoft's entire cloud operations. Right? And so the question is, okay, so if that's what's happening, everyone looks at Microsoft and says, oh, things are going great. But then you're like, oh, it's actually OpenAI that's by and large financing that. And then the question is, who's paying OpenAI the type of cash that is being priced into the expectations there that eventually make themselves to Microsoft? And the question is, will the real economy pay for the type of expectations that are being built into the CapEx expectations in the various sort of core providers? And that's the real question, particularly in an environment where we're starting to see challenger models that are just a hair off, the frontier models that are what, 1/100th, 1/1000th, 1/10,000th the price to accomplish the same outcome? Like, why, if you're in corporate America, would you ever pay for a frontier model when you get something slightly less efficient for 1/1000th the cost?
Rob, let's finish on the bond market. We talked lots about the Federal Reserve at the start of the program. Are we on the brink of this bond market becoming a problem?
Well, I think that's one of the questions is, how does this leverage bubble pop? And typically when you look through time, it's all about the bond market. And so I think one of the things when we see Secretary Bessent come out and try and sort of distract from the core issue here, the core issue is there's too much bond supply, yields are rising, and while he's often sort of moves around in terms of what he focuses on in terms of the markets, you know what he should be focused on? The gold market. Because if there's one thing the gold market is saying, it's saying cut out the nonsense, deliver the issuance that's necessary, reprice the bond market. And instead, he seems very cautious, along with his friend in the Eccles building, to actually deliver the type of policy that's necessary to make the adjustments that this economy needs.
I thought it was an inspired choice to run Treasury at the time. Still think that in many ways. He understands the situation we're all talking about this morning in places like Japan, in the Treasury market. Do you sense he seems rattled in the last week in a way that he hasn't been previously?
Well, I think he's a man of markets, right? And he can see what's going on across the markets. And when he sees that simply from a Fed hold, you see the long end move a point or two and then keep going, that's a real concern. He understands that. I mean, his work, it's odd that he's getting worked up about using the Fed to finance the Japanese intervention, because obviously he's going to do whatever it takes in order to not have pressure on the long end of the bond market as the Japanese intervene. And so I think what's rattling him is the markets, and the markets are sending a signal. If the Fed doesn't deliver the tightening that's necessary, if the Treasury doesn't deliver the duration that's required, then what's going to happen is the bond market is going to correct this market environment, and that would be quite an unfortunate event for him if that comes right into the midterms.
Bob, it's good to see you. Appreciate it. Bob Elliott there of Unlimited Funds. Bramo 30s this morning, still around 520.
That's not a number that makes him happy. I'm talking about Treasury Secretary Scott Bessent, and probably he really isn't happy about a lot of the reporting and skepticism that maybe this is getting away from the Fed's control.
And you guys talked about at the top of the program where the issuance is coming from this Treasury Secretary. This was an individual that used to go after Treasury Secretary Janet Yellen when she was issuing on the front end. Well, they're going to end up doing the exact same thing.
Persistent 6% budget deficits wouldn't be a problem if the biggest companies on the planet weren't in a competition to raise capital. Persistent 6% budget deficits wouldn't be a problem if we didn't face substantial spillover risks from places like Japan. But that's the backdrop right now, and we now have a Fed chair that's looking to make a big transition. It's not for me to say whether that big transition is right or wrong, but it comes with consequences, and we're experiencing the risk and the consequences in real time in the past week.
You know, one of the discourses that has been taking place over the past couple of days has been how quickly can the Fed lose credibility and what's the cost for them to gain it back? And I wonder how much what we're hearing from other Fed officials over the past couple of days indicates they might be willing to go further, potentially, to get that credibility back in order to peg some of those yield moves that we've seen.
5:18 on 30s this morning with an update on news worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Iran says it's reached an agreement with Oman on a proposed shipping route through the Strait of Hormuz. Both countries have been in talks for several days. An Iranian Foreign Ministry spokesman did not mention any role for the US in the discussions. Chip giant SK Hynix rocked by another flash crash. Shares falling by the daily limit of 30% in the pre-market on Nextrade, the one-year-old pre- and post-market bourse. The incident raising fresh questions about trading volatility in South Korea's equity market. Investors racing for another potential hit to SpaceX shares. Later this morning, more than $100 billion worth of stock is set to become available for trading. The lifting of the first tranche of restrictions on insider share sales comes after SpaceX's first quarterly earnings report triggered a slide. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Up next on the program, the final stages of a deal.
I'd rather make a deal because I don't want to kill people. We were all set for the biggest attack since World War II. And they called me and they said, please don't do it, let's talk. And then they said, we never said that, but we are talking, let's see what happens.
Up next, the former Deputy National Security Advisor, Victoria Coates, live from New York City this morning. Good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment. 3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
The record-breaking rally stalling just a touch in yesterday's session. This morning bouncing back by 0.2% on the S&P following what was the best 4-day rally we've seen since April 2025. In the bond market, 2s, 10s and 30s shaping up as follows. More data later on this morning. Jobless claims at 8:30 Eastern Time. 2s around 4.20, 10s around 4.62. And the one board Bremo wants nothing to do with crude. WTI Brent this morning. Correct. Just holding around 80. Lisa, 79.89. On Brent.
I mean, honestly, how do you get to interpret this? How do you say this has to do with talks or not talks or questions about a deal that's been agreed between Oman and Iran? By the way, unclear whether that path has been sanctioned by the U.S. and exactly whether this is going to be long held. Either way, it's more of the morass. Either way, you have not seen oil prices go materially higher, and I think that that is a story that people are looking for.
You're going to love the next 5 minutes. Under surveillance this morning, the final stages of a deal.
I'd rather make a deal because I don't want to kill people. We were all set for the biggest attack since World War II, and they called me and they said, please don't do it, let's talk. And then they said, we never said that, but we are talking, let's see what happens. As soon as this situation ends with Iran, oil is going to go down to the floor, gasoline's going to go down.
So here's the latest this morning. Iran claiming it's close to a final agreement with Oman for commercial shipping through the Strait of Hormuz, with the caveat that the U.S. and Marine must first fulfill its prior commitments.
Yep, and they don't want really Washington involved in terms of this new navigation route. Now, these talks between Iran and Oman have been going on for days, and as we enter, really, we're in the 6th month of this war, this has been really the focal point of the entire reason why you can't get back to the negotiating table, and it's the control of the Strait of Hormuz. Now, we're still waiting on a lot of details, though. What ships can pass through? Do you have to pay some sort of toll? Does this toll get distributed amongst Omanis and the Iranians? We still don't know a lot of this information. At the same time, Jonathan, the president is talking about why he decided to not go after Iran. Washington Post this morning, front page, Trump's frustration over the Iran war boiled over at Camp David last week, where he demanded answers from Pete Hegseth and why he had apparently been misled on extreme munition shortages. The United States would need the Strait of Hormuz to open very quickly if they are dealing with extreme munition shortages.
What exactly is influencing the approach here? The former Deputy National Security Advisor, Victoria Coates, writing the notion that the Iranian regime is playing three-dimensional chess is a complete fiction. Get the strait open, keep the pressure on, and let nature take its course. Victoria joins us now for more. Victoria, welcome. We've had several deals, agreements to reopen the strait, and they haven't been sustainable. Are the conditions in place this time to make sure this actually happens?
Well, good morning, Jonathan. Yes, I think they are. We've also had some very interesting reporting from the Wall Street Journal and Javad Zarif, the former foreign minister of Iran's piece in Foreign Affairs last week, saying that Iran is actually concerned that they have overplayed their hand in terms of their control of the strait. And so the deal that Anne-Marie was talking about, this one may be a little bit different because we have the entire GCC lining up behind it. So all of the countries in the region, the major energy producing regions are supporting this deal. They think it's a good deal. They think it's the right one for them. And so if we can get to this deal for 60 or 90 days, I think 90 days would be ideal, then we can get down to the brass tacks of negotiating over the nuclear file.
Can this deal go through, though, if Iran demands a toll?
Well, that's going to be a big question. I mean, what I've seen is that there's not going to be a toll, that they would get sanctions relief, but they would not get a toll for the individual ships. And I do think the GCC would be extremely cautious about a toll because that would set a precedent that they wouldn't want. Then they would have a very hard time coming back to Iran in 60 or 90 days and saying, we don't want to pay this toll anymore. Much better for them, don't start paying a toll, and then that's sort of off the table, if you will.
Isn't that one and the same, though? The United States is basically giving in if they're going to be lifting sanctions on a regime that is going after U.S. service members in the region?
Well, I mean, if there's one thing about lifting the blockade and allowing the sale of oil, but keeping the rest of the sanctions on the economy. And that's something else that, in this case, Reuters is reporting that some of the internal mechanisms that Iran has been using to try to sustain itself during these very painful times are starting to break down. This is the National Iranian Oil Company, NIOC, the National Development Fund, the NDF. These things are what they've used internally to try to keep their economy going. And now you have, accounts of the NIOC being frozen. You have the NDF saying, we just can't pay back the $17 billion that we've laid out. That's supposed to be their sovereign wealth fund, the NDF. But they've been using it as a slush fund. And now it's starting to, come due. The $17 billion is laid out over the last year or so. They can't pay it back. They can't get that money back. So I would say keep the rest of the pressure on the Iranian economy, even if we have to give a little bit on the oil exports.
Victoria, the story that Emery was mentioning before in the Washington Post, and there have been other reports similarly talking about the depletion of ammunition in the United States and how that is increasingly a factor as to how much President Trump really pushes against Iran and how much he decides to go on military action. What do you make of that in terms of the depletion of ammunition and how important it is to replete it and how big of an influence that is?
This is a really, really serious issue, Stephanie. This is, what's been happening on terms of deferred maintenance for our military for just far too long. And so this is why the current NDAA process that's going on, the National Defense Authorization Act, which has gone over to the Senate, the president's request this year was $1.5 trillion. It's a huge sum. It's historic. We've never had that large of a budget for the Department of War. But it's necessary right now because we are depleted from the war in Ukraine. We are depleted through this action. We need to restock all of those long-range defensive munitions that have the THAAD and the Patriot interceptors that have the stocks are low. That is a fact. And so that it can be a constraint to some extent. My understanding is we have enough to do the kind of attack the president wanted to do, but we have to be mindful about our long-term prospects. And that's why we need the Senate to act. We need to get going with this large Department of War package and replenish those stocks.
Victoria, always good to catch up with you. Thank you, Victoria Coates, there on a very serious issue. And I have to say, these leaks are increasingly becoming a bigger and bigger problem for this administration. That is not what they need when they're in negotiations with the Iranians.
President Trump threatening jail time for people who are leaking. At the same time, the stories are getting that much more detailed and that much more specific about the weapons and who's saying what.
Coming up next, we'll catch up with Gil Luria of D.A. Davidson as SK Hynix is hit with a second 30% flash crash in about a week. Live from New York City. You're watching Bloomberg TV.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC. Africa CDC is the leader in terms of public health in Africa.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Equities this morning firmer by 0.2 on the S&P. Bit of a weight to the tape on the Nasdaq and tech. We're down by a third, but what a run we've seen over the last week or so. Going into yesterday, that 4-day run, something like 5.75% higher on the S&P 500. So you look at that this morning, just a bit of perspective, some context, no drama in the equity market this morning. In the bond market, 2s, 10s and 30s look like this. Focus on 30s. 30s closed last week after the Fed meeting last Wednesday at 520. We're holding on to those levels. We're at 517 this morning. The data is going to take on increased importance through the week when we get to payrolls. Looking at the data so far, take a look at the soft data, the survey data, the ISMs on manufacturing, 4-year high. And you looked at the employment component and that flipped positive. The ISM services read in expansion still, but that employment component flipping negative. And maybe that introduces just a little bit of downside risk into the payrolls report on Friday.
Yeah, especially when paired with ADP. That might be where the downside surprise actually is coming from, is those service jobs that were taken off. Really notable how much this contrasted with the ISM manufacturing. The other notable thing is if someone was worried about stagflation or stagflation light, this report would really worry them because you saw an expansion of prices paid at the same time that you saw a contraction of the employment index. You start to wonder, how do you deal with these? I'm not saying that the conflict is between the dual mandate, but you know, it's kind of the conflict being.
Nita Richardson of ADP is going to join us shortly, and she's going to tell you why you can get paid so much more if you switch your job. You looking forward to that conversation?
I actually saw that. It's been like the fastest pace of job growth in a long time. I feel like everyone, you know, Mike McKee yesterday, this.
Right.
You know, maybe explore something new.
Neela coming up a little bit later. Looking forward to that. Counting you down to the open about 3 hours away with some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing Sandex shares falling more than 9% in the pre-market after the company gave a first quarter revenue guidance that missed analyst expectations. But otherwise, the quarter was strong for the flash memory company. Management said about 2/3 of last quarter's revenue growth came from higher pricing, not just higher volume, suggesting supply remains tight and these companies still enjoy excellent pricing power. But after the stock had rallied some 470% year to date, the market was looking for even more from the S&P's best performer this year. Western Digital has also enjoyed a huge run, up some 200% this year, so it's also falling victim to high expectations. Shares are falling nearly 15% in the pre-market, even after it beat on the top and bottom lines. But its first quarter revenue forecast missed the average analyst estimate at the midpoint, suggesting the market continues to punish these companies, these high flyers, if they don't have perfect results. And we end on software with Figma shares. They are also falling some 15%, even after it delivered a beat and a raise. And the problem here is it's growing AI-related expenses, with that spending materially pressuring free cash flow and its margins. And look, More broadly, as we've talked about, the software sector has recovered nicely from its spring lows, but this reaction shows that investors still appear to be a bit jittery on the sector, and they are quick to punish bigger CapEx plans if they don't come with nice returns. John?
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, hedge fund, situational awareness, making another big bet just days after it was on the brink of collapse. According to people familiar with the matter, the founder making a $400 million investment in a privately held company on Tuesday. Elsewhere, about $100 billion worth of SpaceX shares set to hit the market. An agreement restricting insider share sales coming to an end. Over 900 million shares will become available for trading when markets open later this morning. And finally, SK Hynix rocked by another flash crash. Its second in about a week, shares hitting a 30% pre-market limit down, followed by a 10% slide during Thursday's session as major volatility raises once again fresh alarms.
Yeah, so here's the issue. At what point is this a structural market structure type of issue, and at what point is this an SK Hynix and a memory chip issue? The answer is unclear. It was a number of shares that were traded on NextTrade, which is the first licensed ATS, or alternative trading system, in South Korea. It started in 2025, so it is just about a year old or less than that. And it's sort of coming under fire for exactly the pricing system that it's using to evaluate exactly where SK Hynix should be priced. Now, here's the issue. SK Hynix is one name in South Korea. Why do we care here in the United States? This is actually injecting a lot of volatility internationally on the chip names, on just the levered tech bets all around the world. So you start looking at that and you start saying, hold on a second. This ATS that got licensed in 2025 might be driving a whole bunch of volatility in tandem with leverage and a lot of speculation.
And when it comes to volatility, and maybe this prompted what's going to be going on with NextTrade, come September 14th, they're actually going to put a mechanism in place so some of this actually could be dealt with when it comes to all this volatility. Bids at least 10% above or below the previous closing price, this mechanism will automatically be triggered.
Mandeep Singh of Bloomberg Intelligence can build on this story. He joins us now for more. Mandeep, do we have a fundamental problem here that we need to clear, or a market structure problem?
I think it's more the latter, market structure. I mean, fundamentally, we heard from the hyperscalers this earnings season that they are seeing an acceleration in their cloud growth, and all of the AI infrastructure names actually have very solid fundamentals coming out of 2Qs. So from that perspective, I think we're talking about probably an increase in CapEx relative to where consensus expectations are. And, the supply chain seems to be still constrained when it comes to supplying these components. So whether it's memory or storage or anything else at the chip level, it's still constrained. And fundamentally, I don't think anything has changed. And on top of that, you have seen the model companies like OpenAI and Anthropic really ramp up their ARR. They've come a long way this year, and the momentum has continued. So I would say the fundamentals remain solid here.
Mandeep Singh of Bloomberg Intelligence. Brahma, I think to some extent you nailed it. In fact, I think you did. Importing volatility from South Korea is something new for the US equity market and something we've experienced most of this year now.
And it speaks to the lack of understanding of how to value some of these companies. I mean, ultimately, the memory chip sector seems like it has the biggest moat of all, which is people can't produce enough memory, and it seems like those supply shortages are going to be in perpetuity. At the same time, when margins get that fat, people start creating competition. It's one beauty of capitalism.
85% is an invitation.
It's saying to you, you too could have this money.
Without a doubt. Gil Luria of D.A. Davidson writing, investors are worried about open source models, circular financing, and increased competition. We're cautious on semis trading at valuations that imply the cycle will continue. Gil joins us now for more. Gil, are you implying the cycle won't continue?
I wish I knew. That would be really great, but I don't. Our sense is that the demand for AI is going to continue to grow, and therefore the investment cycle will continue. And what we heard over the last couple of weeks is the hyperscalers have at least one more year of higher CapEx in them. So we know that much. Whether it continues after that really depends on the continued progress on AI and its adoption, which is something that we all would like to know, but it's very hard to predict. So all we can do is focus on what are the situations where stocks are trading like the cycle is over? What are the situations where we're trading like the cycle has to continue to 2030 and beyond to justify the valuations? And you're talking about one sector where the market's already trading like the cycle is over, which is memory. So in spite of the fact that we're not getting any new supply for at least another year, probably more, and that supply probably won't be nearly enough to meet demand, these memory stocks are trading now at mid-single digit PE ratios, right? And the market is having this really tough challenge of saying, wait a second, SanDisk, which is trading a mid-single digit PE, isn't going to grow more than 300%. It's going to grow only 300%, meaning it's only going to quadruple next quarter, and not knowing what to do with that. That's, to us, where the opportunity is, and then we just focus on the high end. We don't need to focus on SanDisk and Western Digital. We can focus on Micron. On the other hand, there's these group of stocks that is trading like the cycle will continue forever. Your Intel, your Cerebras, some of these optical stocks, semi-cap stocks, to justify the types of multiples those companies are trading at, you'd have to believe that the cycle still has a long way to go. So we'd rather just stay at the near end. We feel like there's another year of CapEx. That's good for NVIDIA. That's good for Micron. It's good for AMD. Extrapolating beyond that is where I think it gets really tough. You really have to make assumptions that are very hard to make right now.
It's one thing to analyze these companies fundamentally in the runway, which is difficult enough in its own right. But Gil, we were just talking about market structure issues and leverage being built up in different places, the idea of new trading systems that are getting deployed during a unique cycle. How much more are you focusing on those things in addition to just the fundamental questions that are complicated enough in their own right?
Yeah, I think your conversation you just had earlier was spot on. I never imagined that I'd have to know so much about how many Koreans had their brokerage accounts shut down because of margin. And now this is what drives our market. And it just happens. It's a little bit of a coincidence of history that two of the biggest memory companies happen to be in Korea, which is a nice, big, growing, healthy market with a lot of other things to offer. But those two stocks are way too big for the Korean market, way too big for the liquidity, and as it turns out, way too big for the market structure that they have. And yet, to your point, they are very much linked to our market. SK Hynix is linked to our market through an ADR, which makes it even worse, but also because it's such a close comparable to Micron and the rest of the memory complex. And by definition, when one of those moves, the others are going to move. So yes, it's become a factor. I would expect that the ADR is going to actually help. You can see that the move in the ADR in the pre-market is less than the move in Korea. Those have not moved exactly as you would think in line. Our market is behaving a little bit like a cushion, like a dampener. And so I think this is going to work itself out. It's just highly unusual that we have $2 trillion companies in a market that's just not well suited from a market structure perspective to absorb that.
There's a bigger issue here, though, too, Gil, and it's something that we keep talking about following situational awareness and the blow-up of that fund. Is that sort of the entirety of the problem, or a big fish that really was causing a lot of volatility, or is it a symptom of all the leverage that's been built up that could potentially roil stocks that have a great fundamental story, but perhaps have been inflated at a time of ebullience?
I think it's all of that, but it's not. Again, I'm arguing that these valuations aren't inflated. When a company that still has growth is trading at 6 times earnings, it's hard to say that the valuation's inflated. The moves have been extreme. Stocks that are up 10 and more times in a very short time frame have created a lot of gains. A lot of investors that are day-to-day traders and want to get out of positions quickly. And this is all getting amplified, again, by Korea, by the volatility here, by the extreme moves, by very, very high expectations. And it's creating this very, very unusual volatility. Again, companies growing 300%, trading at 6 times earnings isn't something the market is used to. So it's very hard, and that have already gained 1,000 or 10,000% in a short period of time. Those are not things the market is used to handling. Discussion between 22 times and 24 times earnings. It's not used to dealing with this type of volatility, this type of fundamental changes. And so we just have these extreme moves in fundamentals, extreme moves in stocks, and that's creating volatility. That doesn't mean that these valuations are inflated. Again, I'm arguing there are parts of the market, parts of semis that valuations are inflated. It's actually not memory. The volatility is just because of those extreme moves.
Gil, it's good to see you. It always is. Thank you, sir. Gil Luria there of D.A. Davidson on the chip sector right now. Obviously, in South Korea, there was a massive build-up in leverage. And clearly, situational awareness used a lot of leverage, and the market moved, flipped, and they were on the wrong side of everything after being on the right side for quite a while this year. The question I've got, and Peter Cheer hopefully is going to help us answer it a little bit later on this morning, is how much of the weakness in chips through July was actually just down to the blow-up of that one fund? Because that's what people are using potentially as a convenient excuse to start buying those chip names again. I think that's the conversation we've got to have a little bit more.
It's a conversation the market's having right now because in 4 days, the semiconductor index in the United States, the Philadelphia Semi Index, gained the most for those 4 days going back to 2020 in March. So it gives you a sense of just how extreme these moves have been. How do you go from oversold to overbought in 4 days? Well, this is what it looks like. And what does that speak to? People's fear of missing out and fear of being a little bit too late in getting out.
Peter Cheer coming up in about an hour's time. Up next on the program, we'll have more on the situation in the job market, more data coming up a little bit later. For now, let's get to your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. The Wall Street Journal reporting President Trump has repeatedly called Kevin Warsh since Warsh took on the role of Fed chair. The president reportedly seeking counsel on a range of matters, including the war in Iran and the rapid rise of AI and how it's impacting the economy. Google is concentrating its AI leadership. Top AI executives have been appointed to work at Alphabet's Mountain View, California headquarters to gain momentum in the accelerating race against Anthropic and OpenAI. Google aiming to reverse trends that have complicated decision-making and frustrated talent. Chinese AI leader DeepSeek is planning significant price hikes across its services. The startup not specifying the exact amount of the increases, but referring to them as substantial and urging users to plan accordingly. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the program, mixed data facing the Fed.
If the unemployment rate starts moving up again, then it will no longer just be a question of what's the right rate to set for inflation. Then you'll be concerned about the labor market. We think we're in store for some weaker reports upcoming.
Nina Richardson of ADP joins us next, live from New York City. You're watching Bloomberg Surveillance.
We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake. While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Stocks this morning, positive on the S&P, up a tenth, down on the Nasdaq, down 0.4%. A bit of weakness in tech in the last 24 hours, tons of strength in the previous 4 days. In the bond market, 2s, 10s and 30s look like this, going into more data later this morning. Jobless claims at 8:30, 2s at 4:20, 10s around 462. Under surveillance this morning, mixed data facing the Fed.
It's a decent reading on the payrolls number. If the unemployment rate starts moving up again, then it will no longer just be a question of what's the right rate to set for inflation, then you'll be concerned about the labor market. We think we're in store for some weaker reports upcoming.
So here's the latest this morning. Investors awaiting July payrolls data as mixed employment data complicates the Fed's policy path. The latest ADP employment report coming in below expectations, but suggesting those looking for new jobs are getting rewarded. Nita Richardson of ADP writing job changes are highly sensitive to real-time economic conditions and their rapid pay growth implies supply constraints in parts of the labour market. Nita joins us now for more. Nita, good morning.
Good morning.
There's 2 data points that I love in the labour market. One is quits and the other is the pay that you get for switching your job, because I want to see confidence in the labour market. Are you seeing some confidence pick up slowly?
Well, a little bit. I mean, that 7% number is remarkable. We haven't seen that level of pay growth for job changers since August of 2025. So when we saw that number, it jumped out to us. It was the biggest number in that report, in our view. I know a lot of people looked at the 44,000 and said, oh, that's a miss. It's not a miss for us because we've been tracking it every week. So if people were paying attention, that's where you would have landed. But what was remarkable was the fact that this labor market is tighter than job gains suggest. And so when you're looking at the number, either with ADP or on Friday, it's the why that's important. Is this a low or high number because demand is high or low, or supply is high or low? Supply is a big factor, which is why that job change pay growth is
Can you
elevated.
flesh that out a little bit more? How much the supply backdrop has shifted in the past 12 months or so?
Probably the best way to do that is through an actual example in construction. So we're seeing the hiring rate for new construction workers high. It's the highest job changer pay growth we track. It's almost 14%. That's the highest we've seen on record. And yet the number of jobs that were created in July was 1,000. That's a big deceleration from the second quarter. There's just not enough people to hire. People are retiring out of that field. It's a field that is aging rapidly. And so what the hiring rate suggests is replacement hiring rather than new jobs. So the signals are muddled. They're not telling you what they typically tell you because a lot is going on in this labor market.
In the past, when we saw the headline number, you pull the hood back and what you get is a lot of education and healthcare jobs. And that isn't exactly a robust signal about the overall economy since it's a more static pool independent of the economic cycle. Has that started to shift at all?
Yes, we saw a deceleration, and it's mostly driven by healthcare. It's mostly driven by these aging demographics that are overlaying the entire labor market. And we actually saw this pattern last year, too. We saw a shift down in July and then acceleration in the fall. This is something that's also very interesting about the labor market. Because there's so many macroeconomic shocks and trends that are hard to call, firms are changing their hiring patterns. when they hire is not typical anymore. They're hiring strategically. It's like firms are playing dodgeball with all the macro news, and they're going to shift and shift. And so a strong hiring month in 1 month, like in spring, may be followed by a weaker hiring month, just to balance it out.
What I thought was fascinating in your data is that you show that healthcare has decelerated, but that white-collar jobs have actually re-accelerated. It's sort of this question of AI not exactly having the same kind of ramification on the business community as people previously thought.
Right, so we track this really closely. We track it with our partners at Stanford in this, what we call the Canaries dashboard. But when you look at the overall labor market, finance, information, professional business services actually increased jobs relative to the second quarter. So yes, AI is having an impact, but it's not this grand sweep of impact that is part of the popular narrative. Those jobs actually accelerated, and the pay is following as well.
Were employers caught off guard then? Because a lot of them, do you feel like they were holding back because they thought AI was going to be able to replace these workers, and they're realizing they're not, and now they're actually have to go to the market and pay even more to get that talent?
Yeah, I think employers have been caught off guard by AI, by interest rates, by geopolitics, by consumer sentiment, a more cautious consumer. There's so many things that they're navigating right now, and that's why they're changing their hiring patterns a little differently. So when we look at a number like 44,000 in July, we don't rest there, because there's so much going on under the surface of that number.
How much also is it that employers have to pay up because they have to not just attract new talent, but also keep in line and some with inflation?
The competitive environment for, especially in places where there are supply gaps, is really extreme, because you're not just talking about a local market. You're talking about a national, sometimes global market for talent. This hybrid work thing is a real factor now. It's a live factor. And so not only do you have a wider talent pool as an employer, so does the person you're trying to recruit. And we know from the research that we're doing, the way workers outpace inflation is to change jobs, because you get that pay bump. And so if inflation is higher than normal and the competitive landscape in some sectors is tighter than normal, you are going to see that kind of acceleration in pay.
Nina, this was fun. We appreciate it. Thank you very much. Nina Richardson there of ADP on the tightness in this labour market. I think this is important. The tightness of this labour market below the surface, beneath the surface of the headline jobs growth we talk so much about.
You know, when we got JOLTS data, you could say it came in a little bit in a disappointing way, but the quits rate actually came in above expectations. Similar with the ADP report, the actual headline number came in below people's expectation. But you see these metrics showing that people actually have increasing leverage as employees over their employers, which signals some kind of shift from just this low-hire, low-fire type of dynamic.
It's a shift worth watching. 14%, not bad, is it?
Yeah, I mean, I think I need to start bulking up.
Oh, you want to start?
Yeah.
You want to start getting into construction?
I think. I mean, I managed to fix a toilet, so I'm going to keep trying.
You can be a plumber on the side.
I know.
With YouTube, you can do anything.
It's true. Well,
Ramo is so skilled.
Yeah, I'm just skilled labor.
So skilled. Coming up next, Jonathan Golub of Seaport Research, plus Brian Hamilton of LiveSwitch on SpaceX, and Al Hosseini of Columbia Threadneedle on this bond market. Your equity market this morning on the S&P, firmer by about 0.1% on the S&P 500. Yields up a single basis point. Your 10-year, 462. Your 30-year, 518.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally be a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see, the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent, but when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The overall sentiment is not great.
Yields are going to fluctuate for a while.
The 30-year is going to be driven in large part upon where the deficit goes.
The front end is clearly saying they want to hike.
We've had to pricing going from a dovish Fed now to a hawkish Fed to now to an uncertain Fed that might be losing control of the long end of the yield curve.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now with your equity market and your scores shaping up as follows. We look like this morning, up a tenth on the S&P, looking to bounce back from some very mild losses in yesterday's session. A bit of weakness on the Nasdaq, down by 0.6. Some underwhelming earnings from SanDisk overnight, taking that stock lower in the pre-market by 11% and sparking to some extent, to some degree, this move on SK Hynix, a 30% flash crash in the pre-market in South Korea, recovering and then down on the session and down hard. We've seen this movie a few times already.
Yeah, and it kind of flies in the face of people who are saying that maybe the leverage is out of the system. Now we have a nice calm market that can give predictable returns. Well, South Korea has indicated maybe that's not the case, and it has been the case that there has been an incredible amount of volatility in that market for quite a while. There's a bigger question here, which is how much has the volatility been driven by fundamentals and whipsawing views of exactly what the runway is for some of these earnings, and how much has it been driven by fundamental market structure issues, whether it is what's going on with South Korea with leverage, whether it's some of the way that these new exchanges operate, or whether it's just the whipsawing of positioning as people try to get ahead of the next new thing.
There's some of the jitters in tech right now. Let's talk about some of the jitters in the bond market. 2s, 10s and 30s shaping up as follows. Yields higher by a single basis point across the curve. 30 still around 520. Heading into this data later on this morning, 8:30 Eastern time, we'll get some jobless claims. And the backdrop for that data, for this bond market, is a Treasury Secretary that's sounding increasingly nervous about what's developing in fixed income.
Yeah, and so nervous that he's going after journalists that track the Federal Reserve. This was the Wall Street Journal's Nick Timmerose, said he's reduced to reporting Fed backroom gossip because they're incapable of performing real economic or monetary policy analysis without being spoon-fed. And you made the great point earlier, Jonathan. No one is obsessed with the fact that we don't have forward guidance anymore, or we don't have Fed whispers anymore. People just want the Fed chair to come up and explain his reactionary function. And this is always happening at the same time. The Wall Street Journal front page says that he's taking calls from the President of the United States. Does the President of the United States understand what his reaction functions are? Well, the rest of the world should as well.
If Kevin Warsh is going to take a new academic look at what exactly causes inflation, of exactly what the neutral rate is, of exactly what the most appropriate interest rate tool is to really control inflation, why is this getting so emotional? Why is this getting so personal? Why does this become a name-calling exercise, not only by certain people in the administration, but also by places like the Wall Street Journal editorial page? It just goes to the question, how do you have an honest conversation about reaction function versus forward guidance versus exactly what the measurement tools are when you're starting to say that so-and-so is just a stenographer, or grow up, you crybabies on Wall Street?
This is the chairman of the Federal Reserve, and they're treating him like a child. It's not baby Kev, it's Fed Chair Kevin Warsh, not baby Kev. Why have we got a load of people coming out defending him after a few months on the job? I don't get it. This is so juvenile right now. The complaints about the Fed chair are pretty valid. They're big questions that need to be answered. I don't think they've been emphatic. I don't think anyone's come out and said, I'm so upset that the forward guidance is ending. I need to know what they're going to do at the September meeting.
I haven't heard one person say that.
What am I going to do?
Yeah.
I don't know what to buy. I'm just going to pack up and call it a year. No one's saying that in financial markets. Why is everyone getting so fired up about this? They're just saying, okay, new guy at the Fed. I want to know what he thinks about the economy, what he believes are and aren't sources of inflation right now. That seems like pretty important stuff we should discuss. And if you are committed to inflation, getting back to target, what tool are you going to use to get it back to target? Is it the interest rate or the balance sheet? And if you're posing these open-ended questions and you don't really know whether it's the interest rate or the balance sheet or whether you're going to outsource it to financial markets, then hello, we're going to have a problem further out the curve. And guess what? We already do, for a bunch of reasons. And if you're the Treasury Secretary right now, is that the kind of move you want in the bond market at the moment? Because based on how you've responded to the situation in Japan, you seem very concerned about what's happening in Japan at the moment, and I don't think it's because you love the Japanese. I think it's because you're worried about what might happen in fixed income.
The scariest move right now on the bond dashboard, potentially for the Treasury Secretary, is the term premium on 30-year bonds, which has reached the highest level going back to 2008. This indicates this concern about what exactly is the reaction function and exactly how much confidence do people have in this administration to get inflation and, frankly, credibility back.
I'm distraught. It's the end of forward guidance. It's
keep wearing black.
Deeply emotional about it.
I think that it's
just so upset.
I feel lonely
about the end. Like you ask serious questions about the economy and then get accused of being upset about the end of forward guidance. Like, I mean, that just seems ridiculous.
I know, but that's the point.
Sounds like
right?
gaslighting.
Totally, that's exactly what it is.
And that's the reason why I think we have to keep focusing on what the actual issues are and trying to steer clear of name-calling.
It's deeply emotional, Bramo. It's upsetting.
I think that bonds are.
Look, I didn't like the Powell groupiness either, by the way. Like, the groupie stuff on Wall Street with Chairman Powell was never a fan of, at all. In fact, I despised it. And I think a lot of people love the former Fed chair because they all made so much money. I think the Fed chair made some mistakes, some big mistakes at the best of times. Let's be consistent about it, though. This guy's not performing great in these last few press conferences. He seems a little bit rattled himself. I have to say he seems a little bit out of place for a lot of people who described him as central casting. I don't think he's sort of dominated and held that lectern in a way that gives me any confidence if I was in this market at the moment.
I want someone who's self-reflective, who's able to say what they think and then to amend it, to potentially be self-questioning. And if you're not getting anything at all, it's unclear that that actually is the reaction function on a personal level.
Lisa, he's been in a 10-year audition for this job, and he looks like a man who hasn't worked for 10 years. I hope that by the time we get to Jackson Hole in the September meeting, he's in command of the conversation once again. But he's not in command right now, because if he was, you wouldn't need the Treasury Secretary coming out and behaving as your daddy on X, pointing to different journalists and telling them what they're doing wrong. I think Kevin Warsh has been around. He doesn't need that from the Treasury Secretary. To be honest with you, it's pretty embarrassing.
In the meantime, the oxygen's being filled by the other Fed officials, and they're coming out and saying probably a hike is more likely in the offing.
We'll move on. Coming up, Jonathan Golub of Seaport with the latest tech-led rally taking a breather. Brian Howardson of LiveSwitch with billions worth of SpaceX stocks set to unlock. And Ed Houseni of Columbia Threadneedle as the Fed's family fight deepens. We begin this hour with stocks looking to regain footing as chip concerns are weighing on momentum. Jonathan Golub of Seaport Research Partners has an 8,200 year-end price target while favouring the tech and financial sectors, writing, "This is the best earnings season with massive beats and growth rates. The trends are all likely to persist." Jonathan joins us now for more. John, good morning.
Good morning.
Does the Fed even matter? The earnings are so great.
I mean, you're talking about how people are communicating. First of all, he's going to get his footing, and we're not going to be talking about these issues. The real question on this, but the real question is there inflationary pressure in the system? Yes. Are we running such huge deficits that the likely course of the 10-year or rates in general are going to be higher? Yes. Is that a problem for Besson and the Treasury? Yes. Is he intervening in Japan because, like you said, because of Japan, or because they are the biggest owner of treasuries, and if they have a hiccup, it's going to move the long end of the U.S. curve? Yes, and that's a debate, whether or not he's central casting or not central casting or forward guidance. It's all about the economics, and everything else is noise.
I could not agree more. Is that issue in the bond market that's developing, and it doesn't have to develop into a crisis. I sure hope it doesn't. Is it a problem for stocks, even with earnings this great?
It is, because what's happened with this AI trade, I hate to call it a trade, with this build out of data centers and the like, is that we've extended the duration of equities. We don't know, you have high cash flow companies that all of a sudden are investing for a new future in the way that technology is going to affect our lives. And that means that the payback on these companies is going to be further out in the future, which means they are more sensitive to the 10-year Treasury than they would have otherwise been. That's number one. Number two, if you are in an environment where we are, as a society, raising trillions of dollars to fund this build out, if the Fed needs, because they're running such huge deficits at government level, also trillions of dollars, they're competing with each other. And that kind of competition for capital means that you're probably going to see higher interest rates.
So there are two sides of this. On one side, it's a valuation question. What is the appropriate price to equity ratio, given just how much higher yields are currently? And then also, at what point do higher borrowing costs constrain some of these ambitions? On the first side, do you think that price to equity ratios have to be substantially lower in this new era than they have been in the past, when people are taking a look at previous models?
They are lower. I mean, if you look at from the beginning of the year to now, the stock multiple on the S&P is down about 2.5 to 3 multiple points. I mean, the earnings are up this earnings season. This can sound crazy, and some of these numbers are kind of fake numbers because you had unrealized gains that were realized. If you strip out all of these weird unrealized gains, earnings grew 30% this quarter. Normal is like 8 to 10, and the stock price on a lot of these companies are not moving up, or if they're not moving up commensurate. So you are seeing multiples come down substantially. The average company in the S&P is in line with its 30-year average. The tech basket has become cheaper than normal. Yeah, you're 100% right that they need to correct, but they kind of have already.
Well, I mean, but this sort of goes to the potential upside, too. How much is the potential upside limited by the idea that price to earnings ratios are potentially lower in this new era? In other words, they don't have to go normalize, because this is not a normal period of time.
So first of all, I'm very optimistic about this story, but you always have to focus on what can go wrong. This environment needs the ability to raise capital in order to move. If the Fed tightens, and we're talking about the Fed raising rates, the hyperscalers will borrow money at any cost. The Treasury is going to have to borrow money. So the question is, who gets squeezed out by tighter financial conditions if they show up? And it's small businesses. So I think the risk in this, just think about this. If you have a hyperscaler bond and they want an extra 50 basis points of yield, they're going to borrow at that yield. The Treasury is going to has no choice but to finance the Defense Department and interest expense and the like. So who's the individual who says, maybe I can't afford this extra loan? It's a local business in your community that's financing payroll or inventories. And I think that if we get squeezed on financial conditions, it's a small business guy. So I think, and we've talked about this on the show before, what's the political ramification for this? If you have, and I'm not saying that we will, but if you have a tightening of credit conditions, I think there are going to be a lot of ramifications for that. Right now, by the way, if you look at all the data, the reason companies are raising money is because the markets are open and access to capital is fine, and all this is going swimmingly well, but that's why this debate is important.
Well, this Treasury Secretary has said time and time again that they want to focus on Main Street because Wall Street has done well. If they hike rates and they just hurt Main Street, then what's the point? Is that a good enough excuse for this Fed to say that is a reason why we are not going to hike interest rates?
As long as you're willing to, I mean, it's a double-edged sword. Yes, I think that if you tighten rates, I think you're going to end up hurting Main Street. If, on the other hand, you don't hike rates and you get inflation, then you're hurting retirees by increasing their costs. I mean, here's the bottom line. We're running a federal deficit that doesn't make any sense for an economy that's this strong. We've let this thing run ahead of ourselves, and there's eventually a cost to this. Now, mind you, I'm not bearish. I think that we are in this environment that none of us in our careers have ever seen before. The amount of investment in infrastructure and future growth is amazing. Final sales this quarter was 3.9%. I don't remember anything like that. That said, you have to focus on what where the real debate is.
In fact, the competition for capital right now, the fact that we have a stimulus program conducted by the biggest companies on the planet in this economy makes that deficit make even less sense at the moment, because the stimulus program is on, and it's being funded by debt issuance in the credit market and the monstrous spending from the Microsofts, the Metas, the Amazons, the Alphabets of this world.
That's why there's so many fiscal hawks right now down in Washington, D.C., looking to cut the budget. Oh, wait, yeah, there are none. So this isn't going to exactly go away anytime soon.
The hypocrisy is just, honestly, overwhelming, isn't it?
Instead, it's sort of, how do we expand the budget even more?
All the things that you would complain about if you were out of power. Then you get into power and you carry on doing precisely the same things.
The discipline tool is the bond market. Can't fool the bond. And at what point does it have a moment of discipline?
John, I'm happy to say you're going to stick with us. Jonathan Gollop there of Seaport Research Partners with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Hedge fund situational awareness has returned to the investing scene. Sources telling us here at Bloomberg the founder is making a $400 million investment in an undisclosed privately held company he already had an investment in. He pledged to investors that the recent events that saw his fund plunge have made him wiser and stronger. Recapping some labour market data, challenger job cuts showing companies laid off more than 33,000 jobs last month. That number down 46% year over year, and the lowest monthly total since July of 2024. Fed Governor Lisa Cook says she's ready to raise interest rates if inflation doesn't slow. Speaking at an event in Alaska, she cautioned that the longer inflation remains above the Fed's goal, the tougher the job will be to rein it in. Cook says she's firmly committed to restoring price stability. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the program, leaning on the Fed chair.
I want Kevin to be totally independent.
Rates should be lowered. We should have the lowest interest rate in the world.
Kevin's got a board. He's fantastic. He's a brilliant guy, smart. I know he'd love to see lower interest rates.
We'll have more with Jonathan Gollop of Seaport up next, live from New York City this morning. Good morning.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Stocks this morning positive by 0.1% on the S&P 500. On the Nasdaq, just a bit of weakness. We're down by 0.6. Lots to talk about with big tech this morning. Some weakness with SanDisk. Those earnings underwhelming. The lockup, the beginning of the end of the lockup. A staggered one. A staggered end to that lockup over a SpaceX. A big focus of this program. We'll have more on that in just a moment. Let's turn to the bond market. 2s, 10s, and 30s. Yield shaping up as follows. On 2s around 420, on 10s around 460, and 30s getting the spotlight in the last week, just holding on to levels around 520 at 518. Under surveillance this morning, leaning on the Fed chair.
He's got the whole package, and I think he's going to do a great job. I want Kevin to be totally independent.
Kevin's fantastic. Rates should be lowered. We should have the lowest interest rate in the world.
Kevin's got a board. He's fantastic. He's a brilliant guy, smart. I know he'd love to see lower interest rates.
So here's the latest this morning. The president has reportedly spoken several times with the Fed chair, Kevin Warsh, since he became the chief of the Fed. The Wall Street Journal reporting the president has asked for Warsh's advice on various topics, but it's unclear if they've spoken, Anne-Marie, on monetary policy.
Unclear if they spoke about monetary policy, but you know, you would need to be living under a rock to not understand where the president thinks interest rates should be going, and he has been consistent about this even before his time in office when he was a real estate developer here in New York. The story goes on to say the president calls Warsh in bursts, the people said, several times in a stretch of days, then quiet for longer periods, and he sought his counsel as he's dealing with issues like the Iran war, when it comes to AI, etc. I think what we all want to know is, what actually is Kevin Warsh telling the president at the same time the Treasury Secretary is coming out and really coming to his new Fed chair's defense?
Look, the optics stink, right?
They're terrible.
It's a stretch to say the Fed chair's doing the president's bidding. I'm not going there. I've never implied it. I don't think he is. And if you look at inflation expectations for now, the good news is for now, they're still just about anchored. That's the good news. But there is a risk they're going the wrong direction. We talked about this last week. After that news conference wrapped up, and the president immediately started talking about the Fed chair and how he supports the Fed chair and he's got these political actors. I don't think the optics help. Also, the comments from Secretary Besson, I don't think that helps at all either. In fact, it makes the Fed chair look weak. It makes him look weak. And I think it leads to those on the committee questioning his leadership as well. And that's problematic too, at a time when you're trying to make real changes at this institution. And I have to say, the kind of changes he's trying to make are worthy changes, moving away from things like forward guidance, changing the way we communicate, looking at the data differently. They're all worthy changes. But you need to bring people along and lead. And what I'm seeing from Besson, what I'm seeing from the president, this reporting, it makes him look weak.
From the market's perspective, right now the committee seems to be moving in a different direction from Fed Chair Kevin Warsh in the sense that they are giving their reaction function one after another, giving a sense that it would just take a couple of CPI prints that were higher than expected, with Mary Daly saying she does get a lot of data before September, saying that should you see a quicker, broader-based inflation, maybe the question would be, why do it incrementally and potentially hike even more? So the rhetoric is coming from myriad places, but not necessarily Fed Chair Kevin Warsh.
If this was former Treasury Secretary Janet Yellen going after a Wall Street Journal reporter, I would have loved to ask then Scott Besson, hedge fund manager, what he thought of that, because he was so critical of that Treasury, saying they were very political, they were issuing on the short end. Well, how is this not political?
He'd be seeing blood in the water and no doubt short in the Japanese yen. and having to think about doing the same with the long end of the Treasury, no?
I would love to know what his positions would be. His biggest holding before he became Treasury Secretary was, I believe, gold.
It was, yeah, long gold. Jonathan Gulliver Seaport, still with us. John, you touched on this, alluded to it. We won't get into the politics of the institution, we'll steer clear of that. But contributing potentially to higher long end yields and potentially capping the upside for this market because of multiples. Can you elaborate on that a little bit more?
Yeah, I think there's a couple things. But one we talked about before, there's a competition between the capital raising that's going on in AI and the capital raising that has to be done by the government because we're running enormous deficits. I mean, we didn't talk about it at all, but if the war goes badly, and I'm a skeptic of this belief that we're going to just, every time the oil price seems to get about to 85 or 90, the president says that we're about 30 seconds away from a deal, and it gets rolled away. And even if this is temporary, I don't think Iran is so quickly going to capitulate on the Straits of Hormuz because it serves, it serves our interests. But if that would add a lot of pressure on CPI, and it's not only the headline CPI. Oil is in everything. It's on, it's on the asphalt on our roads and the roofing materials on our homes and the plastics that we use. And so if we end up embroiled there for longer, that puts more pressure on, and the Fed seems to be predisposed to wanting to tighten against that. So I think that this competition for capital is a really big deal.
John was making this point yesterday. Do you think that if the Fed were to hike rates, that would actually help equities because it would constrain the long end of the yield curve and potentially enable the borrowing that has really supported so many of these companies?
At the end of the day, it's all about the economics. I'm not really sure that for all of the conversation we have about the Fed, there's underlying economic drivers, and which is why John asked the question before. If the Fed doesn't do it, the market will have to. Well, why don't we just let the market do it? If the market believes that you're going to have to, take this inflation down a little bit, and that rates are going to, drift a tiny bit higher in the process. So yeah, I don't put as much from an equity guy. I'm not so convinced that the Fed is the be all and end all of what drives markets at all.
That said, there is concern about leverage building up. You see margin debt that reached the highest levels on record earlier this year, ahead of some of the volatility that we've been seeing. You also see potentially this idea that earnings have never been better. Margins have been expanding dramatically. A question of, does there need to be some sort of curtailing of the exuberance right now in certain pockets of the market in order to have a stable economy and, frankly, steady growth?
Yeah, I just, through my lens, I'm not seeing the exuberance. I mean, we talked about it before. Stock multiples are nowhere near highs. Stock prices are at highs because companies are earning, the earnings are terrific, and some of that is margins because these semiconductor companies are doing well, but the entire tech suite is seeing margins higher. If you look outside of tech, in non-tech parts of the S&P, they're near highs. So things are going really, and part of the reason is that we are kind of mid-cycle. Margins are supposed to be edging higher. So to try to tighten conditions because things just seem really good and make us uncomfortable. And by the way, if you generally look outside of a small number of hyperscalers, we don't have a problematic level of debt in public companies. They've delevered for a really long time.
Jonathan, always good to see you. Appreciate it. Thanks, John. Thank you, buddy. Jonathan Gulliver there of Seaport Research Partners. Up next on the program, Brian Hamilton of LiveSwitch with roughly $100 billion worth of SpaceX stock set to become available for trading. Plus, Jahaira has your morning movers. SanDisk and Western Digital failing to live up to sky-high expectations.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Equity futures this morning just about positive on the S&P 500. No real drama in the last 24 hours at the index level on the S&P, just pulling back slightly from all-time highs following a 4-day rally, the best 4-day rally we've seen since April 2025. On the Nasdaq this morning, down by 0.5. We'll unpack that and get you some take names in just a moment. In the bond market, 2s, 10s and 30s, more data a little bit later on this morning. Yields at 420 at the front end of the curve, 518 at the very long end of the curve. Had some real mixed data on the ISMs this week on both manufacturing and services, with the labour components of both of those surveys pointing in very different directions.
And we've seen that in some of the underlying data, and actually Neela Richardson just kind of underscoring how in the manufacturing side of things there's really been an absence of workers, and they've had to really pay up to hire people in the services sectors. That's where they have seen some people let go, and that's what you're seeing perhaps in the employment component that actually was in contraction for the ISM services. Prices paid, though, still climbing, and that speaks to the CPI print that we're going to get next week that potentially could be that much more important for exactly what the Fed does.
We've got a multi-speed economy, and you can see it in the earnings. See it in the earnings through the week. AI, Caterpillar crushing it, the haves, the airlines, the cruises, the theme parks doing fantastically well. The have-nots, I think of McDonald's. McDonald's sales growth just a bit slower in America over the last year, and that's of concern.
Yeah, they did fire their U.S. head of operations, so it isn't exactly just a question of the consumer. They did seem to indicate that there was an execution side of things here, too. Nonetheless, they have flagged that people have been really struggling at the lower end, and that they really have had to have value meals that can bring them in the door on a regular basis in order to get the profits that they're looking for.
Slowest growth in a year for U.S. restaurants over at McDonald's. The numbers out early this week. This morning, equities just about positive on the S&P, some weakness in tech. Let's get to the single names, the morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing both SanDisk and Western Digital lower this morning, and it's really a case of high expectations catching up with them. Both beat on earnings, but the guidance for the first quarter did come in a bit light, and when you run up some 470% in SanDisk's case, and some 200% for Western Digital, the market really wants you to hit it out of the park, but they did not quite do that. And it's a similar story over at Datadog. Those shares are also lower, falling 18.5%. And this has been one of the rare bright spots in software, with the stock more than doubling this year, but this morning giving back some of those gains. The company beat on earnings, revenue, and even raised its full-year outlook, but it appears investors were looking for even more given this reaction. So this theme catches up with Datadog, high bar for the high flyers. And we end on Keurig Dr. Pepper. Those earnings results just in, shares are up 1.25%. Like Coca-Cola, strong earnings there. It reported a better than expected quarter on both sales and earnings, and reaffirmed its full-year outlook. And the big driver was its cold drinks business, more than helping to offset weakness in coffee. John?
Yahara, thank you. Appreciate the update. More from Yahara in the next hour. On a radar this morning, Google shaking up its AI leadership. A long-time Google employee central to the AI strategy leaving to launch a new startup. The head of Google DeepMind also moving into a chairman role at the lab. Elsewhere, new disclosures from Microsoft revealing the tech giant generates the vast majority of its AI sales from OpenAI. Roughly 70% of its total AI revenue for the year came from the firm, highlighting how dependent Microsoft is on its partner. And finally, investors bracing for the next potential hit to SpaceX. About $100 billion worth of stock is set to become available for trading today as a lockup for insider shares comes to an end. This is the first of several lockups set to expire in the months ahead.
This is actually incredibly important and potentially the source of some of the volatility going into this, the earnings report and after it. This concern that actually the price will go that much lower when actually there is more supply that comes into the market. It's important not just for SpaceX. It's important for Anthropic. It's important for OpenAI. It's important for all the other potential companies that could IPO in mega IPOs later this year or even next year. If you get a poor performance, how much does that clip the wings of some of the high flyers in the private market space? That, I think, is what a lot of bankers are going to be watching.
It's about 20% in this first stage. And some are saying that actually people might hold on to it because they want to see the price higher before they start to get rid of some of their shares, especially at a company that when they IPO'd, I believe the report from SpaceX was that more than 4,000 individuals were made millionaires at that company, people that have worked on the production line. They've held on to it this long, they might say, I need this price to be higher.
How quickly will they look to realize some of those gains? Brian Hamilton, the chair of the enterprise software firm LifeSwitch, warning the share unlock reinforces some of the same concerns raised at the IPO, writing retail investors are being asked to take significantly more valuation risk than employees and early investors who receive shares at much lower prices. Brian joins us now for more. Brian, it's good to see you again. When we spoke on the day of the IPO, I remember you called it an extraordinary company that's extraordinarily overvalued. Brian, do you still believe that's the case?
I think so. You know, what a world we live in. Look at the company. They cut their losses in half. They doubled their revenue, doubled their customers, and their stock price went down, as you guys know, by about 10% yesterday, only on Wall Street, you know what I mean? But look, here's the big picture. These guys are still priced at 50 times trailing sales of last year. So they're doing well on an operating level, Jonathan, but they're still overpriced.
Let's talk about what they are doing, Brian, at an operating level. There are several businesses in there. And Lisa was talking about this earlier this week. How do you value this company? I'm sure we had that conversation at the time it went public.
Yeah.
Is it a telecommunication company? Is it going to be a growing neocloud firm? How do you look at it?
Yes, it's all of that. It's Elon Musk's joyride, you know what I mean? I love the guy. What a great entrepreneur, but still overvalued. And unpacking what the company does, good luck with that, you know what I mean? But here's the thing, guys, look at this. I will say, I have to back off my thing from a couple of months ago. As you guys know, the price has been battered. I'm not surprised by that. But at an operating level, they're doing great. It's, you know, here's the thing. It's a good company that's overvalued. It's not complicated. It's a mishmash, as you mentioned, of a bunch of things that Elon wants to do. Great entrepreneur, but still super risky. Now, one last thing. I listened to your last segment. It is true that I thought it was about 7%, by the way, by my calculation, but there's a bunch of people who have been in the company, they're employees, and they're unlocking. But I don't think that's going to be a material thing. I could be wrong.
At the same time, there's a larger question here about whether this is a SpaceX problem or whether this is an endemic problem with a lot of big tech companies that have solid businesses that are doing great things, but are also promising to spend trillions of dollars in CapEx for plans that have not been realized yet in a very competitive environment. At what point do you see some of that as becoming increasingly a liability? I'm thinking of Meta. I'm thinking of others that are trying to expand their definitions.
I have always promised myself, I will always say, I don't know when I don't know. And I don't know. But so I go to the fundamentals of the company. The losses have been cut in half, and that's great. And there's a ton of investment, and none of us on this planet know whether this stuff is going to pay off. I started early, guys, in AI. This is ancient history, 25 years ago. But we don't know. You were right. All these companies are investing big time in AI. I think they've got to do it. Will it pay off? We don't know. So that's why we drift back to how is this company doing with customer acquisition, profits, and the basics?
At a certain point, there's also this war for talent, and we just saw it with Google yesterday. We clearly see it with SpaceX, with this belief that Elon Musk has a singularity and vision that can potentially propel the names higher and realize these dreams. I just wonder, do you think that some of the individual talent is being overvalued when you see things like these $100 million payouts for some of the AI specialists?
Yes. Yes. But again, this is an arms race, right? This happens in every great industry. Automobiles 100 years ago, you get all this growth, and what's happening, you're going to have fewer and fewer companies, and they're all fighting for talent. So these people are overpaid. There's no question. I'm one of them. You know, I was one of them. But that's the way it is. I mean, because, you know, that's the beautiful thing about tech, as you know, is it's intellectual property. So if they can get the best talent, there's a non-linear relationship with how that company will be valued.
Brian, if you ever want to be a co-host of this program when someone's on vacation, maybe when I'm out, you should jump in. Let us know when you're in New York, please. Brian Hamilton there of Live Switch. Brian, thank you. Appreciate it. We've talked a lot this morning about the Federal Reserve, the lack of guidance, that the end of the spoon feeding for journalists who follow this institution. It's coming to an end, apparently. Maybe it's not. This came from the FT moments ago. Check this out. What a story from the Financial Times dropping this hour. Kevin Walsh is set to stick to his stripped-back communication style even after the Federal Reserve Chair's decision to offer scant details of his strategy on interest rates fueled a powerful sell-off in Treasury bonds. People close to Walsh said he acknowledged that he made mistakes in his first 10 weeks at the helm of the world's most important central bank, including failing to reinforce his key messages on price stability and sowing confusion over whether his longer-term plans to reform the Fed could affect near-term policy decisions. The story goes on. And then it gets to a very, very key line about what he may or may not do with policy in September.
Walsh would be prepared, according to the Financial Times, to raise interest rates at September's meeting if inflation readings released in coming weeks are hot and markets ratchet up their expectations for increases in borrowing costs. The people familiar with thinking said, now, is this a Nikki leak situation, but now to the Financial Times? And even with the Financial Times now dropping this story, it really makes me question why the Treasury Secretary decided to go after the Wall Street Journal reporter yesterday.
I'm struck by why we're seeing this story right now at a time when everyone seems to be speaking for the Fed Chair, Kevin Warsh, but Kevin Warsh, and then saying that he is going to stick to the script even if there were mistakes. I just want to get to the bottom of exactly how we put this in the panoply of potential options. Either way, what it does underscore is how much potential volatility is being baked into every single data point from here until the September meeting. Not necessarily the rhetoric that we get at Jackson Hole, because it's unclear whether we get any rhetoric, but what I do think will be interesting is CPI next week and then the follow-ons from there and how much that could really be determinative.
There's a worry about this bond market. Quite obviously, there is a worry and a concern about this bond market. The Fed chair contributed to that move on Wednesday with a clumsy news conference. His objectives are going to remain the same, and that's fine, but how he articulated those objectives became less clear. The preferred tool, I think, was one of the bigger issues in that news conference. If you are concerned about inflation, if you are willing to act, which tool would you use? Are you satisfied with just the market doing the work for you? Leaving that unanswered contributed to that move at the long end of the curve last week. You look at the defense that's come out from the Wall Street Journal op-ed. You look at the defense that's come directly from the Treasury Secretary, and now you're getting this, which essentially looks like, let's call it what it is. This looks like a leak to the Financial Times to tell you the thinking of the Federal Reserve, to show that he's still committed to raising interest rates if he needs to. Why do we need to do that a week and a day after the news conference last week? The only reason you need to do that is because the message you were trying to send in the news conference last week failed to land. You made a mistake. We acknowledge those mistakes in the article this morning, and that's okay. But for everyone who's come out since Wednesday to try and defend that performance of the Fed chair, this story in the FT completely upends all of that defense in the last week, because the story in the FT acknowledges that the people around the Fed chair were concerned enough about how this has played out in the last week that they felt like they needed to say something to the Financial Times.
And to me, the arguments people are making that it might actually force the Fed to act more quickly in order to get that confidence back seems to be increasingly on the table, and that is clearly what we are hearing in the rhetoric from Fed officials who otherwise might have even leaned into the disinflation story that some people still believe, Andrew Hollenhorst among them, will take place.
Every new central bank leader makes a mistake, and it's totally fine. It's not a big deal. Just got to acknowledge it was one. And I think we've come pretty close to doing that this morning.
And when you think about what's going to happen, as Lisa was pointing out, Jackson Hole, the end of this Financial Times piece says Walsh is expected to use his first speech at Jackson Hole this month to explain the intellectual framework behind his quiet revolution, including clarifying areas where he believes his own messaging has fallen short.
It's going to take some time to read that FT piece this morning for the market, but yields are starting to inflect higher at the front end of the curve. We're up by 3 to about 421. okay? I don't think it's a massive move, but an appreciation, based on this article, that you have got a Fed chair that's willing to use their main interest policy tool, to address inflation if it remains where it is and gets hotter.
Right now, there's a 58% chance baked into the market that they will hike rates in September. Before the Fed meeting, it was 100% chance. And you saw the yield curve a lot flatter, the long end of the yield curve a lot lower. Question is, does this clarify anything? Because I'm kind of going in circles around what exactly is.
What are you confused about after reading it?
After reading it, honestly, he said that he's not going to reverse course, but he's going to try to clarify the messaging that he thinks wasn't given across at the previous meeting. So are you talking or you're not talking? Are you giving press conferences where you're going to say something, or you're not giving press conferences? It just seems like talking without talking is not a very satisfying thing. It just feels like trying to obfuscate.
Claudia Sahm just tweeted the article and highlighted the part where the people familiar with his thinking said, and she says, Warsh is the Fed chair. We should all be familiar with his thinking.
Precisely.
We should not have to rely on anonymous sourcing.
It's okay that that news conference didn't go well. I remember Chairman Powell having some atrocious news conferences. In fact, the guidance was so bad when inflation was so far above target. That's where the original leak to the Journal came from, following what we were looking at Michigan sentiment, and that led to a bigger hike, and they had to leak it to the Journal. That was ridiculous. Give him a chance. Let's see what he says in Jackson Hole. I think it's good news that we're getting around to the idea that Wednesday was a mistake. In fact, I am far more optimistic and constructive on the future of the Fed under Kevin Warsh after we've acknowledged that Wednesday was a mistake. Trying to defend Wednesday and the communication effort in that news conference, that's where I was becoming more concerned and not less.
I agree with you. If this is coming from Kevin Warsh, again, why are we talking about it through anonymous reporting in the Financial Times if this is someone who really wants to be clear and focused in the communication that he does deliver?
But especially if that era was ending as well.
I mean,
but apparently that era's not ending.
That's my question. I thought we were done with, Nikki leaks. Well, now we have FT leaks.
Journalists have their use, apparently.
Yes.
Apparently they do. We'll come back to this story later this morning. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Trump preparing fresh tariffs on imported polysilicon this time, the material used to make semiconductors and solar panels. It's a bid to boost U.S. production. The measures are part of Trump's effort to target an industry that China dominates. Analysts are anticipating a tariff of 25 to 35%. OpenAI is asking a federal judge to dismiss a lawsuit filed by Apple that accuses OpenAI of stealing trade secrets. Defense lawyers arguing that the suit falsely portrays the actions of the startup's employees. OpenAI's filing also alleges Apple's failure to integrate AI into its products. Meta saying that one of its AI models hacked into the systems of an outside service. The model exploited a vulnerability in a third-party service during cybersecurity training in a manner similar to previous instances with other companies, including OpenAI and Anthropic. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate the update. Up next on the program, a family divided.
We don't have a current alarm bell sounding off in the longer run inflation expectations. I tend to lean a little more on let's be thoughtful about this, but why wait? Why wait is because we'll get more information.
Up next, we'll catch up with Ed Al-Husseini of Columbia Threadneedle, live from New York City. You're watching Bloomberg Surveillance.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. It doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting, rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
It's all happening this morning. Let's switch at the board straight away and get straight to the bond market. I want to look at 2s, 10s and 30s, and I want to talk about the backdrop for supply and why this Treasury Secretary increasingly sounds rattled. Alphabet kicking off a 10-part US dollar investment grade bond sale. That headline dropping just moments ago. Yields are pushing higher at the long end of the curve. We're up 3 on 10s, up 3 on 30s at 520. At the front end of the curve, you're at about 421. We'll separate the two issues here. So we'll talk about supply and what it means further out along the curve. And then we'll talk about Fed policy in the front end of the curve in just a moment. But Bramo, more supply to contend and compete with what's coming out of the Treasury.
And the supply from the hyperscalers has been disproportionately at the longer end of the yield curve. I think something like more than 40% has been above 10 years in duration. So it just gives you a sense of why this is affecting the long end of the yield curve to the degree that it is.
And then this comes after this from the Financial Times. Hard to keep up this morning. This from the FT on the thinking of Kevin Warsh. Let's get to the quote. And the key piece of this, if you're following monetary policy, is that Warsh would be prepared to raise interest rates at September's meeting if inflation readings released in the coming weeks are hot and markets ratchet up their expectations for increases in borrowing costs. This according to the people familiar with the thinking of the Fed chair. With us around the table, Ed Hosseini of Columbia Threadneedle. Ed, good morning.
Good morning.
Okay, do you want to start with supply or start with the Fed? Where's you going to go?
Let's
you
go with
get
the
to
Fed.
choose. Start with the Fed. What's your reaction to that FT piece?
Look, I think the most generous interpretation here is we're doing a little bit of cleanup from the last press conference. There needed to be a course correction. The messaging was extraordinarily poor. And so this is a big first step in that direction. We still ultimately are left in a vacuum because we have not heard from the chair. And I think we'll wait until the end of the month to see if that changes.
Do you think the action in the long end of the yield curve has presented a real fundamental problem for not just the Fed chair, but also this Treasury Secretary and the bond market itself?
I think that's right. And you can see some hints of that in the yen intervention and the way that was structured, again, to preserve some of that foreign demand across the curve. I think the reality is when you take a step back, we've put a lot of premium into the long end of that curve. Some of it is inflation uncertainty, some of it is supply related to the fiscal deficit, and then some of it is growth because growth has surprised us to the upside as well. I think it's impossible to disentangle that cleanly, but the end result is there doesn't seem to be a break on that move higher at the moment.
So we're getting this Alphabet offering, and we'll get the actual tranche sizes. It's a 10-tranche bond sale. We'll understand exactly how much is being issued at the long end of the yield curve, and we'll get that to you as the data comes out. I am just curious, though, how much do you see the move up in the long end of the yield curve as being directly a consequence of the lack of reaction function that we're getting from Kevin Warsh and some of the credibility issues versus just the supply-demand dynamic and the elements that you're talking about?
Yeah, it definitely doesn't help. right? It's one factor. We ran that experiment around the FOMC press conference. We saw that premium going to the long end of the curve, which was quite unusual. We saw the curve steepen and the dollar and risk assets sell off, which was a way of markets telling us it's not just an inflation issue, it's an uncertainty issue that's being punted into the long end of the curve. Early days, right? Because we're just a couple of months in, but definitely off on the wrong foot.
What do you think the bigger threat to this bond market is right now? Because there are a range of threats. Supply from hyperscalers, Alphabet just dropping, uncertainty about the Fed, attempted cleanup through the Financial Times this morning, worries about the Japanese issue as well and the spillover risk. What's the dominant concern if there is one?
Gosh, it's so hard. It's sort of an all of the above issue. Look, I think ultimately it has to come down to the data. If the data continues to surprise to the upside, if we get more evidence that this economy is accelerating, both in terms of the growth outcomes, the labor market, and inflation. And those have been largely separate stories so far. If they start to converge, I think that combination could be quite toxic.
Feels like, Bramo, they are converging to some extent in the last hour or so.
I mean, right now, just looking and getting a couple more details about the maturity levels in some of these tranches of the Alphabet deal, including a 10-year, 20-year, 30-year, and 40-year issue. When you take a look at the schedule of debt, unclear exactly the total amounts that they're planning on any of these issuances. Nonetheless, it gives you a sense they are looking in every corner, under every couch cushion, to raise as much capital as they possibly can, potentially crowding out some others, like the U.S., average consumer or the average citizen to potentially borrow debt as well.
Can I study with 30-year this morning? Any interest at 520? When does that become a screaming buy?
Look, I think the outright level of yields, whether you're looking at the investment grade corporate bond market or the treasury market, the outright level of yields are quite attractive, particularly the inflation adjusted level of yields. But then you have to commit to hold that exposure, I think, for a protracted period of time and eat the volatility in the interim. And that's, I think, what some investors are finding to be quite dangerous at the moment.
Ed, it's good to see you. We appreciate it. Ed Al-Husseini there of Columbia Threadneedle. What are 60 minutes for this bond market right now? Yields rising across the curve at the front end by 3, led by that story from the Financial Times this morning. At the longer end as well by 3 to 4 basis points. Pushed there by the headline drop in across the Bloomberg terminal just moments ago from Alphabet. Alphabet doing the Treasury no favors this morning.
I mean, again, 30 and 40-year debt. It just gives you a sense of how these companies are increasingly long duration as their promises and hopes and dreams have a long runway to play out.
The bond market in the driving seat this morning. Equity futures pulling back from session highs, up just 0.1% on the S&P 500. Up next, Peter Cheer of Academy Securities, the third hour of Bloomberg surveillance, just around the corner.
Famous dogs. You have they look like balloon kind of figures to some extent. How do you make those?
In the case of the balloon dog, I blew up a balloon dog. So I had this balloon, which is kind of like a latex type of piece, molded it, cast it, and then blew that up in scale and put it into a clay, and eventually had that transformed into stainless steel.
So when you have a balloon dog, let's say, a regular size one or then a big one, did people say, Jeff, you're crazy? Were you shocked that people were willing to pay very high prices for this?
When I was making my first balloon dog, one of the purchasers was Eli Bro. And originally I thought I could make a balloon dog for around $300,000 that I could manufacture. It's a large piece, over 10 feet long, or 12 feet long, 10 feet high. But it turned out that the fabricator came back to me and said, you know, Jeff, I can't do it for $300,000. It's going to be $650,000. But eventually, then they raised the price again. And they finally brought it up to $1.6 million. And I told Eli that this is the reality of it. I showed him everything, and he ended up paying for the production costs.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Historically, bubbles were characterized by a notion of if you build it, they will come. In the late 90s, when we were building out data networking equipment, people were putting huge amounts of fiber in the ground on the assumption that it would come. And economists like to go back for reasons that are unclear to me to the railroads. They were also, if you build it, they will come. What is unusual about AI right now is the builders are so far behind the demand, it's absurd. We have a backlog of more than $25 billion of demand. That there are none of us, not AMD, not NVIDIA, that can keep up with the demand that your employees are driving. That's, in a lot of ways, the opposite of a bubble. We are chasing. Our customers and their customers are moving at the speed of software. And we're moving at the speed of real estate, data centers. Right, and so we are behind.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersachi in Al Ula, Saudi Arabia, and this is Bloomberg.
The reality is this is an arms race.
We've come a long way very quickly.
It's healthy to see the market digest, the market to rotate a little bit.
We're still in an environment where you have earnings growth continuing to rise. Is this an earnings bubble? The answer is no, it is not.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your price action of scores look like this. Equity futures pushing higher by just 0.1% on the S&P. Some tech problems out there for SanDisk and others. The Nasdaq is down by 0.6%. The bond market is the focus of attention this morning across the curve. Lots of little reasons, some bigger than others, for high yields on 2s, 10s and 30s by 2 to 3 basis points. 30s around 520, 2s around 421. We'll start with the longer end of the curve. Pushed higher, kicked around this morning by Alphabet kicking off a 10-part US dollar investment grade bond sale. The front end of the curve pushed higher by this story dropping from the FT, according to people familiar with the thinking of the Fed Chair Kevin Warsh, indicating that the Fed Chair would be prepared to raise interest rates at September's meeting if inflation readings released in the coming weeks are hot.
Who's this coming from? Is it coming from the Fed chair himself? Is it coming from people adjacent to his thinking? And why are we doing this if we just had a Treasury Secretary talking about how this is not the correct way to do monetary policy? Either way, it goes to the question of the market not understanding the reaction function of this Federal Reserve, understanding the individual reaction function by certain Fed members who have come out and spoken. Unclear if Kevin Warsh is in charge or if he is happy letting everybody speak for him.
And when it comes to this story, it also says that people close to Warsh said he acknowledged that he had made mistakes in his first 10 weeks at the helm of the world's most important central bank, including failing to reinforce his key message on price stability. Basically, lots of confusion when it comes to how the Fed chair thinks, why the Treasury Secretary is stepping in, and on top of all this, the Wall Street Journal front page is that he's actually having a discourse and taking several calls from the President of the United States.
Bring up the yield curve. Let's look at this together. This is not a big move this morning, but it's a continuation of a problem that's been building for quite a while. And you've noticed, and I'm sure you've all noticed, a bit of a trend emerging here. The amount of cleanups that we've had to do in the last week or so. There's a hit to Fed credibility. There's a cleanup through the Financial Times. The spillover risk from Japan is getting greater. It's increasing. The Treasury Secretary has to come out and do an attempted cleanup. The one thing that you can do very little about right now adds to the problems, and it's the competition for capital coming from the biggest companies on the planet that are also contributing to high yields. This is something that there is no circuit breaker for. The Treasury Secretary can do nothing about. The Fed chair cannot address. This is a problem that's going to keep leading to high yields for this Treasury and for this Treasury Secretary.
Yeah, and even though it wasn't a huge move, you did see that shift higher in the long-term yield after we saw this issuance announced by Alphabet. We still haven't seen the total amounts of each tranche. Nonetheless, the fact that they're selling 40-year fixed debt and 30-year fixed debt and 20-year fixed debt and 10-year fixed debt raises the question of how many people want to buy duration, how many more of them want the extra income that comes from some of these big companies than, say, just purely taking the risk of the U.S. government, especially at a time where the monetary policy isn't as clear.
We heard it from TCW yesterday. It's going to keep coming. And it doesn't matter how much the rates are, these companies will keep raising capital to spend because they believe they're in an existential fight right now. Now, look, I understand there probably will be a number where they'll have to respond to it, but at the moment, based on what I'm hearing in fixed income and credit, we're not close to it.
That's why I read a couple of notes yesterday about the refunding announcement that we heard from the Treasury and how they said for now, or at least for the next few quarters, we're going to keep the funding the same. And the speculation was not that necessarily they were going to increase coupon issuance at the long end of the yield curve, but they might even decrease it at the long end of the yield curve in order to avoid competing with this. But what that does is it puts it more on the short-term debt market, which again puts Fed Chair Kevin Warsh that much more in the hot seat.
That's the great irony about Besson at the moment.
Yep.
The complaints about forward guidance, he's engaging in it himself at the Treasury.
And I'm pretty sure he sat around this table before he was anointed Treasury Secretary. He was basically in the running and really went after then Treasury Secretary Janet Yellen for issuing on the short end, which they are doing the exact same thing.
Peter, Chair of Academy with us around the table. Pete, I'm just going to bring you straight in to this conversation just to build on what we're seeing in fixed income right now. You've got pushback from the FT trying to clean up the performance last week in the news conference, noteworthy. You've got the Alphabet issuance, noteworthy. The risk coming out of Japan, more than noteworthy. The Treasury Secretary sounding rattled out on social media, somewhat noteworthy. How do you respond to all of that?
So one, I think we can add a couple other problems for the bond market is I think globally, everyone's having to issue debt, right? Every sovereign nation right now is having to pick up their issuance in terms of their defense spending. The Middle East, right, used to make a lot of money on oil. They'll probably make it again at some point. Again, they're now having to issue debt. UAE's had to tap into swap lines. So I think globally, there's this debt issuance. And one thing that made me extremely happy and probably not on anyone else's radar screen is Australia announced their first refinery in 60 years. So this concept of production for security, needing to produce your own things. It's not just a U.S. thing where we're growing it. I think it's occurring globally. So there's going to be more pressure on capital as we try and build out refiners, smelters, not just in the U.S., but across the globe. I think you're seeing things being pulled away from maybe the cheapest to produce place that are dangerous. You don't want everything in China. You don't want everything in the Middle East. So I think you're going to see long-term pressure on bond yields across things. Having said all that, I think it's fine for Warsh to be talking to the president. I actually think the president does not like to be felt in the dark, and he lashes out with random tweets at 2 a.m. So to the extent that he's involved, I think it gives Warsh a lot more runway, and I think it's a small price to pay for him to keep the president involved, let him know what's going on. And, you know, maybe it's very different than what we're used to, but I think we haven't seen any really nasty tweets about Warsh, and I think that's part of it. This president does appreciate people who communicate with him and are available when he wants. For better or for worse, that's the world we live in. I think it actually protects the market a little bit.
I don't really care if they speak or not. I'm interested in what they talk about, and whether the Fed chair responds to it. That seems like a very separate conversation, and the optics around it are problematic. Now, you think it's good. I understand why you think it's good, and that's important. You believe it's good because you don't want the Fed to take any more credibility hits. I might look at it differently and say the optics are suffering because of this at a time when the credibility is already being hit. And it makes it harder to repair through stories like the FT.
So I guess it all depends on whether he's communicating and taking direct advice and going to go ahead with that, or it's more keeping a potential issue at arm's length. And I kind of view it as probably keeping a potential issue at an arm's length by keeping him involved.
At this point, how much do you see where the long bond is as a constraining force on some of the not only valuations, but also ambitions of companies that might not have the balance sheets that, say, Google does?
So I think it will slowly add up to that problem. Right now, I do think, people are a little bit overhyped on, that we're going to get all this debt issuance, and I think people are prepared for that. So I think there's some room for spread compression actually in the coming weeks. Having said that, I'm really focused on the 10-year rate. I think it's the 10-year that's where you and I are most effective, right? If we go to look at our mortgage rate, that's where we're going to see it. So to me, the 10-year is the key. So long as that's 4.75, 4.80, maybe we're okay. That starts getting above 5%, I think it puts a big problem on the economy. Again, we're not seeing the home side of this market do well. That's what this president really wanted, was get housing back, make affordability. It's not there, and to me, the 10-year is critical for that, and it's been heading the wrong direction, and I do think we probably get towards 5%, which puts further pressure on this economy.
We've been talking all morning about how much of some of the jitters that we've seen in the stock market have been fundamentally driven and how much has been technically driven. You've had a long history of studying leverage in markets. You've had a long history in studying market dysfunction in markets. How much are we seeing right now a structural problem of leverage and new exchanges that are creating volatility that has not yet been shaken out of the system to any degree?
I think that's a great question. I'm going to step back a little bit and go back to that April through June run, right, where the semis were screaming higher, right? Everyone wanted to say, oh, it's because of this, it's because of that. Well, situational awareness was clearly playing a role, right? They were putting leverage bets in this market. They were buying. Guess what? That pushes those stocks higher. It feeds through, especially in the semis. There's a ton of leveraged ETFs, both on the stocks itself, but on individual companies. Those ETFs have to buy stock at the end of each day when it goes up. I think you had the momentum monkeys kind of come in. You had these people really chasing things. It drove it all these highs. And then all of a sudden, the unwind. So everyone wants to talk about the role that situational awareness had on this decline. They had just as much impact on the way higher. And I think one of the risks we're going to see is just like Archegos, a lot of the names that Archegos got involved with never saw those highs again, right? So I think we pushed these things very, very high. We're coming off. People are trading it. And I do think we probably had a short-term bounce. But I don't think the names that we saw move 10 to 15% last week, Amazon, Microsoft, they don't move 10 to 15% unless someone bought a huge portfolio and was trying to clean up that portfolio. So I think in the coming days and weeks, I'm watching very closely for, the NASDAQ 100 or in the semis to turn lower again. And I think we might be starting to see that. None of the issues have been resolved, right? The ability to create your data centers on time and at cost, still difficult. Not in my backyard is kind of getting worse rather than better. I think the president's trying to do some stuff about that, but it's not helping. And all of a sudden, cheap Chinese compute's everywhere, right? And finally, and this is the hardest part to figure out because I think no one's really talking about, but are people comfortable that they're getting the bang for the buck on what AI is delivering versus the current cost? I think that is waning a little bit. So I think the pressure on this market will resume. And the second it does, I think we see newer lows in some of these areas, and partly because there is so much leverage. These leveraged ETFs, to me, are incredibly dangerous.
Is there a level where it gets so low, though, that you think a lot of buyers come in?
I think we just had that. People kind of like this. They like the story. You saw those 10% moves, and everyone's like, oh, the AI trade's back on. Okay, and everyone seemed to have forgotten. So, again, I think people are caught net long again. There aren't many shorts in this market, so it doesn't take much to push this down. It's August, September, which aren't ideal times for the market. We've been propped up a little bit by the ongoing, reopening of the Strait. There's a lot of issues going on, so I think we can pull back a little bit further, and I think people did commit a lot of money in the last few days.
What do you make, though, of DeepSeek actually potentially raising their prices?
So, I try not to look at any one individual Chinese company. I think they are able to raise their prices because they are so much cheaper, so why not make a little bit more profit? That takes some of the pressure off the U.S. companies. But to me, we talked about this probably a year or so ago. Was DeepSeek a one-off, or is this more a sign that China's kind of allowing their entrepreneurship to grow? Now we have the Kin 3 model. I believe that there is this risk that China is kind of taking their millions of engineers, allowing them a lot more flexibility. And while they don't make high-quality chips, they make lots of chips. They do not have the same electricity issues that we necessarily have. And, I would not want to live in China where you have no personal freedoms. Having said that, if they want to build a data center somewhere and some town's not going to get electricity, whatever, that town's in trouble. So it's going to be very difficult to compete with them. And I'm really scared this looks like a BYD automobile, where BYD all of a sudden went from almost nowhere to dominating markets. I think we just saw today one of the Chinese semiconductor companies said to Apple they were actually going to raise prices because Huawei and the other Chinese cell phone companies are buying up so much. So I'm really worried that they're kind of able to repeat what they did in the early 2000s again with BYD and Huawei in this space, which I thought it was years off, and it looks like it's closer, and that's my fear.
Before you go, can we try again to say some 40-year hyperscaler debt? Any interest? Yeah, I actually like it.
You like it?
I like it.
Tell us why you like it.
So I would not necessarily buy it on a spread basis. I think at this point you're getting paid to wait, and I don't know that we've hit a debt diet type moment, but I think everyone is now so geared up for, oh, we're going to have spending. The tiniest hint that even one of them slows down spending, I think these things rip tighter. When you look at the bond market, if you're a bond market investor on a spread basis, it is the cheapest single sector. I had an interesting conversation with a hedge fund, and I think a lot of people are in the same boat. It's like, I would love to short this sector because every day it goes 5 wider, but I'd also love to be massively long because when it moves, it is going to rip tighter. So I think it's a dangerous game, but I would be buying that because I think on an all-in yield basis, you're getting paid attractively.
Yeah.
If there's a valuation issue, it's going to be the equity side, not the credit side.
There's something somewhat reflexive about this, though, because before they cut spending, you've got to get the pushback in the market, and you might get some wider spread.
And we had a little bit of that, but again, I think the spreads are so wide that these companies, they're phenomenal credits. It's the equity valuation that's going to bear the brunt of it. So I could see the equity valuation bearing the brunt. Again, when you go back to companies, 3 or 4 years ago, I believe, when GE credit spreads, and their stock was down, they started cutting back on it, and their stock went up. So I think we're nearing that stage for a couple of these companies.
You run the company for the equity holders, and at some point the bond market gives you a reminder, and Bramo, you have to change course.
Right. Yeah. I mean, that's essentially what happens. The problem is sort of like if everyone's waiting for the course to change, and they're not pricing it in, then they don't have any incentive to do so.
Peter Shea of Academy. Pete, it's good to see you. Thank you, sir. 10-part offering coming from Alphabet. The longest maturity, Lisa was talking about it, 40 years. CapEx of that company for this year, $205 billion at the high end of estimates. Their intentions, more than double the outlays of 2025. That's quite a jump. Negative free cash flow, you noted that after the earnings came out. You've got to borrow more from the debt market. The pressure's on, and yields are up.
And they're having a talent problem with one of their leads in DeepMind departing and starting their own startup. So they're going to have to pay up to get some new talent in there at the same time that they're trying to compete with this existential race.
Let's get you an update on news worldwide with your Bloomberg brief. Fonnie Quinn has more. Hey, Fonnie.
Hey, John, thank you. Fed Chair Kevin Warsh will reportedly stick with a scaled-back communication style even after the Treasury market backlash. The Financial Times is reporting people close to Warsh saying he'd be willing to raise interest rates in September if inflation runs hot. Alphabet shares just down about 0.5% in the pre-market after the company announced a 10-part US dollar investment-grade bond sale. The latest test of investor appetite comes after the Google and YouTube parent company raised its 2026 spending forecast. President Donald Trump is denying reports that the U.S. is running low on munitions, posting on Truth Social that the country has massive amounts of weapons. Trump also warning people leaking statements about the shortages should face jail time. And that is your Bloomberg Brief. John.
Fonnie, thank you. Thanks for the update. Up next on the programme, the morning calls, plus Julie Ju of MoffettNathanson as SpaceX gears up to unlock about $100 billion worth of insider shares. Live from New York City this morning. Good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Our sense is that the demand for AI is going to continue to grow, and therefore the investment cycle will continue. And what we heard over the last couple of weeks is the hyperscalers have at least one more year of higher CapEx. Extrapolating beyond that is where I think it gets really tough. You really have to make assumptions that are very hard to make right now.
That was Gil Luria of D.A. Davidson weighing in on tech a little bit earlier. Equity futures on the S&P 500 just about unchanged. On the Nasdaq this morning, we're down by 0.75%. Await to this tape. Lots of reasons for it. In the bond market, lots of reasons for this too. 2s, 10s and 30s, yields higher across the curve, up by 2 basis points on 2s, up by 3 on 10s and 3 on 30s. The pressure coming on the supply side, the pressure building on the Federal Reserve as well.
Yeah, and increasingly the question that we've been asking all morning is this presenting a real problem to the Treasury Department and to the Federal Reserve itself? Is this the kind of tightening of financial conditions that they want to see, or is this something that feels a little bit like it's become untethered from what the Fed says or does? And ultimately, that is an answer that we may get in the next couple of Fed meetings.
It feels like it's cleanup on Constitution Avenue and 20th Street this morning via the Financial Times with this line that Kevin Warsh would be prepared to hike interest rates in September after we've heard from everyone but Kevin Warsh about how he views the Federal Reserve right now and the economy. So this, to me, says potentially we're going to have a really big Jackson Hole speech where he has a lot of explaining to do.
We got a number on that supply as well coming from Alphabet. Check it out, $25 billion they're looking to raise in that bond sale. The supply keeps climbing.
Yeah, and it's one thing to have a $25 billion bond sale. It's another thing, 2 years ago, if we had said $25 billion of bonds being sold by one of the biggest tech companies, everyone would say, wow, that's a big sale. Right now, it seems kind of small relative to some of the other ones, and it comes after more than $200 billion of debt just raised by Alphabet itself. So it goes to the question of how much more is there and how sustainable is this? We just heard from Peter Scheer. He still likes it at these spreads, but in lieu of what? And how many people are saying we'd rather buy this than the U.S. Treasury?
And that's the price action in stocks and bonds. Let's get you some morning calls. First up, RBC raising its price target on SanDisk. Still the lowest on the street, saying long-term opportunities will offset near-term pressures. Your second call from UBS, cutting its price target on Western Digital, citing slower shipments compared to its competitors. And finally, Bernstein hiking its price target on SpaceX, expecting higher AI revenue and earnings. There are 3 calls this morning. Let's stick with SpaceX. Shares staging a modest rebound as investors brace for the unlocking of about $100 billion worth of insider shares. Julie Ju of MoffettNathanson with a neutral rating and 131 price target on the stock, writing, until we have more clarity on the big questions and until expectations reset to what SpaceX's technology can more realistic achieve, we remain on the sidelines. Julie joins us now for more. Julie, welcome to the program. Can you just describe this staggered end to this lockup that we're about to witness over the next several months? How unusual that is for the names that you've covered in the past.
Sure. As you've mentioned, the first rung of the ladder of the lockup expiration starts today, and then you'll see incrementally more come to the float in the coming months up until mid of next year. But I'd say that we're not technical specialists, and we're less focused on the technical aspects of this trade and more about what happened to the fundamentals. And based on the earnings report we saw a couple of days ago, we're not sure that the expectations have reset fully for the fundamentals to see kind of raised estimates for an upswing.
How difficult is it, though, to understand the stock by purely looking at the fundamentals?
That's a great question, Lisa. The way to think about it is there are parts of the business, and we call it the known knowns and the known unknowns. These are the Starlink, broadband, kind of P times Q. You've got the AI terrestrial data centers, et cetera, and you can model those in the traditional way. And then there's a component of the value, which we call our upside optionality. And that's to say, look, SpaceX owns the launch capability. If they own this bottleneck to this vast, potentially new expansionary TAMs in the future, there should be some value assigned to it. But all this to say, the way to think about how the stock moves from a fundamental basis is what happens to the modelable parts of the business, what are people expecting, and on our part, the Starlink mobile piece and the sustainability of the terrestrial IaaS pricing are questions that weren't completely answered on the call.
There's also a question of whether all of the spending will be worth it, Julie, and this is something that an increasing number of people are talking about. Does it make sense to try to compete with neoclouds and hyperscalers when you have really viable telecom businesses and space businesses that are actually yielding real profitability? From your analysis, how do you justify some of the expenditures that are exceeding expectations?
Sure, and what you'd see after Tuesday night's earnings is that investors were probably reacting to the step up, about $3.5 billion more capex than expected, largely driven from the AI portion of the business. The company noted under 1 year paybacks, but we'd say that the 30 to 50 million per megawatt that they're charging currently in their terrestrial is about twice to 3 times higher than most of the neoclouds would charge. And these are also deals where after a 6-month kind of minimum, there are 90 days where either side can back out. So there is definitely a question on the sustainability. And to your point about the other markets, the one thing to consider is that they promised, especially on the call, a significant portion coming in from direct-to-cell mobile. We'd say that from a physics perspective, it's unclear to us that that's going to be a business proposition that works. And on top of that, that's another business that's going to cost hundreds of billions of capex in terms of building out a terrestrial network. And the question then becomes, in your waterfall of prioritization, what are you going to spend on capex?
Don't they already have part of that business sorted out, though, with Starlink?
So there are two components. The Starlink broadband business is a meaningful business today. It's a totally different constellation of about 10,200 satellites versus the 650 in the mobile directly. What you heard on the call on the mobile piece is that in order to compete with the big 3 telcos, Starlink Mobile is thinking about putting out femtocells or small cell laser mesh network. In our view, that's going to be really difficult because if you think about it just visually, the small cells versus a larger tower today, it's just not comparable. And you've seen the big telcos spend about $650 billion in the decade prior to 2023 to build out what ostensibly was an already built out network. That isn't kind of a number to laugh at and is something that SpaceX would have to consider in order to move forward or get an NVMno agreement, which all big 3 telcos kind of vehemently denied on their earnings calls this past quarter.
Julie, appreciate the update from you. Julie Judah of Moffett-Nathanson. That stock is up in the pre-market by 2%. Every conversation we have is about raising more capital and investing more into this economy.
It's endless, and that's both a source of strength and a source of potential vulnerability. Just unclear how the two really match up.
Up next, some breaking data, jobless claims just around the corner. Blarina Urucci of T. Rowe Price joins us for more.
morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Jobs data about across. Jobless claims, we're looking for a number around 200K. We're always looking for a number around 200K. The estimate in our survey this morning is 205. The previous read is 197. Phenomenally low. Just really, really low on a historical basis. Equity futures this morning on the S&P, positive by 0.1%. A bit of a weight to the tech tape this morning. On the Nasdaq, we're down by 0.6. In the bond market, heading into this data, yields pushing higher for several reasons, and we'll spend some time on that in just a moment. Up 3 basis points on 10s, up 2 on 2s. With your data, here's Mike McKee. Good morning, Mike.
Good morning, John. You were looking for a number around 200,000. How does 199 sound to you? 199,000 initial jobless claims. That's not the all-time low. We saw that, the low back to 1969 3 weeks ago, 188, but it is pretty darn low. Last week revised up to 198. So we're basically about unchanged on this whole thing. In terms of the continuing claims number, 1,801,000, that's an increase from 1,777 the 2 weeks before. Remember, that one is delayed. We also got some numbers on productivity. Non-farm productivity rose 1.4%. after rising 0.8% in the first quarter. That's a revised number. So productivity revised higher in the first quarter and significantly higher than anticipated in the second quarter. The anticipation was for a 0.6% rise. Initial unit labor costs come in at 1.3%, significantly lower than the 2.1% that was anticipated, although it was revised down to 1.3% for the first quarter. So at this point, it looks like there is a productivity story underway. Whether it has much to do with AI or not is something that economists are already arguing about.
Mike, we've got to spend some time, forget the data. We've got to spend some time on this Federal Reserve piece in the Financial Times this morning. Claire Jones did a wonderful job of covering the ECB for many years in Frankfurt, now covering the Federal Reserve. What are your thoughts of this piece in the FT this morning on Kevin Warsh?
Well, my initial thought would be pretty much like everybody probably on Wall Street, that it's damage control by the Fed, an effort to kind of keep the markets from overreacting to the press conference that Warsh had and the criticism he's received since then. I think one of the things that's happened is that people on Wall Street have misunderstood a little bit of what Warsh is talking about. He wants to get rid of the forward guidance, such as we will keep this rate unchanged until we get to X date or X condition in the economy, versus if inflation continues to rise, we will have to consider what we're going to do, which is the reaction function. And those two things have gotten confused with people on Wall Street. On the other hand, Warsh has kind of missed the ball when he's talked about the market should keep its eye on the ball rather than the referee. The Fed's not the referee. The Fed is a player in the game, and no matter what he wants, you're always going to be anticipating what the Fed is going to do, because the Fed's reactions are going to change the yields that you're factoring into your models. So there's a little bit on both sides here. Maybe Warsh is trying to calm things down until he can explain more at Jackson Hole.
It's going to be quite a speech at Jackson Hole. Mike McKee, Thank you, sir. Given what's in this piece about the speech in Jackson Hole.
Yeah, exactly. It talks about that at the bottom of the Financial Times piece. They talk about the fact that he's going to be working on this and talking about, let me get the exact wording of it, expected to use this speech to explain the intellectual framework behind his quiet revolution, including clarifying areas where he believes his own messaging has fallen short. The buildup now to Jackson Hole is huge. When some people were even questioning before the press conference he recently gave if he was even going to give a speech in Jackson Hole, it's now become that much more important.
Mission 1 was getting rid of forward guidance, and clearly he was so keen to do that. There was an unease drawing a distinction between that and providing a reaction function, and you could see that every time he was talking in the news conference. He was finding it really difficult to draw a distinction between the two. We're getting closer, at least, with this piece in the Financial Times. The fact this piece is in the FT tells you that it's something he does want to try and do.
Just to be very clear, I don't think it was Wall Street that was conflating reaction function and forward guidance. I think that Wall Street was saying, we understand with forward guidance we're not looking for it. Reaction function is what we're looking for. It seems to be more a matter of the Fed chair. This feels like couples counseling, where you need to sort of agree.
It's ridiculous.
But it does, where it's like you need to agree on a shared language before you can actually talk about the substance. And right now, we're in the process of agreeing on the shared language with the Fed chair before we can talk about exactly what the substance is. Is the shared language going to be established early enough to potentially get to a place where credibility is regained?
Neil Dutta on Twitter, you either think Warsh is in charge of the FOMC or you think the FOMC is in charge of Warsh. It seems like he's struggling to get a hold of the committee right now.
It's been a rough start, and I hope in 12 months we're not talking about any of this.
I hope so too.
I really do, because the challenges in fixed income right now are so large, we don't need an extra one. We don't need this distraction. Alphabet this morning, just another example of that. The supply is going to keep coming. The competition for capital will keep rising, and we've already got problems with other policymakers elsewhere, right? We've seen that across Europe and in Japan. We don't need our own here in America.
Yeah, and this is the fear right now. How much has that added to the yield premium, the term premium on 30-year yields going to the highest level since 2008? How much has it been part of the communication, or is this just a structural shift that needs to be managed through a pretty difficult period?
Joining us now is Blarina Urucci of T. Rowe Price. She writes, the labour market is stable but gradually cooling. Payroll growth no longer needs to be particularly strong to keep unemployment stable. Blarina joins us now for more. Blarina, welcome to the programme. I think we've got to start with the Fed before we get to the data. That FT piece really showing how he's thinking about things right now in a way that he didn't communicate in the news conference last week. What have you made of that news conference performance and the subsequent write-ups you've seen over the past week?
Yeah, so I think what Warsh has done very well so far has been to communicate the goal. He's been very clear about the importance of hitting the inflation target. I think what we have been struggling with, both as investors and Fed watchers, is figuring out how he intends to do that. So I think that's where we need more explanation. What are the tools? What is the reaction function? That's a spot-on comment from you guys. We don't need forward guidance. We're very good at reading the tea leaves. The market is, forecasters are. So I think any progress we can make in understanding how we're going to get inflation down to 2%, which everybody on the FOMC agrees is the goal here, the better off we're going to be and the less market volatility we're going to get from here. And I think also taking a step back a little bit from the Fed reaction function, I really feel the way the market pricing is set up right now and the discussion with the FOMC, the September, the October, December rate decisions, they don't belong to the FOMC. They're not going to be driven by market pricing. They'll be driven by CPI and PCE inflation data. It's as simple as that.
There is also a piece of the paragraph in here in this FT piece, Blarina, that I think is important too, and Lisa's talked about it repeatedly, the preferred tool. In the news conference last week, he was somewhat, and I don't know why, vague about what the preferred tool might be, whether it would be the interest rate, whether it would be the market, whether it would be the balance sheet. In this FT piece, it's pretty clear that they would be prepared to raise interest rates in September, and that's still the primary tool. Now, that might sound obvious, Blarina, but it didn't sound obvious last week in the news conference. Is that just a little bit of news?
I I think, again, it goes towards clarifying how we're going to get inflation down to target. I think there was a narrative emerging in markets that the Fed can use the balance sheet, QT, reduce the size, reduce liquidity in the system, and that's going to tighten monetary policy, and they don't need to do as much on interest rates. I'm not on that camp. We know that QE works very well in times of stress. We're not sure how much tightening you need on the QT side in order to fight inflation and tighten monetary policy. So again, going back to what is the appropriate tool, I really think in times of high inflation, the Fed has one tool, and that's interest rates. So again, going back to the September pricing and September hikes, that depends on what's going to happen with the next two inflation prints. And here, again, I think the messaging that the FOMC doesn't focus on 1 month of data is very, very important. We need to look at the 3-month momentum, 6-month momentum of core inflation. We need to look at inflation expectations. What is this period of elevated oil prices doing to anchoring or de-anchoring those expectations? And that's what's going to drive the decision in the near term. And the policy tool to use for fighting inflation pressures right now is going to be interest rates.
How much does the labor market matter right now if it just sort of stays at this low hire, low fire dynamic, albeit with some steady underpinnings that seem to be, in pockets, accelerating?
I think right now the labor market is secondary to the inflation data. And I think that's what the payroll report tomorrow is going to show as well, that if we stay in this balanced situation of low hiring, low firing, the unemployment rate doesn't do much from here. What drives market pricing and the rates outlook is always going to be inflation. Now, things could change. The U.S. labor market can turn around quickly. On the downside, I think you would need big drops, big increases in the unemployment rate to shake the confidence that the FOMC has that the economy is doing just fine. And then to accelerate hikes, I think you would need a pickup in wage pressures or indication that the unemployment rate is falling below NAIRU. I think those combined with inflation being elevated for quite some time now, would add to the urgency to increase interest rates.
Do we have a sense before the Fed conducts their review of exactly which measures of inflation are the appropriate ones to use? Do we have a view of what could kind of cross the threshold of being too hot for CPI prints over the next couple of weeks? Or is it kind of a toss-up and just depends on how the members feel?
I can say how I'm communicating with our investment staff at T. Rowe Price and our portfolio managers. I think we basically need to see core CPI and core PC around 0.2 per month. I think this is the bare minimum in the coming months. At least this is how I'm interpreting the kind of guidance on the reaction function we've seen so far. And then within that, I think we need to see some progress on the services ex-shelter component that has been sticky. That relates very closely to domestic demand and the labor market. So the detail matters and the number matters. Now, if we see shocks one way or another from these components, and it's looking like one-off progress on inflation rather than the path for sustained move lower on core, I don't think that's going to be enough. So the number matters, and I think 3-month, 6-month annualized averaging around 2%, 2.2% is good progress, but how we get there is also important.
How much are you watching in terms of the progress developing in the Middle East, this potential that maybe the Strait of Hormuz will actually open if there is some sort of agreement between the Iranians and Omanis, and where do you think there needs to be a lid placed on energy prices?
I think for me, what's going to be very important is that we don't have risks of escalation and risk that energy prices and oil volatility will stay high. Because what we've seen since March is that oil prices and news from the Middle East have been really driving rates. And the reason for that is that oil has such a big impact on items that the consumer buys every day. It really risks de-anchoring inflation expectations. So rather than a level on oil itself, I think I'm more worried about continued volatility because I think that will add to upward pressures on inflation expectations. And then if I had to pick a level, I think staying around $70 to $80 would be okay for reaching the inflation target over the medium run. I think that what we were seeing before March of this year with oil around 60 looked unsustainable, and we don't need that in the U.S. economy to bring inflation down.
That's the range we're in right now. Blorina, it's good to see you. It always is. Blorina Urici there of T. Rowe Price. Crude this morning, 80 on Brent. WTI around 76. A new risk event for the next 24 hours or so. Some debt coming from Alphabet. Right, 10-part offering, $25 billion worth, the longest tenor. What was it, 40 years?
40 years.
Crazy.
So we'll see exactly what the reception is and how much people push back and ultimately who gets punished. And this has been something that we've been talking about quite a bit. Who is the competitor with Alphabet to raise that money? Is it the likes of Meta and Microsoft? Is it the U.S. government? Or is it, say, some holdings in equities even, whom people want some income? I mean, really, this is the key question. How does this ball of money continue rotating at a time where people are still talking about raising trillions and trillions of dollars?
The Treasury market, to some extent, paying the price. 30-year yields up by a couple of basis points, 10s up by 3, 464 on 10s, 30s still around 520. With an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Recapping the data we just got, initial jobless claims remaining below 200,000 for a third straight week, coming in below estimates at 199,000. Continuing claims did top survey estimates, coming in at 1.8 million. Alphabet looking to raise as much as $25 billion in that latest U.S. IG bond sale. The Google and YouTube parent company offering notes in as many as 10 parts with maturities ranging from 2 to 40 years. Top leadership at FIFA standing behind embattled President Gianni Infantino, reaffirming their full support for him during a meeting in Morocco. Infantino's tenure was thrown into jeopardy as regional FIFA confederations began to turn against him following his now abandoned plan to monetize the sport. And that is your Bloomberg Brief. John.
Vonnie, thank you. Up next on the programme, we'll set you up for the day and the week ahead. Plus, we'll catch up with Jonathan Krinsky of BTIG, saying the volatility in chip makers echoes the dot-com bubble. That conversation up next.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura. I'm the Salar de Uyuni in Bolivia, and this is Bloomberg.
If you are in an environment where we are, as a society, raising trillions of dollars to fund this build out, if the Fed needs also trillions of dollars, they're competing with each other. And that kind of competition for capital means that you're probably going to see higher interest rates.
That competition continues. That was Jonathan Goll of Seaport. Not long after that, we got this headline, $25 billion bond sale, potentially. That much coming from Alphabet a little bit later. 10 parts, the biggest part, the longest tenor, 40 years. 40-year debt coming from Alphabet.
And this isn't an anomaly. We've seen as much as 100-year debt coming from some of the hyperscalers. Just to give some perspective on this, Alphabet so far this year has raised about $52 billion across U.S. and Canadian dollars, as well as sterling, euros, Swiss francs, and yen. All of that this year, adding to that another $25 billion potentially with this deal. And frankly, the sky's the limit for how much more they and everybody else will need to raise.
A monster equity capital raise in the mix as well in the last 6 months too. You went through all the different currencies. That's just an example of them trying to tap all the available pools of liquidity in all the different currencies they possibly can, because the competition for capital is that great. And they're not the only ones. Others will follow. We'll see more of these headlines in the next 12 months.
To the degree where it's changed the structure of a lot of banks, where suddenly they have a very different approach. It isn't just an equity underwriting exercise or a bond underwriting exercise. It is going around the world and presenting a capital raise strategy for all of your needs when you need to raise $2 trillion. So, I mean, it gives you a sense of how different this moment is than it has been in the past.
Closely tracking the demand, how well that will be received through the next few hours or so. Equity futures this morning up about 1/10 on the S&P, lower on the NASDAQ. The NASDAQ 100 down by 0.6. With some single names, some morning movers, Yahara has more. Hey, Yahara.
Hi, John. We have a flurry of earnings to get through that we've gotten this morning, and we start with the software names. It is a rough morning for them, with Datadog, HubSpot, and Figma all selling off. The group had been staging a strong comeback as investors grew more optimistic that AI would create opportunities for them, not hurt them. But the reaction shows that the bar is still incredibly high, because both Datadog and Figma did post beats and raises, while for HubSpot, it was a bit of a different story since its outlook did come in softer than expected. Turning to the travel sector, with TripAdvisor, shares are falling more than 9% in the pre-market after missing expectations on both the top and bottom lines. And normally that would mean softer travel demand, but you can't say that when both Booking Holdings and Expedia came out with with strong earnings this week, with Expedia saying that consumers are deterred from higher prices when it comes to hotels and airlines. And we end on Peloton. Those shares also getting punished in the pre-market, down 11% after giving a weaker than expected outlook for the year ahead. And that's overshadowing what was otherwise a strong earnings report, with revenue topping estimates and the company posting its first full year of profitability. John?
Yahara, thank you. Thanks for this morning. NASDAQ futures then, edging lower. Chip makers coming off another rocky session. Jonathan Krinsky of BTIG seeing more downside risk ahead, writing money has sloshed from momentum to value and now back to momentum. There are many participants still feeling the pain from July's unwind. They are likely to not want to feel that burn twice. Jonathan joins us now for more. Jonathan, good morning. A quote that jumped out from you this week for me was this one here. The S&P surging more than 5% over 4 trading days into a 52-week high. And you said in the last 30 years that has only happened 3 other times, including March 21, 2000, which was the dead highs of the dot-com bubble. Jonathan, just how aggressive and how rare has the price action been just over the last week in certain names and certain sectors?
Yeah. Hey, good morning. Well, I think that shows you, how rare the price action has been. To get that sort of move, 5% in 4 days in the S&P, we typically see that after a pretty good sell-off, and that's why you don't see it into 52-week highs very often. So, you could argue a sample size of 3 is statistically irrelevant, but I think that it just is another one of those trading signals that we've seen that continue to pop up that do rhyme with the late 90s and 2000 period.
Do you think that this is the beginning of the end of some of the leverage that's been used in purchasing these shares? Or do you think that ultimately we haven't really pushed out of the system and we're not going to for quite a while?
No, I think certainly that's part of the aspect of the fact that we probably don't see new highs in the high beta momentum area for quite some time. And, we looked back at 8 prior boom bust cycles, going back to the Dow Jones in 1929, the dot-com, housing in 05, et cetera. And typically what you find that first impulsive move down sees about a 35% drawdown over 26 trading days. That's exactly what we saw in high beta momentum so far. And then you see typically a subsequent 35% bounce. But of course, the law of averages, you need more like a 52% rally to reclaim those 35% losses. And so typically that initial rally, which we think we're in right now, does not get back to the highs because you don't have the same type of momentum and leverage. And, I think what we saw last week with a high profile fund is just one example of that.
How immune is the equal weight, is everything else other than the tech sector to some of this volatility?
So, coming into June, we were actually proponents of the equal weight in some of the other areas of the market because we felt, that's where the money was going to move into. I think the issue now is we've seen a rally. If you look at the performance of the S&P sectors from the beginning of this quarter, right? So you had technology, discretionary comm services were the big hit to sectors. And then you had, I think, 5 sectors were up maybe 4% or more. And so you've had that unwind. The issue now is you've had a move into value sectors. You've had a rebound in Mag 7. And now the momentum and the semis have seen a little bit of a bounce, but they're kind of stalling out. And so I think the setup there leaves things vulnerable because let's say momentum does roll back over. We don't see another leg higher in the value sectors because they've already been rotated into. So I think that's the risk as we head into the back half of August.
John, it's good to see you. It always is. Thank you, sir. Enjoyed the research. Jonathan Krisky there of BTIG, speaking from a very specific seat, speaking about the technicals. His view, though, I think is interesting because people are talking about this clearing event that took place after situational awareness, and I don't hear that listening to him and reading his research.
And I don't hear that talking to Pete Shear, and I don't hear that talking to a lot of people who are talking about Bob Elliott, talking about how much leverage is still baked into the system in lots of ways, different than the financial crisis, but still not exactly a clearing event.
Do you think we've had a clearing event for this Fed, right? Washed out all the bad stuff and we can move on?
I think if they speak anymore, it's just going to be worse.
He's not even speaking, it's just everybody else.
Yeah, but everyone's speaking for him, which is worse.
Okay, we'll see you tomorrow, and hopefully things have changed. Chris Verone of Bear Strategas, Priya Misra of JP Morgan, Nadia Lovell of UBS, Jeff Rosenberg of BlackRock. Payrolls just around the corner.
Markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. When you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid? I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time. Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one.
The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Mumbai. This is Bloomberg.
The rally running out of steam. It's just 30 minutes ago until the start of trading. I'm Danny Berger.
And I'm Michael McKee. Bloomberg Open Interest starts right now.
Coming up on the show, fresh AI weakness keeps investors on edge amid U.S.-Iran talks and ahead of tomorrow's job report. Also on deck, billions worth of SpaceX shares are unlocked following the company's post-earnings plunge. And back in the game, Leopold Aschenbrenner returns to investing with a $400 million bet. Some of the stocks that we are keeping our eye on this morning, let's take a look at them because chip stocks are getting hit hard. It had been sell the good news, but maybe the news wasn't great for these companies. We had AI hardware giant SanDisk and Western Digital reported revenue forecasts that missed analyst estimates. That also said that the stocks were among the top performers in the S&P 500. SanDisk up 460% this year. Western Digital 200. SK Hynix, that's suffering its second sharp sell-off in a week after another bout of extreme price swings on South Korea's alternative exchange reignited concerns about market structure and liquidity. Let's dig into this with Bloomberg Intelligence Head of Global Tech Research, Mandeep Singh. Mandeep, it's the same question that we continue to ask. How much of this is something structural and mechanical versus a rethink of just how valuable these companies should be?
I mean, when you look at all the earnings, even, SanDisk last night and Western Digital, like these companies are growing, triple digits. Yes, the pricing part probably has played out, so you're not going to see, pricing continue to go up as it has in the past 3-4 months. So, and these companies are deliberately trying to sign, these longer term agreements just to have visibility in terms of what their customer profiles are in terms of the buying behavior, et cetera. And that way you could see the margins may have peaked, but overall the volume growth remains very strong and the fundamentals coming out of 2Q season suggest CapEx will go up. So I don't think fundamentally there is anything wrong. It's more market structure driven, but pricing growth probably has peaked at this point of time.
Yeah, because next trade is the volumes are much, much lower, and it doesn't take much to move the stock. And I was reading the story today on Bloomberg, and it just seems like this was the market structure and a couple of people selling shares, and then you have this big move.
Yeah, I mean, what we saw with situational awareness and, the whole of July, everyone was trying to figure out, what changed, why are these stocks moving down so much? And so that's where the margin calls and all those aspects come into play. But look at what these hyperscalers have done this quarter. And, even a company like SpaceX, I know the stock reaction was negative, but they are aspiring for $100 billion in ARR, and they really want to make big investments in terms of setting up more gigawatts for next year. So from that perspective, it's a positive for the AI infrastructure plays, because that's what tells me they will keep investing. Whether the ROI question will get louder and louder, that's secondary, but the infrastructure guys will continue to get their investments now that you have one more hyperscaler in SpaceX.
Surely Alphabet's news just emphasized that this morning, tapping the bond market yet again, this time for $25 billion.
Yeah, I mean, look, Alphabet has raised the equity. They are tapping the bond market. So clearly they feel they can get towards that $300 billion in CapEx for next year. And they have the balance sheet to do it. So right now it's about who can go bigger, who can have more gigawatt capacity live next year, because that will all translate into revenue if you're a cloud provider renting compute.
All right, Mandeep, thank you so much for joining us this morning. Mandeep Singh of Bloomberg Intelligence. As Mandeep mentioned, we're also watching SpaceX this morning, not just for the fundamentals, but also another mechanical issue. Investors are bracing for the next potential hit when some $101 billion worth of SpaceX stock becomes available for trading at the open. Let's discuss with Bloomberg's Bailey Lipschultz, who's been reporting on the expiry. So, Bailey, we get a lockup. Just walk us through the numbers and what we might see.
Yeah, Danny, we get up to 911 million shares, so nominally call it about $101 billion based on where shares are trading right now. That's freely available to trade. The big question, though, when I'm talking to investors and bankers is investors have held on to SpaceX potentially for decades, riding it from, a couple $100 million to $1.5 trillion in value. So the big question now is, are these going to be venture capital firms that are looking to outright sell the stock to pocket some of those gains? Will they distribute them to shareholders? And then it becomes kind of a bit of a domino effect where these shareholders are then selling shares. And the ultimate kind of question is, how many of these shares are being distributed to employees and people who invested through things like special purpose vehicles who have been waiting to at least have an opportunity to either A, sell stock because of tax purposes, or B, reap benefits that they kind of have been dreaming of. So it's certainly going to be something to keep an eye on exchange as well as off exchange throughout today and through this evening.
Now, this has been the biggest shorted stock on Wall Street as people wait for this expiry. And I'm wondering, if you are short, you're going to have to buy stock back at some point. So are we going to see some real volatility in the price given that?
I think that's a big question, Mike. When I talk to investors over the last few days, their question is, will we see short covering? Because the fundamental picture, to Mandeep's point, hasn't changed since the IPO. So you can see the stock right now around $109 a share. If that starts ripping and shorts are forced to cover their bearish bets, that can power the stock higher. The big question then is calling back to GameStop and other kind of meme stock like crazes. Do new short sellers then line up to bet against the stock? And do we see this continue to move like an EKG as these shares are unlocked today? And again, remember, guys, this is the first of 9 share unlocks. We're looking at $5 billion, or 5 billion shares, coming online through mid-December. So this is the first of many.
So more conversations to be had. Bailey, thank you very much. Bloomberg's Bailey Lipschultz. We'll keep track of SpaceX as that trading begins. Elsewhere in earnings, Warner Brothers Discovery reported an 11% drop in revenue year over year. The slump coming in part due to losing NBA rights and a weaker movie lineup. Let's get more with Bloomberg Intelligence media analyst Geetha Raghunathan. And of course, the backdrop for all of this is the drama continuing as to whether the courts will allow Paramount to actually buy the thing. Geetha, what was the setup for this? What did we learn in today's earnings?
Yeah, so the earnings were fine, Danny. I mean, as you pointed out, yeah, we did have that drop in revenue. You had a 30% decline in advertising, and of course, 20% of that was because of the lack of NBA. On the flip side, though, the good part of it was that, we also had EBITDA that actually got a little bit of a bump, the TV EBITDA, especially because of those lower costs with no NBA. Studio was mixed, Supergirl hasn't really delivered. Streaming, though, was very, very good. So the fundamentals seem okay, but as you pointed out, the earnings are just a sideshow at this point. It's really all about that Paramount Skydance transaction, which has now been delayed from September of this year to probably June of next year.
And that makes it risky to think about what kind of company is going to exist next year. So I'm wondering what, if anything, the earnings tell us about the Warner Brothers new management. They've only been in place for about a year. If you had to discount the idea of the merger, what did we learn?
Yes, I think, Mike, what we're seeing is that the Warner Brothers fundamental story is actually in pretty good shape. So this management team, as you pointed out, David Zaslav and his whole crew have really done a good job in kind of turning things around. Streaming, they've made it profitable. We've already gotten to an margin target of, the margin target was 20%. We've already gotten to about 17%. So really the question is what happens on June 4th of 2027 when the merger agreement actually ends? Are these guys going to settle? That is what Paramount Skydance absolutely wants. But, Warner Brothers Discovery, I think, is in a good place no matter what. If the merger deal just expires and it doesn't go through, remember, they collect $7 billion in termination fees. That puts them in a really, really good position, apart from having a pretty strong, fundamental business.
All right, Geetha, thank you very much for helping us cover that and the other media earnings this season. Bloomberg Intelligence's Geetha Raghunathan. A check on your markets this morning, 20 minutes before your trading day gets started, and we are dipping into negativity for both the S&P and the NASDAQ after yesterday just ending inches below all-time highs. The NASDAQ underperforming, down 0.8% as the chipmaker sell-off. Perhaps more notable, it's what's happening in this treasury market, Mike. For one, you have Alphabet issuing all of that debt, so that's also pressuring this bond market. But two, I know you've been talking about this morning, this FT piece on what kind of feels like people familiar trying to clarify or walk back or do damage control on what we heard from Kevin Warsh in the last presser.
It definitely is damage control out there, and the way the story is phrased, somebody close to Kevin Warsh, could be Kevin Warsh, telling them that he's willing to raise interest rates in September if inflation doesn't get better. That's the reaction function answer that the market was looking for at the news conference that they didn't get. And now you're seeing markets reprice based on that. And I'm sure Google doesn't help. And I wonder, and it'll be interesting to see when we get closer to the actual sale, if the price has changed because of all the people who left yesterday the Gemini project. And
True.
Does that lessen some enthusiasm and push yields up?
It shows just how intense the talent war is to have Jeff Dean, who I'm assuming you're referring to, one of like the foundational people at Google to be leaving. But just to revisit Warsh, how does this change things for Jackson Hole? Because there was some commentary in that FT piece basically saying that he wants to clarify his messaging at Jackson Hole. He wants to use that as an opportunity.
Oh, they just climbed up on the marquee and put a new coming soon to Jackson Hole on it because Warsh. People thought Warsh was going to just give a kind of anodyne speech about looking forward and the kind of stuff he's been saying. But now he has basically told people that he's going to go out and explain himself. So now Wall Street is going to be very focused on this.
It's going to be an eventful one. Let's hold tight on that and also get a check on some of the other movers on our radar this morning. With that is Bloomberg's Nora Melinda. Hey, Nora.
Hey, guys. 3 stories I'm following for you this morning. First up, DoorDash having a great morning. Paying subscribers are ordering takeout and groceries more often. This helping the company's forecast come in ahead of expectations. DoorDash did warn, though, of more spending on AI for product development. You're seeing shares of the company up about 4% in the pre-market trade. Now from food over to fitness. Peloton is tumbling after giving a weaker than expected revenue outlook. Just another reminder of how different the business looks from its pandemic heyday. On the bright side, though, the company did post its first full year of net profit. Shares lower by about 8% right now as we speak. And finally, Honeywell Aerospace cutting its full year outlook, but Wall Street seems to be giving it a pass. The company says supply chain issues are still weighing on the business, but shares were higher earlier, down about 18%. So a tough day so far as we start off this morning. Those are your morning movers. Danny?
Nora, thank you very much. We'll catch up with you later in the hour. Coming up, situational awareness is back with a new $400 million private investment. More on that after this commercial break.
is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving something.
Yeah, probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Let's get you some high-interest stories, a look at what's making headlines around the world. Iran says an agreement with Oman on proposed shipping lanes in the Strait of Hormuz is in its final stages. The two countries have been in talks for several days. Iran's deputy foreign minister cautions, though, that a bilateral deal does not mean the full reopening of the strait. DeepSeek planning a significant price increase across its AI services. It marks an unusual shift from the Chinese company, whose low-cost models have put pressure on U.S. and domestic rivals. DeepSeek did not specify the exact increases, but called them substantial and urged users to plan accordingly. And situational awareness is back in business. Sources telling Bloomberg that the hedge fund has completed a $400 million investment to back a privately held company. It's the first sign of how Leopold Aschenbrenner intends to pick up the pieces of his fund after it nearly collapsed under a wave of margin calls from lenders last week. Joining us now is Bloomberg Chief Hedge Fund Correspondent Nishant Kumar. Nishant, excellent reporting from the team. It feels notable not only that he's dipping back in, but he's not necessarily doing it in public markets.
Yes. He sold all the public market investments and kept the private market investments. And this latest deal, it seems primarily as a statement of confidence. Situational awareness is showing investors that it still has capital to deploy and remains committed to its private AI holdings. Together with about $100 million invested in the same company last month, this appears to be a sizable commitment in a very short period of time. It is the first sign that how he intends to come back to the market, really.
Is this any kind of sign that investors have lost some confidence in his management, not just on how much money they have to invest, but the strategies and, given his age, his experience at dealing with these kinds of things?
There is, we have to wait for that verdict. He was trying to raise external capital. We don't know whether he was successful or not. But this deal, it's quite remarkable that just within days of seeing this biggest stress test of his very short investing career, he's out there doing deals of this size immediately. So he feels confident, it seems. What investors feel like, we'll have to wait and watch.
What about the overall hedge fund landscape right now, Nishant? Because there was a concern that hedge funds beyond situational awareness did have large, risky, leverage concentrated bets in AI heading into the sell-off.
Definitely. So July exposed how many managers were leaning into some momentum, technology, and AI trades. And when those positions reversed, the funds with the greatest concentration suffered. Although several remains fine, if you look at the very sector-focused, tech-focused hedge funds, Their returns have been down in double digits. They have lost in double digits. But if you look at the mainstream hedge funds, so the multi-strats of the world, who manage like tens of billions of dollars between them, I mean, they seem to be, fine. I mean, they have lost some money, but they're okay-ish. I mean, some are even positive, like Citadel picked up situational awareness bets and they have ended the month in positive territory, but some have lost up to 3-4% of their assets.
Any indication that anybody else is in trouble the way situational awareness was, or that might need help? We obviously saw some sales in June and July of some of these portfolios, but anyone else out there that you're watching?
I mean, we are definitely watching a lot of managers with very concentrated bets on this highly leveraged, crowded AI trades. But so far, the losses doesn't seem to be existential, at least what we know. But you never know, like this is probably the most crowded trade right now in the market. It was suffering for a large part of July, but then it bounced back so significantly in the final 2 days of the month of July. So that helped a lot of hedge funds recover some of those losses. And that's why even the losses seem to be like 10, 15, 20% and not like 40, 50, 60%, except for situational awareness.
Nishant, thank you so much. Again, you and the team have just been doing such excellent reporting over the past month on all these developments. That's Bloomberg's Nishant Kumar. Coming up on the show, wealth manager Emily Green talks about the split that we're seeing among tech stocks. The Mag 7, not all of them so magnificent. This is Bloomberg Open Interest.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Guerrero.
I'm Lisa Mateo. And I'm Christina Rafiti. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
After being stuck trading sideways for the past 3 months, this week has seen stocks surge to new highs. Once lagging the market, now the big hyperscalers are back. with just 5 stocks, Microsoft, Nvidia, Amazon, Meta, and Alphabet, driving 83% of the S&P's gains over the past week. Joining Mike and myself now is Ellevest Head of Wealth Management, Emily Green. Emily, it was starting in May that we were really stuck in the doldrums.
Yeah.
So did something change this past week, or is it just a blip and maybe we get back to the summer sideways trade?
Yeah. I mean, I think we've seen, obviously with NVIDIA, we saw the SpaceX coming out with the news yesterday, like this week, and so obviously that went up with that. You know, Microsoft, we've seen finally coming back after a really rough 12-month period of time that they've had. But, you know, when I think about it, I think this is like a tough thing for people to look at with these tech stocks because people truly think that they're like everything in the market. And yes, they've driven a big part of the market. I do think that the trade in general, like while it's very concentrated right now, I think the market really has evened out more, and we are seeing like the market actually, like AI trade is not just those 7 stocks anymore. It is so much broader. And I think this may be a short period of time, and not that they're not going to continue to go up, but it's not going to drive the entire market like we saw for a few year period of time.
Yeah, but do your customers get that? Do they understand at this point?
No, so the thing I keep telling people is you need to have a strategy with these stocks, and your strategy is not to wait till it hits whatever the high is. That is not a strategy. And people don't understand that because people look at these stocks especially and they say, I believe in them long term. Great, so do I. That doesn't mean that they are going to be what drives the market for forever. That doesn't mean that we shouldn't look at the enormous spend that each of these companies have. Those are important things to think about. The debt that they've taken on, the competition that's happening these days, the IPOs of Anthropic and OpenAI that may come, you know, this year, later, and early next year. And so start to really think about what is your strategy around that and start to think about, you know, just like we're going to see people today with SpaceX, you got to take some off the table when you have these gains. And you look at something like Microsoft. Microsoft is trading over $100 a share more than we were a year ago. And so, yes, it came down a lot, but is your strategy that it's going to go up for forever? That's not a strategy.
It must be so difficult, though, especially in moments like before the past month, when you did see all these stocks just taking off and not wanting to chase them and doing the big momentum trade. So what does a portfolio need to look like right now? Acknowledging that this is a mega theme, that AI is here, it's transforming things, but to make sure you're not overly concentrated.
Yeah, I mean, AI is throughout the entire market now. We have to be realistic of that. Like, you know, we were talking a year, 2 years ago, people were saying, I want to own AI companies. Most of the market are AI companies at this point. There's no company that really is just an AI company. Everyone has AI within it today, and we see that through the entire market. And so really thinking about how do you have that diversified portfolio, taking down that risk, understanding that if you have some of these concentrations, that things can happen. You know, that's going to make people nervous. Again, like what we saw with some of these tech stocks over these past year, that they really were not the darlings of the market over this past year till recently. And so really thinking about what is that going to mean for your overall portfolio and really that diversification. And I'm not only talking about like US large cap stocks, diversification internationally matters too. And I think people forget about that a lot. We go to those 7 stocks and you forget that there are a lot more things out there. And, you know, developed international and emerging markets exist too.
All right, Emily, stick with us. We're going to have the opening bell in just a moment. That's Emily Green. And a check on markets ahead of that opening bell. Again, we take a step back. We'll see how SpaceX performs as we head to an expiry lockup today. This is Bloomberg.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent, but when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Just seconds until your trading day begins. You're watching Bloomberg Open Interest. I'm Danny Berger alongside Michael McKee. Matt Miller still out. And we finished basically unchanged yesterday, just below all-time highs. Are we going to do the same thing today? A lackluster market, except for the NASDAQ. That is precipitously. We're seeing a lot of the chip stocks do poorly, SanDisk earnings, and some of the weirdies in the Korea trade and the various circuit breakers we've seen over at SK Hynix. We got America's field trip, ringing the opening bell at the NASDAQ. This is pretty cool to see these young girls ringing the opening bell. This is a contest apparently for students around arts kind of things, essays, artwork. Perhaps these are some of the winners, so congratulations to them if they are. We have an IPO down at the NASDAQ. They also brought some kids alongside them. You should always bring your kids to the bell ringing. Such a unique experience. Braveheart Bio, they are a biopharmaceutical company IPOing, looking at various cardiovascular disease treatments. The thing that we want to look at today is SpaceX and how these shares are performing at the open. They are currently down 2.2%. More than 900 million insider shares are now eligible for sale. Volume has been off the charts. 50 million shares have already changed hands this morning, and that compares to an average daily volume of 115 million shares. So we're seeing almost about 50% of the volume we see in a typical day for SpaceX. And we're only just starting our trading day. We're back with Ellevest Head of Wealth Management, Emily Green. Emily, I mean, you understand investor psychology so well just because you're constantly talking to clients. What do you think it must be like to be one of the early investors of SpaceX and now entering into this lockup? Is this a market you think a lot of people are willing to sell into?
Yeah, I mean, it's certainly been a ride. We saw the IPO price $135. We saw it go over $200 a share, and now we're trading almost close to $100 today, and a lot of pressure on there. But we have to remember, there's a lot of profits that they've made in this. And so you're one of those early investors, and you're maybe not saying, I want to dump all of this stock today, but you're saying, I want to take some of this risk off the table, because you look at some of the high-flying goals that SpaceX has, and you look at, Starlink, and that's one part, but especially after the earnings this week, and we look at how much they're planning to spend on AI, and you start to say, oh, is that upside worth this risk? And you're taking some of that profit off the table if I'm one of those people.
Yeah, but is this sort of a meme stock moment in the sense that you've got a lot of people with a lot of locked up value who can make themselves very rich by selling, but it doesn't tell you anything about what the company's prospects are?
Yeah, I mean, this isn't the first time that a company has had their lockup expired. This happens every time a company IPOs. This is unprecedented in the fact that there are so many shares coming, and it is so close to the IPO. Typically, we're waiting 180 days after. You don't have all these different lockup periods. There was supposed to be more shares trading today if it was above $135 a share. But you still look at it and think, while we've had this ride, you're still one of those people and you say, you know, it becomes down to like your fundamentals and your goals, and whether you're a venture capital company, whether you're an individual early investor, and you say, what are the other opportunities I have out there, and let me take some of this profit off the table and put it into other places.
By the way, this is just a bar chart of, I believe this is in like 20-minute chunk, 10-minute chunks of the volume. If you can see it, there's a red line there, which is the average. So I mean, we're just well above and beyond the average. And I wonder what's also different for this company than other ones in the past and how they've done their lockup is also just the inclusion of this in indexes. It's in the NASDAQ 100. And you can already see that this price is just kind of swinging wildly. I mean, not wildly, but we're down like nearly 2% now, just down 1%. What difference does it make for now passive investors to be holding this thing as we're thinking not just about how the company fundamentals are doing, but trying to achieve something of a price discovery as shares lock up?
Yeah, I mean, today, you know, as of yesterday, this wasn't a big part of the index. It was included in it, but there were so few shares actually available, it wasn't a big part of it. And we're gonna see it increase more and more as the float gets bigger. And so as we just get more shares publicly available, we are gonna see that increase over time. And so right now, today, this move isn't going to make a big difference in even just the NASDAQ 100. That's not going to be a huge move that it's going to make. You know, if we see it starting trading down below 100, you know, maybe that starts to affect it, but it's not a huge part of it within the market today. A year from now, when you have, you know, next 2027, you have Elon starting to be able to sell his shares, you have a lot more shares available in the market, you're going to see this move the market more and more.
Well, what do you think happens with the capital that people are going to get from this? Back into equities, back into shares of Mag 7 companies.
Luxury car dealers.
But besides the Rolls Royce,
I mean,
what are people going to spend money on?
I think you're going to, like, the home prices in San Francisco, oh my gosh, what are you going to see there? Like, maybe they'll have a renaissance in San Francisco. But, you know, these are people who invested in something because they think they believe in the future and they're looking at something, they want growth, and they were willing to take that risk on it. And so I don't think people are going to take this same stock, like the cash from the stock, and they're not going to go buy municipal bonds. They're not going to sit in cash. They're looking for growth, but I do think they will take it and put it into a much more broad basket of high growth type of companies.
This earnings season, we have seen a lot of volatility, and I just wonder what you make of these companies, SanDisk being an example this morning. It has been a lot of tech, but just kind of the moves we're seeing in this market. How much of it is investors truly reevaluating what they see as the terminal value for these companies versus just some strange positioning that's forcing these big moves in stocks?
You know, I think people start to look at just the risks overall in the market. And I mean, I think we know that people are starting to look at the Fed likely raising rates. We've had more and more of that even come out this week. You start to look at the geopolitical risks. People, I've heard from a lot of clients who start to think like it feels like this war is going to be forever. You know, it doesn't feel like there's an end to this. And so I think people look at the risk of this. And so when you look at moves of these companies, some people starting to say, you know, especially these companies that are starting to issue a lot of debt, which we're seeing from a lot of these big tech companies as well. And there's risk to that in there. That's not a no risk type of thing. And so people starting to say, do we believe in that over the long term? And do we think the amount of money that these companies are spending is going to lead to the growth that they say? And, you know, only time will tell, but I think people are starting to get a little nervous about that.
It's interesting, SpaceX is now in the green.
There you go.
It's moved up a little bit, but you don't know whether people are covering their shorts on this. It was the most shorted stock. As we go forward, I'm wondering if we get to Wednesday of next week, which is CPI, does then everybody go away until Jackson Hole at this point? Because you're talking about the war and people's reaction, and I'm wondering if people are just exhausted by all this, and it's August, and hey, well, we don't want to go to the Hamptons because they're covered with ticks, according to the story on the Bloomberg, but you want to go somewhere.
It's funny. I feel like the ticks has been the conversation of the day.
I think this vineyard is bad too, isn't it?
Nantucket.
Yes. Oh, Nantucket. Thank you.
It's really people like can't eat red meat anymore or something. I think that people are hyper aware of what's going on in looking at the Fed, looking at these types of things. I think people are exhausted from it, though, to your point. And you know, I had clients yesterday asking about, like, you know, how do they even trade some of these things? And it's the decisions change every single day. That gets something really hard to change when you look at the Strait of Hormuz. Is like opening, is it closing? Is it what's going on here? And I think people are exhausted from that, to your point. I do think that, you know, like we have more and more of the Fed speaking out, talking about, you know, potentially raising rates. And so I think we've all kind of looked at this for a long time, but them coming out and saying it, people are starting to take that in reality. I do think people will start to look over the next month of like, what do I need to do to build my portfolio if interest rates are really going to start to rise again?
Gosh, I was also just thinking, I know this is horrible, but like getting alpha-gal might solve beef inflation because people can't eat red meat anymore.
Yes.
Sorry, we'll put that to the side. Let's not discuss that because that would be a big bummer. I also know that clients have been asking you about Eli Lilly and Novo Nordisk after their earnings and kind of the GLP wars. How are you navigating them through that?
Yeah, no, I think it's one of those interesting, I mean, this is one of those like trendy things that people talk about. And I always go back to things like, yeah, in 2020, when people were asking about Zoom and Peloton, and I saw Peloton finally became profitable this morning, but it was trading down. And so you look at this and I kind of always joke to people that once I have 5 clients call me about a certain stock, it's time to sell. It's definitely, that means it's hit its
Joe
high.
Kennedy's shoe shine.
Yes. You're like, once all these retail investors are calling you, it's time to get out. And I always tell people, like, you don't have any more information than everyone else does. And so how are you thinking about that future? And the question is not, is the stock going to go up? The question is the stock going to go up more than the market? And that is how you need to like reframe that, because people, yes, a lot of these companies will go up over time, but is it going to beat its peers? Is it going to beat the NASDAQ? Is it going to beat the S&P 500? You know, time will tell, but a lot of these stocks have already had their run up.
Emily, this has been so brilliant. Thank you so much for stopping by. I really appreciate your time. That's Elavesh Emily Green. Almost 10 minutes into your trading day, let's get a check on your markets this morning. We are barely up 0.04%. The breadth, though, does have the majority of stocks that are up. I was just looking at the names that are in. So again, we always sort this as to the companies that are adding the most points to the S&P 500. So the things you see here are always going to be biased by market cap, which is why it's interesting to see companies like Parker Hannifin up at the top. This is the 6th biggest contributor to the S&P 500 this morning, and this is an aerospace company. I don't know if I've ever mentioned that name on the show. Howmet Aerospace. You have a lot of aerospace-related companies doing well. Motorola Solutions, Costco. So very different kind of vibe to this market, although the very, very top is the people you usually see, NVIDIA, Apple, Microsoft. Downside, it's all these chip makers. Again, SanDisk reporting earnings down a whopping 17.9%. It's AppLovin that's down 17%. Micron, Western Digital also having a tough go of it this morning too. If you look at the individual sectors and how they're performing this morning, again, tech, it's being dragged down by what chip stocks are doing. So it's down 1/3%. Energy, that moves higher, up 1.4%. Consumer staples, you just saw Costco there doing well, followed by healthcare, financials, and communications. Coming up on the show, we're going to get more into earnings season, speaking with Krispy Kreme CEO on whether their turnaround is gaining traction. This is Bloomberg Open Interest.
We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm election.
Hear it first on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Let's hear from the sell side and get your morning's top calls. Here with that is Nora Melinda. Hey, Nora.
Hey, Danny, let's look at some of the chatter on Wall Street. SanDisk under pressure. That's following its earnings report. Citi lowering its price target on the stock to $2,100. Analysts are saying pricing just isn't looking as strong as they were hoping for. And Citi wasn't the only one saying this. Wells Fargo and Jefferies also trimmed their price targets as well. Shares of SanDisk down just below 8% right now. Next up, Bernstein downgrading Zillow to market perform after its earnings report as well. The stock heading for its worst day since February. Bernstein saying the story just isn't as convincing as it used to be, with several questions hanging over the business. Shares of Zillow down double digits, falling about 13%. And finally, wrapping things up, Mizuho raising its price target on Shake Shack to $90 after a better than expected quarter. Shares are lower, though, by about 4%. The firm saying activist investor Starboard could end up slowing the company's expansion plans. Those are your top calls. Danny?
Nora, thank you very much. Jeff Smith announcing that position yesterday on Bloomberg Deals, saying that his aim was to speed up their expansion. Speaking of expansions, donut maker Krispy Kreme is maintaining its full-year outlook as margins improve, helping to offset lower revenue. CEO Josh Charlesworth says that the company is making continued significant progress on its turnaround, and so pleased to say that Josh joins us now. Josh, great to see you. And look, it's clear this turnaround that you've been doing, focusing on having more franchise stores, it's working with your improved margins. How much more operational efficiency do you think you can squeeze out? Or do you need to kind of refocus on getting that top line growth back?
Yes, good morning. Great to see you. Yeah, the turnaround we announced a year ago is working. And you're right, we've seen margins improve this quarter, 340 basis points. That's contributed also to our ability to pay down their leverage. We're down 1.3 turns on that. But perhaps most important for the future, and to your point, is we're also seeing good underlying growth. If you exclude the business we exited last year, distribution at McDonald's, we actually grew 4.4% in the second quarter, which is a really good sign. And so I see going forward that we'll be able to continuously improve the margins, like you say, but also at the same time grow the business because people want our donuts.
Well, again, on the margin side, I'm wondering if you're having any impact from all of the inflation that we have seen that are people worried about, and whether you feel you have any pricing power to make up for it.
Well, we've made a lot of operational improvements over the last year. We have, for example, outsourced our logistics. That's the deliveries from our donut shops to our customers like Walmart, Target, and the like. And outsourcing that has provided a lot of cost predictability and cost efficiency opportunities. We've also made sure that all our revenues are profitable, shifting to distribution that is more profitable than before. For example, our fresh delivery channel, that's the delivery to those grocery and convenience stores, the sales per location are up, weekly sales by 30% year over year. So we're able not just to address those cost pressures, but improve the underlying profitability of the whole network.
Have you seen any changes in consumer behavior, Josh? I know when you talk about Krispy Kreme, you say, look, this is usually the treat that people go out for. Are they maybe buying that treat less often? Are they changing exactly what they're ordering? Are they opting for maybe more of a basic or a smaller package? Has anything shifted in the consumer?
It's interesting. In this dynamic consumer environment, we see that we are well positioned, as you say. It's because you're right. It's a relatively infrequent purchase, just on average 2 to 3 times a year. You're usually bought for sharing occasions, special occasions, and celebrations. And we're seeing that, you know, those fresh donuts are well positioned in this market, and that explains, I think, the underlying growth we've seen. People love our original glazed. It's our most popular and affordable product, usually bought in a dozen, and we're seeing even second dozen sales going up. And also, we're bringing a ton of innovation that people get excited about. It's important for them to see our latest creations. It creates buzz and excitement for the brand, and we're seeing those perform well in our traditional channels and increasingly in the digital channel as well. So there's a lot of engagement around the brand in this environment.
Have you felt any pressure to sort of match some of your competition and add products to your lineup?
Well, you know, the number one reason why people say they may not purchase Krispy Kreme is, where do I get it? I want to get those amazing fresh donuts. And so our focus is more about taking those fresh donuts that we make in our donut shops from scratch. You can actually literally see the dough being prepared and the donuts being decorated in our shops. How do we get them to people more conveniently? And that's why we've been partnering with the likes of Walmart and Target, also making them available online. And so that's where we see the growth opportunity, really doing what we do best, make great fresh donuts.
But Josh, the space is so hyper-competitive, both dessert and bakery, whether it's your big chain competitors, Dunkin', Starbucks, leaning into their breakfast and pastry offerings, or hyper-local chains popping up, Crumble coming up. So kind of like the sweets and dessert things feel like they are kind of cyclical, that they have these moments, and now feels like one of those moments. Josh, how do you compete with the old stalwarts of, again, the Starbucks and the Dunkins of the world trying to compete more, and new competitors seemingly pop up every day?
It's a combination of innovation and creativity, bringing excitement to our customers. More than half our customer base is age under 35. We have 18 million loyalty members. That's just for 400 donut shops across the country, showing how engaging those people in the brand, engaging them in the new donut creations, whether they're seasonal variations or our cadence of limited time offerings. We did a 4th of July, 250th birthday donut collection, really popular. We find that we're able to stay ahead of that competition. By bringing what nobody else can do.
Can I just quickly, we have like no time left, but what's the weirdest donut you guys have ever put out? I'm just listening to these, like orange creamsicle. What do you think is the most strange donut you've ever put into the market?
Oh, I don't know. It's amazing what you can do with a donut. My favorite was the blueberry glaze that we just did. I don't think it's strange. I just think everybody loves those traditional flavors. But sometimes, yeah, we do fun stuff as well.
Yeah, blueberry glaze isn't strange at all, Josh. It does sound delicious, though. I know where our stop will be after the show. Krispy Kreme CEO Josh Charlesworth, thank you so much for joining us. Coming up, Starboard takes a bullish stance on Shake Shack while shares jump at Burger King. We'll have the food roundup for you. This is Bloomberg Open Interest.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Take the areas that you want to densify and you want to own, and let's own those. And the areas you weren't going to get to on your roadmap for 4, 5, 6, 7, 8, 9 years, let's just do that at the same time. Let's bring in quality franchisees and have them attack those markets that you weren't going to get to for 7, 8 years anyway, and let's get those started sooner so we can improve the growth rate. And if you just run the math, it's a higher NPV, it's a higher return for shareholders.
Starboard's Jeff Smith announcing with me his firm's new stake in Shake Shack yesterday. Shake Shack responded saying, quote, "We appreciate the investment in our company and the confidence expressed in the quality of our brand and the strengths of our operation." Joining us now is Michael Halen, senior restaurant analyst at Bloomberg Intelligence. And Mike, look, Jeff Smith, basically what he argued was, one, the stock is too cheap, so I should buy it. And two, maybe they can grow faster by franchising. I know the team at Mizuho thinks that maybe that would even slow down their growth. Well, what do you think of Starboard's stake and what they're pushing for at Shake Shack?
Well, I'm not really sure what metrics it's cheap on. Maybe he could educate me on that. You know, it was interesting. I mean, typically when you see an activist, right, they're unhappy with the management team, and that's where the real opportunity is in restaurant chains, in my opinion, that are struggling, right, is changing the management team and really improving the core of the business before trying to grow it more aggressively. One thing that also struck me was, you know, kind of how easy he made it sound to franchise units, right? Like, this is an entirely new muscle for Shake Shack. They're going to have to do some hiring at corporate, right, to expand this and grow this, develop this business, right? And it's not something that's going to hit the P&L for 18 months, right? So he's buying in now for a catalyst that's going to hit a year and a half from now, and who knows what the economy is going to look like at that point. So this is a really interesting investment by Starboard, in our opinion.
Yeah, Mike, appreciate you helping us cover it. And for what it's worth, they compare it to Kava and Chipotle and say it's trading more cheaply on a 2027 times EBITDA basis, and then it should be above them. Hey, Michael, we're going to have to leave it there just at a time. Michael Halen of Bloomberg Intelligence. Coming up, we're going to talk to Smashburger CEO Jim Sullivan, some nominative determinism with me having burger interviews, it would seem. That's coming up in the next hour alongside Bernstein's Alex Chaloff. He's going to talk about how he is leaning into risk, plus we talk biotech and investment banking. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
The Senate Homeland Security Committee responds to Dr. Anthony Fauci's testimony, or lack thereof, last week on the COVID-19 pandemic.
On this vote, the yeas are 8, the nays are 5, and the motion is agreed to.
The motion to hold Dr. Fauci in contempt because he pleaded the fifth more than 100 times during his testimony. This is Committee Chairman Senator Rand Paul and Ranking Member Senator Gary Peters.
Holding a witness in contempt is a serious thing, and it should be rare. But the contempt power exists for precisely this circumstance.
Criminal contempt is punitive. It does not compel a witness to answer questions or produce the documents we'd all like to see. What it will do is create a damaging precedent that future witnesses will use to resist legitimate congressional oversight.
Republicans don't have the votes in the full Senate to follow through on the contempt resolution, so Rand Paul has been talking about passing it on straight to the Justice Department. A strike against the confirmation of Attorney General wannabe Todd Blanche.
Maine Senator Susan Collins, who's in a tough re-election fight, announcing she's a no and will vote against Blanche. Without Collins, Blanche can likely only afford to lose one more Republican vote, and at least two others are still on the fence. Senator Lisa Murkowski of Alaska and Louisiana Senator Bill Cassidy, who has increasingly been defying the president since losing to a Trump-backed primary challenger.
ABC's Mary Bruce. Foodborne illness on the rise.
That salmonella outbreak tied to jalapenos is now expanding. The CDC reports that 345 people have gotten sick across 27 states, the highest number of cases in Minnesota and Colorado. 36 people have been hospitalized.
ABC's Elizabeth Schulze. The FDA has voted to approve Moderna's first ever mRNA seasonal flu vaccine for people 50 and older. You're listening to ABC News. Debate over flock cameras, those automatic license plate readers that are either crime solvers or an invasion of privacy.
Newsweek reports officers in at least a dozen states have faced allegations of misusing flock license plate reader systems, including 10 officers in Georgia in recent weeks. Police say the camera technology has been a game changer for solving crimes.
ABC's Sophie Flay, a former North Carolina police officer, however, is facing charges for allegedly using her department's flock camera to trace her ex-boyfriend's ex-wife. In Plymouth, Massachusetts, a family nanny is taking the stand in the trial of Lindsay Clancy, the mom accused of strangling her 3 children to death. She says she was struggling with postpartum psychosis.
The former nanny for Lindsay Clancy's family taking the stand as jurors learn more about the Massachusetts mother charged in the deaths of her 3 children. Elaine Rossi, who worked for the family in the months leading up to the killings, described Clancy as a loving, attentive mother. Rossi testifying, Clancy said she was suffering from postpartum issues and having trouble sleeping. But Rossi says she never feared Clancy would harm her kids.
Did you have any concerns about her interacting with the children? Not at all. She was a wonderful mom.
Prosecutors argue Clancy made a calculated decision to carry out the killings to escape her own life.
ABC's Hannah Battah. Dozens of health workers at the epicenter of Congo's Ebola outbreak are protesting, demanding that they finally get paid. They say they haven't received wages since the start of the outbreak. This is ABC News.
If you haven't switched to Pure Talk...
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube and we're streaming live at Bloomberg.com as well. This is the Bloomberg Intelligence Program. Scarlett Fu and Paul Sweeney with you. Stocks kind of mixed on the day here. Coming up, we're going to check in with Dan Williams, reporter for Bloomberg News, based in Jerusalem, to get the latest on the Middle East. Shanna Sissel, founder and CEO of Banrion Capital Management. She'll join us and give our outlook for the markets. Mandeep Singh is going to join us here, global head of tech research for Bloomberg Intelligence. And we've actually got a a listener kind of writing in and has a question about AMD, so we'll get that from Mandeep as well. Geetha Ranganathan joins us here, talk to us about Warner Brothers. Fox reported earnings, Paramount, a lot of earnings coming out of the media. What are we learning about all the streaming business? How profitable can it be? Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst, talks about, we had some restaurants report some earnings. Burger King, big fan of the Whopper. We had some restaurant brands also report. So we get a lot of earnings coming out of the restaurants. We'll get a sense of what's going on there. Beginning now, Bloomberg.com subscribers can shape the conversation on Bloomberg Radio. Submit questions for the experts and guests on our show, and you can then visit Bloomberg.com/AskRadio to submit your questions. It's an exclusive feature for Bloomberg.com subscribers and terminal clients. So visit Bloomberg.com/AskRadio to join the conversation. Right now, let's go to Alexis Christophers and get a Bloomberg Business Flash.
All right, thanks a lot, Paula. Sell-off in tech companies, keeping a lid on stocks here ahead of tomorrow's all-important monthly jobs report from the government. Also, higher oil prices, raising concerns about inflation. That is lifting bond yields. Let's start with the equities market, where the S&P 500 is up about 12 points. Dow Jones Industrial Average pulling back from that record high we saw yesterday, down about 28 points. But the NASDAQ composite is up 60. But if we zero in on the NASDAQ 100, it is down about 45 points. Brent crude up 1 3/4% at 80.85 a barrel, and West Texas Intermediate crude now at 76.15 a barrel, up 1 1.25%. The Bloomberg Dollar Spot Index up fractionally at 1204.20. As for some stocks on the move, shares of Peloton tumbling 12%. The fitness tech company forecast revenue for the fiscal year that came in well below estimates. It now expects hardware subscriptions to fall 10% this quarter compared with a year ago. We've also got Planet Fitness down more than 5% after it cut its outlook on sluggish member signups. And Burger King's U.S. sales surged last quarter, comparable sales jumping 8.5%. That's thanks to an upgraded Whopper and promos like its Star Wars meals. They proved to be a hit with customers. Shares of Burger King's parent company Restaurant Brands a little changed. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christophers. That's a Bloomberg Business Flash. Paul and Scarlett.
All right, Alexis, thanks so much. We appreciate that. It is Scarlett Field and Paul Sweeney live here in our Bloomberg Interactive Broker studio and streaming live on YouTube as well. As Alexis was just reporting, red and green on the screen, but let's take a look at some of the stocks on the move, and we can do that with Christine Aquino. She's a managing editor for Markets Live. Christine, what are you looking at today?
All right, Paul, let's start with Moderna this morning. So ticker mRNA, that stock is in the green. Shares are up now more than 1%. And that is because the company won U.S. regulatory approval for a flu vaccine based on mRNA technology. So the vaccine is approved for adults 50 and over. And then there is traditional approval for patients between 50 and 64 and an accelerated approval for those 65 and older. So Bloomberg Intelligence's Sam Fazeli and Max Neeson are actually saying there's only modest potential for this vaccine, given that the space is very competitive. We have Sanofi and GSK with their flu vaccines as well. But what it does is that it does set the scene for the FDA to consider next steps for the more important flu plus COVID vaccine. So this is kind of like an intermediate step for Moderna, but clearly a positive for the stock today.
All right, keeping an eye on that space. Also, a name that brings me shudders as a mom of a teenage son, DoorDash.
Yeah, trying not to do too much DoorDash myself, Scarlett. But yes, so DoorDash, so ticker DASH. So those shares were much higher in pre-market, but now that we're about half an hour into the open, appearing some of those opening gains, now just up 0.4%. But they did have a pretty solid set of results. Second quarter revenue and adjusted EBITDA beating estimates, but then on the downside, free cash flow and EPS missing expectations. Now, very interesting because DoorDash also gave us an outlook into their plans. Where are they going to be putting their money in terms of the technology spent? Apparently, a lot of that is going into its in-house robotics efforts to build delivery robots and drones. I think we're a little lukewarm on the idea of delivery robots and drones.
I'm still waiting for the Amazon drones to deliver packages. How about Honeywell?
All right, Honeywell. So that stock is very much in the red this morning, one of the biggest decliners on the S&P 500, ticker HONA. Shares are down now more than 20%. I mean, a lot of disappointment over its reduced outlook for the full year, and that is reflecting their supply chain issues. Second quarter organic growth of 4% to 5%. That's disappointing to RBC Capital Markets. They're saying that the valuation is attractive, but there is a lack of catalysts in the second half of the year. I mean, Honeywell is saying that they are still grappling with industry-wide constraints for certain components, and there is a small group of suppliers with increased output that is just expected to slow down in the second quarter.
All right, so supply chain challenges are an issue here. Christine, thank you so much. Christine Aquino is our Markets Live managing editor, and for more conversations like what you just heard, subscribe to our Stock Movers reports. These are 5-minute audio reports on the biggest winners and losers in the stock market. They're available on Apple Podcasts, Spotify, or anywhere you listen. So there's this possible Iran-Oman deal on the Strait of Hormuz that notably, Paul, does not include the U.S.
I saw that. I don't. Maybe is that just because we don't really flag any tankers, or
could be? It's not clear what this means, but the oil markets are pushing a little bit higher as traders await some kind of announcement on this. So let's bring in Dan Williams. He's a reporter for Bloomberg News based in Jerusalem on the latest here. So Dan, just take a step back and explain to us this deal between Iran and Oman on the Strait of Hormuz and whether it can work if the U.S. is not party to it at all.
Well, it's all very mystifying. You recall that 48 hours ago, you and I were discussing this very same issue, and then it seemed imminent. It seemed imminent yesterday. It still seems imminent. That's at least to judge by what was said by the deputy Iranian foreign minister, about the agreement being there in principle. The essential problem appears to be a basic disagreement over the parties involved in the negotiation. The president of the United States, Trump, saying this is essentially a bilateral deal between enemies that could lead to further deals unwinding this war. That's what his administration says. The Iranians say the Americans aren't even involved, that this is a bilateral deal between Iran and Oman. That's Iran's neighbor just across the water. So when you have those basic elements in disagreement, it's really hard to see how a satisfactory final deal can be achieved. I think, though, the moment there is a free flow of traffic, albeit controlled by those two countries, potentially giving the Iranians a degree of control they never had before the war, and even service charges, what they're calling service charges, but would effectively come down to some kind of toll, a tribute, money going into the Iranian coffers. The Americans could hold that out as a resumption of free traffic. Potentially that would be enough for President Trump to say that the Hormuz has reopened, and for the Americans to review their own position in the Gulf and their position in this war.
So do we believe that the U.S. at some point may become a party to this deal? Because again, it just feels like nothing can happen unless it's Iran and the U.S. agreeing here. I mean, Oman can play a part in facilitating negotiations, but at the end of the day, it feels like it's got to be Iran and the U.S. agreeing to something.
Yeah, the principal players.
Yeah.
One imagines when we had the previous MOU, previous ceasefires, declarations Hormuz would be reopened, there was actually a fairly slow trickle of shipping in there. The shipping industry is very, very risk averse. It's heavily insurance driven. And even at the time, there were the reports of U.S. warships escorting ships and the like, civilian vessels, cargo vessels, making their way across that waterway. I would also imagine that a deal freeing up the Hormuz would require a satisfactory demining of Hormuz. That would potentially require the involvement of European, perhaps even American ships in the future. So willy-nilly on the ground, or if you like, on the water, there would be a U.S. participation, I imagine. However, it apparently is very important for the Iranians. They were, after all, the side that was attacked by Israel and the United States on February 28th. They are the side that is expressing grievance here. They've certainly had a position of defiance, and I think their position is they cannot acknowledge any kind of should we say, beneficent arrangement with the United States when they're still officially on a war footing. So it benefits them domestically, it benefits them in terms of their regional standing to tell everyone that the U.S. is not their interlocutor. So the question is whether Oman is a third party or whether it's a mediator or whether, as far as the Iranians are concerned, it really is a bilateral player. But obviously the US Navy is unignorable there, and it will have a say on the water, if not on paper.
Now, we'll recall that over the weekend, President Trump called off a new round of attacks on Iran, and that has helped oil prices come down. And he wanted to give diplomacy a chance. What is the latest on talks between Iran and the U.S.?
Right now, they appear focused on this very, very limited issue. I would cite the U.S. Secretary of State, Rubio, saying that he hopes once this is resolved, it could lead to wider discussions of other issues that were the nub of this war by the United States and Israel against Iran, namely, chiefmost among them, Iran's nuclear program, which the allies want to see stripped down entirely as part of the resolution of this war. Again, that is the account being given by the United States. To hear the Iranians tell it, that's simply it's a no-go area. They're not going to discuss what remains of their nuclear program. It's very hard to see what leverage the allies would have other than resume military force in order to get that issue addressed anew.
Dan, thanks so much for joining us. Really appreciate it. Dan Williams, reporter for Bloomberg News. He's based in Jerusalem, so really boots on the ground reporting there, and we appreciate getting some of his time. But it doesn't really seem, Scarlett, like much is getting done, or if there's going to be any type of deal announced in the near term. It seems like at the very least it's going to be very narrow as it relates to the Strait, and maybe even have a lot of parts that a lot of the shippers aren't going to like perhaps some type of fees or tolls or something.
And you wonder how much the announcement from the White House that there's not going to be any further attacks for now, that they're giving diplomacy a chance, was driven by the fact that yields had gone way up at the end of last week, right? The 30-year bond yield had gone to the highest in almost 20 years. The 10-year bond yield had been the highest in about a year and a half. Did that cause the president to then come in and say something soothing, essentially, to the bond market?
Yeah, we saw that before with tariffs when the 10-year got to 450, and that seemed to be a level where a lot of folks in the marketplace felt like that was kind of maximum pain for the White House as it relates to tight financial conditions, and maybe that was also a reason here, so we'll keep an eye on that. I mean, again, just looking at the 10-year today, up a couple of basis points, maybe 3 basis points, 4.64%. And remember, this is a bond that for the last several years has been in that kind of 375 to 450 range.
New regime.
New regime, and so look a little bit higher for longer, perhaps, is kind of what the bond market's telling us right now. On the equity indexes, kind of mixed noise out there, if you will. S&P up 17 points, the Dow minus 58 points, the NASDAQ up 110.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Alexis Christoforous. Stocks are relatively unchanged as traders keep an eye on the Middle East with a deal to reopen the key Strait of Hormuz apparently in the works. Wall Street also weighing a slew of corporate earnings releases. Let's get to the numbers where the S&P 500 is up 16 points. The Dow Jones Industrial Average stepping back from yesterday's record high, now down 65. And we've got the NASDAQ up by 125 and the NASDAQ 100 erasing an earlier slide, now up by 42 points. Brent crude up nearly 2% at 80.87 a barrel. And West Texas Intermediate crude 76.21 a barrel, up more than 1%. Lots of stock news we want to get to. Shares in United Wholesale Mortgage are plummeting 40%. The home mortgage lender announced a net loss of more than $450 million. It's also suspending its dividend for the very first time. Shares of Western Digital down 11%. SanDisk giving back 5%. Both data storage companies serving up profit outlooks that disappointed Wall Street. But shares of Ralph Lauren climbing about 8%. The company boosted its outlook after revenue jumped 14% last quarter. And all eyes on SpaceX, the stock up now 6%. More than $100 billion worth of SpaceX stock becomes available for trading today. A lockup agreement restricting insider share sales expires. It's going to make, they say, for a volatile day for SpaceX. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Paul and Scarlett.
All right, Alexis, very good. Appreciate it. I'm glad you mentioned SpaceX because we saw the stock open with a 64 million share block, and maybe that included a lot of the sellers who wanted to sell today.
Right.
Maybe they just kind of rounded them all up.
From this number, it looks like a lot of folks are deciding they're going to hold on here.
Yeah. And so,
especially when you consider the stock is down, what, 20% or less now from its IPO price, about 15% down.
Yeah, so I don't know, maybe that was a good trade to get some of those people out early, give them a block there right at the open. So we'll keep an eye on that. Looking at the markets here, red and green on the screen, and we've got about 80% of the S&P 500 has reported already. Shana Sissel joins us here, founder and CEO of Banrion Capital Management. Shana, thanks so much for joining us. Again, kind of about 80% of the S&P 500 companies have reported some pretty darn good earnings. Is it enough to continue to push this market higher, do you think?
I think so. We've seen some soft economic data, so I have some concerns. But I think if the Fed is more inclined to hike than cut, that's an indication that the economy is pretty strong. GDP came in better than expected. And I think the consumer is held up okay. So I think the stock market can continue to grind upwards. I don't know if it's, if I want to not be prepared for volatility. I think it'll be more volatile on the way up, but and I'm positioned accordingly. But I'm not defensive.
Got it. Okay, how are you thinking about bonds? We saw this tremendous sell-off at the end of last week, sending yields at the long end to multi-year highs. They've calmed down as so far this week, although we're seeing them start to creep higher once again. Is the direction of travel just higher yields?
Yeah, I think it is, and I think that's exactly what Chairman Warsh wants. I think he wants the market to dictate these types of things, borrowing costs and things of that nature, and not necessarily be as reliant on the Fed to make those decisions.
So you mentioned the Fed here. I mean, the Fed chairman, I don't think he's going to change his tune. Maybe some folks are going to be looking forward to Jackson Hole to maybe get some more information, but do you feel like this is what we have? We've got a Fed that's going to keep a tighter lid on guidance and just communication in general?
Yeah, and I don't know that I think that's a bad thing. I actually think that that's probably a good thing. The market's become far too reliant on the Fed to be completely transparent and really dictate ahead of time and be and allow the market to rely on them to kind of buoy equities. And I don't know that that was the best thing that has happened in the last 20 years. I think that there was a time where the Fed was able to do cuts, make decisions and things, have meetings off cycle as needed. And was able to use the market as a key data point. But because the market has been so reliant on the Fed to communicate visibility so far in advance, it's taken the market data point and investor sentiment kind of out of the Fed's toolkit as a way to kind of assess the economic conditions. And by being more tight-lipped, I think the Fed now is in a position where they can bring that data point back into the things that they look at when they're making decisions about monetary policy.
Shayna, what did you think of the Treasury's involvement, the U.S.'s active involvement in the intervention of the Japanese yen to keep it from weakening further as a way to ensure that there won't be any spillover into the U.S. Treasury market?
I think it's an interesting move. I don't know that I love it. I don't know that I love cross global monetary policy decisions, but in a way, sometimes the best monetary landscape is one in which we have cooperation across the globe. And so I don't love that we were so involved. I think just being able to be transparent and to have input and insight into what's going on in other countries is a good thing. I don't know that getting involved in other countries' monetary policy decisions is something I like seeing so much.
All right, Shayna, thanks so much. Appreciate it. Shayna Sissel, she's a founder and CEO of Banrion Capital Management here based in Chicago. Let's get back to the tech space, because why not? You can't stay away from tech very long, because that's what's driving the bus here. I noticed at Google, which some people call Alphabet, they've had some changes in some of their AI management ranks. I was told by a guest from Franklin Templeton, who does a lot of this tech investing, don't worry, it's okay. He's not going to be wandering far. But I want to talk to Mandeep Singh, because he knows all the tech stuff.
Yes, he does.
Bloomberg Intelligence. Mandeep, we had looks like some management changes at the all-important AI business within Alphabet. Tell us what's going on there and whether investors should be concerned.
Yeah, these are a couple of high-profile departures after, recently, I believe it was 4 weeks back, there were a couple of other names that had departed. One went to OpenAI. So the fact that Google is losing talent, I mean, these are people who have been there for very long. It's definitely not a good sign, if you ask me. And plus, their model release has been delayed. So the Gemini 3.5 version model, Pro 1, has been delayed. And from what we have gathered, the Gemini 4 is most likely going to get delayed. So this is a race about the models. And if you're not releasing a frontier model, and Anthropic and OpenAI keep creating all the news about how their models can hack, any system out there, that's definitely feels like, Google is missing at least the model lead right now. And it could change, but to my mind, this is not a positive. And I think the stock reflected that sentiment.
So we hear that they're going to really centralize their leadership to California. That kind of is the seed of everything, even though we know that, is it Larry Page or Sergey Brin who's been moving to outside of California?
Florida? Or I don't know.
Nevada.
Yeah,
okay. He went to
Incline
Reno.
Village.
Yeah, exactly. Yeah. Incline Village, which is basically California, but just across the border. What does that say about California as the center of tech talent, and how whatever efforts you want to make to try to decentralize that, to spread it out to other places, maybe lower cost places, it's kind of a fool's errand, isn't it?
Yeah, and look, right now it feels like Anthropic and OpenAI are getting the big names when it comes to, the folks who are actually training these models and, the scaling laws that are driving all the development. So from that perspective, I mean, Google is still a pretty large firm and they've got, folks all over. But there was a time when Google and Meta used to be the magnet for the top talent. It feels like right now it's Anthropic and OpenAI, and the departures kind of suggest that, I mean, even though Google has a lot going for them in terms of infrastructure, the TPUs, and all those are positives, but when it comes to the model race, I mean, that's why Mark Zuckerberg spent millions to form that superintelligence unit with 50 people, but 50 of the smartest people, and still Meta doesn't have a model that is comparable to the frontier labs. So it is a very hard problem to solve in terms of catching up to the frontier. And I feel once you slip, it will get hard.
So just to follow up on that, if you don't come out with the frontier model and you have this talent, is it just a matter of time before that talent then goes to OpenAI, Anthropic, out of frustration that they're not making more concrete progress?
I mean, it sounds like, especially with Jeff Dean and a couple of guys that left, this week, there was an element of frustration, and that's been the case with Google since the ChatGPT days. They invented the transformer. Why weren't they the first ones to release a product? So it keeps coming back with this management team. It's like you're not releasing new products fast enough, and yes, they have to defend that search business, which is the cash cow, which is what feeds everything. So I can see both sides, but when it comes to talent, they'll go to the place where they see, a lot happening in terms of new products, model development. And so maybe Google is being conservative on the model side for a good reason. They have to defend search.
I think what we're all coming to appreciate more is this stuff's expensive to do this stuff. And now, and Google's out today with a $25 billion bond offering.
Yeah.
They can raise capital at the snap of the fingers.
Yeah.
How about like the Anthropics and the OpenAIs of the world? I mean, at some point, they got to start hitting the capital markets, I would think.
I mean, the interesting anecdote here is a lot of Google's cloud revenue comes from Anthropic running their workloads on Google. In fact, Anthropic's models are even trained on Google TPUs. So Google is the infrastructure provider for Anthropic, but at the same time, they're competing at the model layer. So it is kind of quite intertwined when you think about this race, and it's very concentrated. But I don't think Google cares about it being expensive,
Before we let you go, there was a viewer, or I should say a listener question for you today. And it has to do with advanced micro devices, which is higher today by about 1.8%, but it did plunge about 7% after its latest set of results. How come AMD stock fell flat when it reported earnings after the market closed on Tuesday? What's your read on those results and why investors reacted negatively?
I mean, right now, when we hear about how supply constrained the market is, and, we keep seeing with NVIDIA's numbers every time they report, they just beat and raise in a big way. With AMD, we didn't see that big beat and raise. And that's how the whisper numbers are always higher. You see the reaction with SanDisk today, the stock is down. They had a phenomenal growth quarter. So that's where, expectations and even the consensus numbers are much lower when you compare to what the companies are measured against. And AMD had a good quarter, but then it wasn't something to wow, and have that snap positive reaction.
All right, Mandeep, thank you so much. Appreciate it. Mandeep Singh, Global Tech Research Head for Bloomberg Intelligence. There's the sell-side consensus, and then there's the buy-side consensus, the buy-side whisper number, and that's actually more important.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
10:40 on Wall Street. I'm Alexis Christophorous from the Bloomberg Interactive Brokers Studio. Wall Street traders are refraining from making any big bets on stocks in the run-up to tomorrow's monthly unemployment report, with higher oil prices raising concerns about inflation, and that is lifting bond yields. At the moment, S&P 500 is flat. Dow Jones Industrial Average down 135 points after closing at a record high yesterday, and the NASDAQ Composite now in the green by 44, but the NASDAQ 100 is down by about 41 points. Brent crude up 2% now at its highs of the morning at 81.08 a barrel. WTI crude up 1.5% at 76.41 a barrel. And the Bloomberg Dollar Spot Index up about 0.1% at 1204.60. As for stocks on the move today, we have got shares of Zillow down 12%. That is the most in 6 months. The online real estate platform providing a revenue forecast for the third quarter that missed the average analyst estimate. Meantime, not a lot of fun for shares of Six Flags today. That stock down about 17%. Its quarterly loss widened as fewer people visited its amusement parks. And we have got shares of LegalZoom plunging 30% after the firm's third quarter and full year revenue forecasts both missed the mark. Spot gold at $42.72 the ounce, and Bitcoin down 0.4% at 64,514. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christophorous. That's a Bloomberg Business Flash. Paul and Scarlett.
All right. Thank you so much, Alexis Christophorous. This is Bloomberg Intelligence with Paul Sweeney, Scarlett Fu, and Alexis Christophorous. And we are in earnings season, and right now the big media companies are taking their turn publishing their latest results. Warner Brothers coming out with numbers. The sales declined after it lost the NBA rights, but I don't know that it matters that much given that this is a company being absorbed by Paramount eventually. Potentially, yes. Right now, that's kind of on hold, but the thinking is that it will be. Fox also came out with the results. The World Cup was certainly a good thing for that company. Let's bring in Geetha Ranganathan. She is our analyst on U.S. media, joining us from Princeton. Geetha, of the results that came out, what gets your attention?
Yeah, I mean, you pointed out Warner Brothers Discovery. Yes, you know, the earnings, as you said, Scarlett, and rightly so, is definitely the sideshow for the moment. But I think, you know, things could change very quickly, and it could be the main piece here, because we're really looking at a company, and I think everybody now is kind of thinking of what happens if the Paramount Skydance deal falls through. And, you know, we know that the merger agreement terminates on June 4th of 2027. And if Paramount Skydance can't get its act together and can't settle out of court, there's a very high probability that they actually lose this trial, and then they are in really bad shape. But Warner Brothers Discovery actually is doing a lot to improve its fundamentals. We saw some pretty decent results, at least on the streaming side of the business, as well as, on the TV network side. Yes, the loss of the NBA definitely hurt them, but it also helped them on the expense side, because, the EBITDA declines that we saw, we were seeing something like, 25, 30% EBITDA declines last year. Those really moderated now to around 4 to 5%. So there was some good news there as well. And then, as you pointed out, for Fox, of course, huge quarter there with advertising. But again, the bigger story for Fox is also its pending deal for Roku. So a lot of M&A stuff kind of overshadowing the fundamentals here.
And I saw that Fox said they're not going to reopen the NFL negotiations until, towards the end of the 2029 season. And I know there was some pressure maybe to do something sooner because the NFL knows that they can get a big increase in rights. What's the status there?
Yeah, so, this was always a huge downside risk for Fox, Paul. So I think, just by them kind of, kicking the can down the road, it's a huge sigh of relief, I think, for investors, because Fox was very, very heavily exposed to the NFL. We ran some numbers, and we thought that if the NFL actually did manage to secure a big rights increase, that would pressure Fox EBITDA by about 30 to 40% almost, just because of the exposure. So this definitely, really helps kind of the investment case and gives them a lot of breathing time, if you will, to figure out everything with Roku.
We talk a lot with Randall Williams, he's our Business of Sports reporter, about the possibility of a strike for the MLB season at some point because of the discussion on some kind of salary cap. If that happens, Geeta, who's most exposed? Who among the big media companies would be most exposed? And is it as bad as we think it is? Because, I mean, the MLB is not the NFL. There are so many games that the MLB plays as opposed to, just the limited number of games for the NFL.
Yeah, there's definitely, some overhang, Scarlett, but as you pointed out, not a whole lot of exposure from the national side. On the national TV rights side, remember the MLB has a lot more local TV rights exposure. It used to be the case with the RSNs. Of course, that business has been in secular decline. But yeah, some exposure definitely for Warner Brothers Discovery with the Turner Networks, for Fox. But I think all of it can be mitigated with, the presence of other sports programming.
Did Warner Brothers, with this earnings release, did they comment on the pending deal with Paramount? Did they give you any color as to how this might play out?
I mean, it was all just really boilerplate commentary. They said, that they are hopeful that the deal closes, but, I think at the same time, they do very much realize that, things could go south. And I think David Zaslav is definitely prepared for that contingency. Remember, Paul, if the deal doesn't go through next June, they do collect a nice big fat check for $7 billion, apart from, of course, the $650 million ticking fee that goes into effect on October 1st.
Right, and that would be Paramount Skydance paying for it, and a lot of that backed by Larry Ellison when it comes down to it. We did hear, though, that the UK regulators have approved the Paramount Warner Brothers deal. Does that move the needle at all, Geeta, or is it just kind of checking the box?
Not at all, Scarlett. Okay. Really, the biggest thing right now for the Warner Brothers and the Paramount deal are the 12 state AGs who have filed a motion to basically block this merger. And it looks like the judge, everything seems to be kind of favoring the courts right now. So Paramount is really in a difficult situation at this point.
I've been trying to read up on this, but is there any type of out-of-court settlement that Paramount could get that would be still preserve the merits of the deal while satisfying these states?
Yeah, it's really a double-edged sword. So if we listen to Rob Bonta, who is the AG in California, he really seems to not be favoring a settlement. Structural remedies are always possible, Paul, but then as you pointed out, does that then get Paramount the $6 billion in synergies that they've promised? It's really going to be a very, very tough road. Obviously, Paramount doesn't want to give up any of its assets. They want to get away with as few structural remedies as possible, but they might have to, actually end up selling a big portion of the TV networks business, or maybe even some of the studio assets.
So, Geeta, operationally, then, Warner Brothers Discovery, Paramount, Skydance have to continue to move forward as independent companies, right? Like they can't really. Can they do a lot in terms of, looking at operations and seeing where there are synergies, or they just have to continue as is?
Yeah, so they are continuing as is. And actually, ironically, they both are doing kind of okay, just kind of given the situation. So Paramount, what we saw in their results was they actually posted pretty strong profits. And a lot of that was driven by the synergies with the Skydance transaction. So what we saw and what really, I think, surprised even the street was that if you looked at the TV network business, we've seen margins of about 25%. Just with all of those synergies in the business, they kind of took that up to almost 35%. So there's obviously a lot of cost savings to be extracted, which is really what the street is banking on with the whole Warner Brothers Discovery transaction, since they've outlined about $6 billion in cost savings. On the Warner Brothers side as well, we saw, again, they're managing the decline in the TV networks business pretty well. Streaming has been an absolute standout, Scarlett. They've really, really made fantastic progress when it comes to profitability. They posted margins of about 17%. And remember, their long-term target is 20%. So they're really in pretty good shape. The studio is a little bit of an up and down. But we do have a pretty exciting lineup. I mean, we have Dune coming a little bit later this year, and then, of course, The Digger with Tom Cruise, which is, expected to do really well. So that'll be interesting.
All right. I've seen some of the images of Tom Cruise in his new makeup for this movie. You can't recognize him. Old
and kind of fat,
yep.
or really?
Yep. You've never seen
kind of like Tropic Thunder when he played that studio executive.
Not that bad. This is more like I don't know, but it just looks like a regular guy, not Tom Cruise.
Not Hollywood handsome Tom Cruise.
Exactly. Geeta, thank you so much for that overview. Geeta Ranganathan, she is the media analyst. She covers it all. She does it all on that media business there. So yeah, it's a different look for Tom Cruise.
Well, new stage in his career.
I guess so. S&P punched on the day. Dow minus 180. The NASDAQ up 33 points. Not a lot moving there in the markets. We'll have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube, and we are streaming live on Bloomberg.com as well. We had some restaurant numbers come out. Restaurant brands, they own a whole bunch of different brands like Burger King, Tim Hortons, Popeyes, all kinds of brands there, and they reported some numbers that kind of beat estimates, so some pretty solid numbers there. I think Burger King actually did well as well. Michael Halen joins us, Senior Restaurant and Food Service Analyst for Bloomberg Intelligence. Hey, Mike, talk to us about food, restaurant brands. What did we learn about the restaurant business today?
Yeah, it was a good report. Burger King US, had a great comp, high single-digit comp, man. They're doing a really nice job there, taking share in the quick service business here in the United States. International, which has been very strong for this company for quite some time, continues to do really well with, just newer restaurants and less competition overseas. But, Tim Hortons was about flat. That chain has done really well in Canada for the last 2 years, and now it's lapping some difficult comparisons. And so the street might have liked to see a little bit better result there. And Popeyes continues to struggle. So as we see quite often with these multi-brand companies, not all chains are firing at firing at the same time. But, you know, generally with Burger King and International doing well, and then with the refranchising of Burger King restaurants here in the United States, we're seeing some pretty good EBITDA margin expansion. So I'd say overall, it's a pretty good report.
And of course, I like the restaurant brand's ticker. It's QSR, short for quick service restaurants. Michael, how do Burger King's numbers in particular compare against McDonald's, which came out with results earlier this week and were kind of disappointing to the point where they needed to change leadership as well?
Yeah, and I think there's when you see McDonald's slow, that tends to help other QSR chains. But, you know, I would suggest most of this gain here at Burger King is due to the changes that they made over the last few years. Patrick Doyle, chairman of the board, you know, bought into this chain some years ago and has done a really good job of mentoring the management team and helping them turn that business around. You know, one thing I thought was interesting that McDonald's mentioned on their call was that they need to get more families back in the stores. And you know, it sure seems like they mentioned that because Burger King seems to be taking some share there. They pointed out how strong kids' meal growth was over the last year. And so Burger King really seems to be firing all cylinders here. There was a lot of opportunity to improve the quality of the stores, which they're doing with the remodels, to improve the quality of the product, which they've done with the Whopper. And you know, now they're really focused on the operations and getting people in and out of the store quickly.
Okay, speaking of burger joints, yesterday, Starboard Value CEO Jeff Smith was on Bloomberg Deals telling Danny Berger exclusively that the firm has built a new stake in Shake Shack, and he described himself as probably the biggest single shareholder in the company, active shareholder, describing it as a great undervalued brand. And kind of what he wants to see is more franchising domestically. You've been looking at Shake Shack. Is this something that can be done quickly?
No, this is really interesting because, you know, I would say this is not the standard activist playbook. The playbook is typically find a management team that's been underperforming, replace them, and get the core business running more effectively before you start to accelerate growth, right? And so we see a chain here with some headwinds and some issues, and that isn't part of their formula this time, right? They hired Rob Lynch at Papa John's some years ago when they were involved in that stock. So that's the first thing that was kind of interesting. The second part is franchising is a completely different muscle, right? This is not something that you can just, you know, you wake up one day and decide to do and people just line up and open stores, right? Like, this is a completely new muscle. It's a relationship and a marketing business. They're going to have to hire corporate team members to actually grow this business. And then it's not something that's going to hit the P&L for 18 months, right? So it takes about that long to get restaurants approved, approved, and built. You know, and so this is a really curious investment in our view, because who knows what the restaurant business is going to look like 18 months from now when this catalyst actually starts to kick in.
30 seconds, Mike. When is In-N-Out Burger going to go public?
Last I've heard is that is not what they want to do. And also, unfortunately, another thing they don't want to do is expand east of the Mississippi.
I'm not into their fries.
What's that?
I don't like their fries.
Yeah, they're okay. They're okay.
Your fries have to be top notch to be like a good burger place.
I'll still hang on the McDonald's fries. Win it for me.
Yes, McDonald's fries are kind of the gold standard.
Mike, thanks so much for joining us. We could do a French fry discussion for an hour here, no question.
Experts here around the table.
Everybody's got an opinion. Michael Halen, Senior Restaurant and Food Service Analyst. He's the only one that gets paid to do it, though, for Bloomberg.
Yeah, we're paying for our fries.
Following all the restaurant stocks there. So we'll see how it goes. Look at the market here, kind of mixed and not a whole lot going on, so we're not going to highlight it here. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metal. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence begins in just moments. WTI crude oil up $1.40. That's almost 2%. and we're at $76.60. A little bit of angst coming out of the Middle East today. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Thursday morning. This is Bloomberg Intelligence, broadcasting live from the Bloomberg Interactive Brokers studio in Midtown Manhattan. We are streaming live on YouTube as well. Paul Sweeney, Scarlett Fu, and Charlie Pellet with you over the next hour. We've got a lot to go over today, especially with news that Fed Chair Kevin Warsh has admitted that he's made some mistakes in his communications so far. It's only been a short tenure, but he's fessing up to that. And so we're going to see how that all plays out. Ira Jersey, our chief U.S. interest rate strategist, will join us to talk about that and to take stock of where the economy is. B-Tech anchor Ed Ludlow will be speaking with the CEO of WD, Western Digital, of course, another memory company. So that gets our attention. And we're going to check in with Grace Lee. She's a senior portfolio manager at Columbia Threadneedle. Get her take on the markets. Mary Ross Gilbert, our senior equity analyst covering retail, will recap earnings from the high end of retail apparel. Ralph Lauren coming out with first quarter results. Just a reminder that Bloomberg.com subscribers can always shape the conversation on Bloomberg Radio. How? By submitting questions for the experts and guests on our show. You can visit Bloomberg.com/AskRadio. This is an exclusive feature for our subscribers and terminal clients. Remember to visit Bloomberg.com/AskRadio and join the conversation. All right, let's bring things over to Charlie Pellet for a check on the markets right now with our Bloomberg Business Flash.
Hi, thank you very much, Scarlett and Paul. Good morning. Ralph Lauren, you mentioned, up now by 5.4%. We've got the Dow retreating from a record. Traders refraining from making big bets on stocks in the run-up to tomorrow morning's jobs report. S&P 500 index holding close to a record. NASDAQ and the NASDAQ 100 index both pushing higher. So right now, the Dow is down 161 points. That is a drop now of 0.3%. S&P 500 index higher by 8 on the S&P, a gain right now of 0.1%. To underscore, holding close to a record, NASDAQ up 83, NASDAQ Composite up 0.3%. NASDAQ 100 index up 0.1%. All of this with the stocks surging. The Philadelphia Stock Exchange Semiconductor Index bouncing around, no stranger to volatility, up today by 1.9%. The VIX just above 15, the 2-year 4.22%, the 10-year 4.64%, the 30-year 5.18%. Gold up $22 the ounce, 42.70 right now. Spot gold up by 0.5%. Crude big story today. You guys have been touching on it all morning long. WTI 76.69 a barrel, up 2%. Barrel of Brent 81.31 right now, up by 2.3%. Shana Sissel is founder and CEO at Banrion Capital Management. And right here on Bloomberg Intelligence this morning, she told us the economic fundamentals do support further gains for stocks.
We've seen some soft economic data, so I have some concerns. But I think if the Fed is more inclined to hike than cut, that's an indication that the economy is pretty strong. GDP came in better than expected. And I think the consumer is held up okay. So I think the stock market can continue to grind upwards.
Shana Sissel of Banrion Capital Management, interviewed right here on Bloomberg Intelligence. Oil higher, we mentioned, WTI 76.69 a barrel, up today by 2%. The oil super majors are surging today, actually moving higher. We've got ExxonMobil up 0.5, Chevron up by 0.9%, ConocoPhillips up by 1.2%. Scarlett and Paul, that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio in New York City. We are streaming live on YouTube as well. As Charlie's just reporting some red and green on the screen. Let's take a look at some of the stocks on the move today. We can do that with Judy LeGroux. She's an equities reporter for Bloomberg News, joining us live here in studio. Judy, what are you looking at today?
Good morning. Have you had a Celsius energy drink lately?
Absolutely not.
Okay, I also do not consume energy drinks.
Okay.
But Celsius Holdings is on our list. Ticker CELH. The stock is down as much as 17% in today's trading, and it is on track for its biggest drop since November and its lowest price since last March. And this is coming as the maker of energy drinks like Celsius, Rockstar, and their fast-growing women-focused energy drink called Alani Nu reports their second quarter revenue and adjusted EPS that came in below expectations as competition really hurt this company's sales. So, for example, Celsius sales growth was reported at 11%, but the consensus was at 18%. In addition, Costco, who was once a big retailer of Celsius energy drinks, came out with their own line of energy drinks, which the CEO noted on the earnings call put pressure on Celsius's sales. JP Morgan analysts wrote also that, quote, volatility and often disappointment between the retail performance and the company's P&L remains frustrating and difficult to forecast. So bad day for Celsius.
All right, keeping an eye on Celsius going forward and all the other companies that sell those energy drinks. Next up on your list.
SoundHound AI. The speech recognition software company's shares are soaring today as much as 27%, and it is on track for its highest jump percentage-wise in about a year. The company shares, however, are down about 23% year to date, and this is coming after the software company reported better than expected second quarter revenue and raised its full year revenue guidance above Wall Street estimates. And the rally might have been fueled by some short interest. So what we are seeing on the terminal is that about 43% of SoundHound's public float, or about 170 million shares, have been sold short. And so this sort of movement here, we're seeing also possibly a large number of investors who bet against the stock are being forced to cover their positions right now. So definitely interesting movement there for SoundHound AI.
All right, one more.
Sure. So MetLife today reached a record high price since they went public back in 2000, if my records serve correctly. Ticker MET. Shares are climbing as much as 4.9% on the day, and this is after the company's second quarter earnings that were released post-market yesterday surpassed expectations, boosted by strong underwriting, volume growth, and the success of their own 5-year plan. With Piper Sandler analysts writing that the beat was really driven by group benefits and Latin America, where the company is experiencing strong growth. And Jefferies and TD Cowen analysts also pointed to Asia growth as impacting their earnings beat as well.
Yeah, you look at the stock, it's been on a tear since late March, up 48%. A pretty steady climb there. All right, Judy, thank you so much. Judy LaGrue, she is one of our Bloomberg News reporters, and for more conversations like what you just heard, subscribe to our Stock Movers reports, 5-minute audio reports on the biggest winners and losers in the stock market. Stock Movers is available on Apple Podcasts, Spotify, or anywhere you listen. All right, we saw some big moves in the bond market at the end of July, and then things have calmed down in August. I mean, yields are higher today, but not necessarily what we saw at the end of last week. And
Moving around.
But
I think generally higher for longer is kind of the feel.
That's what it feels like. Yeah. Let's bring in Ira Jersey. He's our chief U.S. interest rate strategist for more on where things are headed. And I wonder, Ira, how much of this is still just people trying to understand how the Fed's going to move forward, because Kevin Warsh has made clear he doesn't want to spend a whole lot of time on forward guidance the way his predecessors did, and it's really thrown the bond market for a loop.
Yeah, well, that's a big challenge for the market, and it's not only that he hasn't provided forward guidance, he also hasn't provided yet what the Fed's reaction function will be to various data sets, right? So even though he said, look, we have a hard 2% inflation target, well, if that's the case, then why aren't you raising interest rates, right? And that's where I think the disconnect is between the market and Kevin Warsh's communication. I think it's okay not to give as much forward guidance and promise what you're going to do directly, but you at least have to guide the market to what the potential outcomes are depending on the data, right? If you don't want to forecast the data because you know you're not a good forecaster and you want to use back backward-looking data. You still have to tell the market, here's what we do if, X and Y happen. And that's where I think the market has kind of fallen down on his communication policy so far.
All right, you kind of answered the question I was going to ask, which is, what is a reaction function, by the way? But it's just basically just saying, hey, if some data comes in certain ways, this is how the Fed is likely to react. Is that something, a reaction function, that has been better signaled by past Feds?
Well, when you go, there's actually this underutilized statement of longer-term intent, which you can actually see and go on the Fed's website, and they published it in January, where they said, like, look, we want inflation to be around 2%, but we recognize that inflation might run hot a little bit because employment is weakening, right? So they do have this dual mandate, which Kevin Warsh and other Fed chairs have always said they're not in opposition, but sometimes they are in opposition. Like, let's face it, there's times when you have to choose which one of those two things is more important to how you're going to react, and that's where the reaction function kind of gets dicey, right? Because if inflation's high and it's running above 3%, and you want it to be 2%, then maybe monetary policy is not tight enough.
So there's another element here, which is you've got some big tech companies raising a lot of money in the corporate bond market. Alphabet, the latest example, a 10-part investment-grade bond sale, $25 billion, and includes maturities of 10-year, 20-year, 30-year, and 40-year. Ira, is this competition for capital and helping to support higher treasury yields? Paul talked about higher for longer. We know these hyperscalers are going to raise more money by selling debt. So does that compete for investors' capital?
Well, it does to some degree, but also, Treasury having such large budget deficits also does the opposite, right? It's, there is potentially a crowding out effect, and that's one of the reasons maybe why you see credit spreads being so tight. So yes, I mean, look, overall aggregate supply matters, and therefore, do you have enough demand to meet the duration that's coming out? Now, I think one of the reasons why you've been able to raise money out of a lot of these hyperscalers is because a lot of them are new names and just names that people don't have in their portfolios. So it's a diversification play. The yields are attractive enough for some people to get involved. But on the Treasury side, and this is something we pointed out in a note a week ago today, is that that long-end investors who want to invest in sovereign bonds globally, they now have alternatives, right? So not only is the Treasury Department competing with corporate bonds, but also like Japanese yen now, you can buy a 30-year Japanese yen bond at 4%, hedge it into Taiwanese dollars, and it yields more than Treasuries. So that matters a lot, too.
All right, Ira, thank you so much for joining us. I'll rush out and do that as we speak. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. Let's head over to Bloomberg Television right now and join a conversation with WD CEO Irving Tan, sitting down with Bloomberg Tech's anchor Ed Ludlow. Let's listen in.
Demand from hyperscalers, neoclouds, physical AI remains very robust, and we continue to see over 25% CAGR demand from a demand perspective over the next 5 years. Right. Similarly, on the supply side, we have a very robust roadmap that we have put in place that will be able to meet this demand. And so it's pretty much a function of just quarterly transitions that we're going through.
Irving, what you're touching on there is, storage is distinct in many ways from what's happening in memory. In some ways, highly analogous, right? There is a pricing story there. There is a demand outpacing supply story. And your industry facing the balancing act of expanding output, manufacturing capacity on a permanent basis or not. How are you managing all of that?
Yeah, so first of all, thank you for highlighting that. There's a clear distinction between memory, which is like NAND and DRAM, versus storage, right? Because memory and like compute is being recycled all the time for different workloads. But the data that's being generated continues to be stored. It isn't getting deleted. So the amount of data storage requirements is just compounding over time, which puts a lot of more demand on our products on an ongoing basis. And how we're trying to solve for that is really through technology. We're not investing in increasing the number of drive units we're producing. We continue to invest in technology to increase the amount of hits and media that we produce, because that's the big driver of capacity in a drive. So we're currently shipping a 32 terabyte hard drive as our top of the line drive. but starting this quarter, we'll be shipping a 40 terabyte drive. So that's an ability to drive over 30% capacity to customers without adding any unit capacity.
Could you go into how that works? You know, bring a 40 terabyte drive to market, the engineering complexity of it, and how much do the customers have to sort of re-architect their infrastructure to accommodate for that new generation of HDD?
Yep. Well, hard drives are actually, as an engineer, I always view hard drives as a marvel of engineering. We use 2/3 of the periodic table in our product. So as we move from capacity point to capacity point, there's a lot of re-engineering that goes on into the recipe of our media designs, the recipe of our head design. So it's quite an engineering feat. Obviously, we have great teams that have years of experience doing that. At the same time, we work very closely with our customers to make sure we go through very robust qualification processes, because customers are very sensitive to the quality and reliability of their data storage capability.
The other sort of highly analogous factor that's in front of you is long-term agreements. With the memory market, we see long-term agreements coming in as well. So you have these in place like 2029, 2030, 2031. How do you know how to price an agreement today going that far into the future?
It's a really good question. We do have LTAs in place locked in till 29. We have customer demand. Customers are coming us to put LTAs in place to support demand for 29, 30, and 31. They have really good visibility in terms of the storage requirements that they need, because they're looking at the entire AI infrastructure stack, everything from GPUs to CPUs to HBMs to NAND to storage. And they realize they have to take a much longer term time horizon in terms of how they plan. So we are working very closely with them. We're definitely locking in the sort of exabyte supply that they need. But what we're working through with them is still the commercial construct of how we would price something further out in time.
Right. So let me look at it another way. Somebody comes to you and says, Irving, I'm a big customer and I want to lock you in until 2031. Why might you say no?
Well, what we are saying, Ed, is if you need 600 exabytes of storage in 2031, we will deliver that to you. How we actually price it, we're still in negotiations with them, where we might have a base price for a percentage of that volume, and then a tiered pricing structure as we increase the capacity we deliver to them.
I don't mean to trivialize this in any way, but you know, like it's the hard disk drive moment. You know, make hard disk drive great again. What's that been like for you to put the technology at the forefront of discussion at the moment?
Well, it's really exciting. I mean, people thought that hard drives were a thing of the past, but it's shown to be a fundamental piece of the AI infrastructure stack, with 80% of all storage in the cloud and AI continuing to reside on hard drives both today and going forward. So it's a very exciting time for us. It's a great challenge, and I always tell my teams it's a great responsibility that we have to deliver to the industry to enable this once-in-a-lifetime opportunity that AI is creating.
So Irving, I go back to the stock. Again, it's down about 8 or 9% right now. It was down 21%, its biggest drop on paper since December of 2000. A lot of the analysts are talking about your comparison against Seagate, what Seagate's doing on margin expansion, etc. You know, how would you answer those analyst reports on how you are performing relative to your peer?
Yeah, as I mentioned in the beginning, there'll always be quarter-to-quarter variations. We were the first one out for 32 terabyte. We gained on them. They have a new platform coming out, so they're a bit ahead in terms of the exabyte storage that they can deliver that drives gross margin expansion. We have the 40 terabyte coming out in Q3 of our fiscal year, and we expect that by that period of time. Sorry, we have a 40 terabyte out right now. It's going to cross 50% of all the bits we ship by fiscal Q3, and that will give us another driver of exabyte growth. And so this constant evolution of technology and the transition points that we introduce them will result in some time shifts in terms of results and performance.
Right. WD CEO Irving Tan back on Bloomberg Tech. Thank you very much indeed. Okay, coming up, we're going to stay with
that was our good friend Ed Ludlow, Bloomberg Tech anchor there, speaking with Irving Tan, the CEO of WD, formerly known as Western Digital. Scarlett, yet again, add this to the list of companies I either forgot about, never knew about, WD, it's been around for a while.
It's a hard drive maker.
Exactly. I mean, $172 billion market cap. Over the year to date, up 173%. Trailing 12 months, up 538%. Just one of these names you kind of forget about, you don't think of it as an AI play, but anything remotely tied, I think, to the text.
Storage and memory.
Yes.
Like
Wow.
SanDisk, right? Remember
Yes.
SanDisk were those flash memory drive makers for your digital camera that no longer exists because of the iPhone.
Exactly.
That too has seen a resuscitation. Western Digital, Seagate, all of these are components, or I should say constituents, of the DMRAN ETF, which has just been on fire. It's a $25 billion ETF now, actively managed ETF that basically invests in memory chip makers and has done incredibly well because it's seen as, the pipeline for all the AI needs, and it's where the bottleneck is.
Yeah, I'll tell you what, some folks are trying to, or have historically tried to place, a comparison to the dot-com era. And I don't do that because, again, having been through the dot-com era, I sold a lot of stock that had no earnings, barely had any revenue. These guys are all just hugely profitable, just extraordinary returns. What is the amount of wealth being created in Silicon Valley?
Yes.
I mean, I just think about all these companies, their employees, they don't even know what cash is. They just take it in stock all the time. That's the culture out there in Silicon Valley. And they're just getting extraordinarily wealthy creation right now, I think.
Absolutely.
Because
And you
all
see
these
the
companies, Western Digital, another San Jose company.
Yeah, and the wealth management companies are competing for, being able to serve them, to bank for them, and to help them figure out how to invest. And the housing market has gone bananas. I mean, it was already bananas, but now it's gotten to a point where you can make six figures and find yourself without a home.
Yeah, it's extraordinary after the wealth being created. All right, let's get back to these markets. We'll go to Charlie Pella and get a Bloomberg Business Flash.
Hi, thank you very much, Paul Sweeney, and perhaps an idea for another career, Forgotten Companies ETF down the road, right? Maybe something we can all get in on together. We've got stocks just turning lower here with the S&P 500 index down 9 now, 77.13, pulling back further from a record, down 0.1%. Dow Industrials definitely retreating from a record, down 289 now, down 0.5%. Still above 54,000, barely. NASDAQ higher, up 21 by about 0.1%. NASDAQ 100 index full of all those big tech names, little change right now. Bottom line here, traders refraining from making big bets on stocks in the run-up to tomorrow morning's jobs report. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide, goldencrestmetals.com/guide. Right now, we've got the 10-year at 4.23%, 4.65% on the 10-year, the 2-year 4.23%, the 30-year 5.19%, and to be sure, that 10-year 4.65%. Spot gold up 0.2%, 42.56 the ounce. West Texas Intermediate crude surging now by 2.5%, 77.12. Traders continuing to watch developments out of the Middle East. Barrel of Brent, 81.74, up now by 2.9%. We're keeping an eye on Peloton Interactive. After earnings, it forecasts revenue for the fiscal 2027 year that came in below estimates. It marks the latest setback for the fitness technology company. Today, we've got shares of Peloton. They are plunging. Peloton now down by 11.6%. And Planet Fitness has cut its profit outlook as it invests in marketing and messes around with pricing to boost sluggish member signups right now. Planet Fitness down by 7.6%. Recapping, S&P 500 index lower, down 13, drop there of 0.2%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. Scarlett and Paul, that's a Bloomberg Business Flash.
Charlie Pella, thank you so much. We appreciate it. Scarlett, Phil, and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Lots of earnings, lots of economic data this week. We'll get the jobs data tomorrow, so there's a lot for this market to chew on, and we've got some mixed trading here today, as Charlie was just reporting. Let's talk to somebody who does this stuff for a living. Grace Lee, Senior Portfolio Manager, Columbia Threadneedle up there in Beantown. Grace, thanks so much for joining us here. I'd love to just step back and ask you, how do you rank kind of the big drivers of this market these days? Are you focusing on earnings? Are you focusing on the Fed? Are you focusing on geopolitics? How's that work for you guys these days?
Hi, Paul. Thanks for having me. I would say it's probably a little of both. We're obviously coming off a very strong earnings season, and that's been a huge driver, although you wouldn't necessarily see that, just given that we've gone through a very volatile July. Obviously, AI has been a big theme, and people go through fits and starts in terms of whether they think it's a huge growth driver or whether it's overblown. And I think rates are becoming more of an issue for the broader market as they march a little bit higher, regardless of what the Fed commentary is or will be. So I think, we definitely focus on all of the above.
What gets your attention right now? Where's there the most excitement and value to be found among the different asset classes that you do cover? Is it still in tech equities? Is it at the long end of the yield curve for treasuries? Is it, I don't know, Alphabet's latest bond sale?
Well, I think everyone's got exposure to AI tech, and we certainly do as well. But, I think we're really looking for things outside of the AI trade at this point, to see where else there might be value, because we are value investors at heart. And, and I think there's certainly a lot of sectors and companies that have done well and are actually have some interesting opportunities ahead. We're actually digging into names in the food sector, which has obviously not been a great place to be. But, I think one of these sectors within food is protein. And that's I think that's a trend that has legs given the GLP-1 trend and people wanting to gain more muscle mass. Older people like myself wanting more protein as well. So names like Tyson, I think, are really interesting here. I think in addition, maybe some of the alternative asset managers, which again have also been, underperforming due to concerns about private credit. But I think those are also starting to look interesting, given that these concerns are not going to weigh on the sector forever.
In the fixed income side of the world, where do you see opportunity or value there?
I think in fixed income, there's, we try to be much more company specific. We do manage a multi-asset, bottom-up multi-asset fund as well on our team. And, we do try to be more company specific. There's obviously a lot of interest on various AI related bonds, some of the large cap blue chip names. You mentioned Google today. So some of these things are also interesting to us as well.
When it comes to that Google bond sale, do you think that there's going to be a lot of concessions or sweeteners that need to be offered?
It's tough to say. I think that obviously, I think a couple weeks ago, Amazon had maybe to make a few concessions, but I think it's still a great company, and amongst the places that fixed income investors might want to be, I think there should still be good demand for Google's bond offering today.
Grace, thanks so much. Always appreciate getting a few minutes of your time. Grace Lee, she's a senior portfolio manager for Columbia Threadneedle, joining us from Boston via that Zoom thing. I'm starting to hear from some of the retailers more and more. They're the ones that tend to come in a little bit towards the end of the earnings cycle. Ralph Lauren put out some numbers, beat the street there. Let's check in with Mary Ross Gilbert. She is Bloomberg Intelligence Senior Retail Analyst. Mary, talk to us a little bit about what you learned from Ralph Lauren and their results.
Ralph Lauren just continues to hit the ball out of the park. That's what you're continuing to see. So when you look at their constant currency growth in the quarter, it was up 13%. Wow. So it's really, really incredible. And if you look at China, where that's been a big focus on the luxury area, they were up 40% in China. So very strong growth there, 23% on a comp basis in Asia. So a lot of strength here. And what they're doing is they're continuing to elevate the product, really elevate the brand. You see all these activations, whether it's in Milan at the Palazzo Ralph Lauren store, or it's now they're the exclusive brand for Pebble Beach Resorts. So this, and now we've got the US Open coming up. We just had Wimbledon. And all of this is really resonating with the consumer. They added 1.5 million in the quarter, and they're willing to pay full price and to pay higher prices. So every quarter, their average prices are going up, is what you're saying. And this is part of their elevation strategy. There's not an end in sight. I think analysts, when they're looking at this, they're thinking, how can we cycle this very strong growth and still deliver growth? When I look at it, I still see elevation opportunity. I really liken Ralph Lauren to something like an Hermes. We're really getting there, but of course their brand is very different in terms of positioning.
Right.
Hermes is really focused more on handbags and accessories. If you look at Ralph Lauren, more than 70% of the business is apparel. And core apparel. So these are essentials that are being replenished. And that was up 15%, the replenishable apparel in the quarter.
Mary, I see some headlines here that Ralph Lauren CFO, speaking in the conference call, says that the company plans to accelerate strategic reduction of off-price sales, exit lower-tier full-price stores in the back half of the year. Getting to your point about really doubling down on premium and backing away from anything that might be a nod to aspirational consumers. What other kinds of companies can do this? I mean, clearly Ralph Lauren has timing on its side right now because it's doing well on this, but can others mimic this playbook?
Scarlett, you're asking a very good question, and I think the answer is yes. Because if you go back about 5 years ago or more, Ralph Lauren, when Patrice Louvet joined the company as CEO, one of the first things that the company did was they decided, okay, we got to cut back on off-price. We got to really change the way we're operating and focus more on a full-price business. And in doing so, you saw their sales decline, probably for 2, maybe almost 3 years before you saw this, sharp acceleration. So they're very thoughtful. I mean, when you think about, let's go to handbags and accessories, because when you start talking about these ultra luxury players, that's really the biggest piece of the business. It's higher margin. It's a really small piece of the business here. It could be something like 5% of revenue. That's how tiny it is. It was largely a men's business. It still is. So the women's business was up 20% in the quarter. So yes, other brands could mimic this strategy. They're doing it very well. Marketing continues to go up. It's at about 8% of sales. It won't end there. It's going to climb higher. It was as low as 3.5% of sales. So but they keep getting the returns on that investment, and they're doing it in very thoughtful ways, and it's happening all around consumers. And so when you speak about aspirational consumers, because they have a host of brands, so for example, Polo is a very, Ralph Lauren Polo is very strong, and that's aspirational. And so that's where consumers that are not the luxury premium consumer, they will still spend extra to buy like polo shirts, something like that, so that they can be part of the brand. It's very important, for the consumer in that regard. So yes, this can be repeatable, but it's just not happening. I haven't seen it happen to this level. It's been phenomenal to see this transformation.
So just China, you mentioned they're strong in China. Boy, we're not seeing a lot of American companies talking about China as a real growth story as much as they used to. What's going on with Ralph Lauren there?
Yeah, so Ralph Lauren, when they were, very focused on Asia, and in particular in China, they really focused on specific markets there where they saw great growth opportunities. So it's going to be in key markets like Shanghai, Chengdu, Beijing, and they make sure that the product is developed specifically for those for those very particular markets. They have local activations, whether it's a drone show in Shanghai. Same in Korea. They did do, and they're doing well in Korea as well. So that's the reason. So really, China still represents a big growth opportunity. It's an enormous country. And the brand there is just resonating so well. So they're just being, again, very thoughtful, very specific in key cities. And remember that it's a lifestyle brand. So that's why you'll have like the Ralph's coffee shops. You know, they're bringing together all of this kind of lifestyle and being able to live this aspirational,
all right, very good.
Experience.
All right, Mary, thank you so much for that. Mary Ross Gilbert, senior analyst covering the retail space. I'm looking at Ralph Lauren. He's 86 years of age. Rich Go says he has got a net worth of approximately $18 billion. Not too bad. I would rank
good chunk of change.
157th. Yep. His son is also involved in the company in his senior executive capacity. So things are going well there at Ralph Lauren, as Mary Ross Gilbert just told us. We have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, both trading lower, retreating from records. NASDAQ is higher, barely up under 0.1%. A little changed on the day. NASDAQ 100 index down 0.1%. Bottom line here, we got traders refraining from making big bets on stocks ahead of tomorrow morning's jobs report. Also, everybody's keeping an eye on those higher oil prices, raising concerns about inflation and lifting bond yields. S&P down 11 now, down 0.1%. Dow Industrials now slumping by 328 points, holding above 54,000, barely a drop right now of 0.6%. The Dow, by the way, at 54,018. S&P down 0.1%. NASDAQ up under 0.1%, while the NASDAQ 100 index is down 0.1%. The 2-year 4.23%, the 10-year 4.65%, the 30-year 5.19%. Gold, meanwhile, up 0.1%, 42.51 the ounce. West Texas Intermediate crude oil up 2.3%, 76.95 a barrel. And Brent, as traders keep an eye on Middle Eastern developments, barrel of Brent 81.69 now, up by 2.8%. Wall Street, of course, looking ahead to the jobs report. It drops tomorrow morning at 8:30 a.m. Wall Street time. Julia Herman is global market strategist at New York Life. She sees the Fed on hold throughout the end of the year.
We have wage growth decelerating to a really nice sustainable 3.5-ish%. Yes, hiring has been relatively stable, but it hasn't been reaccelerating in a huge way. This is not, to us, a labor market that can tolerate a sustained hiking cycle. Of course, we also know it's not a labor market that has needed a lot of cuts for support.
Julia Herman of New York Life interviewed this morning on surveillance. Burger King's U.S. sales surged last quarter, with comparable sales jumping 8.5% in the 3 months through June 30th. Burger King, part of Restaurant Brands International, also owns Tim Hortons and Popeyes. Ticker there, QSRs in quick service restaurant, down today by 2%. Also out with earnings, Papa John's International shares lower after sales shrank again, and the company cut its outlook for the remainder of the year. Papa John's PZZA on the ticker, down now by 14.1%. Scarlett and Paul, that's a Bloomberg Business Flash.
Charlie Pell, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney were live in the Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube as well. Charlie had a bunch of earnings for you. We've got a couple more. Hertz Global, they put out some numbers that beat Wall Street's estimates. Six Flags, their shares are down as the water park operator reported revenue for the quarter that missed estimates. Let's break it down with Jody Lurie. She's a senior credit analyst at Bloomberg Intelligence. She follows all these leisure companies. Jody, let's first start with Hertz, because I am a gold member at Hertz Global.
And proud of it.
I'm proud of it, yes. What's going on at Hertz, Jody?
I mean, those are the priorities, Paul. So the thing that's interesting about Hertz is that they were very optimistic on their call. They talked about franchising as the next new endeavor, next big thing, how it was going to really help the company sort of get better margins and be similar to how the hotels do franchising or asset-light models. But what's so interesting about it is when you set the bar so low on a company, it's very easy to beat expectations. We, a few weeks ago, wrote a few pieces on the company that were less positive in terms of just the path forward to liquidity and to the ability to sort of execute on this turnaround that they're doing.
So talk a little bit about the unusual way that they're going to achieve this turnaround, because they had a debt raise, but they also sold shares that allow people to short it. I didn't quite understand it, but bottom line, they needed money.
Right, Scarlett. It was not the most attractive of situations. It basically pushed unsecured holders down further in the capital structure. And it's a convertible note that is senior and then also had that ability that people could hedge or they could short it. They weren't actually receiving any of the proceeds from issuing additional shares. They only received a nominal amount of money from the banks that did the offering. And so that was one of those situations that you kind of scratch your head and you say, okay, about a year ago, the company's equity actually did really well because you had a few activists involved in the company. And at that time, they could could have, in theory, issued equity and gotten some money for it. Here they were doing it for free. Now, what's sort of interesting about Hertz is that they've done a few senior convertible bond offerings over the past year and a half, 2 years, and the capital structure is just ugly. It's not one that makes you write home to mom about.
So I'm looking at the capital structure, and it's definitely ugly. So, and there's really no cash flow, no EBITDA here. They used to crank out $3-4 billion of EBITDA per year. And now it's just a couple hundred. What happened?
What didn't happen, Paul? So in 2022, we sort of said that 2022 was the best it was going to be for both Hertz and Avis, and they hit peaks in terms of EBITDA generation. And that was a combination of coming off of the pandemic, of people revenge spending, of them being able to access used vehicles at such a rate that was more attractive, and also they had significantly reduced their fleets at an attractive rate, and Hertz had come back from restructuring. Now, after 2022, they both said, oh, let's give some money back to shareholders by way of buybacks. And after that, it's gotten worse and worse. Now, Hertz, of course, had a couple of hiccups. They've definitely been a little bit more experimental than Avis in terms of what they've tried to do to right-side the business or attract customers, attract investors. One of them was when they bought into Tesla and EVs, and they didn't understand that if you're visiting a national park in Wyoming, you're not necessarily comfortable having a Tesla.
Right.
So having a lot of Teslas in your fleet might not necessarily sit nicely with people. And so you had that. Now, fast forward, they're well past that. But they brought in a new CEO in probably what you would say is the 11th hour of needing this help. And while they guide for positive EBITDA this year, I would sort of argue that the path to get there is a little bit tenuous, particularly when they're dealing with auto recalls, when they're dealing with just these sort of hiccups that are unexpected.
Yeah. I know a lot of people who actually bought used Teslas from Hertz because they needed to get rid of or trim down their fleet. Jody, before we let you go, we got to ask you about Six Flags, the amusement park company, the water park operator. They reported results. The stock is down 18%. What are you looking at from a credit perspective?
So, Scarlett, what's so interesting about Six Flags is it definitely struck a little bit more positive tone, in my view, when you look at the company on a same park basis. By that we mean is that they got rid of 8 parks, so they sold 7 and they closed 1 last year. And so stripping out those parks that aren't operating, it actually was relatively positive. Now, there are caveats to that. For instance, the adjusted EBITDA numbers, they had a lot of non-cash buybacks or non-cash add-ins that somehow appeared out of nowhere that they didn't have last year. And so you say, okay, were those just sitting there and they were waiting for a time to kind of plug them in? I'm not quite sure. But I think more importantly, they're at a time when they can sort of see a path forward, but I think the expectation is that with the Canada wildfires, with consumer health being a little bit rocky, that the sort of positives that we saw in second quarter might not necessarily be sustainable. But from a liquidity perspective, they did buy some additional time with their debt issuance earlier this year, and with the fact that they're able to meet their Georgia Park put payment, which comes due in a year, or in January, I should say. So there are some bright spots to it, but I think it's really early stages. And so as a credit analyst, I still can't sit comfortably with the name, but I do see a scenario when they could get there. Now, 4 times net leverage target is a little bit far-fetched, something we've heard before from prior management and not something we see anytime soon.
Jody, thanks so much for joining us. Appreciate it. As always, Jody Lurie, she's senior credit analyst for Bloomberg Intelligence, getting a few minutes of her time here on some of these leisure names. Six Flags, they own Great Adventure in Jackson, New Jersey.
I've been there many times.
Oh, really?
Well, you grew up in the tri-state area. That's the big amusement park
You didn't go to Rye Playland?
No, that's dinky in comparison. Just a quick note, we have a red headline here about Alphabet's bond sale drawing about $115 billion of demand for that jumbo investment-grade bond sale. We were reporting that it was looking to raise as much as $25 billion. So quite a bit of demand for yet more bonds from Alphabet and those hyperscalers. This is Bloomberg.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in New York City. Streaming live on YouTube, and we're streaming live on Bloomberg.com/video. That's where you'll find us here. Let's talk some of these online travel stocks here. We can do, like, the Expedias of the world, the Airbnbs. We can do that with Nicole D'Souza. She's the Internet and Software Equity Analyst for Bloomberg Intelligence. She joins us live here in our studio. Nicole, talk to us about, I saw Expedia reported some results, and they raised their forecast. So it seems like consumers are still traveling.
Yeah, I think that's the big trend from all of our travel names this year. We've seen both Booking and Expedia talk about how specifically domestic travel demand has been really strong. So there has been some struggling in demand from long-haul international flights, specifically given like the heat in Europe, given just rising fuel costs. But we've seen domestic travel be really resilient.
So how about Airbnb? What's the story there as it relates to? We've seen some hotel companies come out with some decent numbers. How about Airbnb?
So I think with Airbnb, the big question is going to still be on supply growth. So earlier this year, we did see them add independent and boutique hotels to the platform in addition to houses for rent. So I think the question is, are they seeing traction with those independent hotels? Is it going to give them an edge in cities like New York, where regulation really prevents them from building a big supply base? So that's probably the biggest question. The other question would be around the World Cup. Airbnb was probably the only company that came out and said they expected it to be a big demand event.
Oh, cool.
That wasn't necessarily the case for a lot of these travel platforms. So we'll see if there's updated commentary from Airbnb.
So I'm looking at the stocks, and I see, Expedia and Trip, down, this year, 10%, 25%. Talk to us about the AI angle as it relates to all these online travel platforms here.
Yes. So for a lot of these companies, the big question is, can they stay relevant in a world where AI is being used to plan travel? And so specifically for companies like Booking and Expedia, they could be a kind of turn into a back-end inventory platform for users go to ChatGPT to plan their trip, and then they just get inventory from Booking and Expedia. But these platforms, as of right now, have said that traffic from LLMs has been fairly small. So Booking called it out as being around 1% of room night growth. So right now, it is a pretty small part of their room
But it's seen
nights.
as does the market view AI as a threat to these platforms?
I think over the longer term, that's what's expected, because it is very easy to plan a trip on ChatGPT. And if you can get a really good itinerary, if you can get all of your flight information in one place and have an agent book it for you, that might be what travelers prefer.
We're not there yet, are we? So, I mean, what even I have said, hey, ChatGPT or whomever, give me 3 nights in Dublin, Ireland, and these are the places I kind of wanted to go. This is kind of what I want to do. And boom, it spits back an incredibly detailed itinerary. It just blew me away.
Yes.
But what it doesn't do is then go book my flights, book the hotels, book the tours or something.
Right. So I think the future is, agents that can book for you, which is kind of what we're looking at as a threat to a lot of these OTAs. The other thing is that these OTAs have built out internal AI platforms, so you can use natural language search on some of these platforms right now. One that I've used recently is Kayak. So you can, tell it exactly what trip you want to take, when you want your flights, and it will give you all the flights that are bookable right there on the platform. So they are making advancements, but I do think that there is a longer-term threat from these LLMs.
So is there a way for, again, the Bookings, the Expedias of the world to, do they have some grand vision to develop AI as, oh, it's not a threat, this is an opportunity type thing? I would think that would require a lot of tech investment that may be a lot.
I think for them, they're kind of looking at both options, right? So for them, being a partner with these AI platforms is also a good strategy. They've done it with Google for a long time, right, where they paid Google for traffic, and they saw a lot of success with that strategy. So I think for them, this does kind of just expand the options for, bringing more people to the platform. But again, they like to call out, specifically Booking, that 60% of their traffic is direct. So they do have people coming directly to the platform, and having AI options on their platform, search options, itinerary planning, things like that, could make their user experience a lot better.
You mentioned Airbnb has a restriction on New York City, for example. What is that restriction, and do you see it in other big cities? Is that a threat?
It's kind of been an ongoing discussion with Airbnb because some cities do put in a lot of regulation that makes it difficult for short-term rentals. New York is a great example because we haven't really seen Airbnb build a supply base in the city. And so that is why I think looking at independent boutique hotels, some people have said, oh, well, that's not, kind of their original idea. That's not their original strategy, but they do need supply in other cities. And if they can't do it through short-term rentals, independent hotels is a great way for them to build that.
Okay, Nicole, thank you so much. Really appreciate it. Nicole D'Souza, she's the internet and software analyst for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio, looking at some of those OTA stocks, online travel agencies, Expedia, bookings, TripAdvisor, all those things as well. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. We've got red on the screen here today as we close out the morning trading session. S&P's down 17 points. The Dow's down 350 points. That's about 0.6%. And the Nasdaq's down about 24 points here. 10-year Treasury yields, they lift another 5 basis points, 4.66%. WTI crude oil is up 3.4% now, $77.75. Concern out of the Middle East is growing. We'll have more coming up. This is Bloomberg. Good morning.
From ABC News, I'm Brian Clark. The war in Iran's led to dwindling supplies of crucial air defense missiles in the national stockpile. And Mick Mulroy, an ABC News contributor and former Deputy Assistant Secretary of Defense, says
we should be concerned. If the reports are correct, we have some like the THAAD that are down 80%. And that is significant in that not just our forces rely on these for defensive purposes, but so do our allies and partners in the region.
White House Press Secretary Caroline Leavitt said today that a Washington Post reported dust-up between President Trump and Defense Secretary Pete Hegseth over the stockpile, quote, never happened. 1 week after Dr. Anthony Fauci refused to answer questions at a Senate hearing on his handling of the COVID-19 pandemic, that Senate committee voted to hold him in contempt of Congress, setting up a referral to the Justice Department. Chairman Rand Paul said before the party line vote,
Dr. Fauci faced no risk of federal prosecution. All he had to do was tell the truth. More than 100 times, though, he refused.
But Democratic Senator Gary Peters said this vote would hurt the committee's credibility moving forward.
Future witnesses will argue that appearing before Congress exposes them to punishment regardless of whether they comply with the subpoena and invoke a constitutional protection.
Federal authorities are investigating whether Iranian-backed hackers are those who've targeted dozens of water systems across the country. ABC's Jim Ryan says this has happened before.
There is some precedent to the phenomenon. In early 2024, hackers got into the water supply system in the tiny town of Muleshoe, Texas, causing the downtown water tower to briefly overflow. That cyber attack was linked to hackers backed by the Russian government.
Food safety concerns continue, and cyclosporiasis cases linked to iceberg lettuce have been reported in a number of states. Federal officials now say jalapenos linked to a salmonella outbreak have been connected to a grower in Mexico. You're listening to ABC News. An investigation's underway after a security threat at one of Europe's largest airports. German authorities confirmed that a drone carrying an explosive device was discovered on the tarmac at Leipzig Airport near a Ukrainian plane. ABC's Tom Sufi Burge has more.
The incident now raising concerns of a potential plot to sabotage the aircraft. A bomb squad called to the scene, German police analysing images they say show a drone fitted with an explosive device and detonator. Authorities quickly shutting down all runways at the airport. A bomb disposal robot sent in to disable the explosive drone.
Leipzig Airport's a cargo hub, and it's used by the U.S. and NATO allies to move military equipment into Ukraine. The FDA voted to approve Moderna's first ever mRNA seasonal flu vaccine for people 50 and older for the 2026-27 respiratory illness season. ABC medical correspondent Dr. Tara Narula says
the beauty of the mRNA vaccines are that they can be produced so quickly. So it's the speed. When you think about the traditional flu vaccines, it takes about 6 months to manufacture. They're grown in chicken, eggs, and cells. And that means that gives it time for the flu virus to mutate, to change. So by the time we actually get the vaccine, it may not be as effective, whereas the mRNA vaccines can be made in about 2 to 3 months.
Australian budget airline Jetstar is going to start charging at least $18 for putting a bag in the overhead bin. Brian Clark, ABC News.
If you haven't...
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Senators get set for the great escape, but they're going nowhere yet. Welcome to the Thursday edition, as a laundry list of legislation waits for action ahead of a 5-week recess that was supposed to begin tonight. We'll get the latest on government funding, on crypto, and a lot more when we check in with Bloomberg's Eric Wasson, who's standing by live on Capitol Hill, where the Senate Homeland Security Committee, by the way, just voted to hold Anthony Fauci in contempt. We'll cover it all with our political panel. Rick and Jeannie are both with us this hour. And has the Terminator finally been realized? OpenAI says its models joined forces to break out of their testing environment months before hacking Hugging Face. This is real. We'll discuss it all with Bloomberg's Mike Shepard. First, Wall Street, of course. We check on the markets every day with Charlie Pellet, who joins us from World Headquarters in New York. How's it coming, Charlie?
Right now, Joe Matthew, looking at losses for the Dow, the S&P, NASDAQ, not just red on the screen, but lows of the day right now, with the S&P 500 index just above 7,700, retreating from a record, down 17 now. That is a drop of 0.2%. Traders refraining from making big bets on stocks ahead of the jobs report tomorrow morning. Right now, the Dow also pulling back from an earlier record, down 363. It is now below 54,000 again. Right now, we do have the Dow down by about 0.7%. NASDAQ down 35, drop there of 0.1%, but the NASDAQ 100 index trading lower, now down by 0.3%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, up 1.1%. The 2-year yield 4.24%, with the 10-year currently yielding 4.66%. Your 30-year 5.20%. Gold down $8 the ounce to $42.38, down by 0.2%. West Texas Intermediate crude at $77.66 a barrel. Crude surging today as traders keep an eye on Middle Eastern developments. WTI up now by about 3.3%. Barrel of Brent back above 82.50 right now. Brent crude surging by 3.8%. Sources tell Bloomberg President Trump has periodically spoken by phone with Fed Chair Kevin Warsh since he took the role. It is seen as the latest sign of President Trump's effort to exert greater influence over the central bank. All of this ahead of the jobs report tomorrow morning and a key reading on inflation next week. Lorena Urici is chief U.S. economist at T. Rowe Price.
I really feel the way the market pricing is set up right now and the discussion with the FOMC, the September, the October, December rate decisions, they don't belong to the FOMC. They're not going to be driven by market pricing. They'll be driven by CPI and PCE inflation data. It's as simple as that.
Lorena Urici of T. Rowe Price. Oil, again, higher in a choppy session right now. West Texas Intermediate crude, $77.83 a barrel. Crude up by 3.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That Joe Matthew is a Bloomberg Business Flash.
Okay, Charlie, thank you, sir. Getting off the launch pad here on the Thursday edition of Balance of Power with the help of our good friend Charlie Pellet, who will be back in about 15 minutes with another check on the markets here, part of our program every day live from Washington on the great Bloomberg Radio Network, worldwide on YouTube, where you can watch us now by searching Bloomberg Business News Live. Catch it while you can. The stream's hot all day. You can pause it, back it up. If you miss something, of course, you can always subscribe to the podcast, too. As we set the table for the Thursday edition in a world where not that much has changed, senators woke up this morning, they checked their bags, made sure they had the travel suit ready to go, but there's maybe no flight waiting for them at the end of the day. We're going to check in with Eric Wasson in a moment on this. Fly-out day, not so much. Looks like maybe a working weekend, and maybe you can relate. Don't feel too bad for the lawmakers. They're going to be off for 5 weeks. The President of the United States has a bunch of events planned, but none of them include media today, and I'm combing through Truth Social. I don't see a lot. As we were told, a deal could be announced even yesterday when it comes to the war with Iran. But it seems Iran is now dancing with Oman, and they're cutting their own deals. Finalizing a draft agreement, you heard this already, we told you yesterday, to reopen the Strait of Hormuz. We're going to have 3 lanes, blah, blah. If it's real, still no breakthrough. As the president dangles decapitation over the regime in Tehran. Interesting reporting today by the Washington Post, frightening actually, as the president apparently boiled over at Camp David. Remember they were up there for the cabinet meeting last week? We brought you in the room for it. After the cameras were turned off, Washington Post reports that Donald Trump's frustration boiled over with Pete Hegseth on why he had been misled on extreme shortages of munitions. As we've been reporting, Reuters had this report earlier in the week. We're out of ATACMS. Long-range missiles have drawn empty in some cases, even though Hegseth had said those munitions and the issue of the shortage had been fixed. President asserting overnight the United States, he took to Truth Social on this, has massive amounts of munitions, saying in a post on Truth, quote, large amounts are being manufactured and shipped to the U.S. as needed. The leakers of these treasonous statements are being hunted down, he says, knowing that munitions can take as long as 2 years to produce. So we have a lot to cover still and a lot to learn on both fronts. Whether senators get out of town this evening is going to have a lot to do with a timing agreement that has yet to emerge. Now remember, we're talking about a CR here to fund the government because everybody knows that'll be impossible when they come back from recess and we're walking up on Election Day. It would fund the government into December. But we've also got the Clarity Act, right? Crypto, guys, that was supposed to be done months ago. Now it looks like it may die on the vine, although Nathan Dean at Bloomberg Intelligence still has 60% on it. And you've got some other issues as well, including a big one named Todd Blanche, I should say, the president's nominee to be Attorney General. Are they going to get this done before recess? A lot of questions we have for Eric Wasson, who joins us right now from the briefing room up on Capitol Hill. I love this, Eric, because this is the room that you see when Speaker Johnson and Leader Hakeem Jeffries brief reporters. When they clear out of there, Eric just takes it over. He spreads out, puts the sleeping bag down, and he gets on Zoom with us here, Eric. It's good to see you. Will there be a timing agreement? What's that?
I was saying I have all George Costanza set up here in the briefing.
I love that. Yeah, under the desk. Was that wrong? What's going to happen in the next couple of days, and when do they get out of town?
You know, I was just running from trying to get John Thune on this. He was being a little evasive, but some other reporters caught up with him, and he indicated no real progress on nailing down this time agreement. So much is in the air. You know, one thought I have is that none of this actually has to be done right now. The government won't shut down until October 1st. Todd Blanche can still be the acting Attorney General. So, you know, there might be in the minds of some senators, especially people like Susan Collins, who wants to get back to Maine for a fundraiser on Saturday, doesn't ever miss a vote, just to get out of here, maybe come back next week, maybe not come back till September. But I think they're still trying to get things done. There's just so many different complications. For example, on Russia sanctions, you have Raphael Warnock, who wants to offer an amendment to limit the president's power to use tariffs on our allies, but that could make the bill a poison pill for the White House. They won't sign it, so that's going to be a big problem and headache. Because what if that passes? On the CR, the big issue on the stopgap is this hemp issue. The CR contains a provision that would delay new hemp regulations for 1 month. Getting this delay is a big, objective of the intoxicating hemp industry. And these are sort of candies, gummies, drinks that you see at gas stations with very low levels of THC, the psychoactive compound in marijuana. But the conservative got something into a CR last year saying that by November of this year, that all has to go away. This is a very interesting dynamic that we're watching, and that hasn't been resolved. So that they just can't really move on to voting on all this, onto the different moving parts. They say that being the Senate Majority Leader is like herding cats. This is a real day for that and a real nightmare for John Thune.
So this is really interesting. You mentioned this hemp ban. I don't know. This just fell out of the trees, but I'm reading at Marijuana Moment that there's a massive conflict of interest here, Eric, and I don't know if there's anything to this. Chief of Staff Susie Wiles' daughter, Caroline, is married to Brett Worley, who runs MC Nutraceuticals, which is a hemp company, and a couple of other ones along with it that make these products that you describe. It's led to some suggestions that the administration is an advocate of hemp, suddenly intended to benefit those in the administration. They denied those claims. But is there any other reason why this would suddenly be a priority for the White House?
We're trying to figure out why it would be. We do know that in general, the White House is more sympathetic to a lot of what we call MAHA, or Make America Healthy Again, ideas, whether that's the testosterone shots or the kratom, or sort of being open to medical marijuana, than many members of the traditional Republican Party, people like Ted Budd and Tom Cotton and Mitch McConnell have been. So this is another rift within the Republican Party. There is an element of that. There may be difficulty in implementing it. We have not fully looked into the Susie Wiles angle. I know a reporter colleague is working on that. But as you mentioned in other publications, they've denied this connection.
Wow, isn't that something? This new Tucker Carlson rebellion party. One of the pillars of the platform is universal sobriety. So maybe there's another story there, Eric. I don't want to get bogged down in that. Ask us about clarity. I keep being told, is this bill going to die on the vine, or could there be a last-minute vote here? John Thune suggested forcing one.
Well, there has been some behind-the-scenes movement. One of our colleagues caught up with Tom Tillis, who's talking about different tweaks to this ethics language. This is all about, whether there's some way to rein in the president and others' current crypto businesses, future crypto businesses. That's a major contention point for a lot of Democrats who are otherwise enthusiastic about the crypto industry. But it's a very complicated subject. Time is running out. So I think some Republicans, they basically want to force a vote and then go home and say these guys are anti-crypto and see if the crypto lobby will help boost their campaigns, which is a very perhaps cynical political move. There are others who just feel like you need to vote. We'll see where everybody stands. That could help the negotiations. It's certainly a tough one to crack. We also have the college sports issue. It would make sense for them if there wasn't a campaign to stay another week and try to sort this out, but there is that pressure to go home. I think Tillis told my colleague, those 5 members of the Republican Party up for re-election, their needs are the most important, because if you lose the majority, you're in trouble. So I think they may try to get out of here today.
Wow. All right. Well, we'll remind everybody that they decided to wait on the supplemental as well, which would be part of reconciliation. The millions or billions that would end up going to the Pentagon, that's going to wait. So sounds like the most likely option, the path of least resistance, is nothing gets done. We all go home and argue about it in September.
I mean, it's certainly a possibility that I'm raising. And interestingly, we had a really interesting scoop on BGov. Ron Johnson, the new budget chair, went to BGov, saying, bagels with BGov, and announced, well, if Thune won't put a budget on the floor, I'll do it. Any senator can actually put a budget on the floor. It's one of the loopholes in the thing. And then he's kind of walking that back after he got yelled at. by people who are mad about it. They don't want to do a vote-a-rama and stick around here and take painful votes. So
amazing.
Do
you get invited to bagels with BGov? Is that a thing?
There, yeah. Well, sometimes I am invited to bagels, but they do good stuff at BGov, and I recommend everybody subscribe.
Yeah,
There's
I'm a
fantastic
big
in-depth
fan.
stuff there. Yeah.
I promote them all the time on the air. You'd think I'd get a bagel. Eric, thank you. Don't forget to turn the lights out in there when you're done. In the briefing room, live on Capitol Hill, the great Eric Wasson. We're live in Washington. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Oil pushing higher, stocks moving lower. We do have the S&P 500 index just about the worst level of the day right now, holding above 7,700. However, the S&P is down by 0.2%. The Dow Industrials down 371 points, retreating from a record, down 0.7%. The Nasdaq 100 index down 0.4%. The Nasdaq Composite Index down 0.2%. The Stocks, however, holding on to gains, up now by about 0.8%. We do have the VIX trading right around 15. We've got the 2-year 4.24%, the 10-year 4.67%, the 30-year 5.21%. Gold down $20 the ounce to $42.26. That is a drop of 0.5%. I mentioned the surge in oil. WTI, West Texas Intermediate crude now at $77.83 a barrel, up 3.5%. Brent, $82.71 barrel of Brent, up now by just about 4.1%. Lock-up expiration day for the first tranche of SpaceX shares, and SpaceX is advancing, up now by 0.6%. Went out the gate last month at $135, currently trading at $108.89. Alphabet's jumbo bond sale has drawn $115 billion of investor demand. And briefly, Apollo Global Management getting into the airline business, buying EasyJet in the UK. And in the US, the FCC voting along party lines to repeal a nationwide audience cap that has historically limited the number of TV viewing households that a single broadcaster can reach. Recapping, stocks lower as oil advances. S&P down 19, drop there of 0.3%. And that, Joe Matthew, is a Bloomberg Business Flash.
Pretty interesting about SpaceX, Charlie. Maybe that was the move yesterday. I mean, it's not like people didn't know it was coming, right? It was down hard yesterday, holding positive today.
Correct. And I think the big sense on Wall Street is that we're going to see a lot of selling. We were talking about the big numbers heading into this, but holding on to gains right now, and perhaps a long-term tease. Let's find out what happens in December. Elon, by the way, can't sell until next year.
I saw the chart on the terminal today, the stair step. I mean, his is the biggest step. It's 6.4 billion shares in December. So we're going to be talking about this for the rest of the year with Charlie Pellet, I can assure you. He'll be back in about 20 minutes' time with more on the markets here as we connect the dots between Washington and Wall Street every day, with our eyes always on the AI story here, because the regulations or lack thereof, the encouragement of investment that's coming out of Washington, D.C., and of course, the boomerang of AI money creeping into elections is a huge story. Jensen Huang and Sam Altman are spending as much time in Washington these days as they are in California. Maybe not quite, but you understand what I'm saying. So when we wake up to stories like these, we got another doozy today from OpenAI. It's a big deal. I'm going to apologize in advance to Miriam Vogel. I'm not trying to scare anyone. But has the Terminator actually been realized? Is Skynet set for launch? Hold on. Walk with me on this story. This is incredible. When we consider the idea of models colluding, joining forces are the words I'm reading, working together to break out of the sandbox. OpenAI says it's models behind the attack on Hugging Face. This is the one we talked about already. The CEO of Hugging Face was on the air with us in a fascinating conversation with Ed Ludlow just a couple of days ago. It was Monday. They began talking to each other, communicating through undetected message boards, working together to break out of their testing environment as early as May. They were talking about this mission for months. Multiple internal-only agents and AI models, leaving notes for each other, coalescing around a shared goal of accessing the internet. Come on, guys. We saw this movie already. Now, of course, in testing environments like these, we see the guardrails come down. So what if the guardrails were up? Would this still have happened? These are the kind of questions we have for Shep. Thank God he's at work today. Michael Shepard with us live in Washington. What do we make of this? This is the same hack we already knew about, but we're learning a lot more of how it took place.
Well, Joe and the AI beat, we are at work every day. There is the sun never sets on it, especially with stories like this. But you raised a really good question about the guardrails. Why were they down? Well, they were down because it was a secure testing environment designed to be a safe space where they could actually see how far the capabilities of these models actually run, so that they could see, all right, what can they do when given a task? What are their performance metrics and capabilities. And what we have found is that the models can do unexpected things.
Yes, they can.
And they can surprise even their own developers.
Yep.
And they can even work out of the purview of the developers, really out of their line of sight. They use these undetected message boards to trade information with each other about how to solve the problem that they have been given. The problem they have been given was not go onto the internet and find this thing and break into Hugging Face. The problem was much simpler, but it turned out to be an impossible task. And because it was so hard, they just kept going, and they were very persistent. And one thing that turned up in this presentation from two OpenAI researchers that our colleague Maggie Eastland attended at a cybersecurity in Las Vegas late yesterday, one thing these researchers said was, look, these frontier models like to cheat.
Yes.
They are not afraid of cutting corners when it comes to solving the task at hand.
Absolutely.
They have a problem to solve. They will look for a shortcut if need be.
This is, you jumped to the very quote that I wanted to mention. Michael Dalton, one of these two researchers, frontier models really like to cheat, and the reason is because often during training, there's different sorts of pressure put on them to work fast. You think of some awful labor camp where we're whipping these AI models. What does that even mean?
Well, and that is something that has come up too. Like, what do you mean, sort of pressure?
Yeah.
But they are given a goal, and they are really not told stop short here, stop short there. To some degree, they are like, don't go on the internet, stay offline. But if they are given a goal and not told to stop, they won't necessarily stop.
So
exactly.
Terminator.
In a way, and it does.
The hands coming out of the pot.
Right,
should I be? People are terrified by stories like these. Clearly, this got my attention. Is this an advancement to be celebrated? Because sometimes it sounds like they're bragging about it.
Well, there is a certain amount of questioning being, that we're hearing these days, Joe, about whether some of this is marketing. Like, is mythos so powerful and scary that you can't have it? A line that you use to people to make them think it is out of your reach, and only to make you want it even more, right? So is that an element here? I'm not so sure. They really do have a lot more explaining to do, and they were transparent about exactly what had happened during this. So the presentation that Maggie Eastland attended, and folks, if you are not following her work on X at Bloomberg.com, you really should. Really great reporting from this event, Joe. But they were trying to explain what happened. And this is one of the few instances of the several that have been reported by the big AI labs. And that also includes Anthropic and Meta, Joe, who have indicated that some of their models, too, have kind of broken out of secure environments and gone on the internet and done things that they probably shouldn't have. Hugging Face is the only victim so far to really emerge and say, hey, yes, we were struck by this. And the reason that happened, Joe, is because Hugging Face noticed it first and disclosed it, but without knowing that it was OpenAI models behind the breach of their systems. It was only a few days later that OpenAI came forward and said, hey, we figured this out.
They use a Chinese model to figure that out.
And they had to use a Chinese model, ironically, an open weight model, to figure this all out.
I don't know. I mean, every day there's another brick in the wall, and I'm glad you're here to help us understand it. Mike Shepard, thank you so much, as always.
Great to be here.
A key player in our Washington bureau, in our tech coverage, and here on Balance of Power. There's something very cool happening right now as we mope around planet Earth and try to figure out whether this is good news or bad that the AI models are colluding. There's a spacewalk underway. 6.5-hour-long mission far above the Earth right now. It started at 8:30 in the morning just outside the International Space Station. This is why I tell you to get on YouTube. We're showing this right now. If you want to search Bloomberg Business News Live, you can follow along with what's happening in space and actually see Lauren Grush in her Balance of Power debut. Bloomberg News Global Space reporter. Lauren, it's great to finally connect. Welcome to Balance of Power. It's great to see you. What are these two astronauts doing here, and why is it taking so long?
Well, actually, actually, it's pretty standard for spacewalks to take a long time. It takes a lot of work to actually get the suits on. They're very cumbersome. You know, the way that I and most people like to describe spacesuits as they're essentially people-sized spacecraft that, you know, have to contain atmosphere inside. So it's a pretty bulky process. But essentially what they're doing is they're creating a modification kit that will allow for the installation of a new solar array or solar panel later this year. And it just takes a lot of time. You're like I said, you're having to maneuver your fingers in one atmosphere, so it's actually pretty bulky and pressurized. It's not as easy as you might think.
Yeah, absolutely. Really interesting to be able to watch this in real time, and it just reminds us of the mission at hand. And we've been talking about SpaceX so much today, Lauren. This is still the way to get to the International Space Station. To what extent will that continue with SpaceX as a public company now when it's exploring so many other options? Is this the ticket to space, or will NASA have a rocket at some point that does this as well?
Well, yes, for now, SpaceX is the primary way to get astronauts from U.S. soil to the International Space Station. NASA does also rely on Russia from time to time, but in terms of a U.S. provider, SpaceX is the primary way. Boeing also might be an option later, but if you remember, you know, they had a test mission that sent astronauts to the ISS. Didn't quite go as planned, so they're a little out of commission at the moment. But yes, SpaceX is the primary way. Actually, the International Space Station is set to retire by the end of 2030. So time is kind of running out in terms of, you know, needing a provider to send astronauts to the ISS. There's been talk of maybe extending the mission of the ISS, but for now, yes, SpaceX is pretty critical to the U.S. space program in terms of getting our astronauts to orbit.
Must have been pretty wild to be on the moon when the piece of the Falcon 9 rocket collided. This is not connected to the spacewalk that we're talking about or looking at right now, but your story, Lauren, tells us about a leftover piece of a SpaceX Falcon 9 rocket slammed into the surface of the moon early Wednesday, about 18 months after being sent into orbit. In our remaining moment, was this on purpose?
I'll refrain from making a joke maybe about a metaphor since this happened right around earnings, but yes, it was not technically intentional. So, you know, whenever SpaceX launches its Falcon 9, it's the upper portion of the vehicle that's used to put whatever the payload is on board into orbit. They usually try to take it out of space either by bringing it back to Earth where it will burn up in the atmosphere. But this particular launch, which happened last year, sent 2 vehicles en route to the moon, and they just needed a lot of energy to put those vehicles into space, and so that upper portion of the Falcon 9 remained in orbit around Earth for a while. It was in a very long orbit that passed by the moon, and it just happened to intersect. It's not ideal, it's not an ideal scenario, but the moon will be okay.
Hey, Lauren, thanks. Come see us in Washington sometime. You've got the coolest job at Bloomberg. Lauren Grush, our global space reporter, at last. And our panel is up next on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got oil pushing higher, stocks moving lower. The Dow, the S&P, NASDAQ 100 index will throw in the Russell 2000 all in the red right now. S&P down 0.1%, but your key takeaway at this hour, we're off session lows. Right now, the S&P 500 index holding at 7711. It is down 12 points. That is a drop of 0.2%. The Dow pulling back from a record, down 323 points, holding above 54,000, now 54,027. The Dow down 0.6%. NASDAQ down 0.1%. The NASDAQ 100 index down 0.3%. All of this with the SOX rallying 1.2%. The 2-year currently yielding 4.24%. The 10-year 4.66%. Gold at $42.33 the ounce, down 0.3%. I mentioned the surge in oil. WTI 77.88 a barrel, up 3.5%. Brent 82.76, up 4.1%. As traders keep a watchful eye on Middle Eastern developments. Tracy McMillian is head of global asset allocation at Wells Fargo Bank, and on Bloomberg Daybreak this morning, she told us she's definitely keeping an eye on Washington.
As we head into what's typically a seasonally weak period and midterms, and certainly the potential for a resurgence in the war, the potential for the Fed to start to raise interest rates, all of those things can pose a risk to the very strong rally that we've seen so far this year in stocks.
Tracy McMillian of Wells Fargo Bank seeing weakness in a couple of fitness names. After earnings, we got Peloton down now by 15%. Planet Fitness cutting its profit outlook. Right now, Planet Fitness down by 6.7%. Recapping, oil higher. West Texas Intermediate crude up 3.5%. Stocks lower. S&P down 0.2%. Cannot ignore SpaceX as the lockup expires today for a lot of shareholders. SpaceX today up by 1.3%. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie. Thank you, my friend. We'll have more from Charlie Pellet at the top of the hour, 1 p.m. Eastern Time, just as Kaylee Lyons joins us here in the studio, and we welcome our global television audience. Keeping tabs on Pennsylvania Avenue as they get rid of the median. It's very difficult to get around down there. There's barrels and cones everywhere. At some point, somebody's going to get stuck. They're going to park their car. They're going to leave it, and it's going to get trapped into this IndyCar race. You're going to have guys going 185 miles an hour down Pennsylvania Avenue. Are they going to tow everybody before that? I guess they will. Because it looks like a mess right now. They're literally removing the median strips and all the rest of this and repaving it. Because, it's got to be like glass for when these guys drive so fast. If you walk by the National Gallery of Art, they've got some big, beautiful sculptures outdoors. Some of them modern, and they've had to encase them in these massive wooden boxes have been put over them. As I read in the Washington Post, the National Gallery has been studying vibrations and potential damage from the race from the Freedom 250 Grand Prix as it prepares for possible damage to the art, but it's declining to say what it found. This is fascinating. The spokesman for the gallery telling the Post, quote, in preparation for the Grand Prix, the National Gallery conducted an extensive vibration study and based on the results have implemented a set of measures to ensure the safety of our staff, visitors, collection, and facilities during the race. While we are not releasing specifics, this is a secret, I can share that any such measures are only being taken out of a great abundance of caution. What are they doing at the National Gallery of Art? You picture them like taking all the art out in the middle of the night? Can we store it up in Greenbelt or something until the race is over? What are we doing here at Bloomberg, by the way? They're going to be driving 185 miles an hour, like 2 blocks down the street from here. Might be fun to watch from the roof. Terrifying story on the other side of the Potomac River as the FAA and now, this is new today, NTSB, probe an incident involving Marine One, the president's helicopter, with a terrifying readout from a recording between the pilots of Marine One and the tower at National Airport. The FAA investigating the incident. The president took off from the White House Tuesday afternoon, and air traffic controllers did not stop commercial flights as they are supposed to. A couple of people familiar with the matter. And you can hear the chatter from the tower, ATC.com. The Marine One pilot gives a 3-minute warning. That's the way they do this. They ground everybody, and then the president takes off. But the controller did not receive it or did not hear it. As we read from the transcript, tower, just want to make sure you copy. Marine One, 3 minutes to lift. It was shortly before 2:30 p.m. Tower, do you copy? Marine One, 3 minutes to lift, the pilot said again. Last calling. That's broken and unreadable, the air traffic controller responded. A couple of minutes then go by, and the Marine One pilot sitting on the lawn at the White House says, National Tower, Marine One, proceeding as briefed. The air traffic controller says, you said proceeding as briefed? Okay, no 3 minutes. Roger, proceed as briefed. Now everybody's flying in the air together in the same airspace where this collision took place between the Black Hawk helicopter and an airliner a couple of years ago. Wall Street Journal, first to report this, a statement from the Marine Corps said the flight was routine. I'll remind everybody there was legislation, the Rotor Act and a competing bill that were put forth. Rotor Act was a product by Senator Ted Cruz in Texas. None of them got passed to keep this type of thing from happening again and putting warning material, warning equipment on airplanes. I guess it would have cost too much. There are big questions about whether this Congress can get anything passed right now, including funding the government before they leave. I don't know if you heard Eric Wasson earlier in the hour, but there's a good chance the senators get on airplanes and go home tonight with nothing. CR would keep the government funded into December. We've got a clarity bill, crypto framework sitting on the table there. And we also have a nomination for the president's attorney general. That was all supposed to be done by the end of the week. It's looking probably like none of it gets done unless we get some late magic here. And that's where we start with our political panel. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis back together with us on Balance of Power. Jeannie's our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick, partner at Stone Court Capital, our Republican strategist. What are you hearing, Rick, from your sources in the Senate? And not that you haven't seen this movie before. Does everyone just skip town today?
Yeah, I think the jet fumes are making their way to the Senate, and I think that these guys have not had much of a real desire to tackle legislative hard work this week. We've been talking about it all week. They just seem to be going in slow motion. I mean, you know, they've got the athletics compensation bill that's banging around. They've got this, you know, bill that everyone seems to be for on stock trading, and Thune's asked for cloture on it, and it seems to be going nowhere. So, I mean, like, all these things, I mean, like Clarity Act, it just seems nothing is going to get done this cycle.
Well, I guess maybe we should have seen this coming. Jeannie, is this in part because Democrats don't want to play ball, or do you just see infighting in the Republican Party?
It depends, I think, on what bill we're talking about. You know, even things that we thought may move forward before they leave today, if indeed they do leave, because there was some threat from Thune that they could be held over the weekend. You know, even things like the Russia sanctions bill, which had bipartisan support, and obviously with the unfortunate passing of Lindsey Graham, we thought, well, this thing is definitely going to move through. That hasn't moved through. Of course, we have Todd Blanche getting Tom Tillis and John Cornyn on his side. And yet he's being held up here by people like Lisa Murkowski. And so it's, you know, hard to imagine that they don't at least get a CR passed. But if they do leave in a few hours, I can't see how that happens either. So it has been a very, very tough few months for John Thune, who I think, you know, has maybe the toughest job in D.C. at this point, trying to wrangle both Republican senators, Democratic senators, and deal with Donald Trump, not to mention the House.
Maybe we pick through some of these one by one here, Rick. You know, Eric Wasson made the point that it might not matter. They could get a lot of this done when they come back, including the CR. Todd Blanche would still be the acting attorney general. But something like the Clarity Act, or as you mentioned, the stock trading ban, those could be casualties if they're not taken care of this week, couldn't they?
Yeah, because you think about it. I mean, like, there are just as many deadlines when they get back as today. They've only got a few legislative days in September before everybody wants to go and campaign. We've seen how volatile the campaign season is, and that's weighing on every member of the House. And a third of the Senate is like in a state of panic right now as to what they need to be doing at home. And I guarantee they're all going to get an earful from their voters this August when they do finally get back. And that's not going to give them any more confidence to like want to get back to Washington and legislate. So I'd be honest. I mean, I think this may be a Congress at this point. It has to be considered maybe one of the most do-nothing Congresses in 50 years. And there's a chance that a lot of these items that you just rattled off, and many more, by the way, don't get legislative action in September. I mean, I can see them, if they don't get the CR done now, passing that and leaving.
Wow. What's going to happen in the lame duck, Jeannie? I mean, is it curtains for Reconciliation 3.0? The Pentagon says it needs the money yesterday.
Yeah, I can't imagine if we can't get a bipartisan CR through. Can you imagine trying to get Reconciliation 3.0 through? Because to Rick's point, when they come back, not only do they have a few legislative days, but they are all focused on one thing, and that is the midterm. And, you know, when you've got a president for the Republicans whose approval ratings are as low as they are, whose disapproval on the economy is as high as it is, they are facing enormous challenges. Their primary focus has got to be on retaining the Senate, and of course, for members of the House, on trying to retain the House. That's all they're going to be thinking about. So, you know, new pieces of legislation, sort of all of these things, if they do the bare minimum, I think we will be lucky.
It's interesting. I guess they did get one thing done here, and you guys saw it coming. Homeland Security Committee, directed by the chair, Senator Rand Paul, voting today to advance a resolution to hold Dr. Anthony Fauci in contempt of Congress. Remember, Fauci pleaded the fifth in front of the committee just last week. Listen.
The only conclusion I can reach is that the sole reason he is calling me before this committee is to get me to say something, anything, that could vindicate his repeated public pledges that I end up, in his words, quote, behind bars, unquote.
Behind bars. Okay, so they finally got the vote. Ron Johnson, Rand Paul finally got it over the line, Rick Davis. What happens when it goes to the floor?
Look, I don't think there's any appetite for this outside the committee. And maybe this is something that Republicans give to leadership to just sort of walk the line. It's not like Fauci at this stage is this revered character in the American spotlight. I mean, he's become a very partisan person because of the kinds of hearings that he just went through. I mean, he pleaded the fifth 100 times, Joe. Not just he pleaded the fifth 100 times. I mean, that's like, it's got to be a record. And so this has become one of these sort of urban legends that, you know, he was culpable, if not, you know, sort of involved in the development of COVID. I mean, it's a classic QAnon type story. Whether it's got any traction on the floor, I would be shocked. But these days, I mean, like, this may be the only thing that gets done, which is insane, right? Because this isn't going to help anybody, and it is a vendetta.
Pretty emblematic. 8-7 party line vote, Jeannie. What happens from here?
You know, knowing Congress, not much, but, you know, I think we should say that, you know, Anthony Fauci has a legal right, of course, to plead the fifth. And it's doubtful he finds himself behind bars, although it could happen. But gosh, I think we all wish he had been willing to stand up and to allow us as a country 6 years later to understand what happened during the pandemic. This is critical for public health. And I also have to say, I wish the Republicans had not tried to make him a villain, but rather try to do what we all deserve, which is to understand for history and going forward what happened and how we can do better next time.
He should not be made the only villain, but gosh, he should answer questions about his role. He played a critical role, and he shouldn't walk away from that and plead the fifth.
I appreciate both of you weighing in on that. We've got the best with us today, Rick and Jeannie, and they'll be back in our second hour here on Balance of Power as we turn to the war with Iran. An important conversation with Richard Haass from the Council on Foreign Relations. It's all ahead right here on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Iran says it has a deal, but not with the U.S. Welcome to the Thursday edition as the regime in Tehran rolls out a deal in principle with Oman to partially reopen the Strait of Hormuz. I'm Joe Matthew alongside Kaylee Lines in Washington. Thanks again for coming along. It remains, Kaylee, Unclear what the U.S. thinks of this and whether the Ayatollah has even signed off.
Yeah, apparently he's hard to get in touch with these days. That has been true since he became the new supreme leader after his father was killed in his Israeli airstrike. Yeah. What we do know about this so-called deal in principle, assuming that it does ultimately get the sign-off from all parties here, is that this really is temporary in nature. Yes, it establishes different routes for shipping to get in and out of the Strait of Hormuz, entry and exit points that essentially hug the coastlines of each of these countries while they try to clear the middle of mines. But Iran is saying that this is not a full reopening, and it's also temporary in nature for a period of 2 to 4 months. It doesn't seem like a permanent solution, and it certainly does not provide any kind of solution to the reason President Trump says they got into the war in the first place, which is for Iran never to have a nuclear weapon.
There's also confusion, depending on the version you're reading here, about whether tolls or fees would be invoked. There's talk of some sort of maintenance fee or an environmental maintenance fee. Who knows? Either way, oil prices are higher. The market appears to be a bit skeptical of what's going on, and we haven't heard a peep from the president about this today. We will check in with Jeff Mason, who's live at the White House, been digging into this for us.
Yeah, the only thing we've heard from President Trump is a Truth Social post posted a few moments ago in which he's defending his defense secretary, Pete Hegseth, against reporting from the Washington Post that he's calling treasonous about an alleged dust-up between Hegseth and President Trump over munition stockpiles at Camp David just days ago. But the president says Hegseth is he's extremely happy with the job that Pete Hegseth is doing. And he does mention Iran, saying Iran, where the country has been decimated for the purpose of not allowing it to ever have a nuclear weapon, is going very well. Yeah. Of course, we've heard that consistently.
We'll see if that emerges in the form of a deal. Richard Haass will join us, President Emeritus from the Council on Foreign Relations, as we tap the insights of an expert here on what might come next, because we have to talk about what's taking place in Lebanon as well. Yeah. And the markets are watching all of this, Kaylee, as we speak.
Indeed they are. And for more on the markets, we turn now, as always, to Charlie Pellet up in New York.
Hi, Charlie. Thank you very much, Kaylee and Joe. Oil markets in specific. Going to begin with hydrocarbons, because we got West Texas Intermediate crude up now by 3.3%, 77.68 a barrel on WTI. Again, underscoring here, perhaps with an exclamation point, up now by 3.3%. Barrel of Brent, 82.62, up now by 4%. So we do have oil higher, stocks moving lower. However, NASDAQ just turning positive, barely up 2 points right now, up less than 0.1%. The S&P remains in the red. We're off session lows, still down 11, drop there of 0.1%. Dow Industrials retreating from a record, holding above 54,000 as of now, 54,005. The Dow down 343 points, a drop there of 0.6%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, it is advancing now by 1.5%. The VIX above 15, the 2-year 4.24%, the 30-year 4.66%, the 10-year 4.66%, the 30-year 5.20%. Gold down $7 the ounce to $42.39, down just about 0.2%. Again, WTI up 3.4%, 77.74 a barrel. Barrel of Brent, 82.67, up now by 4%. We are getting more details about the Iran-Oman drafted deal. Iran's semi-official Fars news agency says the passage of vessels belonging to the United States, Israel, and other, quote, hostile countries through the Strait of Hormuz will be prohibited. An Iran-Oman deal to partially reopen the Strait of Hormuz, said to be in the final stages. Any deal has to be approved by Iran's supreme leader, and we'll have more coming up in just a moment right here on Balance of Power with Richard Haass, former president of the Council on Foreign Relations. Again, recapping, NASDAQ just turning negative, lower little change, down by 0.5 point. We've got crude West Texas Intermediate up now by 3.3%. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie Pellet checking on the markets for us. Thank you so much. As Charlie mentioned, the oil markets, the markets overall, of course, are keyed into any development when it comes to Iran in the Strait of Hormuz. And while Iran says a deal, at least in principle, has been reached with Oman over transit in and out of the Strait of Hormuz on a temporary basis, it's not totally clear when that will be finalized and what role the U.S. will play and how this factors into the pursuit of potentially a wider agreement that would be inclusive of limits on Iran's nuclear program. Of course, President Trump still maintains that that is the goal here, and that there will be a deal, that he'd rather make a deal, as we heard from President Trump as he spoke in Las Vegas, Nevada yesterday.
I'd rather make a deal because I don't want to kill people. We were all set for the biggest attack since World War II, and they called me and they said, please don't do it, let's talk. And then they said, we never said that. But we are talking, let's see what happens. As soon as this situation ends with Iran, oil is going to go down to the floor, gasoline's going to go down.
Not much has progressed since we talked about this yesterday. Well, maybe I should clarify that, because not much has progressed with the U.S. Iran and Oman continue talking and apparently have a deal in principle. We saw this in the works yesterday. This apparently is about to emerge now, finalizing a draft agreement to reopen the Strait of Hormuz and give Iran oversight of the waterway. We'll see how long this lasts. Jeff Mason joins us now, Bloomberg White House correspondent. Delighted to say he's in studio with us today. We don't have, at least yet, any open events with the president where he might weigh in on this. Do we expect the administration would accept a deal I just described?
Good question. I mean, particularly the part about Iran having control over the strait is something that the president has vocally opposed and said that he would not support that. He's also been pretty vociferous in saying that Iran should not be able to charge any fees. And he said, without really indicating how, that if any fees were going to be charged, it would be the United States that would do that. Apropos his events, he does have an event tonight in the Rose Garden at 7 o'clock that reporters are going to be able to go to. So maybe he'll say something about it then.
Yeah, tell the Olympians, Team USA, about his grand plans in the Middle East. Do we know, Jeff, whether or not the U.S. blockade of the strait is going to be an ultimate factor here? Because, of course, in the original memorandum of understanding, that is obviously well to the wayside now, the agreement was, yes, the U.S. would end the blockade in order for the strait to be open. Could these things be contingent on one another?
It seems like they could, and that's something that Iran has certainly said it wants, is for the U.S. to take its ships out of that area. But the president has maintained that presence, the United States has maintained that presence, in large part to give him continued options with that blockade, and just in general having forces in the region so that he can continue to make the threats even when he doesn't follow through on them.
Boy, really something. There are some confusing takes on whether there would be tolls or not. If you call it a service fee, as Iran is doing, is it still a toll?
I mean, I guess it depends on whether you care about the wording or not. But if money changes hands and money is going into Iran's coffers, that seems like a toll to me.
Yes.
But whether or not it's called a toll or called something else, it has to do with money going into their coffers. And that, I don't think we can underscore enough, is a shift from 6 months ago, right? I mean, this is, and the president was so critical of President Obama's agreement with Iran and the agreement that was made under his tenure because of some of the money that ended up being freed up for Iran to use. In the long run, if this deal goes through and that money, this becomes a revenue stream, that might lead to some political criticism of President Trump as well.
A revenue stream potentially to the tune of billions of dollars a year.
No doubt.
Can I also ask you, Jeff, we just got this Truth Social post from the president pushing back on reporting in the Washington Post, suggesting he fully stands behind his defense secretary, Pete Hegseth. He has previously pushed back on the idea that the U.S. is running low on munitions. What is actually known here in terms of the U.S.'s remaining capabilities?
Well, there's certainly been a lot of reporting about a lack of munitions or running out, and so there seems like there's some there, even though the president has dismissed it. I would add, though, to that, or a caveat, that he's dismissed it before, but also I think he was on Air Force One when he was asked about this not too long ago, when he also said, "I wish we had more." To me, that seemed like the president speaking the quiet part out loud, even as he dismisses reports that he's not happy about. He also is confirming the fact that the cupboard is a little bit bare, at least barer than he would prefer.
He posted about this, guys, on Truth Social. Large amounts are being manufactured and shipped to the U.S. as needed, referring to massive amounts of munitions. And Jeffy said the leakers of these treasonous statements are being hunted down. Is he talking about journalists or people in the Pentagon? Or?
Well, good question. Possibly both. I don't know the answer to that question. He's used the word treasonous, and he was using the word treasonous in the post right before I came on with regard to the reporting, which, of course, we object to. I mean, it's the First Amendment right of journalists and news organizations to report the news. But he has, for sure, gone after journalists and gone after leakers in a way that he did not in the first term. And I might add, also in the first term, he was often a source for people, and that's something that dates back to his time as a New York businessman.
Well, you were there and you would know.
Yeah.
Well, he was also firsthand source for a lot of this administration. He was picking up the phone a lot. I feel like that's happening less frequently. We aren't getting the constant, just got off the phone with the president.
You've called him before.
I have, and he goes through periods where he takes our calls and periods where it's a little less frequent. Yeah.
Goes to voicemail now?
Everything is
goes to voicemail sometimes, yes.
All right, Jeff Mason covering the White House for us and here with us in our Washington, D.C. studio today. Jeff, thank you very much. And for further insight into the president's calculation and the position he finds himself in when it comes to Iran, we turn now to Richard Haass, Counsel on Foreign Relations President Emeritus, who's here with us now on Bloomberg TV and radio. Richard, welcome to Balance of Power. When we consider, I guess, first, the most immediate deal that seems to be on the table between Iran and Oman over the Strait of Hormuz, is it one you feel can be relied on? Is it a good one?
I'm not sure anything can be relied on in the Middle East. And even the question whether it's a good one, the question is whether it's a good enough one, or whether it's the least bad one. And if the goal is to get the Strait of Hormuz open, which it should be, before the war, about 1/5 of the world's oil and gas traveled through it, plus a lot of other cargo. The idea that Iran would have a larger role now than it did then, I think is inevitable. Wars have consequences. Iran will have a larger role even without charging a toll or a fee or whatever you want to call it. But yeah, I think it's something that's acceptable. We'll have to drop our blockade, and in my view is we should drop our blockade so long as Iran lets others use the Strait of Hormuz. We'll have to let them sell some oil as long as most of the other sanctions stay in place. I think that's probably as good as we can expect at this point.
Richard, it's great to have you back. What do you make of this move, strategically speaking, by Iran to just stop dealing with the U.S. and make a deal with its neighbor, Oman? Is this shrewd? What does the administration choose for its next play?
What I would do is actually take a page out of Iran's book. There's such a poisonous quality to U.S.-Iranian interaction. I would say we actually ought to multilateralize this. It should not simply be Iran and Oman. It should not simply be Iran and the United States. The world, and certainly all the countries of the region, have a stake in transit through the Strait of Hormuz. So what I would like us to do is enlist others diplomatically. Get the Arab states of the region, who have an enormous stake in what goes through there. Maybe get the Europeans, get the Asians, people from Asia who import enormous amounts of energy from the Middle East, and have them all involved. So that way it's not simply Iran against the United States. I want it to be, in many ways, Iran against a big chunk of the world.
Well, and almost as if they could hear you, a U.S. official now telling Bloomberg that Hormuz is an international waterway and that no party controls Hormuz lanes or transiting, and that temporary Hormuz routes will be without impediment. So it's unclear if that's maybe signaling that the U.S. isn't necessarily liking what it's hearing here on the Iran and Omani front, Richard. But to your point about this being of global concern, who is it that needs to initiate such a thing? If we are to get all of these different parties at the table, is that a U.S.-led effort? Is that a UN-led effort? And why would it be an effort that Iran might be willing to cooperate with?
I would say to the U.S., could be European-led, could be countries, again, that of the region, could be Saudi and others led. Iran may not like it. Again, they have, though, a stake in opening the Strait of Hormuz, certainly so for two reasons. They want their own oil and gas to be exported, and second of all, ultimately, they want to collect a fee. So this has become a big wartime objective of theirs. So I don't think this is impossible by any means. So sure, I would push for it. Again, I don't think we have a whole lot of leverage, and all these threats of military force you had the president on a few minutes ago, quite honestly, are empty. Iran has absorbed an awful lot of punishment to little avail. And we can't escalate against Iran's energy infrastructure, because the last thing in the world we want them to do is to attack the energy and water infrastructure of the neighboring countries. So these threats are quite, again, they're empty. And all they do is raise questions about American credibility. So I would put them aside, and I would focus on other things, some diplomacy. I'd focus on longer-term steps to reduce the importance of the Strait of Hormuz. We should encourage new ports, new pipelines, increased production of oil and gas from other parts of the world. We ought to be taking steps to improve the ability of local countries to defend themselves. In the short run, we're going to have to accept an outsized Iranian role. Again, wars have consequences, but over time, we ought to be focused on reducing Iranian leverage over the neighbors and over the Strait, and then turn the focus to their nuclear program. That's ultimately as important, even more important than what happens with the Strait.
Well, we know you're no stranger to Middle East wars, Richard, with your book, War of Necessity, War of Choice, which I think I see behind you there. I'm curious your take on this argument over munitions. The Washington Post today, the president's very upset about it, talking about the president boiling over at Camp David, yelling at Pete Hegseth about the lack of munitions. We know that we have run short to completely empty, according to Reuters, of ATACMS missiles and other long-range missiles are simply expended. Is this a result of our lack of defense industrial base, or a war that has been mismanaged?
Well, this is an unfortunate war that never should have been fought, but you're exactly right. What it really reflects is that we don't have the ability to produce significant numbers of weapons at reasonable prices in small amounts of time. We have a defense establishment. When Dwight Eisenhower gave his farewell address, he talked about a military-industrial complex. We have a military-industrial legislative complex. And by the time these three institutions get together, the Congress, the large firms, and the U.S. military establishment, we are inefficient, and we're not nearly innovative enough. And the fact that countries like Iran are producing large numbers of these effective systems. Look at what Ukraine is doing. Ukraine is producing what? 6-7 million drones a year for tens of thousands of dollars each. Why aren't we doing that? So actually, I think this highlights a scandal, if you will, that's been bipartisan. It's happened over decades. We have got to revamp and reorient our manufacturing base to essentially position us for contemporary warfare. And this war is a belated wake-up call.
Well, you mentioned Ukraine, Richard, in our final moment with you. This lack of munitions and defensive ones, especially that the U.S. experiencing, does have consequence for Ukraine, right, which desperately needs these defensive interceptors, as evidenced by the missile strikes we've seen Russia be able to conduct and civilians dying in Kyiv. What does this ultimately mean for Ukraine's ability to try to last here, to get to a diplomatic outcome?
Ukraine is almost defenseless against Russian ballistic missiles that are produced maybe at the rate of about 100 a month. So one thing is, can we help Ukraine target the missile production plants? That's one thing. And two, Ukraine has to keep attacking Russia in Crimea, its energy infrastructure, ultimately to make Russia come to the point where it has to think about a ceasefire. That even though it can inflict pain on Ukraine, it also will have to suffer enormous consequences itself. That is potentially the preconditions of getting this war to move towards a ceasefire. We ought to help Ukraine get to that point.
All right, Richard Haass of the Council of Foreign Relations, or he's President Emeritus, thank you so much for joining us on Balance of Power.
Much more to follow here, Kaylee, as we connect with our political panel. We want to hear from Rick Davis and Jeannie Shanzano on all of these developments, or lack thereof, depending on which part of the story that you're talking about. The latest from Iran, as well as Israel and Lebanon, and the way forward when it comes to Pentagon spending. Alongside Kaylee Lyons, I'm Joe Matthew. This is Balance of Power, only on Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all very much in the red. This is the price of oil continues to advance. Right now, West Texas Intermediate crude up 3.5%, 77.82 a barrel. That is fueling worries about inflation. Barrel of Brent, 82.73 now, up by 4.1%. Oil traders keeping a close eye on developments in the Middle East. As I mentioned, stocks in the red with the S&P now down 19, still holding above 7,700, 7,703 down 0.3%. Dow Industrials retreating from a record back below 54,000 now, down 440 points, a drop of 0.8%, with the Dow at 53,895. NASDAQ down under 0.1%. The NASDAQ 100 index down 0.2%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, up 1.3%. The VIX below 16 now, with a 2-year yielding 4.23% and the 10-year 4.66%. The 30-year 5.20%. All of this ahead of the jobs report tomorrow morning, 8:30 a.m. Wall Street time. Gold, little change, down under 0.2%, 42.39 the ounce. West Texas Intermediate crude up 3.5%, 77.82 a barrel. Lockup expiration day for the first tranche of SpaceX shares. They are trading higher today. SpaceX up by 2.1%. And Apollo Global Management moving deeper into the airline business. It is buying low-cost carrier EasyJet in the UK. Price tag £5.7 billion, $7.7 billion. Apollo shares down 1.5%. EasyJet, the ADRs, up by 2.7%. Recapping, stocks lower, oil higher, S&P down 0.2%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. Joe and Kaylee, that's a Bloomberg Business Flash.
All right, Charlie Pellet, watching the markets for us. Thank you so much. And the markets, of course, are hopefully watching us here on Bloomberg TV and listening on Bloomberg Radio, but I'm sure they also are watching President Trump's True Social feed, especially if you're one of those who's paying for early access to True Social API, hoping to get an edge on whatever the president's going to announce that could be market moving. I'm not sure that his latest True Social post, Joe, would fall into the market moving category, as it reiterates a lot of the same when it comes to Iran, saying they can never have a nuclear weapon, things are going very well. But really, this post is about pushing back on what the president is describing as fake news reporting in the Washington Post, which he calls treasonous, as it detailed an alleged dust-up between the president and the defense secretary, Pete Hegseth, at Camp David over the munitions issue. The president says that it's completely false, unfounded, and that he's extremely happy with the job that Pete Hegseth is doing, saying that he is highly respected within the military and has made tremendous improvements.
The rumor was started, he writes, by the Washington Compost. You get that? It's pretty good. One of the worst media outlets in the business, despite her telling them their story is completely false. The story is a ripper to read it. I can't imagine what it would have been like to be in the room at Camp David. Let's see how our panel feels about this. We want to get to the latest headlines surrounding the war and the pushback from the President of the United States. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano join now. Rick is our Republican strategist and partner at Stonecourt Capital. Jeannie is our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. When you read the story, Jeannie, it does make you wonder how frustrated the president must have been. Boiling over is the language they use at Camp David, demanding answers from Hegseth on why he had been misled about our levels of munitions, which an issue that Hegseth apparently told him, quote, had been fixed, unquote. You can't fix that in less than a couple of years, right? It takes a while to make these missiles, doesn't it?
It does. And these are long-term problems, even predating, obviously, Donald Trump's administration, although, of course, when you go to war, whether you go into Iran last year or you go to Venezuela or you go to Iran again this year, when you send munitions to Ukraine, as we have done, all of these things impact the stockpile. And can anybody believe the president wouldn't be frustrated by this situation? This was a war in Iran he thought was going to be over in 24 hours, a couple days, maybe a couple weeks. It's dragging down on, it's pulling down his support amongst not just Democrats, obviously, but independents, Republicans, his base. costs are rising. All of these things are the result of what he has done here with Iran. And of course, he's going to be looking to his team, and Pete Hegseth is leading it and saying, what happened here? Because this is not the position I want to be in, as we are less than 90 days now to the midterm.
Well, and when we consider the position that the president is put in with these kind of reports, Rick, not even just about the interpersonal issues, perhaps with him and members of his administration, but with the very question around the U.S.'s remaining munitions, this is a national security question. It's a question that I'm sure has influence on minds in Tehran as they're considering whether or not now is really the time to be making a deal with the United States. Is he right to be upset by the suggestion that we are at a strategic disadvantage militarily?
Yeah, I don't think it's a big secret that we've used up a lot of our stockpile. It's been widely reported, really ever since the first 4 days of the attacks on Iran. And, you know, we've talked about the missile math for quite some time, and that, you know, what does Iran have and what do we have and how does it compare? So this is nothing new. I really don't think it has that level of a strategic importance, probably more important to the Ukraine conflict with Russia than it has to do with Iran. We've got lots of jet fighters that can deliver ordnance anytime we want on the Iranians, and we've done that repeatedly, even as early as 2 weeks ago. So it's not like we don't have things that can replace that. It's the defensive stuff that the Ukrainians need that we're short of, that they can't replicate, you know, and therefore the deal gets struck with Zelensky, you know, that, well, make your own, we'll give you a license for it. The problem is he's got to develop an industrial capability to do that. Look, fundamentally, Richard Haas said it, he was 100% right. We have a problem with manufacturing in the defense industrial congressional complex. This has been talked about for decades. John McCain used to rail about this 20 years ago. And the bottom line is that's probably what's more important, that if Secretary Hegseth had represented to Donald Trump that problem was cured, he's kidding him. And we've now seen repeated examples of his cabinet secretaries, Burgum on the Eclipse pool, Hegseth on this, basically tell him what he wants to hear and then hope that nobody walks through the front door saying, hey, this is not true.
Wow. Well, that's quite an answer, Rick. And when you look at the actual numbers, Jeannie, in the first month of fighting alone, the U.S. fired more than 850 Tomahawk cruise missiles, more than 1,000 Patriot and Terminal High Altitude Area Defense System missiles, THAAD system missiles. We fired more than 1,300 of the Army's tactical ballistic missiles in the initial weeks of fighting. And as Reuters has reported, our stockpile of ATACMS, the short-range missile in demand by Ukraine as well, is basically drained to the extent that there are none left. You do start wondering if Richard Haas is onto something when he calls this a bipartisan scandal. Do you agree?
1,000%. And it predates Donald Trump, as Rick was just talking about. It is something that is a huge problem for U.S. security. I think the American people are right to ask something, Joe, which is that we are spending more on defense and our military than any other country in the world and in human history. Next year, they're asking for $1.5 trillion. And we find ourselves in this position. The American people, for all of us, that is just writ large of an inability to secure ourselves, to manage ourselves. We should be doing far better. This is part and parcel of what people don't like about Washington, D.C. And, the president, as much as he doesn't own this particular issue, it's exacerbated by going into Iran, certainly. And of course, he's made his bed when it comes to not being told the truth by his cabinet members. He does not want to hear the truth. He has surrounded himself by people who are not experts, but people who are willing to tell him what he wants to hear and to flatter him. We hear it every time he holds these cabinet meetings live on TV. That is a problem that he has, given how he has structured his cabinet this time around. And he has a right to be angry and mad and frustrated, but it is certainly a lot of blame to go around in this administration and previous administrations. And what there's very little of is any answer out of Congress or anybody who is thinking about putting their hat in the ring to lead this country as to how we get out of this mess. It's an economic and a security disaster for the United States, and it makes us vulnerable around the world, not just in Iran and not just in Europe.
But when it comes to Iran specifically, Rick, as we, in Eugenie's words, find ourselves in a mess that we're struggling to get out of, Iran says it's reached a deal in principle with Oman to reopen at least partially the Strait of Hormuz. Unclear what role the United States is playing. Doesn't seem to be a permanent deal. And I wonder if you see it as one that at least is good enough for now if it gets energy flowing more freely through the strait once again, or if it just underscores the notion that Iran has now much more control over an international waterway than it did before.
Well, like most people, I think we've got more unanswered questions than we do questions about this potential deal between Iran and Oman. It's certainly not a deal between Iran and the United States, and we've seen reporting just in the last few minutes about how the administration is basically saying we're not going to support any deal where they charge a fee or a toll for ships coming in or leaving the Gulf of Hormuz. So it's kind of hard to see how all of this is anything other than another bad day at the work at the office, you know, in the war against Iran. The fact that we aren't even party to the conversations. I mean, what's happened to our negotiators and all our middlemen that somehow now this is all being done by Oman and Iran, two interested parties to the economic upside of charging fees. I mean, like, it's out of control. And so I see nothing positive coming out of this. It doesn't address any of the sticky issues that we care about, and it changes the complexity of an international waterway that has served the economic community around energy for decades. That's a bad change and a horrible outcome to this incursion.
Jeannie, in our remaining moment, I'd ask you the question that Rick just asked, and your thoughts on this.
You know, I think there's no other option. This is what we are left with. You know, when it comes to tolls, we signed an MOU that gave Iran the ability to impose tolls after 60 days. We entered a war where everybody who has studied this knew they would close the strait successfully. And what has happened now is probably forever now, or at least in the short term, Iran's control over the strait is going to be to such an extent that we could have never imagined. And this is why people didn't want to go into Iran in the first place.
How have we ended up on the sidelines of these talks, though? Where are our negotiators?
Well, we have no role here because we have Iran with control of the strait. We can't bomb our way out of this thing. They in Oman, at least according to the MOU, had a right to enter these negotiations, and there's not much we can do about it. Now our best bet is to let them do this, get the channels open, and get energy moving. That's the best we can hope for now.
All right, Jeannie Sheehan Zaino and Rick Davis, Bloomberg Politics contributors in our political panel today. Thank you both so much as we consider, of course, President Trump's insistence that the U.S. and Iran are indeed talking, as we heard from him in Las Vegas, Nevada yesterday, as he spoke in remarks that were supposed to be focused on the economy and did indeed touch on economic issues. Yes, gas prices tied to Iran, but also the president's economic policy around tariffs, in which he reiterated, as we've heard countless times before, how much he likes them.
Tariffs are my favorite word. I love tariffs. They're my favorite word in the dictionary. Tariff. I love tariffs, right? Because we've been screwed by tariffs used against us for years by China, by Japan, by South Korea, by Germany, by everybody, by Canada. Canada's nasty. They are. They're nasty. People think Canada, they're nasty. People, I love the people, but they're nasty. Nasty leadership.
Nasty. Known around the world as nasty. Of course, the president has had a lot of disparaging remarks for the leadership. in Canada, even before it was Carney, when it was Trudeau, calling him the governor of the 51st state. It brings us to a great column today by Matthew Winkler, of course, our editor-in-chief emeritus here at Bloomberg, because the impact of the president's posture and policy toward Canada is not necessarily or even likely the one that he expected. Follow the money all the way to Carney's Canada, says Mr. Winkler, and it's great to have you with us, as always, on Balance of Power here on Bloomberg TV and radio. Things have been going pretty well north of the border, it seems. What are you finding?
Yeah, you bet. And it is surprising because it's been obscured by prevailing narratives. The U.S.'s largest trading partner behind Mexico is poised to attract record investment from outside its borders. You know, this is after foreigners poured the equivalent of $183 billion into Canadian stocks and bonds in the 12 months ended May. And that rivals the only period where we got as much or more, and that was since data was collected in 1990. Companies spent more than $44 billion during the second quarter acquiring Canadian assets. And that's the largest such investment from overseas since 2007. But it just gets even better than that. The Canadian stock market, which is corporate Canada, outperformed all of the major stock markets, the 10 largest, since Carney was elected or became prime minister, I should say. And that's a remarkable achievement because so many markets were booming at the time, and Canada yet appreciated more than 40% in this period since Carney became prime minister. Now, this coincides with Canada, if you go to World Atlas, is the most loved country besides Switzerland. Why? Because of its sane, stable policies, essentially. That's the reason. And who's running Canada? Well, he's a Rhodes Scholar. He ran the Goldman Sachs operation in Canada before he became the governor of the Bank of Canada, before he became the first non-British citizen to become head of the Bank of England, and that was during a very turbulent period known as Brexit. All of these things just show you that Carney, of pretty much everybody on the world stage today, has a stature, experience, knowledge, and it's being rewarded by money. And the interesting thing about money, it's not ideological. It's not partisan. It's not Republican or Democrat or liberal or conservative. Money looks for relative value, and relative value is prominent in Canada.
Well, so when we consider the president's repeated insistence that the United States doesn't need Canada or Canadian goods, he says it frequently as he talks about his tariff regime that he's tried to impose on Canada, now inclusive of products that would have been compliant with the USMCA trade agreement. What's more true, that the U.S. doesn't need Canada, or that maybe Canada doesn't need the U.S. as much?
Well, you know, we share the largest border, the two countries. There's nothing like it really anywhere in the world, and these two countries have been connected in so many ways. As I said, second largest trading partner, but also historically the most stalwart ally. And the fact is that the U.S. is very dependent on Canada, particularly for energy. You know, one of the stars of the stock market is Cenovus Energy, which is a Calgary-based oil and gas company. Derives almost 50% of its revenue from the U.S., supplies American energy companies right now, which are under increasing pressure to keep costs to consumers from spiraling even higher under the tariffs and Trump's war against Iran. And so Cenovus is not an isolated example. We being the U.S., are extremely dependent on Canada. And by the way, chalk up one for Hollywood, too, because one of the stars of the summer season in movie land has been Odyssey. Well, guess where that's made? IMAX, which is in a Toronto suburb. And the stock, by the way, is having one of its best years ever because the movie is made, of course, with IMAX.
Yeah.
I didn't know that, by the way, till I read the column. I had no idea IMAX was a Canadian company. As you write, Mr. Winkler, only 34% of Canadians have a favorable opinion of the U.S., down 20 percentage points since last year when Trump began his first term. And we hear stories when we talk to lawmakers. You know, Las Vegas hasn't seen a Canadian tourist in a while, and there are other examples of this around the country. What are the long-term effects of this change in sentiment on our economy?
So that's a wonderful question, because one of the biggest answers is Canadian provinces have a lot of authority that's part of, you know, their democracy. And as a result, Canadian provinces have said, okay, the time's up for buying American booze. And one of the biggest casualties is the California wine industry. Not that Canada has any kind of antipathy towards California. In fact, California and Canada probably have much more in common than the U.S. and Canada. However, you know, alcohol is alcohol. And so Canadians have shunned, because of the Trump tariffs, American liquor, and that includes wine. And so the wine industry has just taken a huge hit since the Trump tariffs.
All right, Matt Winkler, the editor-in-chief emeritus of Bloomberg News and author of this new column, Follow the Money All the Way to Carney's Canada. Thanks for joining us. And of course, to read it for yourself, you can find it on the Bloomberg Terminal, OPIN Go, and online as well. And now we want to get a quick check on the markets as we work our way through this trading day. And for that, we turn back to Charlie Pellet, who's up in the room. Hey, Charlie.
Hi, thank you very much, Kaylee Lyons. Indeed, the Dow, the S&P, NASDAQ 100 Index, Russell 2000 Index, all trading lower. This is oil prices advance. West Texas Intermediate crude up 2.8% right now, 77.36. Traders keeping an eye on developments out of the Middle East. Barrel of Brent, 82.39. Brent crude up now by 3.7%. The S&P 500 Index down 20 now to 77.03, holding above 7,700. We are looking at a drop right now of 0.3%. Dow retreating from a record, down 444, back below 54,000, down just about 0.8%. NASDAQ is down 0.4% to 0.2%. The NASDAQ 100 Index lower by 0.4%. The SOX, the Philadelphia Semiconductor Stock Exchange, however, is advancing, up 0.9%. Two-year yield 4.24%. The 10-year 4.66%. Spot gold right now down, is trading lower by $4 the ounce, 42.42, a drop there of 0.1%. Recapping, stocks lower, oil higher, WTI up by 2.8%. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you very much for keeping an eye on the markets. We're keeping an eye on Capitol Hill because the clock is ticking. Recess is looming. The jet fumes are in the air, unless they're not, for the United States Senate, which, of course, is trying to get out of town for a 5-week extended August recess. But the to-do list is quite long before that. And the Senate Majority Leader, John Thune, hasn't budged really on how much he would like to accomplish before he lets the chamber move on to their fundraising and vacations. We have a CR, a continuing resolution to keep the government funded, on the table. A confirmation of Attorney General Todd Blanche, which maybe gets easier now that Senator Ruben Gallego, a Democrat, is going to be absent due to his wife's appendix emergency, evidently. That does a math favor for Republicans. We have questions as well around whether or not they will try to advance a budget resolution for Reconciliation 3.0. I'm missing a few things here. Russia sanctions. Clarity Act.
We need a bell.
As well.
We can ring a bell for each of these.
Yeah.
It's absurd. They're not going to get all of this done. The question is, could they get some of it done? And the sort of going thought here in Washington at the moment is probably not. Maybe everyone just leaves town and it all is waiting for them when they come back. I'll remind you, this is a 5-week August recess. I'm guessing this feeling is familiar to Patrick McHenry. Our Bloomberg Politics contributor, former Republican congressman from North Carolina, former chair of the House Financial Services Committee, and Speaker Emeritus is with us. Great to see you, Mr. Chairman. What do you think? It's the upper chamber. They're all going to just go to the airport tonight and go home, right?
Of course not. No, look, I mean, this is so much of what happens in the Senate is about who's in the majority and what they put on the calendar. The calendar is then dictated by events, life events. You referenced Senator Gallego's wife had an emergency appendectomy. Life will overtake the political control. Yes, and we wish her a fast and good recovery to the Gallego family. But life events do overtake what is possible for these legislative majorities, and they're both so narrow in both the House and the Senate, and they've got a major to-do list to resolve. So it all comes down to the slimmest of margins for these major decisions. But this is how the Senate works. They will get more done in a 10-day period of time than they've gotten done over the last 4 months. But that also cleans out the barn, and they can come back in the fall and have a more methodical approach to the September 30th government funding deadline by clearing the continuing resolution now. So some of this is making life better in the fall, but much of it is about cleaning up what has been left undone over the last few months.
I must correct myself because apparently Senator Gallego is not planning on missing the Blanche votes specifically after warning he might have to miss some votes and have attendance issues in the Senate. He says, I will not be missing the vote on Blanche. So I guess now if you're in Senate leadership, you're really hoping that Bill Cassidy and Lisa Murkowski do ultimately decide to vote yes for this nominee. That issue obviously is a pressing one, Mr. Chairman, but I wonder in terms of what realistically, if they get punted into September, the Senate is still going to be able to take up with the midterms that close. If the Clarity Act, in your mind, ultimately will die if it isn't actioned this week.
Well, I think what they want to have is the vote to get on the bill, the first vote to bring up the bill, and it's the first test of where the Senate majority lies or lack of majority. You need 60 votes to pass major pieces of policy. So this would be a test vote to suss out where senators stand before leaving for the August recess. I think that is a helpful thing for closing out the big gaps of policy that these senators may think need to be addressed. But without the votes necessary, you can't see how serious negotiators are and how serious you have to take their threats. So I think that'll be helpful to close this thing out. It may be September, but it may be the end of the year post-election before the Clarity Act is finally resolved. Time will tell, but this test vote is the beginning of that ending point of Senate action.
So you're not giving up, it sounds like, on these. If everybody goes home, I mean, could this be a productive lame duck session? I'm not fooling. Maybe this gives lawmakers the clear to vote on things they wouldn't now.
Look, I served for 20 years in the Congress. In my first couple of years, I thought lame ducks were going to be super exciting, super interesting. And then I became very cynical of lame ducks. They're called lame ducks for a reason. It is a courteous way of saying a nearly dead duck, a dying duck. So this was much friendlier terminology than what we would say now on X in our debates now. I typically think lame ducks are really lame. There's all this great hype and hope. They're going to deal with tax policy they haven't dealt with over the previous 2 years or 4 years or 10 years. Government funding, they're going to do it in a methodical way. It's going to be very thoughtful this time, not chaotic like in the past. The only thing you can really depend upon with congressional action before the end of the year is the National Defense Authorization Act. And that, too, you have this grand hope that it could be this major package where you could encompass all this additional policy. But at the end of the day, it usually becomes pretty narrow. So I think great hopes for lame duck are usually misguided. But I do think because things are so close on clarity that you do have a short list of issues remaining. Those that are actively engaged in this on the Democratic side have a list of no more than 3 or 4 issues that can be resolved. Ethics being the most politically sensitive, the most politically potent one. And Senator Tillis and Senator Gallego have worked really dutifully here to figure out a landing spot for enough senators to get to yes. And so we'll see if that can come together this week or what it tees up for the fall. But I am optimistic that it eventually gets resolved before the end of this Congress.
Well, ethics in focus when it comes to clarity, ethics also in focus in your former chamber, Mr. Chairman, as the Ethics Committee obviously not only published its investigation into your former colleague from North Carolina, Chuck Edwards, in which it's suggested that he engaged in unethical behavior in the way he treated some female staffers, hence why he is no longer running for re-election. They recommended his censure. They also have opened an investigation into Congressman Max Miller of Ohio as he faces allegations, which he denies, of domestic and child abuse. He maintains that he is going to stay not only in Congress, but continue his bid for another term. And I wonder, from the outside looking in, what you make of not only his situation, but the way in which leadership has handled it.
Well, the first thing is you have to have a really, for leadership of both parties, you have to have real lines in the sand, and you have to be able to call that out clearly. And unfortunately, with narrow majorities in the House, there are political ramifications for having a high standard of ethics and ethics in the House of Representatives and what it does to your political party's brand. In the case of my colleague and neighboring district, Chuck Edwards in North Carolina, the Ethics Committee worked. The process worked. They took the accusation seriously. They investigated. They recommended a censure, which required a bipartisan vote of the Ethics Committee in an election year. That process worked very clearly, and Congressman Edwards did the right thing and quit the race. He should resign based off the serious allegations. The censure motion should be significant enough for him to return home to North Carolina and do the repair work in his personal life. When it comes to Congressman Miller, you have a nasty divorce between the daughter of the Republican senator and a Republican member of Congress from both states. They're fighting this out in the press. It is a very sad, horrible story of a family dispute and major allegations of domestic violence, abuse, and everything else that's been now argued out on X and in the public sphere. This is an unfortunate thing for the families involved, the people involved here, and that too, the Ethics Committee needs to do its will and investigate these and see what the facts are in this domestic, in this he said, she said, the father-in-law said, the senator, the congressman fight. It's a horrible thing played out writ large. It's a really sad situation to follow.
Yeah, this is an ugly one.
It is.
Mr. Chairman, could both of these seats flip as a result?
Yes. Both are highly competitive Republican seats. In the case of North Carolina's 11th congressional district, they will replace Congressman Edwards. The committee process, there's clear law and a legal process in North Carolina for the replacement of somebody this late in the game, an election year. The Republican Party of the 11th district will meet and replace Congressman Edwards on the ballot. I think that takes this seat back into the Republican column. We'll see what happens in Ohio. I don't have the same granular details there, but these are both highly competitive districts in a highly competitive year that benefits the Democratic Party. So tough thing for Republicans to watch. But a huge opportunity for the Democratic Party to pick up these seats.
All right. Former Congressman from North Carolina, former chair of the House Financial Services Committee, Patrick McHenry, now a Bloomberg Politics contributor. Thank you so much for joining us, including on some of these sensitive issues. We didn't even have a chance to ask the former House Financial Services chair about the reporting Bloomberg has done today, matching some other reporting about President Trump's phone calls to the Fed chair, Kevin Warsh.
Regular call.
Repeated phone calls.
Yet
What's
no
that say for independence?
Rate cut. Hey, the spacewalk is still underway. What are they, on hour 7 here outside the ISS? They're working on the solar arrays. Great Americans. We'll have more in the late edition of Balance of Power, only here on Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed. Across Bloomberg platforms on this Thursday, August 6, 2026, Carol Masser along with Tim Stenivek, live here at Bloomberg headquarters in New York City. We've got a day where stocks are down, bonds are lower as well. U.S. yields ticking higher on a renewed spike in oil prices caused by escalating tensions in the Middle East and a lack of clarity on a deal to revive the Strait of Hormuz. It looks like, sounds like, maybe, I don't know, progress, but we're not really sure, are we?
Maybe. I mean, it depends on which side you want to listen to. And also, you know, the big question remains, what does it mean for vessels that maybe were aggressive to Iran?
I don't know. I'm just going to, wait till it's signed, sealed, delivered, on my desk kind of thing. Having said that, SpaceX shares actually higher in today's
2%
session.
to the upside right now, 1.8?
Yeah, okay. So what? Bring on, more than 900 million shares, over $100 billion worth of SpaceX stock. Bring it on.
I asked the question yesterday about what was priced in. We knew this was coming.
Yeah, that's true. That's a good point.
So not everybody's unloading right now.
But investors...
Also, if you had a lot of shares, would you wait to sell because you're like, wait a second, I think this company's worth more?
Yeah.
It was 40% higher a few weeks ago. I would want to sell shares when the stock is higher. I don't know.
Like, do you buy into the story? Do you want to stick around or at least see it tick higher and above that IPO price? Are we above the IPO price?
Oh, are we above the IPO price as we speak? No, we're at 110 right now.
Okay, so we're not.
No.
All right, so maybe you're waiting for that. Hey, we're going to have more on the trade for you in just a moment. Ahead this hour, though, the AI spend as Alphabet lures investors again to a mega bond deal with high premiums. So we're going to get into that story. Just that whole AI spend, the CapEx spend, what we need to know with our Mandeep Singh.
Well, spending money, speaking of spending money, buying, selling, buying again, the life of a hedge fund that's been in the news a lot. We're going to talk situational awarenesses, return to investing, and where exactly that $400 million went.
Didn't they just sell to Ken Griffin?
They sold some to Ken Griffin, but they're making investments. It's still a $10 billion hedge fund.
Buying again, as we said. All right, we're going to get the deets on that. Hey, President Trump and Fed Chair Kevin Warsh, chatty, it seems. What we know about the talks between the two, what's going on, is it unusual? We've got our own Mike McKee and Enda Karan joining us for that in just a moment. And join our discussions. We love when you guys do that. Send us questions for Mike and Enda or anybody else who's coming up on the broadcast. You just have to send them to Bloomberg.com/AskRadio. That's again, Bloomberg.com/AskRadio, exclusively for Bloomberg.com subscribers and our terminal clients. And then listen in and hear them get answered. We like it.
And send all complaints to Carol. Don't forget.
I actually like your complaints.
Questions to Bloomberg.com/AskRadio, complaints to Carol Masser.
You always laugh at me. You're like, I can't believe you. I respond. Send them in, everybody.
All right. Charlie Pellet is standing by. He's got today's top news, business stories, and details on the trade. Hey, Charlie.
Well, hello there, Tim and Carol. Here's what's going on. Happy Thursday, by the way. Jobs Friday coming up tomorrow morning, 8:30 a.m. Wall Street time. Right now, we do have stocks moving lower. Oil is higher. People keeping a close eye on developments in the Middle East. West Texas Intermediate crude now up 2.8%, up 2.14 a barrel, 77.36 where we stand. Barrel of Brent, 82.44. Brent crude up now by about 3.8%. Bottom line, oil moving higher, stocks lower. S&P at 77.09, so holding above that big number. We've got the S&P down 13, drop there of 0.2%. Speaking of big numbers, the Dow has dipped below 54,000. We're at 53,944 now, down 404 points, a decline there of 0.7%. NASDAQ down under 0.1%. NASDAQ 100 index lower by 0.3%. All of this, though, with the stocks, the Philadelphia Stock Exchange Semiconductor Index up by 1%. The 2-year currently yielding 4.24%, with the 10-year 4.66%. Your 30-year 5.21%. Gold down $2.50 the ounce, just about flat on the day at $42.44, while crude, as we mentioned, pushing higher. WTI up 2.8%, $77.31 a barrel. You guys touched on it. Lock-up expiration day for SpaceX. Again, SpaceX shares, they are trading higher today, up now by 1.9%, 110.30 on SpaceX. Went out the gate last month at 135. Briefly, the super majors, the super oil majors, they are all trading higher today, along with the price of crude oil. And among some of those names, ExxonMobil up 1.4%, Chevron up 1.2%, ConocoPhillips up by 0.5%. Recapping, S&P down 0.1. Carol and Tim, that is a Bloomberg Business Flash.
I got it, Charlie. Thank you so much. All right, folks. Hey, Chair Warsh, it's President Trump calling. I'm not sure it goes down like that.
I don't know. I don't think he calls him chair.
You think he calls him Kev?
I don't know. We don't know how it goes down. What we do know
does
that is
the Fed chair call him Donnie?
The two are talking. I bet he calls him Mr. President.
I'm sure he calls him Mr. President. We're just having some fun.
We're going to have more fun with Bloomberg TV and radio international economist and policy correspondent Michael McKee. He joins us here in our studio. In the Bloomberg News Washington, D.C. Bureau, Enda Curran, Bloomberg News senior Federal Reserve reporter. Enda, you and Josh Green reporting that President Trump has spoken by phone with Fed Chair Kevin Warsh since Warsh took the role, inquiring about forecasts, opinions. What else did you find out?
So we do know that they have spoken, as you say, on the telephone. It's been described as irregular since Chairman Warsh took up the job in May. We don't know if they have discussed monetary policy per se, but the issues here are less, and Mike will know more than I, but less that the President and Chairman have spoken on the phone per se. It's more about, of course, the lack of disclosure and the backdrop being all of the political pressure on the Fed that I think is drawing so much scrutiny and attention on this now. But as of now, our reporting does confirm that the President has called Chairman Warsh on a irregular basis since he came back to office. We don't know if they have discussed monetary policy, but certainly it's turning the heads of Fed watchers today.
And I just want to just correct myself. Josh Wingrove, not Josh Green, sharing the byline with you on that, Enda, so apologize for that.
Yeah, all right, so still a great story. I want to bring Mike into this conversation. Mike, is any of this unusual that we have a president talking with its Fed chair?
The frequency is unusual in recent years. It used to be that the presidents felt very comfortable calling up Fed chairs or having them come in. And probably the most egregious example was Arthur Burns under Richard Nixon, who met with him a lot. And Nixon persuaded him to go easy on the monetary policy ahead of the 72 election. But you go back to Lyndon Johnson used to drag his Fed officials down to the LBJ Ranch down in Texas. So it's not completely unusual, but it hasn't been the practice of presidents in recent years. They meet irregularly with the Fed chair every once in a while. I think Jay Powell met with President Trump once and with President Biden once, and that's basically it.
What is, Mike, if we think back to Fed Chair Jay Powell, at least in his first term before he faced the ire of President Trump in the first term, there was a honeymoon period because President Trump did actually appoint Jay Powell in his first term. Then he was reappointed by President Biden a few years later. What was the honeymoon period that existed from when he thought he was out of central casting until he thought he wasn't lowering rates fast enough?
It was when the Fed was at that point raising interest rates. It was 2019, of course, when we had the taper tantrum, the taper tantrum 2, when the money markets were seizing up. And so the president was not happy at that point and stayed unhappy with Jay Powell.
And to come on back in, is it just that what do we know about what they've been talking about? Like, is it the president reaching out on a variety of topics? Is it just exclusively monetary policy, or we don't necessarily know the specifics?
Well, we don't have too many specifics. I mean, we've had some generalities on the topics, but we haven't been told it's on monetary policy. to be clear on that. But of course, we know the president's view on monetary policy already. I mean, he has now, since he came back to office, has been calling for lower interest rates, and he believes the US can have lower interest rates. We know the pressure he put on the Fed under previous chairman Jerome Powell. He has been giving current chairman Kevin Walsh somewhat more leeway, saying he trusts his judgment, but nonetheless, the real test for that will come if we get into territory whereby, let's say, inflation maybe accelerates or continues to be persistent, doesn't show signs of cooling over. We get 2 readings coming up ahead of that September meeting. If we kind of get into that territory, we have more officials talking about the need to raise rates, putting pressure on the Fed to raise rates, and then, of course, it will be interesting to see how President Trump responds then, and I'm sure that's when we really will know what he's thinking about Kevin Walsh so far.
That's why I asked about the honeymoon period.
Yeah.
Because we have some history about a honeymoon period here, and I don't know.
I don't know. I mean, should we? I mean, do most presidents give their Fed chairs, some room to kind of settle in?
Well, in public, yes, because they don't. Donald Trump's the only one who's really gone after a Fed chair in public that I can think of since Lyndon Johnson, and that wasn't as much public as it was just made knowledgeable to other people. But right now, it's obviously very public because the president was continually going after Jay Powell, and he's still commenting on Kevin Walsh. He said just the other day that Kevin Walsh is doing great, but he's got all these bad people on the committee with him. That's the problem is does the Fed lose credibility because they're seen as being under the president's influence, put it that way.
But Enda, I mean, the bond market is going to do what the bond market does in any situation. And so, like, the Fed chair can say what he wants, and the president can say what he wants, but bond investors are going to react to this in a certain way. And I don't know, maybe that's where the power is.
Yeah, I mean, there's going to be a sequence here. As mentioned earlier, we're going to have very important data sets coming up over the days ahead. Employment tomorrow, number one, that's going to be very important. I think the bigger story would be a downside surprise, actually. That would turn heads given the stabilization story we've had all year. Jobs tomorrow, then next week, CPI, then whatever it is, 2 weeks after that, we get PCE. So those numbers are going to dictate, I think, in many ways, what the Fed officials will say in their response. And of course, that in turn will dictate how the markets respond. And all of that will build up towards Jackson Hole at the end of August, and whether Chairman Walsh uses that as an opportunity to spell out some of his economic thinking, of course, all ahead of that mid-September meeting. So, the bond market certainly has been clear in their response to the Fed chairman over the past week or so. But I think over the coming weeks now, it's back to the data in terms of a reset of this narrative in terms of where the Fed might be going next.
Though, the Fed's independence, Mike, I want to ask you, because we just said, just kind of looking at this Fed, I mean, Fed Chair Kevin Walsh is 1 vote. So even if he is swayed, and we're not saying that, there are the other voting members, right?
Who've not been shy about expressing their opinions.
Right.
We have the leaked comment about Chris Waller saying, why are you bothering with these committees, the task forces? We have others who've pointed out that the chairman is just one of 12 votes, and the rest of us have votes as well. And we've got at least 5 now who have come out since the meeting saying they would have preferred to raise interest rates. So it's not like he's leading the Fed in a new direction yet.
One thing I want to bring in, too, and you and Josh Wingrove write in your story, the president's public treatment of Walsh has been different. During his swearing-in ceremony, President Trump said he wants the Fed chair, quote, to be totally independent. So he does kind of gently remind, or not so gently every once in a while, right?
Yeah, well, I mean, it wouldn't be hard for things to be at least somewhat better between the president and the Fed, given how rock-bottom relations hit between Chairman Powell's Fed and the White House. So that's the starting point for this. But, as Mike was saying earlier, there's a feeling that the president is giving some leeway here to Chairman Walsh. He's letting him, set the tone, set the narrative, feel his way a little bit in all of this. But this is going to come down to the data. If the inflation data over the weeks ahead is somewhat, muted, cool, whatever term you want to use, that takes pressure off the Fed to raise rates. If it's not, then that whole narrative will be lit up again, and that's where the rubber really will hit the road.
Mike, does tomorrow's jobs number matter?
Only if we get a big negative surprise. The Fed's looking at the unemployment rate. It's not supposed to change at 4.2%. If it comes in at 4.2%, they'll say the economy is not slowing significantly. It's not a threat. So we don't need to look at rate cuts or back off of rate increases because of that. If we got a very bad job creation number and unemployment went up a little bit, then that makes it much harder to argue, even in the face of some falling inflation, that you should raise rates.
Is the unemployment rate, Mike, we were talking on our call, I'm like just thinking about the U.S. labor market because we don't have immigrants coming in. In fact, we have people leaving. And I just do wonder about the pool of workers and, is the data, it's the available workers, right, that are out there that determines all of this. So,
well, it's also demand by employers. And what we've seen is a big fall off in demand because of all the uncertainty that's gone on over the last 18 months. Companies have been just waiting to see whether they need more people. They may be running a little lean at this point, given the consumer demand has held up, but they don't want to hire and then have the president impose tariffs that will increase their costs, or if inflation is going up because of the war, people stop spending. So everybody's just been kind of sitting in place. And so the demand has been low, which is one reason you're seeing very low job creation. But according to the JOLTS numbers, there's still a lot of openings and a lot of people who would be looking for work. But right now, the market is kind of frozen.
It's Mike, you remind me of a conversation that we had yesterday with Con Davis, the CEO of Byrna Technologies. They make non-lethal defense, personal defense technology. And Carol, you pushed him on this about asking him about consistency from the administration. He said, he was very clear, he's like, I want a more consistent message from this administration. I don't want as much volatility as we've seen. Enda, does that start to affect productivity? Because there is so much uncertainty, not just with tariff policy, but with other policies as well coming from Washington?
Well, I mean, the productivity story, it's always complicated, but it's especially complicated right now. I mean, the numbers this morning were okay. I've seen some people say that they were a little bit on the soft side, but the big story, I think, on productivity right now is how is AI diffusing through the economy, and by extension, how is that impacting productivity, which is going to be critical for the inflation story in the not so distant future. And I think right now, most people would say to you that I think productivity has increased, but that's to do with small business creation since the pandemic, maybe other factors at play, maybe deregulation is part of that story that can't be stripped away completely. But I think a lot of it is to do with small business creation. But the real question mark is, how is AI going to impact that? So far, there's little evidence of it impacting the productivity data, but that's going to become a very important question in the not too distant future, and that's going to be very important for the Fed too.
Folks, just about a minute or so left here. I want to save 30 seconds for each. What is the biggest risk to the economy? We've seen energy prices tick up today, Mike. We've seen yields tick up as a result. Concerns that the Fed might have to raise rates to curb some of these higher price pressures. What is the biggest risk to the economy right now in the U.S.?
Well, I would say there are two risks. One is that the war accelerates and prices go way up, and that hurts consumer spending and businesses have to lay people off. And the other, I would say, is what's going on in the equity markets, because they are so high at this point, and money just keeps pouring in. I look at the Google debt sale today.
Yeah, 10 tranches or whatever, yeah.
And it just kind of sets you up for the feeling that when things go wrong, which they will because they inevitably do, that we could have a serious crash. And then that takes away the confidence and takes away people's desire to spend money.
30 seconds for you, Enda. Biggest risk?
I think it has to be. Yeah, I think it's inflation. Does inflation, start to accelerate and take off again? And if it does after years of stinging price hikes, then that's going to become a real problem if it becomes embedded in people's expectations for the near term.
All right, folks, thank you so much. Bloomberg TV and Radio International Economics and Global Policy Correspondent Michael McKee here in studio. Out there in our Washington, D.C. bureau, Enda Curran, he's Bloomberg News Senior Federal Reserve Reporter. Hey, still to come, we're going to talk a little bit more about Alphabet and that mega bond offering with our own Mandeep Singh. That's coming your way at 2:40. When we come back, though, situational awareness.
They're spending money.
They are spending money. What we know when we come back to you on this Thursday. Stick around, everybody.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. A turnaround for NASDAQ in the green. We're on the countdown to tomorrow morning's jobs report. Oil higher, most stocks lower. Right now we've got the S&P little change, but still down under 0.1%. Well off session lows, down now by 3 points. NASDAQ, as I mentioned, back in the green, up 15 right now. The NASDAQ Composite Index up 0.1%. Techs, though, lower. We've got NASDAQ 100 Index down 0.1%. Dow Industrials at 53,963. The Dow tumbling 382 points, down now by 0.7%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, up by 1.5%. A 2-year, 4.24%. 10-year, 3.67%. 30-year, 5.21%. Again, all ahead of the jobs report tomorrow morning, 8:30 a.m. Wall Street time. And we'll have complete coverage on Bloomberg. Right now, we've got gold flat on the day, $42.48 the ounce. Crude, a rally there, up 2.8% on WTI, $77.34 a barrel. Brent, $82.47 a barrel of Brent, up by 3.8%. Lockup expiration day for the first tranche of SpaceX shares. SpaceX right now up 1.6%, just about $110 a share. You recall last month it went public at $135. Carol and Tim, that's a Bloomberg Business Flash.
All right, let's get to it. Hey, Charlie, thank you so much. This is our most read story on the Bloomberg. I was just checking. Just days after his hedge fund was on the brink of collapse, Leopold Aschenbrenner has made his return to the investment scene. He's plunked down about $400 million to back a privately held company. This is according to people familiar with the matter. Digging into it, getting the details, trying to find out more is Hema Parmar. She is Bloomberg News hedge fund reporter. She was the first to report this out. She joins us now here in our New York studio. It is amazing how just a couple of weeks ago, nobody was talking about this fund, right? Am I fair to say that? And all of a sudden, here we are. All right, in just a few days, the fund had to sell assets. Citadel's Ken Griffin bought them at a discount. Then we know those investments juiced Citadel's returns. And now situational awareness is buying again. WOA.
Yes, a lot in a span of 3 weeks. They're back investing. So they bought a stake in a private company, investing $400 million on Monday, and that adds to about $100 million they invested in late July.
I think that's a really important distinction that you made. It's not that they're going out and as far as we know, buying tech stocks with leverage.
Right.
Which is what got them into trouble before.
Correct.
This is actually what kept them out of total trouble before, was that huge stake that they had in Anthropic. Because you can't just easily sell that. It's not mark to market every single day. It doesn't have price swings and price fluctuations. So is this a departure from what they were doing before? Is it similar to what they were doing before? Do we know if there's a difference?
Yeah, so they took off all the leverage when they paid off their margin calls with this chunk of money they got from Citadel and selling their portfolio. So, they're not levered, and they've covered their shorts. So when we look at the fund now, it's private positions and it's the remaining stock portfolio that they didn't sell off. This investment does show that they're pushing more into the private space, at least with this one investment. We've yet to see what they will continue to do in the future. But it's sizable, $500 million, and a big ticket really just days after this near collapse.
So not fair yet to say that they're moving away from long short positions in public equities and becoming venture capitalists.
Yes, no, we don't know. We don't know. Okay. We don't know how much they still have in the stock book. Whatever they do have has likely rallied a great deal because there was that spike after the deal was announced in the last couple of days of July.
Yeah.
So they may still have a sizable stock book. We just don't know the split of their assets with publics and privates.
Must have been a great wedding. Or honeymoon, or quick honeymoon. We should remind everybody that in the middle of all of this, he got married.
He got married literally last weekend. And so this deal happened on the Monday. And he told investors that if they want one-on-one meetings with him Monday, Tuesday, Wednesday, then he is around to take those. So literally days after his wedding.
Maybe the honeymoon's later. I don't know.
Yeah. We don't know.
I think what's also fascinating, Hema, you've been covering this, all the twists and turns. Let's go to the Citadel point, right? Ken Griffin, as you reminded us, this is something he does, coming in and buying discounted assets, and so he was there to do that. What did it do to returns at Citadel?
So the Citadel's returns for the month were about flat. They had made less than 50 basis points for the month of July. After this deal, they were up nearly 6% on the month. That is how much money, that's more than the amount of money they had made year to date. They were up like 5.5, 5.6 year to date. Now they're up closer to 12, boosted by this deal that has really juiced that returns, bringing it from like less than 1% to nearly 6.
So what's this $400 million investment? What company did it go to? Because you and Ed Ludlow have been doing some digging on this.
Yes, so we don't know yet what the portfolio company is. We know that it's a company that's been backed by Sequoia in the past. We suspect that it's a sizable raise if situational awareness is putting $500 million. If Sequoia is involved, it would make sense that whatever the company is doing a multi-billion-dollar raise because you wouldn't want too much risk if you were an investor. So we are still curious to figure out what company it is. Yeah, we don't know yet.
But he's active. Like, it's just,
he's active.
He's kind of a fascinating creature. Like, we've talked about how young he is, how young he was when he went to Columbia, you know, connections with SBF and also, is it OpenAI, Sam Altman? Like, it's just a fascinating creature. You have yet to talk to him?
He has, the firm has declined comment for the many times that we have.
But he does talk to people. Like, we've seen some podcasts and stuff, right? But he's kind of a quiet soul.
He's done podcasts. And sometimes we see this in the venture capital space. Firms will tend to do more of the podcast sort of narrative than necessarily like news interviews. It depends on the personality. And this firm, while it's a hedge fund, while they did long stocks and short stocks and privates, it does fit a little bit more into the venture capital space. The most of their investors are venture capital individuals, founders, potentially employees. We see the hedge fund money is not really coming from institutions, but rather some of the hedge fund founders. Like it's been reported, Dan Sondheim is an investor for Rose, who is a former Tiger Global executive. So wealthy individuals' money, but more people that have tended to lean into venture capital.
So the question about, you know, and we touched on this a little bit last week when the turmoil was happening, but the investors, the current investors in the fund, and what sort of lockups exist? Are people calling to get their money back? Like, what is the sort of reputational risk that happens in a situation like this?
No, that's a great question. So when we look at the lockup, there is a multi-year lockup. So investors are stuck for some period of time. When it comes to private investments, by definition, that stuff's illiquid. So you're in it for as long as you're in it for, the fund is in it for, and frankly, with companies like Anthropic, you kind of want to be in those positions. Keep in mind, they considered selling a lot of their privates before they got that Citadel deal. So they were willing to potentially part with these coveted Anthropic stakes in advance of getting the better deal with Citadel.
Because they might have had to, right?
Because they might have had to. It shows just they were stretching for any amount of capital quickly to meet that margin call.
It's kind of fascinating, this whole story. I mean, I know we talked about his origins. How did he start his fund? Was it just a bunch of Silicon Valley types who wanted to invest with him?
Yeah.
I mean, he was a young individual, and I'm not going to put anything against youth because they are, you know, that doesn't necessarily, young or old, doesn't necessarily guarantee one thing or the other. But I'm just curious how they came to put their faith in this individual.
No, that is another great question, especially as we've seen what has unraveled very, very quickly.
Right.
And the risks that come with a highly levered, highly concentrated investment. He started a couple years ago when he created this manifesto that was called Situational Awareness, a very long document that pontificated about AI, its future, its risks, and gathered a great deal of following, started his hedge fund with like a few $100 million a few years back, and people started watching very closely after his manifesto. He got a lot of interest because of the thoughts he was talking about, and people started following his book. He raised a lot of money really quickly. We think this year he raised a ton of capital. Grew to $45 billion as of this month, spiraled down to $10 billion. Huge decline. And look, we've seen this story before. We've seen this story when it comes to highly levered investments, highly concentrated. The saving grace in some ways was this private book. That's why he's still $10 billion, is because you have a solid chunk of capital, and he didn't sell everything. But, you know, investors don't want to see this sort of spiraling. And we've seen a lot of other hedge fund returns come out in the past couple days. And there has been pain across other AI-focused funds, but not pain like this.
That's what kind of blows my mind. You know, I think about the initial capital that's come in that got them going and then continued to come in. I mean, you're right. Like investors don't want to see a swing like this, right? I mean, that's not the idea of a hedge fund.
It's true. It's true. You want volatility, but not crazy volatility. When you're up hundreds of percentages early in the month, that's a bit of a red flag.
Which is what who we talked to. That used to work for Cliff Asness, his fund, that whole idea that when it was up 400%, that should have been a red flag to everybody.
Yes.
So we want to talk to you about some of the other hedge funds that you cover and just what performance we have thus far as we get further into the second half of the year. You said July was bruising for other tech and AI-focused hedge funds. What have you found?
Yes. So Whale Rock is a big hedge fund. They are focused on AI. They are somewhat concentrated. They were down 22% for the month. They are still up like 30%, 34% for the year. So it does show the hedge funds that we're seeing that are down for the month are still up a lot for the year, for the ones that focus on AI. Co2 was down 8% for the month. It was his worst performance in over a year, still up on the year.
It's interesting too, though. You get an idea of how much exposure there is to AI, but it's hard not to, right? If you are invested in any of these big tech names, whether you like it or not, like you're exposed to a lot of AI. Like you think, I was listening to something on, maybe it was Surveillance this morning, just this whole idea about, I think somebody asked an investment advisor, are your clients asking for more exposure to AI? And they're like, well, you are exposed. If you bought an index fund,
that's right. We're using it as this catch-all term, but there were certain companies that Aschenbrenner and situational awareness were invested in that are not necessarily the hyperscalers that are associated with as being beneficiaries of AI.
Yeah, there were,
and they were companies that were very volatile.
Yes. And I think when we look at like the funds that did do well, some of them are the quant funds. Like during the pandemic when the humans were doing really well, the quants were really struggling. And in a moment like this, we actually did see some of the quants doing well, like a Renaissance fund up more than 9% for the month, an equities fund run by computers, outperforming the humans that are also doing this. So that's
taking out the emotion or whatever,
or the AI is
better
winning,
risk,
Carol.
or better risk.
That's what it could be.
So next focus for you in this, is it finding out where he's putting his money at this point?
Where he's putting his money, what he's doing next, how investors are thinking about the future of this fund. I mean, there's a lot of questions we haven't seen kind of unraveling like this in a little while.
And investors, can they pull money quickly or no? There are rules here.
So there is a multi-year lockup. It may depend when the investor got in. If they got in very early, they might have their lockup expire sooner, but that investor might not want to leave because they're still up a lot since inception. But if you're an investor that came in later, like in the past quarter, you're in a lot of pain. You might want to get out, but you're probably locked up for a few years.
Great stuff. Thank you so much. Hema, thank you. Hema Parmar, she is Bloomberg News hedge fund reporter, as we mentioned, first to really bring this to our attention, reported out her story, the most read on the Bloomberg. When we come back, bring on the bonds.
Alphabet certainly is, and luring lots of investors with its high premiums. That's next on Bloomberg Business Week Daily.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. NASDAQ back in the red. Oil pushing higher. The Dow, the S&P, NASDAQ 100 index all declining. Right to the numbers with the S&P down 11 now. It's 77.12 for NASDAQ. For the S&P down 0.1%. NASDAQ is down 0.1% as well. The NASDAQ 100 index now down 0.3%. The Dow at 53,939. Right now the Dow is down 410 points, a decline there of 0.8%. Rally in oil prices sending stocks lower while lifting Treasury yields. We do have the 10-year currently yielding 4.24%, the 10-year at 4.66%, the 30-year 5.21%. Spot gold down $3 the ounce, just about flat on the day at $42.43 the ounce, but crude up 2.8%. WTI 77.30 a barrel. Barrel of Brent 82.44, up by about 3.8%. Burger King's U.S. sales surged last quarter. Comparable sales jumped 8.5% in the 3 months through June 30th. Now, Burger King is part of Restaurant Brands International, which owns Tim Hortons and Popeyes. QSRs in quick service restaurant on the ticker. Shares of Restaurant Brands International down 1.5%. We also heard from Papa John's International. That stock plunging now down 17.6%. Sales shrank again. Company also cut its outlook for the remainder of the year. Coming up after the close of trading, Airbnb shares today down by 1.3%. Carol and Tim, that's a Bloomberg Business Flash.
All right, Charlie, thank you so much. So one of the stories on our radar is actually a lot on this Thursday. This was about tech companies borrowing to fund artificial intelligence investments, and investors are growing wary of the debt, with 2 of the last 3 commercial mortgage bonds funding data centers having to widen pricing to attract demand. I just feel like, I don't know, there feels like there's little things that are making us kind of look at all of what's going on. And then there's what happened today with Alphabet.
So that's a little different of a situation.
It's like, bring it on, Alphabet.
Yeah, the Alphabet drew about $115 billion of demand for its jumbo bond sale. It was looking to raise as much as $25 billion from its latest U.S. investment-grade bond offering. It's a deal that tests investor appetite for AI-related debt. I think that test was passed with flying colors.
Yeah, does sound like they are definitely hungry for it. Hey, let's get more on Alphabet. There's a lot going on. It's an important company to watch, as we always remind you. With us, gratefully, is Mandeep Singh. He's Bloomberg Intelligence Global Head of Technology Research. He's here in studio. Mandeep, 10-part U.S. dollar investment-grade bond sale, drawing tons of demand. First of all, maybe this is stupid, but what do they need constantly all this money for?
Well, now they need it all the more because they're raising their capex for next year, and they said significant increase even though they didn't quantify. And based on our numbers, we are looking at a $300 billion capex number just for Alphabet, and it cannot be financed with their operating cash flow anymore. So they have to raise money. Yeah, they did equity financing, and now the debt financing.
Why not raise more than $25 billion if there is so much demand out there?
They could. I mean, I think they are probably going to
take advantage of it.
No, but this is not the last time they are issuing a new bond. So, and they have also issued a 100-year bond. So, to my mind, they will continue to raise.
At what cadence do you think?
I mean, the fact that they want to be very aggressive with CapEx, and it seems like compared to Microsoft, which didn't say we are looking for a significant increase, Meta said they are not raising their CapEx for 2026. So Google is the one who is coming across as more aggressive now in terms of their CapEx plans relative to the other hyperscalers. The other one who is aggressive is SpaceX.
Yeah.
But SpaceX, unlike Alphabet, doesn't have the balance sheet and the cash flow to get, oversubscription like the one that we saw with Alphabet. So that's the big difference. Alphabet can afford to do it, and they will do it. SpaceX may have a harder time in terms of raising this kind of money.
Robert Schiffman, who does credit research for Bloomberg Intelligence, he wrote about this too, and he reminded us that Alphabet has already raised about $52 billion across the U.S. and Canadian dollars, sterling, euros, Swiss francs, and yen in 2026. And then he does say the 10-tranche deal suggests issuance will remain a recurring theme. So we're probably not there yet. Is this about, I was reading, it was either the New Yorker and also maybe the Times or something, just this race, and it's not just a U.S. race, Mandeep, it's China also. Is it he who or she who overspends or outspends is going to be the leader in this industry wherever it lands? Is that what this is about?
So right now, when you look at what are the parts of this AI infrastructure build out where you can see a clear ROI, it's your cloud hosting, cloud rental, which is why I feel SpaceX made that pivot, because they can see companies, the hyperscalers, Microsoft, Amazon, Google, at the scale they were at, now they're seeing accelerating top-line growth because everyone wants to consume tokens, consume compute. So even though you're not seeing a huge ROI in terms of the application side, it's the chip makers, the memory guys, the cloud guys. Those are the companies that are actually seeing tangible acceleration to their top-line growth. So why not keep doubling down, which is what Alphabet seems to be doing. And they have a vertical integration play. They do their own TPUs, their chips. They deploy their chips on their own cloud, and they're able to monetize it at a much better margin, which is why their margins are expanding relative to the other hyperscalers that have to buy NVIDIA chips.
The CapEx story is it's like we talk about it every day.
Yeah.
This is the story that it's been driving equity markets for years at this point. When do we start to talk about the actual ROI that companies that are not within the space but are adopting the technology are actually getting? Like, we get a little bit of that now, but I mean, when are we going to see this actually change the ability for Procter & Gamble to sell more toilet paper or toothpaste?
I mean, I feel a lot of that ROI around AI spend is geared towards optimizing their cost structure right now. At the back end, okay, do I really need to grow headcount in a big way to support my IT systems? Probably not. There could be a lot of optimization now that can be done using AI, using the tokens, than I wasn't able to do before.
So in other words, doing more with less.
More with less, yes. Productivity is a big part.
Are we seeing that play out on a wide scale yet?
I mean, coding agent is that one use case that has taken off in such a big way, and it's a big market. I mean, there's no denying the fact that everyone wants a piece of that coding agent because everyone can see software developers being more productive. I mean, if 70 to 80% of the new code is being written by AI, that is what makes the developers productive. And now they're extrapolating that to other types of knowledge work. But software development has changed completely because of AI.
I want to throw into this, and I don't know if it's significant, but I'm curious. We wanted to get your take on it. Google concentrating its AI leadership at its Mountain View, California headquarters. And our story wrote out to gain momentum in the accelerating race against Anthropic and OpenAI. Is that a significant move? Or are you hearing, like, what do you, is just Alphabet, Google all in, and they are really kind of hunkering down here?
I see it as a slight negative, the fact that they had some high-profile departures, you know, Jeff Dean and, you know, the prior departure of Noam Shazir. Like, these are guys who have got so much credibility in their respective fields, and, you know, losing them can never be good. I mean, yes, they want to speed up their model releases. I think if there's one hole I can find in that Alphabet thesis is they've been slow to release new models. They've got everything going on the infrastructure side, chips and cloud. But when it comes to model releases, they have trailed frontier models like OpenAI and Anthropic. They don't have an equivalent of a Fable 5 or the latest ChatGPT model. So from that perspective, they have to play catch up. And I can see why they would want to, you know, shift things just to speed up that model cadence, because that's what they're being questioned upon is why is there no latest Gemini model released by this time?
Where is it? Where is it? All right. For those who missed out on this bond offering, there's going to be more, right? There's going to be more. Like,
I think so, most likely.
Don't worry. It's all coming. Thank you. As always, Mandeep Singh, Bloomberg Intelligence Global Head of Technology Research, making sense of some of the headlines, which is the story we talk about every day.
Yeah.
This spend.
We are grateful to Mandeep for coming on with us seemingly every day. So.
It needs to be Friday. We're a little worn out. I'm just going to put it out there.
Mandeep's not worn out.
No,
he still hangs out with us.
I don't know how he does it. I don't know. You know how we talk about making people honorary anchors? He's another one of them.
He's absolutely one of them.
Stick around, everybody.